25% rate, while South Africa's goods will be hit with 30% and Laos and Myanmar will be subject to a 40% levy. Other nations on the list include Indonesia at 32%, Bangladesh at 35%, and Thailand and Cambodia at 36%. Bosnia will face a 30% tariff, while Serbia's rate is set at 35%. Important to note here is that US maintains the August 1st cutoff date. It is not a new deadline, but an outer limit for countries to speed things up. But even as a deal with India is awaited, the president hinted, saying it will be done soon. Listen in.
If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now, yeah.
Are the tariff letters that you sent today final offers, or are they negotiable?
More or less final offer. We've made a deal with United Kingdom. We've made a deal with China. We've made a deal. We're close to making a deal with India. Others we met with, and we don't think we're going to be able to make a deal, so we just send them a letter. If you want to play ball, you have to. This is what you have to pay. So as far as I'm concerned, we're done. We're sending out letters to various countries telling them how much tariffs they have to pay. Some will maybe adjust a little bit depending if they have a cause. We're not going to be unfair about it. And actually, it's a small fraction compared to what we should be getting. We could be asking for much more, but for the sake of relationships that we've had with a lot of really good countries, we're doing the way I do it.
Moving on, Donald Trump hosted Benjamin Netanyahu for dinner at the White House as he pressed the Israeli Prime Minister to end the devastating Gaza war. Trump voiced his confidence that Hamas was willing to agree a truce with Israel. Netanyahu also handed Trump a folder containing a nomination for him for Nobel Peace Prize. And lastly, Iranian President Masoud Pezeshkian told Tucker Carlson in an interview that his country remains open to talks with the US, but that it was difficult to trust Washington after its strikes last month. That's all for today. Now back to you, Hormaz.
Dia, thanks a lot for that update there on the big developments last night. Now, Treasury Secretary Scott Bessent, in an interview to CNBC, said that the tariffs announced will be back in April will take effect on the 1st of August for countries that have not reached an agreement with the Trump administration.
Is concerned about is the quality of the deals, not the quantity. As you could imagine, as he started herding the cats and trying to get everyone across the finish line, when he said that there's a chance that countries could boomerang back to their April 2nd reciprocal tariff levels, we've had a lot of people change their tune in terms of negotiations. So my mailbox was full last night with a lot of new offers, a lot of new proposals. So it's going to be a busy couple of days. But importantly, too, that President Trump has said that the countries would not go back to the reciprocal rate until August 1st.
Let us also now listen to Guhun Kwan and his views on the tariff letters issued by the U.S. president.
Well, I guess market now tend to focus on the August 1st deadline, which means the extension of the current low 10% tariff rate rather than expecting 25 or 20% as written in the letter. So from Korea point of view, probably Japan as well, they have more time to negotiate with the U.S. In good faith, which could reduce the tariff rate from the renewed the 25%.
Well, in the overnight action on Wall Street, the indices ended lower. Now, the Dow Jones fell over 400 points. The Nasdaq was down close to 1%. The S&P 500 also fell almost 0.8%. And there were multiple triggers. Of course, the markets had run up a lot, and both S&P 500 and Nasdaq were trading at record highs. And the Dow Jones also was nearing its record high levels, as a result of which they fell. Now, Toyota and Honda, shares of both of these companies, fell over 4% as well, following Donald Trump's announcements on tariffs on Japan and South Korea. Now, Nvidia was slightly lower, while Apple and Alphabet, along with AMD, shed over 2% each, and that is what put pressure on the S&P 500 and the Nasdaq. What also put pressure was Tesla. that was down 4%, or more than 7% actually in trade, and it lost more than $68 billion in market cap, and that is after Elon Musk announced plans to form a new political party, and Donald Trump has called this move ridiculous, and that Musk has gone quote-unquote completely off the rails, and that has added to concerns for Tesla shareholders as well, as to now that the Doge overhang was over and he was announcing that he is putting his focus back onto his own business, is when this overhang has now emerged with him trying to form a new political party, and that weighed down on Tesla's stock price. Now, Allianz's chief economic advisor, Mohammad Al-Arayan, believes that the market will not react as much as it did in the initial phase because these levels are not firm and are likely to change by the next deadline. Listen in.
The conditioning of the market has been, let's wait and see, nothing is final. And you know what? We learned the lesson in April. We sold off violently in April, only to see highs, record highs within 80 days. So that's certainly the conditioning of the market. And that's why you're seeing a relatively muted response to what we're hearing today, because what we're hearing today are quite high tariff rates.
Let's now also listen in to what sectors and areas are safe from the tariff uncertainty and what sectors are at risk. Here is Jefferies' US equity strategist, Scott Cronert.
We continue all in on the AI-related infrastructure spending tailwinds, which we think are pretty visible here, even with the tariff discussions coming in. So we're all in on growth, if you will. Now, where we've been underweight has been areas such as consumer discretionary, staples, industrials, and materials. Turns out that those sectors of the market, in our view, are a bit more sensitive to tariffs, the consumer space in particular. And so when we look at these country-specific data points coming in here, we're going to be looking at them through the sector lens. And right now, we're trying to steer a little bit clear from where we've had good runs off the lows, where there's still some tariff uncertainty to be dealt with here. But in the meantime, stay as sort of our guiding force here, where we see these underlying spending tailwinds, which still point us down this growth, mega cap growth, tech, comm services trajectories.
So all the global market action from last night. We take a short break, and on the other side, we'll tell you how will all of this impact our own markets. Stay tuned. We'll be right back. Welcome back. We have our research team ready to tell you how will all of the overnight action impact our own markets with the trade setup, the stocks that are likely to be in the news, and of course the setup on the FNO side of things as well. Firstly, Vivek joins in with all the market cues that we need to watch out for. Vivek, listless session yesterday, still awaiting more clarity on the US trade deal, but what are the cues that you're watching out for today?
That's right. Good morning, Hormaz. All eyes will be on the trade deal, whether it's a mini deal or what exactly transpired as far as that particular, and the outcome of that is something that the street will watch out for very closely. Like you mentioned at the start of the show, the US markets ended pretty negative yesterday, and the entire Musk fiasco is something that did weigh on the stock price over there as well of Tesla. Now, talking about oil prices, now despite the steep production hike that OPEC Plus will be taking, you did see oil prices yesterday recover from day before yesterday's sell-off. So oil prices yesterday managed to end with gains of 1.8%. Today morning's rate is what you're seeing on your screen. Again, a marginal dip is what you're seeing over there. Like you mentioned, Indian markets range-bound listless session. Markets ended largely near the flat line. A very stock-specific market is what we witnessed yesterday, and largely on the back of quarterly updates is where you did see stocks move. FMCG stocks, most of them have come out with their quarterly updates. So you did see names like GCPL and Dabur managed to outperform. On the other hand, Jubilant Foodworks, despite a good set of quarterly updates coming in over there, the stock did see some selling pressure. Today, all eyes will be on Kotak Mahindra Bank and Titan. They came out with their updates yesterday. Advanced decline ratio in yesterday's trading session was largely in favor of the declines in the ratio of 2:3. Asian markets, GIFT Nifty indicating 0.4% lower start as far as Indian markets are concerned.
Still a 40-point downtake. Vivek, thanks a lot for that. And it's still stuck in that range, right? 25,300, 350 on the downside, 25,600, 650 on the upside. So it's struggling to cross the higher end of the range. But of course, the index continuing to respect lower levels. And of course, it's not like we are devoid of any domestic cues of our own, considering the slew of business updates that have been reported over the last couple of days and after market hours yesterday as well. And Ria is joining in to list out all of that. And of course, some of the other names that you should keep an eye out for. Ria, good morning.
Good morning, Homers. A lot of companies have come out with their quarterly updates. First, coming to Kotak Mahindra Bank, good updates for this one. The total deposits have gone up by around 13% on a year-on-year basis, and even the loan growth has been quite strong at 14% on a year-on-year basis. So, good updates coming in for Kotak Mahindra Bank. Coming to Titan, the Q1 international business has gone up by around 49% on a year-on-year basis, and even the consumer business has jumped up by around 20%. Moving on to M&M, the June production numbers have gone up by around 20%, coming in at about 83,435 odd units. The June sales have also gone up by around 14% on a year-on-year basis, and exports have seen an increase of about 1%. For Tata Motors, the JLR wholesales have seen a decline of about 10.7% on a year-on-year basis, and even the retail sales for JLR have gone down by over 15% this time around. Two other real estate companies have come out with their quarterly updates. For Phoenix Mills, the retailer sales have gone up by around 12% on a year-on-year basis, and for Macrotech developers, the pre-sales have seen an increase of around 10%, and even the collections have gone up by around 7% on a year-on-year basis. Apart from this, JSW Infra is expected to be in focus today. The company has received an LOA for the mechanization of Kolkata port berths, two port berths with an estimated capex of around 740 crores for this one. And lastly, Naveen Fluorine will also be in focus today. The company has launched a QIP to raise about rupees 750 crores, and the floor price has been set at rupees 4,798 per share.
Ria, thanks a lot for that update. And lastly, Sudarshan joins in with cues from the FNO space. Sudarshan, good morning. What are the FNO cues indicating for our own markets today?
Good morning, Arma. So yesterday it was a range-bound day of trade, and at the end we saw both Sensex and Nifty closing with minor gains, while broader market underperformance led to market breadth in the favor of declines. Market advanced decline ratio at the end was at 2:3, and for today also GIFT Nifty is indicating a start with minor cuts. As far as flows are concerned in the cash market, we have seen both FIs and DIs buying. FIs have bought more than 321 crore, even DIs have bought almost 1900 crore. But in the derivative market, FIs continue to add to short positions. They have sold in the index futures, and that sell figure was almost 670 crore. They've added long positions of 900 contracts, but at the same time, they have added short positions of more than 4,300 contracts. Now, FI's long exposure remains around 28.2%. On the option front, 25,600 and 25,500 call have seen healthy additions, and on the put side, 25,300 put has seen addition of almost 23 lakh shares. So that's the reason support for Nifty remains around 25,300 and resistance around 25,700. One stock remains in the bank, that is RBL Bank, and apart from that, I'll keep an eye on auto ancillary because there is no mention of India in all the letters that US President Donald Trump has sent regarding the trade tariffs.
Auto ancillaries, that remains an important sector to watch out for in today's session, apart from the textile names, of course, with there's the 35% tariff on Bangladesh. So interesting day that lies ahead for our own markets. But an interesting study, Sudarshan, thanks a lot for that though. An interesting study though was put out yesterday by market regulator SEBI, and they put out a similar study last year on the derivative losses made by individual traders in the F&O market. And if you could take a look at the data that has come out, now if you compare the index options premium wise, it's declined 9% from last year, but if you compare that over a 2-year period, it's still up 14%. Now, if you compare that on a notional basis, that too is down almost 29%. But on a 2-year period, if you take a look at that, it's a 42% uptick that you're witnessing. But the big number though, before we get to that, it's the individual turnover, that's down 11%. The unique individual investors also is down 20%, and that we're talking about on a year-on-year basis. Now, the big number, of course, is the losses made by these F&O traders last year, and that was 1.05 lakh crore rupees, and that is a 41% jump from the 74,000 crore loss that they had made in FY24. So that's a 41% uptick. The losses have widened. And if you take a look at the loss-making trend also, the number of traders who lose money in the F&O space, that has remained constant. It was 9 out of 10 traders last year as well. It remains the same in FY25, 9 out of 10 traders. That trend of 91% of traders losing money continues to remain consistent over the last 4 years. But if you take a look at the quarterly trend though, in FY25, you'd observe that between the third and the fourth quarter, the net loss made by the trader has narrowed, and the number of traders also has narrowed. And this is because SEBI attributed this to the slew of measures that they took, almost 7 such measures that they had announced for the F&O market in November of last year. And that has had an impact on this. What has also had an impact is the percentage of loss-making traders. That too has come down between the third quarter of FY25 and the fourth quarter of FY25. And the average loss per trader that is made, that too, even if it is still higher than the first 2 quarters of the year, it is lower when you compare it to the third quarter. The third quarter was the peak at around almost 63,000 rupees. That has come down to around about 58,000 rupees. Now, despite this, SEBI still says that India is still a very highly traded derivatives market compared to the other countries, and that is evident from this 5-year CAGR that you see. The options premium, be it on an index level or on a stock level, have gone up both anywhere between 55% to almost double. The notional index options CAGR has doubled over a 5-year period. So it shows the kind of activity that you have seen in the F&O market, although there has been a slight reduction on a quarter-on-quarter basis based on the numbers that the measures that SEBI has taken. And this has also an impact across the board of trader categories. Now, if you take a look at this, the number of traders with a traded value of less than 10,000 rupees has seen the biggest impact. It's down 30%. You compare this from a December 2024 to a May 2025 period when the measures actually took effect, and that is on a year-on-year basis as well. And even the 10,000 to 1 lakh category and the 1 lakh to 10 lakh category has seen a drop in the number of unique traders by over 20%. The bigger categories though is a nominal impact, because of course the number of traders there too is far lesser, so the proportionate impact is lesser. The 11% drop in the 10 crore plus category, the 10 lakh to 1 crore category is down 14%. The 1 crore to 10 crore, not so much, still a 4% drop. So measures being put in place, and that is showing up in the changes that you're seeing in the F&O market. We'll get you more details as the day goes by. But take a short break here on Power Breakfast. On the other side, cues from the commodities market. Stay tuned. Welcome back. Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. What's on your radar today?
Well, we've seen some safe haven buying come in Hormuz, and that really seems to be showing in gold prices, which have gained on tariff concerns. The U.S. trade policy clearly going to be on focus, and there is demand, for safe haven slightly coming back. You look at gold, it's trading higher. You look at silver, that's trading on the positive side as well. But also what seems to be not working well for the precious metals is the geopolitical tensions in Middle East easing. EU also has signaled closer to the trade agreements that we've seen with U.S. and China. Reports suggest less restrictive stance on export of rare earths. So that's what's putting cap on the prices as well. In the meanwhile, you've seen crude oil prices gain 2% overnight. We've seen natural gas prices gain up by 3% as well. Also, what hasn't done well is the base metal prices. So copper is down 2% overnight. So is the case with aluminum, zinc as well. So it's a jittery market, especially with the US dollar index gaining above 97.5.
Interesting developments there. Manisha, thank you for that update. We'll keep an eye out on all of these, especially a firming dollar. We call time on this edition of Power Breakfast. From me and the team that put this show together, thank you so much for watching. But don't go anywhere. Bazaar Morning Call on the other side to set you up for today's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 News studios. It was a consequential evening, let's put it like that, which basically gives us a lot to talk about in terms of what really matters for the market. Those letters have gone out. Love letters, whatever you want to call them. You've got mail, guys, right?
Oh, yeah. The movie, gosh.
Thank you for your attention. You've got a mail.
We are really the 90s kids, and Prashant is reiterating that, and how, my God, used to be one of my all-time favorites. But anyway, more on movies and love letters later. The fact is that the news is out, but markets are actually not reacting too badly. I think they're still hoping that maybe there's scope for further negotiation.
Well, that's right. It appears, markets are holding on to that thread, going by what evidence we have in the last few months, that if it's too bad, then he pulls it back. So let's see how it goes this time around. But participation has been low. We'll talk about that in further detail in just a bit.
Absolutely. And room for negotiation. And generally, I mean, I think it's just one big hot mess in that sense. And let's just take it from the top, right, in terms of what you need to know as we start this session. So those letters went out. Trump's tariff letters went out. And they had unilateral reciprocal tariff rates. So one-way reciprocal tariff rates. Now, I want to make right at the top, I want to make a mention that there is no letter for India. Remember, we, of course, have been reporting, Parikshit has been saying for a while that decision on whether we will sign on the mini trade deal is in the next 24 to 48 hours. So we're still within, the time period of what we said. But in any case, there was no letter. And President Trump essentially said that they're close to making a deal with India. So India was called out specifically with regards to a deal. Here's Trump himself.
If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now, yeah.
Are the tariff letters that you sent today final offers, or are they negotiable?
More or less final offer. We've made a deal with United Kingdom. We've made a deal with China. We've made a deal. We're close to making a deal with India. Others we met with, and we don't think we're going to be able to make a deal. So we just send them a letter. If you want to play ball, you have to. This is what you have to pay. So as far as I'm concerned, we're done. We're sending out letters to various countries, telling them how much tariffs they have to pay. Some will maybe adjust a little bit, depending if they have a cause. We're not going to be unfair about it. And actually, it's a small fraction compared to what we should be getting. We could be asking for much more. But for the sake of relationships that we've had with a lot of really good countries, we're doing the way I do it.
Okay, so close to making a deal with India, that is President Trump himself. Now, let's get to the letters and the tariff rates which were announced yesterday. So the simple point is these tariff rates look almost identical to the Liberation Day tariffs, which were put out on the 2nd of April, right? I mean, there is very, very little change, except I think Japan, where rates have moved up a little bit, and maybe another country where rates have dropped sharply. Otherwise, it's largely identical. I mean, you can just look at these rates, and we'll put some of the important ones, the big ones, which came through. There's not very much change. Those are the rates up on your screen. Japan 25, South Korea 25, Malaysia 25, Bangladesh 35% or so. There's some fine tuning. Now, I can't, for the life of me, I don't think anyone can really figure out what led to this fine tuning by a percentage point, by 2 percentage points in some cases, slightly larger in for some other countries. But it is what it is, and those are the rates which actually did come through. The only new piece of information, I mean, actually, in a way, this is also not new, because yesterday morning we were talking about how that 1st of August, when the new date when these tariffs will go into effect. I mean, we got to know this from Scott Bessent over the weekend, and we sort of put this out as like the de facto extension, the new deadline. So in a way, after all is said and done from last night, the only new thing was a 1-month delay. The tariffs are largely identical, 1-month delay with regards to the date of implementation, which is now the 1st of August. Now, is that also sacrosanct? We don't know. That could also move around. I think there was some indication, there was some talk with regards to that. Although President Trump in that bite, as you just heard, said, well, these are, as far as we're concerned, final offers, at least in terms of rates. Okay, now the letters also say that these tariffs are separate from any sectoral tariffs. So, sectoral tariffs for pharma, electronics, and many others which come under that Section 232. Treasury Secretary Scott Bessent was also on the record to say that we are going to have several announcements in the next 48 hours. This was yesterday evening. So now we're talking about 48 hours from yesterday evening. And presumably a deal with countries like India and others perhaps is what he's kind of referring to. Now I'll come to just very quickly wrapping up the market. US equities were down. S&P was down small. I mean, you know, last session S&P made a new all-time high. So we just sort of gave back a little bit. 0.75% down on the S&P. NASDAQ about 1% lower. The 10-year yield increased 4 basis points, about 4.38. Dollar index was up about 0.4. Oil prices were up 2% or so. So that's essentially the global picture. It's not really one way up or even down in that sense. There were many big single stock movers like Tesla and Capgemini and WNS, etc. And we'll sort of refer to those as we go along. Now to the market here. Yesterday was very, very quiet, and that largely was a theme when we started in the morning, same time, that expect the market to quieten down. And there were 2-3 factors that we put out. There was, of course, the James Street order and those players perhaps pulling back a little bit, but also generally expectations with regards to earnings, etc., being pretty muted. So, in a way, lack of triggers in that sense. So, yesterday was exactly that, except the FMCG space. The rest of the market was absolutely quiet. Now, not very much has changed in that sense, while we still await details of what will be announced between India and US. If something will be announced, these are levels, very near term. Support for the Nifty stands at the low of 25,331. Resistance on the Nifty stands at the high of 25,669. For the Nifty Bank, same levels. Support is 56,223, which is the recent low, and resistance stands at 57,628. GIFT Nifty will give you a quick sense of how we are kicking off trade this morning, which is down about 40-odd points. Surabhi.
You know, the market seems to be saying something. And the market seems to be saying that it's not too bothered. And a lot of these tariffs that have been announced, these so-called final tariffs via the letters, they're very similar to the original tariffs that were announced on the 2nd of April. It's not like there's a major climb down. Take Japan, for instance. The tariff remains at around that 25% mark. It was 24% earlier. It's 25% now. But the market is taking this in its stride. If you look at the Asian screens, all Asian screens are green. The Japanese market has cooled off a little bit. Yes, it was up 0.5% when it opened. Now it's up 0.1, 0.2%. But the headline is that there is no major market chaos across Asia. Markets are taking these developments in their stride. Now, you could argue whether it's because they think that the long-term impact will not be too damaging, or maybe there's a feeling that there will continue to be negotiation, and eventually over a course of next couple of months, maybe the tariffs come down. We don't know. But the reaction in Asia is fairly, optimistic on a morning like this, to say the least. By the way, the other facet is that in some way, if the US earns more via these tariffs, will it be good for the US? Well, that's what some commentators and the Treasury Secretary, Scott Bessent, seems to be indicating. Look at what he said yesterday. He said that we are taking in substantial tariff income and almost $2.8 trillion in tariff over 10 years. And that, he says, and other, market participants say, that could actually tide over the big, beautiful bill impact to a certain extent, fund the massive US deficit. And maybe that's some sort of a positive that the market is taking on as well. He also went on to say that he'll be meeting his Chinese counterpart in the next couple of weeks. So there's no shock and awe from these letters across markets. Even US futures for the time being right now, the Dow was down 1% yesterday, but down 1% after hitting all-time highs. So, not too much. US futures right now are absolutely flat. The markets are marching on. Let's come to India. Here, of course, we're dealing with a whole other set of issues beyond the global headlines. Like Prashant also mentioned, earnings, Jane Street, there's just a lot in the mix. Yesterday, the flows picture was positive, but the index could not make any headway whatsoever. Almost 2,000 crores of buying from domestic institutions. FPI is also for a change, but not selling at least. They bought total stocks worth a little over 300 crore rupees. We go back to looking at individual stocks because it's very granular. A lot of those updates are coming in. Titan is not sounding as optimistic as some of the other jewelers, which are posting 25-30% growth. Titan's jewelry business growth, domestic business growth, is 18%. So let's see how the stock reacts. M&M, June sales are up 14%. Production is still in the high teens, so the picture continues to look good. We've got numbers out of JLR as well, and again, they're not looking all that hot. In fact, there's a decline. JLR wholesales are down almost 11%, retail sales down 15%, so watch for Tata Motors. Naveen Fluorine is doing a QIP, so that's another stock that's going to be on our radar. So very, very stock specific. That's the way the market's been trending. And I'll round up with some headlines from the SEBI study. I'm sure it caught everyone's attention. So the numbers are still the same. The headline of the study says that 91% of the participants, individual retail participants in the F&O market, are losing money. That number's been steady at around 91% for the last several years that the regulator has done this study. What's changed this time is that the quantum of losses that individual retail investors are suffering, that has gone up, says SEBI. It says that now that loss in the last 1 year has gone up 41%. So at the end of FY25, which is when the study was done, an individual retail investor at an average is suffering an F&O market loss of over 1 lakh crores versus around 87,000 crores in the previous year's study. So, they're still very, very cautious on the F&O market, as they have been, and that trend is intact. So just some food for thought there as well. But Nigel, what are you looking up for?
Well, I look at the Troika first to kickstart trade, and all the three, in fact, they had spiked up a little bit overnight. So you look at the yields, they moved to around 4.4%. The dollar index, strengthened a little bit. And also you have Brent crude prices that moved up, despite the fact that OPEC Plus, they released a higher than expected production into the market. The one that I'll be looking out for is the yields. The last thing you want is for the yields to go dancing away to around 4.55, 4.6% odd. And as we saw last time around, that's the one that actually breaks the back of the market. So we'll keep an eye out on that. The dollar index, after spike up, actually has cooled off a little bit. All three still not, no worries on that front. But the point I wanted to make with regard to participation, just take a look at the participation yesterday. And if you compare it with the averages, the last couple of trading sessions, the volumes have been very, very low in comparison to what we've seen on average. So normally we have more than 1.1 lakh crore worth of value trades on the NSE. Last couple of days, in fact, yesterday, it was sub even 80,000 crores. So we'll keep an eye out on that. For the time being, it appears participation has been very, very low. Couple of holidays in the Western world, Canada, as well as the United States. That could be one of the problems as well out there. What did the FIs do? Well, they added closer around 5,000 short contracts, while the clients, they did the opposite. They added closer around 5,000 long contracts. And if you look at the positioning, there is some shorts in the system now, because when we started off the series, the FI net short positions were only around 30,000 contracts. That's at least moved to around 70,000 contracts or thereabouts. Normally, the number you look at is around 1 lakh net short contracts. That's what gives the bull some kind of hope, because that could be a bit of a squeeze that takes place. In percentage terms, more than 70% of the positions from the FIs are on the short side, while you have the clients, well, they are net long, but close to around 57% of their positions on the long side. We should get the options data that comes up for you on the screen. The call writers, they're getting very, very confident now. The 25,500 call yesterday added another 20 lakh shares or thereabouts, while on the downside, that 25,300 put, that as well was fairly active. So just plugging in the levels, going by what we saw in terms of call writing, this 25,600 mark, this becomes the near-term resistance mark. So we'll keep an eye out on this one. And in terms of support, the options data suggests that this 25,250, which earlier was the resistance zone, that will be one level of support. And the recent low is in this vicinity of around 25,332. So that's going to be the important range you want to see supported on the downside. You don't want that level to get breached. Index I'm looking at is obviously the FMCG index. Well, that yesterday did quite well. There's a debate whether or not there is actual recovery on ground. But at least in yesterday's trading session, what you saw was it ended closer around the 50 DMA and it conquered the 20 DMA. So let's see whether or not it has more legs out there. But besides that, we'll keep an eye out even on the Nifty bank. And, that's the FMCG index, basically, with the levels coming up for you on the screen. But since tariffs have been put on other countries, you also could probably look at textiles because of the tariffs that are imposed on Bangladesh, maybe the paper industry as well because of the tariffs that have been imposed on Indonesia. So stock-specific action will continue.
All right, no, absolutely. And, we'll keep an eye on many of these names as trade starts and kicks off today. Cameron Brand is with us, Director of Research at EPFR Global. Cameron, great to have you with us on the program. Good morning. So markets, of course, have been around the world, actually, have done quite well. US, of course, really the leader in that sense, despite last night's slight pullback. So, in a way, unbothered with everything which is happening with regards to tariffs, etc. There was that one-time shock around April, and the markets did dip quite a bit, but they are back. And how? What are flows telling you, Cameron, globally and specifically with regards to India?
So the flows are telling us that investors are certainly happy that this is the case, but they don't really have great faith in it. Certainly in terms of the U.S., they are not chasing the latest leg up in the market. Ditto for China, where the latest stimulus measures, monetary easing, has had no real effect on the sort of slow outflows that we witnessed for most of the year. Investors do seem to basically be positioning themselves for a reasonably soft landing. They're loading up on higher funds that offer exposure to higher yielding debt. I think the assumption is that those yields will go down as the U.S. and other economies weaken. I think the main sort of note that I think may have changed a bit is that though markets are certainly behaving as if any landing will be soft, there seems to be a sense that once certainly the U.S. economy has landed, it won't be a short turnaround time, that you could be in for a period of slower growth.
Cameron, hi, good morning. The markets are completely Good morning. They're completely unfazed, and that's the point you were just making, that a lot of the tariffs that have been announced in these letters, they're pretty similar to what was announced on the 2nd of April. But the markets are seem to be comfortable, 25% for a lot of Asian trading partners, 35% for countries like Bangladesh. What's the sense? I mean, and data out of the US is still very, very positive. So is the market actually getting it right versus the economists?
Yeah, I mean, I think the market tends to react on what is rather than what might be the worst case scenario. And, you have the history of the first Trump presidency to sort of base, at least some predictions on. And that history is of fairly protracted negotiations that usually end up well short of the opening salvo. So no, that said, I do think that markets, I'm beginning to wonder what really will move them in a sustained basis. There's been a series of things from Iran and Israel exchanging missiles to the big, beautiful budget bill, which, if you're a deficit hawk, is not beautiful at all. And then, the markets get moved for, 4 or 5 days, even 2 weeks, but shrug it right off. So
Sure. But Cameron, on the flows, when all of this began in April, there was suddenly a big sort of chatter around de-dollarization, moving away from U.S. assets, and we saw that play out in some of the Asian markets, for instance, getting more flows. What evidence do you have from the latest data in terms of just how is money moving, and if you have any estimates or projections of what we may see in the near term?
So, it continues to be mildly positive for India, which I'm guessing is what you really want to hear about. Pretty much since the de-dollarization theme emerged, dedicated India funds have really seen steady inflows that fell well short of the banner period between 2023 into last year. What I think is positive both for India and emerging markets is that investors are showing a preference for diversified exposure, especially on the equity side. Global equity funds have done well for a while, and we're starting to see a significant pickup in flows to the global emerging markets funds, which still have a very healthy allocation to India. You circle back to my earlier comments, what theme really is going to stick with markets? It seems even the de-dollarization theme for the moment has run out of steam. But it's resonated enough that there's certainly been a modest but appreciable rotation towards the stronger emerging markets. India and Korea and Brazil, I think, have been the main beneficiaries of this.
Okay, all right. Cameron, great speaking with you. Thank you very much for your time. Appreciate your thoughts here on CNBC as always. Well, what we're going to do is take a quick commercial break here. We'll come back and focus on individual stocks, which should be in focus. And there is a list, and our research team will run you through that as we come back. But, here are some of the interactions which are lined up on the program today. 8:35, we have Gurmeet Chahal of Digitide Solutions joining us to discuss the quarter gone by, their F526 outlook. Of course, there's that big deal as well, Capgemini WNS. We'll talk about some of that. 9 o'clock, we'll have William Lee of the Milken Institute to talk about the Trump tariff letters which have gone out. 9:20, Gautam Dugat of Motilal Oswal Financial Services on markets. 9:30, Astra Microwave Products will be with us. Outlook for F526. Mayank Shah of Pale Products and Vishesh Dora of Bizom will be speaking with us on consumer trends. Remember, the FMCG index did quite well, the only index which did well. 9:50, it's our special segment, Quarter Se Quarter Tak, and we'll put the focus on, of course, what's first off the block, which is the IT sector as far as the first quarter earnings go. Towards the end of the program, it's the economy. Lata speaking with Robert Subramanian of Nomura and Chandresh Jain of BNP Paribas to discuss the impact of Trump's tariffs on EM economies, currencies and rates.
But time to a quick break. We've got a lot of stock-specific action to track for you today. We get to that in just a bit in our special Top 10 segment. For the time being, I'll run you through the list. Tata Motors, Kotak Mahindra Bank, Macrotech Developers, Phoenix Mills, Soba, GSW Infra and Textile stocks. They'll all be on our radar on the back of positive news flow. Titan and Navin Fluorine will be reacting to negative news flow, while we get a mixed reaction coming in on the crude sensitives. Take that break, come back, further detail on all of these names.
Welcome back. Well, as we've been telling you, the reaction across Asia is actually very, very sanguine. You're not seeing any major deep cuts or anything of that sort. In fact, there's a fair amount of green across Asia this morning as the markets are digesting the tariff letters very, very well. It's going to be a lot about individual stocks, including sectors like textiles, perhaps, that stand to benefit given where the tariffs for countries like Bangladesh and Vietnam are landing. Let's see. Implied Open is saying we'll start soft and then we'll pick it up from there. Let's talk about individual stocks, though, and our team is standing by, as always, with the CNBC-TV18 list of top stocks to watch. Lots of updates coming in for the quarter. Sudarshan, morning. Let's start with Tata Motors. Still not looking good.
That's correct. So Tata Motors has reported Q1 sales volumes, both wholesales and retail volumes for JLR. And while sales have declined both on a sequential basis and year-on-year, but company is saying those sales are largely in line. So wholesale volumes have fallen by almost 11%, while retail volumes are down more than 15%. And most of the major markets except China have seen a decline, with Europe and US seeing a fall in the range of 12 to 14%, while UK, because of winding down of legacy Jaguar models, have seen a fall of more than 25%. Now, MS has come out with a note on that. It maintains equal weight call on the stock and says strong mix helps partly offset weak volumes and tariff headwinds for JLR, and it believes that company is likely to report an improvement of almost 8% sequentially in average selling price. And on the margin front, it's expecting 11.4%. So the reason company is saying that despite a decrease in the sales volumes, those sales are largely in line. I'm going with green for Tata Motors.
All right, going with green for Tata Motors. Got that. Thanks, Sudarshan, for that. But Mangalam, you're going with red for Titan. A little softer than expected.
It is softer than expected, and more importantly, it's softer than what the peers reported as well. So if you bid up Titan yesterday thinking that, the way Senco and Kalyan Jewellers reported, you'll be disappointed today because the domestic jewelry business for the Titan company grew just 18%. Remember, a couple of weeks ago, we had a brokerage which was estimating around 20 to 21% growth in the first quarter, led by Akshay Tritiya. But remember, it's the gold price volatility which has affected consumer sentiment. That's what the companies alluded to. And more than that, even studded ratio, that was lower year on year as demand for plain gold growth grew in high teens, whereas you had studded segment which grew in early double digits. So that's, margin dilutive. At the same time, buyer growth was absolutely flat year on year. There were some green shoots in other segments, like watches grew about 23%, emerging businesses led by fragrances and women's bags grew 38%. There was strong growth in Carrot Lane as well as the international business as well. But the mainstay of the company, the jewelry business, did not grow as well as expected and did not grow as much as the peers did as well. So to see some red on Titans in today's trading session.
All right, Mangalam, thanks very much for that. Let's talk about Kotak Mahindra Bank as well. Gaurav is here with details. Gaurav, morning.
Well, yes, Kotak Mahindra Bank definitely is going to have a great day today, and the reason being that they have actually reported good set of numbers in terms of advances. 14% growth is what we have seen. Even 4% on a sequential basis is a strong growth. Let's not forget that industry is growing at a rate of around 9 to 10%, and in this environment, Kotak Mahindra Bank is coming up with such growth. Let's also not forget that when we compare these numbers with the consensus, there also we are seeing that these numbers are higher than consensus. In terms of deposits, there also we are seeing 14.5% of growth on a YOY basis. Now, this is actually driven specifically from the term deposit side because CASA has seen a little bit of softness, but this is actually a trend in Q1, and that is the reason why this is not a concern for Kotak Mahindra Bank, at least for now. We will be watching out on what segments have grown during their results, but definitely for now, a good set of number from Kotak Mahindra Bank for provisional updates.
Okay, all right. So Kotak Mahindra Bank looking steady in the first quarter. Got that, Gaurav. Thanks very much. More updates coming in from a bunch of real estate companies. Sonal, tell us more about this morning.
Good morning. Well, let me start with macro tech developers. They have seen a growth of around 10% in the quarter gone by in terms of their sales. Now, remember, they had guided for a 20% growth, so it's lower than that. In terms of collections, it's up 7%. However, the company says they are on track to achieve their guidance of 26,000 crore rupees in terms of sales in FY26. They're also talking about collections in second half to be higher than their first half. Phoenix Mills, it was decent consumption in their malls business, up 12% on a YOY basis. However, the trading occupancy came in lower on a quarter-on-quarter basis. That is because of some shutdowns that they had taken, and this was a planned vacancy that they are talking about. For Sobha, again, it was a double-digit growth in their sales. Their sales were up 11% at 2,079 crore rupees. Sales volumes were up 27% as well. And this is the highest ever quarterly sales number for the company. So looking good for Sobha as well.
Okay, all right. Thanks a lot for that, Sonal. Going to Vivek now to tell us about Naveen Fluorine, who's doing some fundraising, and JSW Infra. Morning, Vivek.
Well, good morning, Naveen Fluorine. Last evening they launched a QIP for a fundraise. The company is looking to raise close to 750 crore via the QIP route. And as per the term sheet that we managed to access last evening, the indicative issue price is at 4,680 rupees a share, which indicates that there is a dilution of slightly over 3.2% of the total pre-equity dilution. Now, what is the company raising the funds for? Number one, debt repayment for both Naveen as well as one of its subsidiaries, and the remainder of the funds will be used for general corporate purposes. Now, coming to JSW Infra, remember last week we had the management on a channel where we quizzed them about getting the license as far as the Kolkata port was concerned, and along expected lines, the company has received the LOA for 2 berths at the Netaji Subhash Dock of Kolkata Dock System. The project has been awarded on a design, build, finance and operate transfer, 30-year concession period, capex estimated at 740 crore. Total capacity as far as handling of volumes at this particular terminal would be close to 1 million TEUs. Now, the company said that this is expected to be an accretive, acquisition as far as the port volumes are concerned.
All right. Thanks very much, Vivek, for that. Now, textiles should also perhaps be in focus. Of course, with regards to textiles here in India, which is a labor-intensive sector, which, of course, the government's been very mindful of. It's come up in our reporting with Parikshit as well on this potential trade deal, mini trade deal with the US. For now, I guess we're looking at some of the tariffs imposed on countries like Bangladesh, which are big competitors. Vinny's got details. Vinny, morning.
Hi, good morning. So yes, we're keeping an eye out on all these textile stocks today. So obviously, last week the announcement came in for the Vietnam tariff from US and Vietnam that was imposed at around 20% tariff on textile. Now, Bangladesh also in the recent announcement that has come in, updated tariff is at 35%. On April 2nd, it was 37%, so slight reduction there. What we're watching out for is also China. They had already been imposed with a 55% tariff. Now, India currently faces 10% tariff overall on all goods, but for textile, it's 26%. What does it mean for India in terms of Bangladesh, Vietnam, China, where these are big competitors for India in terms of importing or exporting to US over there? So these are big competitors there. So what it means that if, as of now, there's no deal that is announced, but we are expecting a deal coming out soon, tariff lowered would give us a competitive edge over all these countries, whether Vietnam, Bangladesh or China. But if tariffs are kept at this 26% mark right now for the textile sector, then we would lose some bit of a competitive edge over Vietnam, but over Bangladesh and China, the competitive edge would still remain. Possibility of market share gains. So obviously there's 35% on Bangladesh. We are expecting, textile stocks to react positively in today's trading session.
Okay, all right, Vinny, got it. Thanks for that. So textile stocks on our radar as well. Let's also talk about crude oil and how that may impact today's market sentiment. We have Manisha joining in with the latest updates here. Manisha, morning.
Morning, and thank you for that, Surbhi. Pardon me. The crude oil prices are trading at a 2-week high. We've seen 2% of gains in the overnight market there. Well, remember, there was a knee-jerk reaction to the lower side after OPEC Plus increased output by 548,000 barrels per day for the month of August. Now, this brings in 80% of the 2.2 million barrels per day of a cut. Having said that, the markets believe that there is demand in the near term, and that has been supportive is the reason you're looking at the crude oil prices trading around that $70 a barrel. Also, Saudi Arabia has raised August prices for Asia for a fourth straight month to a 4-month highs. So that tells you that the demand even at these levels, even with the tariff concerns going on, has been on the stronger side, and that is keeping the crude oil prices on the higher side.
Okay, all right. So we'll watch out for the crude sensitives as well. Manisha, thank you very much for that. Let's quickly recap our list of stocks to watch then. The ones that have positive news flow would be, actually Tata Motors will be on the negative side because of the JLR sales. Then there is Kotak Mahindra Bank, Macrotech Developers, Phoenix Mills, Sobha, JSW Infra and textile stocks on the back of the tariff developments. On the negative news flow side could be Titan, Navin Fluorine. Crude sensitives could see a mixed reaction in today's trade. Okay. All right, so that's on the stock list front. But now let's address that really interesting study that came in from market regulator SEBI on the derivatives market, which shows that retail traders lost that's at an individual level, every retail trader at an average saw a loss of over 1 lakh in FY25 on derivative bets. The quantum of losses has gone up significantly in SEBI's study that was conducted for FY25. Hormaz is here with more details. Hormaz?
Every possible adjective that you can use in that SEBI study. There are certain things that have gone from bad to worse. There are certain things that have remained constant, and there are certain things that have improved as well. Let's start with the big number first, is that the overall loss in FY25 that the retail traders made in the F&O market, over 1 lakh crore rupees, and that is a 41% jump from the loss of around 74,000 crore odd that they had made in FY24. So that is the big number that comes up in the study in comparison to last year. And of course, the trend that has remained constant is that in the previous study as well, 9 out of every 10 retail traders in the F&O space made losses. That number remains the same. That 91% figure remains constant, as has been the case over the last 4 years as well. But if you take a look at the quarter-wise trends in FY25, although the things in the first 2 quarters go from bad to worse, there is a sequential decline that is being witnessed in between the third and the fourth quarter of the year, and that is because of the measures that were put in place by SEBI in November of 2024, which has had an impact on this. Now, the number of traders and the loss made by the number of loss-making traders both have declined on a sequential basis in the third and the fourth quarter. And even the average loss per trader, if you see that in the third quarter, that comes up to around 63,000 rupees. That has come down to 58,000 in the fourth quarter on a sequential basis, although it is still higher than the losses that were witnessed in the first 2 quarters. And even in the number of traders list, if you could see, the number of loss-making traders too has seen a decline on a sequential basis. But despite all of this, India continues to remain a very highly traded derivatives market according to the SEBI study, and that is evident from the 5-year CAGR that you see, whether it be in the index options premium or in the stock options premium, even on a notional basis as well. The index optional premium on the notional basis, the 5-year CAGR has doubled. So that shows the kind of activity that you have seen in the derivatives market, and the measures that SEBI had put in place has shown its effect across categories. Now, the number of unique traders has had the biggest impact in the sub 10,000 rupees category, where the number of traders has declined more than 30%. And even in the other categories, the losses are up to 1 lakh rupees too, has seen a loss or a decline of around 20% from last year. And even on the 10 crore plus category, that has seen a decline of 11% in the number of unique traders. So interesting analysis coming in from SEBI. The one thing that remains constant, 9 out of 10 retail traders still continue to make losses.
Okay, all right, Hormuz, thanks a lot for joining in and giving us that quick update. For the time being, though, we'll slip into a short break. On the other side, we'll be joined by Gurmeet Chahal of Digitide Solutions. We'll be discussing the quarter gone by, the outlook for the next year, and also potential repercussions of the deal that we saw overnight with regard to WNS. Stay with us.
Welcome back. Digitide Solutions is on our radar. Now, the company recently demerged the entity of Quest Corp, focusing on AI-led digital solutions. The company is betting on AI-led transformation and is eyeing 3x revenue growth by FY31. Let's talk about this and their overall business plans with Gurmeet Chahal, Chief Executive Officer and Executive Director at Digitide Solutions. Mr. Chahal, thanks very much for joining in. So, let's just start there. When you say that the focus is going to be on AI-led solutions and you could be looking at some more investments over there, what is the plan, and the near-term plan that you perhaps have in mind?
So first of all, Surbi and team, a very good morning, and thank you for hosting me. So look, for us, AI is the big bet. And the reason we are taking that bet is we believe AI is going to be value accretive for us. You know, on one hand, it helps us to optimize the cost. On the other hand, it opens a lot of new opportunities and frontiers for us. So that's where we have taken a big bet on AI. We've invested in senior leadership from the industry. We are building our own platforms, and then we are partnering with some industry leading product companies. The approach we are taking, Surbi, is a threefold approach. I call it the three lens approach. Lens number one is the lens of industry. So we will have AI for insurance, AI for banking, AI for healthcare, so that's lens number one. The lens number two is the lens of the process. So AI for customer care, AI for HRO, AI for FNA, AI for software development. Third is, which is most interesting, is the persona lens. So AI for CIO, AI for CTO, AI for CFO. So that's how we are making investments.
All right. Hi, Mr. Chahal. Good morning. Good to see you. Ben, just let's get the numbers out of the way. I'm looking at your ambition with regard to profitability and return ratios as well. You have mentioned you're looking at 200 basis point margin expansion, in the next few years. Could you tell us what would it look like in absolute terms? Because your last year's numbers for the year, I think they were close to around 14%, but for the quarter, they were close to around 11%.
Yeah.
So this 200 basis points expansion takes the margin number to what? Point number one. Point number two is you're looking at scaling a business big time to $1 billion. Could you tell us on the core business, that's the current business, how much will the contribution be? Should we look at around 750 million and 250 million of inorganic? Could you split that up for us?
Sure. So you've got two questions. First, on the margin expansion, the 200 basis point that we are saying in the 3 to 4 years is with respect to the 14% that we were at. So we are looking at 16 to 17% margin eventually. As we stated in our Q4 commentary, we are also looking at optimizing our portfolio. So we are getting out of some non-core business, and as a result, 1 or 2 quarters we expect the margin to be dipping as we do the cleanup. In parallel, we are also making investments, investments as a standalone company, investments in leadership, investments in some offerings. So in the short term, that's where the margin came down. But in the long term, we are looking at the 16 to 17% margin. So that was your first question. The second question, so look, when we will be $1 billion company, I mean, think of it, we have to add about 650 million incrementally from where we are. So we believe roughly about 200, 180 to 220, roughly 200 will be through inorganic. The remaining will be organic. Traditionally, we've been growing at about 14% CAGR. So that means organically, we have to grow at about 16%. We are very confident given all the investments we are making. And for inorganic, we are already looking at certain segments that we believe are aligned with our investment thesis, our growth thesis, and are adjacent to where we play today, and we have a right to win.
Okay, Mr. Chahal, you've also indicated that there is going to be a ramp down on several non-core, low-efficiency businesses, and this happened, over the fourth quarter. How long will these ramp downs take? What will they mean in terms of loss of revenue, maybe improvement in profitability because they're perhaps low-margin businesses? And what will the implications be? Also on the AI front, yesterday we saw the big deal between Capgemini and WNS. So what does that indicate? Standalone BPOs, is AI a real threat? Just take us through, the contours of how the company is going to look like a year down the line when you complete some of these structural changes?
Yeah. So I think, look, why are we making these structural changes? See, today about roughly 70% of our business comes from BPM, 30% comes from technology, data, and AI. We want that 30% to be 40%. Secondly, we want our international revenues to grow from currently 40% to 50%. Okay. So the investments that we are making and the portfolio optimization is aligned to this direction, and we believe, this is where we can add more value. Coming back to your second question, I mean, look, yes, it's a marquee deal, WNS and Capgemini. The way I look at it, I think it's not about a standalone BPM as much. I think it was for Capgemini to add a BPM capability so that they can effectively compete with the likes of Accenture. In fact, I read an article where they are saying, hey, now they can also compete with the big four. So I think it was adding a capability, BPM capability, and look at the premium they've paid. So BPM is not going anywhere. The form and shape of it will change. And that's why we have gone all in on AI and we are getting ahead of the curve. Just to give you an example, when we declared our Q4 results, we did give this detail. Our customer lifecycle management business grew 16% year on year. However, there is a lot of AI now getting built into that business. We have developed our own agentic AI solution called QBuddy, which is coexisting with our human agent. So it has made it more efficient. That's why companies are seeing more value, and we are getting a lot of business in that segment.
Okay, all right. So looking at transformation and looking at scaling up on some of these businesses. Got that point, Mr. Chal. Thanks very much for joining in, and we look forward to more conversations in the future. Thank you for being with us. Well, with that, let's move on. Amnish Agrawal is joining in to talk about fundamental stock ideas and, of course, individual names that would be in focus today. Amnish, good to have you on. I want to start with textile stocks because the numbers are, at least right now, looking very, very favorable. We have a 10% levy on our exports to the US. Vietnam is at 20%. And a major rival market like Bangladesh is at 35%. China is even more. So even if the 10% levy continues, I mean, this could be a huge advantage for textile players, won't it? Do you like any stocks here, apparel and textiles?
The main thing is we need to be first clear what are the ultimate tariffs going to be. Because you never know that today it is 10%, next day morning we get up and it is 25 or somewhere it is 30. So all these are very interim things till the time the trade agreements are there between US and some of the other countries. So we can't rely on these tariff numbers just to buy these stocks. So that is one. Secondly, as far as your exports are concerned, I think we have Gokuldas, we have Wellspun. So there are a few companies which are actually doing all these exports. In particularly your home textile and bed linen, India has been competitive, and the competition from Bangladesh and some of the other countries, that has been more in case of your apparel. Okay, where due to the duty advantages and you can say the most favored nation status from US and Europe, or Bangladesh had a huge advantage over India. So I think just because of this, you can say news, I will not tend to buy the textile stocks. Let the things settle, let the duty structure be clear over the coming few months, because there can be, you can say, very wide variations in the duty.
No, okay, I take your point, Amnish. I take your point that we never know with these tariffs. Any day can be a different day. But intrinsically, like you mentioned, Wellspun living on the made-up side and the fabric side and a home textile side, or a Gokuldas on the apparel. Intrinsically, X of tariffs, just looking at business efficiency, valuations, margins, which of these companies do you like, if at all?
You see, Wellspun has been under pressure in the past few quarters, whereas Gokuldas has done well. So I think that there are many, you can say, factors at play. One has been the soft demand in US, and secondly, the margins have been under pressure. So, for example, Wellspun has rallied from something like 110.15 to 145. So till the time there is clarity, I think I would tend to be, it's more like sideways kind of a counter for me. When it comes to, say, Gokuldas, yes, the company has been doing well. But given the fact that it has risen significantly over the past few months, I think at the current juncture, I would tend to avoid any of these counters for fresh investments.
All right. When you talk about Welspun India, since Wimbledon is going on, you can't take your eye off those towels, which are made here in India. But we got your view on the textile stocks. Let's talk about FMCG. Amnish, what is your view? We have Titan's numbers that have come out. And actually, if I compare it with some of the peers, it's looking a little bit softish. Maybe a couple of one-offs, maybe the high price of gold as well. Your view on Titan as well as the other jewelry names?
Nigel, we have to look at it in two ways. One is absolute growth, and the second is your same-store sales. If you look at some of the, you can say, names, say, which have grown faster than Titan, there the store additions have been far more. So, for example, in case of Titan, the growth rate is, say, 18%, and the store additions are hardly, say, 1% of the total. Whereas some of the other names, the store additions are even, say, accounting for 10-12% of the total numbers. So while, yes, there are a little soft relative to others, maybe by you can say a couple of percentage points, the gap is not that much if you look at on a per store basis. So that is one. Secondly, in case of, say, entire jewelry space, the last 1.5 months, beginning from middle of May, it had seen very sharp spike in gold prices. So that is one reason that there was some softness in demand during that period of time, which now I think might be better because in the last 15-20 days, gold prices have corrected by a few percentage points. So I think these are all temporary sort of, say, variations. For example, despite all this, Titan has very strong sales in watches, and the company can post 18 to 20% PAT growth in this particular quarter. So I think while the stock has run up quite sharply from 3,150 to 3,200 to the current levels, I think I don't rule out a little bit of, say, correction. In the long term, yes, it remains to be a good stock. But I think valuations for all the jewelry companies, they are reasonably rich at this point of time.
Okay. All right. Got it. Amnish, request you to stay with us. For the time being, we slip into a short break. We continue our fundamental chat with Amnish. We'll also be joined by Sudarshan and Vitesh. They'll be helping us out with their technical calls on the market. Welcome back. Well, as promised, Sudarshan and Mitesh are with us to give us their check on the technicals. Good morning, gentlemen. Good to see you all in as always. Sudarshan, you go first. Yesterday, what was standing out was volumes were extremely tepid here in the Indian markets. In fact, if I look at the US markets overnight as well and compare it with the 20-day average, volumes are relatively lower. What's your view in terms of market action from here on? We appear to be in a bit of a range, but how would you trade it?
Yeah, good morning. See, we are in a trading range, but the difference this time seems to be that every time we were in a trading range, the markets would try to go up, hit the resistance levels, and eventually break out on the upside. This time, the range is doing the exact opposite. The Nifty is in a narrow range. It's not coming down. It's not going up, but it's hitting the lower support levels repeatedly. That's worrying. Now, this could be a one-off event. It may not mean much. But at this point of time, I'm not upbeat on the markets for the short term till we break some significant resistance levels, 25,600, 25,650. Till then, I would say avoid the Nifty completely and focus entirely on stocks. I am not, after a long time, so upbeat.
Okay, not so upbeat. Got it. All right, Sudarshan. Mitesh, what about you? How are you feeling about the markets?
Good morning, Nigel. So, this market has been, what I would say is going through a contraction phase. And the next directional move will take some more time to build up. Now, whether it will be on the downside or on the upside is mildly difficult, though I think there is no reason to worry about a big downside move. But, the idea is that post a contraction, a breakout or breakdown can happen in either direction. So we are waiting it out. The key level to watch for me on the downside is 25,200. As long as we are not breaking that, I think we're pretty safe. Only if we start trading below that, we'll be worried on the downside.
Got that. Gentlemen, morning, Mitesh and Sudarshan. Mitesh, what would your trades be?
Morning, Prashant. I have a mix of buys and sells. FMCG was a strong performing index yesterday. So Britannia is a buy with a stop at 58.30 for targets of 6,000. Cummins after consolidation appears to be breaking out. So buy with a stop at 3,400 for targets of 35.20. A sell on Hoodco with a stop at 232 for targets of 218. And a sell on HDFC AMC with a stop at 50.50 for targets of around 49.
Okay, and Sudarshan, what about you? What do you have for us?
Well, I have a mix today, and that tells you that I'm not very sure about what the markets will do. Bharti Airtel is a positional buy. Despite the significant rally, I think there's more upside. Consider buying with a stop under 1989. Hindliver, that big move yesterday tells us that some kind of a breakout has happened. I can't say if it sustains, but on a small dip, it's worth buying. Buy Hindliver with a stop under 23.60. I have two intraday shorts, Tech Mahindra, Techem, intraday short with a stop above 16.53, and Naukri, which is InfoEdge, an intraday short with a stop above 14.59. So it's a mixed bag.
Okay, all right. Thanks a lot for that, Sudarshan. Well, I'll tell you what, we'll slip into a short break. You come back, we'll be due for pre-open rates. We'll also get chatting with William Lee of the Milken Institute to talk about Trump's tariff letters. Stay tuned for that conversation.
Okay, welcome back. There's 16 minutes to go for the market open, 2 minutes to go for the pre-open session, and we'll of course pick up on some of this stuff as things start to trade. The next 24-48 hours will still once again perhaps essentially we may get one more round of news flow with regards to a deal, and we've been saying this, that the markets are largely unbothered, but at a slightly, if you pull back a little bit, the fact is markets have done phenomenally well, and the question is whether some of this tariff bit eventually is going to start to feed into the real economy. And I mean, around the world, tariffs are substantially higher now. I mean, I think average US tariff rates are about 14% as compared to 2-3% when Trump actually took office. And of course, they are expected to go even higher, maybe north of 15% average. And of course, then there are specific deals, etc. So this is a space, I think, where we'll have to wait and watch for more. Amnish is still with us with what he's making of things and what the sense is. Amnish, thanks for waiting. I'm kind of sure you wouldn't have a view on any of these names, but let me throw them your way in any case. These are all kind of, in a way, penny names, but they had some of the largest volumes on the NSE yesterday. JP Power was limit up 20%. They'll come up on your screen. There was PC Jeweler. There's some buzz, by the way, around this one. And there is Ratan Power, which also was up big time. I think 1, 2, 3 in terms of volume-led gains yesterday. Amnish.
Not fair to give any view of any of these, because some of these companies, they have seen very sharp moves in these past few months. But till the time one is very sure on the numbers, I think it's playing with investors' money.
Yeah, no, never. I don't know if you picked up anything. My question was more in that sort of, on that line in terms of you picked up in terms of news flow or anything of that sort. But all kinds. I mean, market, of course, buzz with all kinds of stuff which has been going around. These amine stocks from the chemical space, Amnish, have also done very well. I mean, actually, last 6-7 days now, Balaji and Alkyl. Do you track these?
Yeah, I think we might be looking at some of these names.
So, Amnish, which within the specialty chemical space, specifically, which ones do you like?
See, I think we have got very few likings if you look at, say, the specialty chemical space, because this entire scenario of China plus one and all, it has not played out the way it was earlier thought to be. So there are, I would say, not many stocks which can give you the decent upsides from here on. So if you ask me about, say, you can say the particular stocks, maybe you can look at, say, Navin Fluorine is one, or maybe I think some of the others. But our view on the chemical stocks is very mixed as of now.
Acha, mixed view. Navin Fluorine, by the way, is also raising a QIP, so stocks in focus in any case in terms of today's trading action. The first of the pre-open rates have started coming in, 80 points down on the Nifty. That's the first rate, 82 lower. You can see there at the bottom of your screens. There we go. That's the Nifty. Look at the textile stocks. Gokuldas in the pre-open is up 5.5%, 6%. And it's a bit of a no-brainer of a trade, purely from a trade point of view, perhaps that's how people are looking at it. But in terms of real benefits, like Amnish says, we need to know that what the final tariffs are actually eventually. And then perhaps a clearer view will emerge. The Nifty is down. I mean, it's a little volatile, actually. Suddenly 180 points down. It's completely all over the place right now. So let's wait for it to settle and focus on a couple of stock names and news flow. We've got a lot of brokerage notes out on pharma companies today, and Ekta has been making sense of them for us. Ekta, good morning. So which ones caught your eye?
Well, I'll start with HSBC. That's written on Divi's Labs. They've upgraded the stock to buy with the target price raised to 7,900. According to them, the long-term growth drivers by tirzepatide, which is basically Mounjaro, other peptides and contrast media would be something to watch for. They see revenue potential of around $450 million from peptide and $260 million from contrast media. by 2030. They forecast FY5 to 28 estimated EPS CAGR of 23%. Macquarie has written on pharma. They've said they've revisited the export-focused pharma. US generics market is under pressure. Price erosion is expected to accelerate due to fewer drug shortages. Revlimid generic is nearing end of exclusivity, which is by Jan 2026. Earlier than expected price erosion is likely to impact Q1 FY26 results for key players. Lower P multiples for US-focused generic companies amid changing dynamics is what they see. Aurobindo, they've downgraded to underperform. Dr. Reddy's, they've downgraded to neutral and cut the target price as well. Cipla and Zydus and Lupin, they've maintained their outperform, but they've cut the target prices on all three of these stocks. And Sun Pharma, they've reiterated an outperform. Minimal US generics exposure benefits their outlook on that stock.
All right, Ekta, thank you very much for that. So that's the call coming in from Macquarie on a bunch of pharmaceutical names. Stocks should be in action. Let's focus on one more name. This is Leela Hotels, recent listing. Mangalam has got more on this one. Mangalam, morning.
Good morning. So it's a recent listing and a couple of their bankers, the likes of BofA as well as MS, have gone ahead and initiated coverage on the stock as the silent period between the bankers initiating coverage on the stock and the IPO has ended. So we have Bank of America Securities having a buy rating, a target price of 520 rupees. They believe that the overall valuation at 20x FY27 is attractive. 12 to 14% is what they're expecting in terms of revenue and EBITDA compounding over the next few years. And on a low base, the earnings grow over 90% between FY25 to FY28. Morgan Stanley too has initiated with an overweight rating. They have a target price of 549. They believe the only thing to watch out for will be the concentration risk, because a large part of their revenue comes in from smaller number of hotels. They again expect 12% EBITDA growth all the way until FY27, with net income from a low base increasing nearly 9 times as interest costs come down post the issue. We have the balance sheet, which is now nearly debt-free, leaving free cash flow to fund the upcoming capex cycle for the company. So those are a couple of things that they'll be tracking in Hotel Leela too.
Okay, all right, got it. Thank you very much for that, Ekta and Mangalam, and thank you, Abneesh, for all the calls this morning. Look forward to connecting again soon. But let's go back to that big story, global story. President Trump's tariffs, and those tariff letters have gone. And once again, I reiterate the point as we introduce the next guest, that Asian markets are taking things in their stride. US futures are very flat. There's no major downside across Asia. In fact, markets like Japan, which are at 25% tariff, the market is actually holding up. So what is the interpretation of all this, and what does it mean for markets from here on? William Lee, Chief Economist and Executive Director at the Milken Institute, is joining in. William, hi, morning, great to have you on. I remember, just last week we were doing the global reset and you were there. And I think you're among the rare voices that perhaps feels that while tariffs will bring about a major trading and economic reset, it may not necessarily be a bad thing for the market. And that's the view that the market seems to be taking. I mean, a lot of these tariffs are not too different than what was announced for countries on the 2nd of April, and yet the market is not falling. What do you make of it?
Exactly. If you remember our conversation, I said the purpose of the tariffs was to initiate discussions and really accelerate them. Well, it looks like they didn't accelerate them, but President Trump, I think, has got in mind a restructuring of the financial system, the global trading system, in a way that allows each country to make a deal with the United States. And unfortunately, most countries have taken the attitude that we're still under the old rules of WTO, where lawyers take their lawyerly pace and it takes years to negotiate the stuff. Well, President Trump is very serious. He says, look, we have some tariffs that you will have to confront if you choose not to partner and trade with the United States in a way that makes sense to both sides. And what President Trump was trying to do was say, bring your investments into the United States, bring your production into the United States, bring your technologies into the United States, and we will give you a protective barrier of tariffs to protect you from unfair competition from other countries. But at the same time, you'll benefit with higher profits and higher output and higher sales in the United States. Unfortunately, very few countries have really taken him up on this offer. But I think President Trump is showing his patience as well. And I think that's what the market is really sussing out. And as I said to you before, the markets really are figuring out that we are in this process of restructuring. It's going to take time, but we need these framework agreements first. And right now, President Trump has sent out a bunch of letters saying, okay, you don't give me an offer? Here's my offer to you, 25% tariffs. I think that surprised everyone by the fact that they were so low. But I think that's also President Trump's way of saying to everyone, let's talk, and let's talk now.
Make an offer you can't refuse.
Anyway, not too many can refuse. I think China is the only one that, managed to refuse and say, hey, this is not how we roll.
I have a very important question, Surabhi, for William. William, good morning, Prashant. I'm scratching my head. What is the reason for, fine-tuning of some of these tariff rates? Japan has gone from 24 to 25.
Well,
on a lighter note, go on, William.
Well, remember how he came up with these tariff rates, right? He said, look, it's not about tariffs. It's about not being able to get into your markets. It's not being able to get into the foreign markets, India included, by the way. And he said, it's not the tariffs that are bothering us that much. It's the non-tariff barriers and the fact that your markets just aren't open to trade. So let's have open markets. I think that's the objective of these discussions. Open up both sides and we'll both benefit. President Trump is not trying to isolate the United States. In fact, he's trying to engage in much more bilateral and regional trade. And I think that's the essence of how these tariffs are calculated, to say, look, the barriers that you have put up, tariff and non-tariff barriers, have resulted in these imbalances. So I'm going to give you the equivalent on our side, but let's get rid of this stuff and let's start to negotiate seriously.
Yeah, we are 6 minutes from market open, so maybe this is not maybe we'll do this another time during the day. I can make the opposite points to you, William. Actually, just look at what he's done. I mean, some of the closest allies, right? Japan, Korea, for 50 odd years. He's kind of that line that you said, he's not trying to isolate America, but the real practical effect of what he's announcing is exactly that.
Some of our closest friends have also been some of our most troublesome trading partners, including Canada. I mean, they're trying to protect the dairy industry. The Japanese are trying to protect their rice industry. Everyone's trying to protect their home turf in some way. And I think President Trump is saying, we acknowledge that, but let's try to remove as many of these home turf barriers as we can.
But William, to press on the point further, and at a level as we've all understood in the last 3 months, this is not entirely about tariffs or non-tariff barriers. It's about trade deficits. He doesn't want to run large deficits with a lot of these countries, which is a separate argument altogether. The reason the deficits happened is that because it was more efficient, perhaps, to manufacture in Japan and then ship to the U.S., or manufacture in China and then ship to the U.S., and that's what he's trying to turn around. We'll see if he succeeds or not. Yeah, go on.
He's not trying to get rid of the overall deficit. I think he acknowledges that Americans just consume way too much, right? And so that we have to live with the fact that we have an overall balance of payments deficit. Where they're distributed, that's the thing he's trying to shift with these tariffs, right? He's trying to shift the deficits to our friends and take them away from our competitors. And the point of a tariff is not to reduce the overall deficit, but it's to really reshape the distribution of the deficit.
Yeah. So, okay, one final point, and I go back to our last week conversation where you said that this will have some impact on inflation, U.S. inflation, but may not be like all destructive. Now, see, if you're bringing in an item of clothing, a T-shirt from Bangladesh, the tariff is 35% now, which is a lot higher than what it used to be. So won't there be a serious inflation implication and therefore consumption and growth? What are the implications on the second half in the U.S. economy?
I'm going to look for, as an American shopper, those T-shirts that are not so much made from Bangladesh, but Mexico or other areas with lower tariffs, because they will sell at a lower price. And I think that's really the way American shoppers are going to substitute lower cost stuff for the high cost stuff. Now, some stuff I just can't substitute away, but I'm going to learn to live without avocados from Mexico. And I will try to find California avocados, or maybe use hummus. So I mean, there are substitutes that you can do, and I think that will contain the amount of absolute rise in U.S. inflation rate overall.
Okay, so William is not going to maybe not have avocados in the near future. That's one small takeaway. Okay, at about 9:12. So, William, very, very quickly, I think just 30 last seconds on to this conversation. India, amidst all this, would you be positive on the economy and the markets here?
I think India really is in that position of saying, we will open our economy. And now the question that President Trump is asking India is how, what sectors, and how much can we really engage in a bilateral trade that's beneficial for both.
All right, William, we'll leave it there. Thank you very much for joining us. Good conversation, and some good banter as well. Appreciate it, as always, here on CNBC TV18. I think what we're going to do is just take a look at prices. I think we've come to the end of the pre-open session, but also get you some trades as well. So Darshan and Mitesh are back with us. So let's actually do the trades first. Morning again, gentlemen. So Darshan, you go first. What are your 9-10 calls?
Well, it's Bharti Airtel. It's a positional buy with a stop under 1989.
Okay, Bharti is Darshan's trade. Mitesh, what about you?
I go with a buy on Britannia for targets of 6,000.
FMCG, Britannia in focus for Mitesh. Gentlemen, thanks very much, both of you, for joining us at this point in time. I think so, surely, but slowly headed to the market open, which is again going to be a little quiet. And that has been true yesterday, has been true actually the last few trading sessions as well. Absolutely nothing on the Sensex, and I think very little on the Nifty as well. Although names like Gokuldas, etc., which we highlighted with our research team in the morning, are higher, 4-5%. Will they, will those rates? Okay, it's almost 7% now on Gokuldas exports. I mean, that's become kind of the go-to stock to express a view in terms of what's happening with textiles. Apparels actually is what Gokuldas does, and US, of course, is the single largest geography into which bulk of its products really go into. So
just one more stock, Prashant, I wanted to highlight as we get into the open is Titan. Titan's talking about roughly, I think, 18% jewelry growth for its 18% growth for its jewelry business. When the smaller players are still growing, right? Senco, Kalyan, they're still talking 25% plus kind of growth. So this is also something that the market will have to perhaps contend with. And big stocks like Titan, market always wants more, perhaps.
Absolutely, and I think the 2.5% cut shows that. We'll sort of address some of this with our market master who tracks consumption pretty closely. Gautam Duggad will be joining us in just a bit. We'll do market open, then go across to him. So we have the first rates which are starting to come up any time now. Indices first, and of course we'll look at specific stocks, etc. Yesterday, of course, was all quiet except maybe FMCG as a space. So there you go. Nothing very much. 25,444 on the Nifty. The Nifty Bank is just sort of settling down, but that doesn't amount to very much. At least the open 57,000 flattish open there. You've got the Midcap index, which is up down 50 points, 60 points, 59,455. And the small cap index, which will come up on your screen as well. And they're about a 20-odd point change. So again, it's absolutely flat. A little high, skewed to the positive side, the advanced decline. So 1,050 higher out of the gates, but this will change 600 stocks lower. Yesterday, the market breadth was negative. Numerically, the number of stocks, if you just looked at what was up and down. Heat map, more down than up, but not a lot. So 25,446 is where the Nifty is starting at, about 13 points, 15 points lower. Surabhi.
Okay, Titan is not sparkling this morning. Look at the cut on the stock. It's almost 4.5%. That is the big news and the big mover of the morning. Titan, the issue being this 18% growth in the jewelry business, the market is not happy. And some of the notes are pointing out that the base was also relatively lower. So on a lower base also, if you're not delivering faster growth, then it's a problem. So that's the one big headline. Other than that, on the weaker side, some pharma names, Dr. Reddy, Cipla, Sun Pharma. So pharma is a little soft this morning. These stocks are down about 0.5% each. There is some weakness on ICICI Bank, on L&T, on TCS. These are some of the heavyweights which are all dragging on the lower side. But now let's see what's up. Kotak Mahindra Bank reacting very well to its Q1 updates. Kotak is the best stock on the Nifty this morning, 3.5% higher. Tata Motors actually reacting positively. Perhaps, the market taking that JLR weakness in its stride, not as bad as expected. Eternal, ONGC, Wipro, and Geo Financial Services. These are some of the other stocks moving. But with all of this put together, Nifty is moving a grand total of about 13 points at this time. 13 points lower this morning.
All right, there should be a couple of stocks, though, that are in focus. J&K Bank, that's one of the big volume gainers this morning, so that's doing pretty well. Titan, as you said, was under pressure, but it seems that on PN Cargill, at least the start is in the green. The retail segment revenue growth has been closer around 19.5%. So, that's doing a relative outperformance, is up 1% or thereabouts. Phoenix Mills, well, a mild green tick is what you're seeing. The quarter-one consumption is up by close to around 12%. And the occupancy as well at around 89%. Nectar Life, that's the one that's the big loser this morning. We've got that announcement that came in earlier today, they'll be selling their API formulations and menthol businesses for around 1,290 crore rupees. For the time being, I'm not sure whether it's valuations or the street doesn't like that deal or it ran up ahead of it. But that stock is clearly one of the big losers this morning, down close to around 15%. And aggressive selling is what we're seeing on this front. But the sector of the morning has to be textiles. Gokuldas exports flying away up 5.5%. Welspun India as well, more to do with the tariff news that came overnight rather than the Wimbledon tulls. So that one, in fact, has also opened up well in the green this morning. So that's, I think, the sector to watch. Let's pull up a couple of paper stocks. I think JK paper should come up for you. These stocks actually had a big run in Friday's trading session. I'm not sure whether they're doing too much this morning, more or less flattish as we speak. So,
I just wanted to point out Kotak Mahindra Bank as well and just revisit those numbers. When look at the growth, scintillating growth from Kotak Mahindra Bank in the first quarter, 14% up on advances, 14.6% up on deposits. The CASA ratio has been improving as well and 4% higher. So wherever there's growth, the market is willing to take up notice and salute the stock. That's what Kotak seems to be looking at today.
Well, that's Kotak Mahindra Bank. 22.31 is where Kotak is at this point in time. Gautam Dugar is with us, Head of Research, Institutional Equities at Motilal Financial Services. Gautam, welcome to the program. Good morning. Thanks very much. Prashant this side. Let's just start with what we've been talking about since last Friday, which is consumption, FMCG, but consumption broadly. And many have been sort of on the sell side pushing this theme, but it's not worked yet. And maybe it worked yesterday. It's been fleeting, to put it mildly. What is your sense? There are lots of factors aligning, and I think we know all of them. Perhaps this GST rate realignment, that 12% slab, perhaps will also help along with everything else. But what is your view? Will this part of the market make one money? And where exactly?
Hi, Prashant. Good morning. Thanks for having me. So when you talk about consumption, it subsumes so many sub-segments that it's very difficult to take all of them and paint them with one brush. So what has been happening over the last few years is that the low-ticket consumer staples has been struggling. And they've been struggling for the last 3, 5, 10 years, not a recent phenomenon. Of course, it got broadcasted more recently. But if you look at the last 10-year compounded sales, growth of many of these consumer staple names, hardly one company or two company at max, if you stretch, would have done a 10% top line CAGR. And I'm talking about top line, not even volumes, right? So, and of course, the last 3, 5 years have been very, very tepid. In fact, I won't be surprised if there are many stocks you will find which would have given zero returns on a 5-year basis. Like the bellwether stocks have done nothing. So what has actually happened is within the consumption space, the higher ticket discretionary goods, they've done far well. And which is where our stance has been for last 4 years now. And we are continuing with that stance. In fact, yesterday when we published our strategy preview for this quarter, we've made consumer staple weight 0 in our model portfolio. We had a single stock as it is, that also we've removed. So all our consumption allocation in the model portfolio now resides in discretionary. We feel as we move from $2,800 per capita to somewhere close to $3,500, $4,000 over the next 4 to 5 years, the alpha that you will generate in consumer discretionary stocks will be far better than consumer staples. In fact, consumer staples volume growth, there can be some episodes of few quarters where the volumes might go up to 3% or 4-5% here or there. But from a slightly longer term perspective, I think the alpha and the absolute returns that you can generate in discretionary will far outweigh what you will get in staples. Having said that, staples will obviously provide downside support in a volatile market when market is in a corrective phase. But I don't think we are building portfolios for those kind of markets. So our stance remains intact. We prefer consumer discretionary or consumer staples.
Got that. Gautam, hi, morning. Great to have you on. I remember that in your model portfolio, I think Titan is a stock that you've liked for a long, long time, right? Yeah. Now, when we talk discretionary consumption, even there, the market is hungry for growth. And say, for instance, I mean, if you just talk about the jewelry space, there are other companies, smaller companies like Kalyan and Senco. They're managing to grow at 25 or 30%. But Titan, I mean, at least this quarter, they're talking 18%. So what is happening with this industry bellwether? Is it just a temporary sort of realignment of sorts? Because the market's mood changes very quickly. And we're seeing some of that play out this morning itself, that they're hungry for growth, they might as well go for tier 2 jewelry stocks. What would your advice be to investors in this sort of situation? Trent is another classic example, right? Great company, great pedigree, but from a 50% growth rate, now they're doing 20%. And we remember how badly the stock was punished. So how should investors think about some of these high pedigree, marquee leader stocks if the growth rate starts tapering down?
So, Surbhi, just 2 points. On Titan, the size of Titan versus other jewelry players is 5 to 6x on revenues. And in some cases, even 10x maybe versus the smaller companies that you mentioned. So obviously, if those companies are growing at 25-30%, Titan's 18% is very respectable on that size. Plus, also remember the fact that 1Q FY26 jewelry prices, gold prices versus 1Q FY25, the underlying gold price inflation itself is more than 30%. So clearly, there is going to be some impact on volume here or there. Third, the sector's size is $80 billion. And sector over the last 10-15 years has been very consistently and gradually transitioning from unorganized to organized, which augurs very well for all the organized players. And of course, Titan being the bellwether leader of that industry will stand to benefit the most from it. The reason why we are positive on jewelry and not just Titan, some of the other names like PN Gargill, etc., is the fact that the size of the industry, the TAM, gives us confidence for a very long runway of growth visibility. Today also, organized is hardly 40 or 45%. And if you go by the demographics of India, which we discussed extensively in your last Friday's Editors Roundtable, we have a very young demographic where wedding will continue to happen. And out of the 650, 700 tons of annual demand of gold in India, around 55 to 60% is wedding. So this industry offers tremendous growth visibility, of course, with a lot of intermittent volatility, depending on how the underlying gold prices behave. So we remain very, very positive and constructive on jewelry. Titan has been our long-standing top idea in not just jewelry, but overall consumer discretionary space. And our view has not changed. Coming to trend, that is where we've had a tactical positioning change in our model portfolio now. We've replaced trend with Jubilant FoodWorks. As you rightly said, for a company which is trading at 110, 120p, there's absolutely no room for error. I mean, if you view it in isolation, 20% growth on top line for trend looks very, very respectable compared to what the peers are printing right now for last 2-3 years. They're struggling to grow even at 8-10%. But the fact is, trend trades at triple-digit PE. So expectations embedded in that stock price were of 25 to 30% top line growth on a minimum, right? So therefore, 20% growth will look like a dampener vis-a-vis the valuation that it is commanding. So we think that it'll take a couple of quarters, and more importantly, not just the growth. We were a little bit surprised by the store additions for the quarter. Maybe there's going to be a bunch up, and obviously, whatever the annual targets are, they generally don't tend to be linear, more non-linear in nature. So story remains very intact. If I were to take a call on 3 years, there is absolutely no doubt that trend will form a very respectable allocation in my portfolio. But from a near-term tactical 3 to 6 months perspective, we think there's going to be more time correction that is that trend might see.
Interesting. So, Trent makes way for Jubilant FoodWorks. That's quite interesting. Sorry, 10 seconds. I'm taking from Nigel's time, but just 10 seconds. So, Jubilant FoodWorks, I mean, QSR, is that the only stock, or overall have you turned very positive on QSR? Quick 10 seconds, and we're going to move on to other sectors.
So QSR has a very favorable base, plus incrementally, we think urban consumption is about to revive for a variety of factors that you already mentioned. And that's why Jubilant, being the only company with great market share, excellent delivery on cash flow, and a strong balance sheet, we think it's a small sector ultimately. You can't have too many stocks of QSR space in the model portfolio. So we chose the best one that we thought.
All right. Hi, Gautam. Good morning. Good to see you. And as always, let's talk about earnings then. Earnings season is going to be upon us in the next few days. Results will start trickling in. Q4 was great, actually, because expectations were so weak and then muted. And then suddenly, in fact, it looked better than expected. This time around, in terms of earnings growth, what are we factoring in? And for the year, what are you looking at in terms of Nifty EPS growth?
Good morning, Nigel. So yes, you rightly said, fourth quarter was the best quarter of last year in an otherwise very tepid full year FY25, which turned out flattish after 4 years of 20% plus earnings compounding in Nifty and close to 30% earnings compounding in Nifty 500. This year is looking much better compared to FY25 for a variety of factors. Government, RBI, lot of things have come together and they've given a lot of pro-growth measures, be it rate cut, liquidity, income tax cut, monsoon is good. So we think FY26 earnings will be far better. We are working with an assumption of close to 11-12% earnings growth for full year. To begin with this quarter, we are expecting 10% earnings growth for our coverage universe and about 5% for Nifty, which essentially means that as we progress into the subsequent quarters, and because we always prepare 4-quarter breakup right at the beginning of the year, the next 3 quarters we are building in about 13, 15, and 16% growth for our coverage and 6, 12, and 15% for Nifty. So as we progress further in FY26, I think the news flow around earnings will turn far better. Second, a lot of sectors are contributing. Last few years, we have gotten used to few sectors driving the growth. The interesting thing in FY26 and more particularly for 1Q FY26 is that the smaller sectors, which have hitherto not contributed much to the earnings growth, they are joining the party. So sectors like cement, sectors like retail, they are coming and printing more than 20% kind of earnings growth this quarter. Whereas the bigger sectors, auto, BFSI, IT, pharma, consumer durables, they're still struggling in that 4 to 8% kind of growth band right now. We expect financials to become far better as we progress in second half. The benefit of rate cut and surplus liquidity will start manifesting in their numbers from second half. So net about 10% earnings growth to begin with for this quarter for our coverage universe.
Talk about some 50% upside stocks, Gautam.
And 25%.
And by the way, I'm not joking. I'm serious.
So I'll give you an option: either stocks with 50% upside or stocks with 25% earnings growth. I'm making it very simple for him, right?
Absolutely. So I'll choose Survi's question then. That's far easier. 50% upside stocks generally, Prashant, are known in hindsight. Just like
you give us 25% earnings stories, they'll give us 50%.
Absolutely. That's why I've chosen the easier path. Look, there are sectors like cement, EMS, where we are expecting very strong growth this particular year. Cement has struggled for last 2 years, and we are expecting pricing to improve. EBITDA per ton to grow 30% this quarter. While stocks may not have corrected much in FY24-25, despite very tepid earnings, but as you start seeing print of better earnings there, and of course, the underlying macro on consumption, capex spending by government has also given a bit of a hope if you looked at the March and April number of government capex data. So cement clearly looks like a good bet. Second, EMS, there we are continuing to see not 25% but 50-60% earnings growth. Very difficult to find this kind of stocks in other sectors given the environment that we are living in. So if you look at it from a very top-down perspective, Prashant and Surbi, we are slowly transitioning into an era where the nominal GDP growth itself will settle at 9-10% band now. Because you've gotten a control over inflation. We are talking about 3.5-4% inflation and roughly 6.5% GDP growth. So nominal GDP, if it settles in 9-10% band, very difficult for corporate India to print more than 12-13% earnings growth in this kind of an environment. With that, of course, there will be a lot of stocks which will compound at 20-25%. There are stocks in retail sector where we are seeing more than 25% earnings growth for FY26. Then there are some pharma names, some consumer discretionary names, obviously, that we discussed about. So there are many stories out there for bottom-up stock picker and asset allocators to find that.
You mentioned Jubilant Food, Gautam, out of the just completely published, nothing non-published, out of cement, EMS, etc. Which are those names?
So for example, in EMS, we are very hot on Dixon and Kate. Both are there in our model portfolio. So they have benchmark 0 allocation in the benchmark indices. We have 4% allocation, right? In discretionary, as I was discussing with Surbi a few minutes back, we have Titan, we have Indian Hotel. They've been part of our model portfolio for many years now. We have Page, and we've added Radico Khaitan. Again, very strong earnings growth there. Last 5 years, they've compounded earnings at 35%. Next 3 years, we are expecting 25% plus earnings CAGR. That finds entry in our model portfolio. And of course, we have Page also. So there are a variety of names. In fact, Prashant, while at it, I must also mention that we have increased the weight on mid-caps after a long time in our model portfolio. So till April, we had 76% allocation to large cap. We have brought it down to 69% because the mid-cap earnings are looking very strong. Last quarter, our mid-cap portfolio of 93 stocks delivered 26% earnings growth or 22% earnings growth. This quarter, again, we are expecting 21%. And as we progress for the rest of the 3 quarters, our expectation are 10, 25, and 20%. So mid-cap earnings are outperforming large cap by a margin of 2x. And therefore, while we keep debating on valuations, and valuation premium is there, everyone can see it, and it's been there for more than 3 years now. If this kind of growth continues, it's very difficult to imagine that that premium will.
And what are the new additions on the mid-cap side, Gautam?
So there are quite a few additions there. Jindal Stainless is something we've added. UTI AMC is a new stock. As I mentioned, Radico, Jubilant, they are new additions. We've added Lodha, Macrotech basically. We've added Niva Bupa. So quite a few allocations, new allocations. And of course, we've also gone, we upgraded our stance on auto, like we discussed a few months back. That auto is offering you a combination of reasonable valuations and modest expectations. So while we have not changed our stocks in auto, we've increased the weight on both M&M and TVS, which were already part of the model portfolio. But auto moves from underweight to equal weight now.
Very interesting. So auto moves from underweight to equal weight. And that's largely because of your focus on auto ancillaries, or just expand on that? Because again, auto, for the longest time, like FMCG, has just failed to enthuse. FMCG, you're not changing your stance. You've explained that. Within auto, what are you turning positive on now?
So auto, we already had M&M and TVS in our model portfolio for some time now. M&M,
which have already done well, Gautam. But anything new?
We expect it to do better now. In fact, this quarter also, if you go into the details, you will find that out of the 26 auto stocks that we are covering, the two best performers for this quarter in terms of earnings growth will again be M&M and TVS. Rest of the stocks, Maruti, Hyundai, Tata Motors, Bajaj Auto, they will print a negative earnings growth again in this quarter, right? So we are quite lucky to have chosen the right stocks even when we were underweight on the sector. So you're not changing the stock calls per se. Insofar as auto anchors are concerned, we think Craftsman, Endurance, and Happy Forging are the names where we have a slightly positive bias. But the change in stance in auto is primarily dictated by top-down trends where valuations are still reasonable, expectations are modest, and underlying trends on monsoon, income tax cut, inflation, all of them are giving a signal that at some point of time in next 1 or 2 quarters, things will start looking better for auto. So we are positioning for that.
Very quickly, Gautam, no conversation on the market can be complete without discussing defense, right? And the next company that we'll be speaking to is Astra Microwave from that sector. So just very quickly, your thoughts. Prices have run up, but the order books are coming. Big order announcements are still coming. What's your advice to investors on defense?
We continue to like it. In fact, we've added Bharat Electronics now in the model portfolio in place of ABB. We also like Hindustan Aeronautics. The problem, however, is the stocks have run up too fast. What was our target price when we initiated HAL in March for 12 months was achieved in 1 month. In fact, as we keep highlighting this, the total market cap of defense went up from somewhere about 1 to 9 lakh crores in a matter of 3 years. July 24 was the peak. Between July 24 and February 25, it came down by 35%. And then between February and June itself, it recouped all its losses and crossed the all-time high market cap. Right. So opportunity is tremendous. The focus of the government is there, and kind of geopolitical turmoil that we are seeing in the world. This sector will definitely merit attention. Just that one has to be patient and shouldn't expect a quick buck here. So if one has a 1 to 3 year horizon, I think we can still make money here.
But long term, yeah, don't look at quick gains because that
valuations have gone up substantially over the past 3 years, and more so post Operation Sindoor and rest of the geopolitical events that we have seen unfolding in the last 3 months.
Absolutely. So a little bit of caution perhaps warranted. Great conversation this morning, Gautam. Thank you so much for joining in. So we are, all excited for the earnings season, and the expectations are that this is going to be a good one, and maybe we get out of that single-digit growth funk that the Indian market has been in FY25. Well, let's then continue that focus on the defense sector. Astra Microwave is the company on our radar. So let's figure out what the business prospects are looking like. There's a huge increase in procurement. They, of course, look at the space segment as well quite carefully and closely. We have Mr. Atim Kabra, Director Business Development and Strategy at Astra Micro, joining in. Mr. Kabra, great to have you on. So I just want to start with the focus on the defense part of your business. Just last week, we've got another big headline announcement, right? That the Defense Acquisition Council has approved proposals worth 1 lakh, I think 5,000 crores thereabouts. So in the new proposals and the replenishment program that's ongoing for the government, Do you see any significant potential for you? Because you've told us, I mean, I'm just repeating, your FY26 revenue target, I think, is about 1,200 crores, which would be roughly 20% growth. Would you look at increasing this estimate, given the pace of replenishment that the government is speaking of now?
Hi, good morning, everybody. Good to be back. I think the government has done its part. Now the industry has to step up and deliver. A delicate balance has to be maintained between timely deliveries in an industry which has slightly longer life cycle, and homegrown tech supplemented by outsourced pieces which are missing tech pieces. So our numbers will go up, obviously, as the orders from what has been announced flow down into the picture. And but more or less, the larger programs which have been defined, they are already taken into account in our estimates. But we will add them to our order book as the orders are translated into reality.
So as of now, you're not looking to increase your estimates for the year. That's 1,200 crores of your revenue target. FY26 order booking target is around, I think, 1,400 crores, if I have the latest numbers. You're not looking to increase those numbers?
The announcements have to result in the orders flowing down to the the customers, and in turn they will place orders onto us, right? And these are slightly longer gestation projects, so it takes time to actually for the cycle to flow down and translate into real numbers.
No, fair enough. But what the DAC announced last week, this was last Thursday, Friday, where they're talking about quick reaction surface-to-air missiles, all kinds of other, systems and subsystems.
Yeah.
So what is the opportunity size for you from that huge number of 1 lakh crore that was announced?
When we talk about, for example, QRSAMs, right? QRSAM, Astra will get about 1,800 to 2,000 crores, which we have disclosed in our analyst interactions. When you look at newer missiles coming in, if you have passive homing heads, which we are making, we are into missile electronics. Akash missile has been, we have supplied crucial subsystems to that. So space allocations, as you touched upon, right? Okay, there's in-space tender, which I think there are 4 or 5 consortiums which have bid for us, and we have bid. We are part of one of the consortiums. So these are all big picture programs which will translate into numbers as we go forward. So the order book will be increased in actual numbers as the orders are booked into the company. These are announcements of allocations which have been made right now. So,
all right.
Yeah.
Mr. Kabra, just to reconfirm on the quick reaction surface-to-air missile, the potential order that you'll get is how much? And the order will come in from BEL, right?
Yes, please. We will get between 1,800 to 2,000 crores. That's our estimate on the QRSAMs.
And
supply chains need a lot of time to be perfected, right? So these are all things which allocation is made. Then the BL, which is the main agency for this, they will in turn now intimate their suppliers, etc., etc.
All right. And by when do you expect this to come about?
I think could be last quarter of the current financial year, or maybe spills over into the next quarter of the next financial year, first quarter of the next.
When you talk about an opportunity of 1,800 to around 2,000 crores odd, your current order book itself is closer on 2,000 crores, which would mean that effectively your order book could double. So the execution timeline for this particular quick reaction surface-to-air missile, to which the order will come from BEL, the execution period will be how long?
3 to 4 years, I expect.
All right.
Yeah. The tech curve now is very steep, right? And it's the short end of the time scale. So we expect that more and more such programs will be coming up, which have a very crucial tech element. So where there's a huge barriers to entry for people who are not part of the supply chain or the development cycles. So we are fairly well placed.
So this is very, very significant, Mr. Kabra. What you're telling us is that almost 2,000 crores of orders could be flowing into you by maybe end of this year, if not early next year.
Yes.
Very, very significant. And this is just the QRSAM program that we've discussed.
Yes.
What about, say, radar systems, unmanned aerial vehicles, other aspects of defense where you're active? What else is happening there?
See, it's basically the war is now tech-driven. The government has done its part. Industry has to step up. We are talking about, do we have the complete tech elements built in from A to Z, right? So there has to be assimilation of the missing pieces of tech which have to go in, and it's not about just modules which are being procured and put together, right? So you have to go down to the base components wherein you will actually break up the products, the tech pieces which you are maybe outsourcing and procuring from outside, add them to what you have and create solutions and products, right? So this is an ongoing exercise. There are a lot of programs which are coming up, but as and when they are adopted, the airborne platforms, all the fighter planes are being upgraded.
No, again, we were sorry, sir. I'm rushing you, but because our next guest is also waiting. But we were again just trying to understand the opportunity size for Astra in particular. So obviously, this QRSAM program is going to be massive for you over the next year and a half.
Yes.
Apart from this, when you talk about other defense components on the electronic side, on the radar side, are you expecting any other, big orders to trickle in? What else could be a contributor to your defense revenue?
If Atmanirbhar Bharat prevails, if the DRDO designs on, let's say, Su-30 plane upgrades, if they prevail over other technologies on offer, then Astra is very much a part of the Virupaksh radar program. Okay, so we hope that itself will be a very, very big chunk of business for us, because there are more than 230 Su-30s which will need to be upgraded. So if there are MiGs which need to be upgraded, so airborne platforms are one. Radars are the backbone of modern warfare, as you very well know, right? So there are multiple radars which are being constructed at this point in time at various stages. You have triple LWR, the low weight, long range, triple LWR. These are the radars. Bird detection radars are in the offing. The counter drone radars and
what could be the potential business opportunity, sir, from this?
It's very difficult to put a number onto it.
Want to put a guesstimate?
These are all programs which will contribute substantial chunks of business every year. 300, 400 crores coming in lots every year, right? As you look at that.
All right, Mr. Kabra, very quickly before we let you go, everything's looking good from 1,200 crores. Probably in the next 3 years, you could do 2,400 crores. Probably double your revenues. Margins could be healthy as well. So give us a few numbers. In the next 3 years, where do you see your revenue move from 1,200 crores in this year? Where do you see it move? But more importantly, I wanted to ask you about your working capital days. That's got stretched very much. Cash conversion is very, very high. Tell us whether these numbers stabilize at, sir. Please go ahead.
The industry is capital intensive, right?
Yes.
There's no two things about this, right? But you have to also remember that the biggest chunk of orders, they are released in the last quarter, right? So
yes,
you may do whatever, but those orders will always reflect in your books as receivables, right? So as your sales grow, your receivables will keep growing. Right. So the year-end number of March 31st is a function of the fact that orders are released in bulk in the last quarter, right? But capital-intensive nature of the business is there and will remain. So if innovative ways of financing can be thought of, that's something which will ease. But otherwise, this is GOI credit, right? Okay, the banks should be more than happy to finance this. So we are not looking at this being a concern, but we need to manage our books very judiciously, the cash flows.
Okay, all right. We'll get into further detail when you declared your quarterly numbers, sir. For the time being, though, the street likes what you've had to say. The stock actually has moved to the high point of the day. We look forward to having a longer chat with you, Mr. Kabra. Well, let's focus on the consumption space. FMCG stocks are showing an uptrend as green shoots are becoming visible in consumption. In fact, FMCG companies have come out with fairly positive Q1 updates. So is demand recovery here? And what are the trends visible inside? To help us out with that, we're joined by Mr. Mayank Shah, the Vice President at Parle Products, as well as Vishesh Dora, the Chief Growth Officer at Bizoom, who joins us. Hi, gentlemen. Good morning. Thanks a lot for joining in. Mr. Shah, you go first. Tell us, how are you reading demand on ground? First of all, break up your mix for us between urban as well as rural. How is consumption on ground? And are you seeing a good revival?
See, firstly, if you talk about the contribution of rural. If you look at our product range, almost about 55% of our turnover comes from rural. So in terms of our stakes in rural, we have a substantial stake in, rural India. As far as consumption is concerned, we are seeing, good demand coming in from rural as well as urban India. So as we all know, last year was a little difficult one for FMCG and urban demand was under stress. But thankfully, we've seen revival happening in the first quarter of this year, this fiscal, and we've seen, urban demand reviving. We will see, further revival of urban demand as we go forward. And rural continues to be, strong. So we continue, we see continued strong rural demand. Given, both urban and rural good demand, coming in, we're expecting a good year this year.
All right. What would good be, Mr. Shah? What is the industry growing at and what are you growing at? Have you gained market share?
Yeah, we gained market share last year. Last year, if you look at the industry grew at about 5 to 6%, mid-single digits. We grew at high single digit at about 8 to 9%. And that, gave us almost about 80 to 90 basis point increase in market share. If we talk about this year, current year, we're expecting, as far as the category is concerned, at least a lower double-digit growth. We are expecting at least 12-13% growth coming in, despite of, the challenging, situation as far as the input costs are concerned. So, if we talk about crude, we've seen, spike in crude, although it's gone down now, but some challenges remain. So, given, last year was difficult as far as input costs are concerned, there was, for the most part of year, it was very inflationary. And if that sustains this year, then, that would be one challenge that we would be facing almost all food companies or almost all FMCG companies.
Guys, guess what? We could do so with some biscuits here to go along with the chai right now. I think,
consumption.
Well, a hint to the PCR team. Maybe. But gentlemen, thank you very much for joining us, Mayank and Vishesh. I just want to, Prashant here, I just want to ask both of you this one question. Many have made the point that actually it's not consumption which has been weak. It is just too much competition across product categories. An intensified competition, especially over the last 3 or 4 years. Mayank, would you agree with that? Or you think it's a combination of both? Or it's basically, we're talking about different categories. So, in some categories that could be the case. Others, consumption itself has been very low. What would you make of it?
That's partially true. So, regional companies are growing, smaller companies are growing, and they're definitely giving, run for their money to the bigger companies. However, if we talk about Indian market, I think, in terms of penetration, in terms of per capita consumption, I think we have a long way to go up, and that's something that, probably is the reason why you'd see that, most companies are very optimistic when it comes to, capex and other things. And not just that, even in terms of, growth and consumption, we're seeing a continuous increase and a continuous, growth coming in as far as, certain categories like foods and, few other categories, adjacent categories are concerned.
Okay. Vishesh, same question to you.
I think
yeah.
I think largely great products are winning is what we've been seeing for the past couple of years. Of course, consumer sentiments are moving towards different kind of products. Distribution, of course, is a key node to win the market, but great products are taking the forefront. When you talk about, is consumption lagging? I don't think it's lagging. It's continuously growing. And we've been seeing great indicators of it, especially in urban. Right, large pack consumption is growing, out-of-home consumption is growing. Your smaller packs are not growing that well in urban. Premium categories are penetrating deeper, right? So urban market is set for a great revival of consumption is what we see.
Morning, gentlemen. Vishesh, particularly want to address this question to you. The big debate that's out there that says that really D2C has disrupted perhaps structurally, that huge distribution moat that a lot of FMCG companies had enjoyed, especially I think in things like personal care, right? where consumption is happening through your Instagram and ordering is happening through that channel or through, the quick commerce sites. What would you say to that? I mean, the effects of quick commerce and the way we will see volumes play out and just competitive intensity play out in the staples space.
I mean, if we still compare the vastness of the nation, D2C is still early in penetration. It will truly lie on how they scale offline. Online penetration of e-commerce is still, lower single digit, if I may say so. Right. So we are seeing that impact in urban, where great products, again, like I mentioned, are winning. Young brands who are investing into consumer-centric products. What we also see on the other side is large brands also adopting faster, bringing in or entering into categories which are D2C heavy. But all in all, you have to be offline if you want to penetrate deeper into the Indian market.
All right, Mr. Shah, coming back to you then, if you could tell us, what is your absolute market share? You said it's improved by 80 to 90 basis points, and if you could mention the category as well.
Yeah, so as far as biscuits are concerned, we have about 29% market share. And if we talk about confectionery, which is also another mainstay that, we have about 15% market share. Within snacks, we have about 7% market share.
All right. And what about quick commerce? Has it affected your channel strategy? If you could tell us, how much does it contribute in your overall share, quick commerce?
Quick commerce contributes about 4.5% to our, total revenues. And I think, as Surabhi was just saying, or she was checking, I think, that's one channel that is making a huge difference. So while, you talked about D2C is, good for niche brands, very premium brands. But when it comes to, value brands, or when it comes to, categories which are deeply penetrated, I think, the last mile delivery cost is something that's prohibitively high in India for most D2C brands to, really succeed. I'm talking about, value and mid categories. In niche categories, yes, you can do with that. Whereas when it comes to QCom is something that, when you aggregate it and when you have aggregators, it makes a huge difference. And if you look at the growth rates in QCom, we are seeing, almost about 40-50% plus growth rates year on year since last almost about 3 to 4 years in QCom.
Okay, so gentlemen, as we wind down the discussion, we'll be happy to report that I think the Kirana channels are strong and they're thriving for most of the players because we've got our biscuits. Prashant, demanded, and it has been delivered
that makes
right in the time in which the discussion is on. And this is not Q-commerce. This is a regular, general trade channel delivery, and it's working.
Since it's appeared so fast, I'm thinking, what should I ask for next?
Don't push it. We have to be satisfied with what we
I'll tell you in the break.
All right, gentlemen, thank you very much. Mayank and Vishesh, appreciate both of you coming in. Very interesting discussion, and hope we can do more of this to get a real sense, a pulse of what's happening on the ground across, a range of topics, really. We'll come back in just a bit from now. Our special segment, Quarter Se Quarter Tak. Kawaljit Saluja of Kotak Institutional Equities will join us to talk about expectations from the IT space that's coming up. Stay tuned.
Welcome back. Well, the next sector that we're putting the spotlight on is the IT space, and that's because it is time for the earnings season, and we are back here with our segment Quarter Se, Quarter Tak, bringing you expectations from each sector day after day. Well, Rima kicks it off, of course, with the IT earnings. Rima, so is there any good news in store first quarter, FY26?
Well, unlikely. So you're not going to see the usual strength that we typically see in Q1 because so far the visibility on demand reviving is very low. So let's look at the early indications from the CNBC-TV18 poll. Well, large caps are showing weakness while mid caps continue to lead the charge. This is a large cap picture, and as you can see, 4 out of the 5 large cap IT companies are likely to report a decline in their revenue. Commentary across the board is likely to reflect that while the macro environment hasn't improved in the last 3 months, the good part is it hasn't deteriorated. Now a little bit more about the guidance. Now, Infosys is likely to raise the current guidance. It stands at 0 to 3%, but they made acquisitions, and therefore that guidance could be upped. If the lower end of the guidance is raised from the current 0 to 1%, it's unlikely to signal anything positive. It's the upper end which needs to move on an organic basis. Now moving on to HCL Tech. HCL Tech too could upgrade the lower end of its guidance. So 2 to 5% may become 3 to 5%. But here is where the good news comes in. Mid-caps are likely to outperform and very strong growth. Look at Coforge. That's been leading the charge in the mid-cap space, and we're expecting about a 6.5–7% kind of a constant currency revenue growth on a quarter-on-quarter basis. Persistent is close to about 3.5–4%, and that's been the revenue run rate, at least quarterly growth rates for Persistent over the last couple of quarters, 3–4%. That's going to continue. Hexafair and Mphasis also upbeat. So mid-caps are likely to report stronger growth, and this is led by some market share gains and favorable portfolio. For instance, a few mid-cap companies have a little less exposure to manufacturing. So that's the key, takeaway. Large caps weak, mid-caps will continue. Now moving on to the stock price performance. As we've been highlighting, mid-cap IT has underperformed. On a year-to-date basis, the Nifty IT has underperformed by nearly 17%. Valuations for large caps are similar to their 5-year averages. But then again, they've got muted revenue. Earnings growth is expected to be fairly muted for the large cap IT companies. So in that context, even if the valuations are not expensive, are they cheap? It's the mid-caps where you are seeing a valuation premium. Now, the mid-cap IT companies are trading at 32–33 times PE on an average, much about a 38–40% premium to large cap IT, which is at about 23–24 times. But that's because the mid-cap IT companies are also likely to report stronger growth. With high valuations are coming strong growth expectations. So this is the EPS estimates for mid-cap IT companies over FY25 to FY27. We spoke about Coforge's strong top-line growth this quarter of 6.5%. Well, they're likely to report a 38% EPS CAGR growth over FY25 to 27%. Hexafair Persistent could see about a 20% kind of growth, much higher than the single-digit EPS growth that large-cap IT companies are going to report. Now, what to watch from TCS, because that's the first one off the block on the 10th. Well, constant currency is likely to decline by 1.5%. The what to watch, the company last quarter told us that the international revenue growth, that's ex of BSNL, in FY26 is going to be better than FY25. Do they hold on to that? Does that commentary get stronger? And one puzzling factor for all analysts is that, margin expectations are not going up. And this is despite reduced contribution coming in from the low margin BSNL deal. So why is that not happening? Why are margins not expanding for TCS? And also, if you remember, last quarter, they decided to defer the wage hike. So the timing of the wage hike will be watched very closely this time. Back to you.
All right, Rima, thank you very much for that. So very, very good explanation as far as the IT sector companies are concerned and what to expect. Coforge, top of the list. I remember Coforge last quarter as well. I think the stock moved 8–10% after earnings. Expectations are equally strong this time around as well. Kawaljeet Saluja is Senior Executive Director and Head of Research at Kotak Institutional Equities. Kawaljeet, good morning. Great to have you with us here. Thanks for your time. So let me just get straight to the point. In terms of stocks that you track the entire gamut of companies there. But with regards to exceptional performers in a weak environment, it's very, very clear. It is, 2–3 of these mid-cap companies. Why is that, Kawaljeet? And, can some of the larger players start to do this as well? What would you be focused on?
Large companies may not replicate the strength shown by mid-tier companies. They have a few things working in their favor. First and foremost is the portfolio mix in itself. As Rima did highlight that many of these mid-tier companies do not have manufacturing and relatively modest exposure to retail. So that will help their growth in the current environment. Second is that they have the benefits of lower size as such. And third is that they can use Gen AI in a lot more proactive way rather than think about the deflationary risk to the portfolio. So as long as you have the right leadership and these mid-tier companies, it's reasonable to expect that they'll outperform some of the larger companies as such. Large companies, of course, again, they have a portfolio challenge in the current environment. And of course, there's some deflationary risk of Gen AI that they have to take into consideration. So this divergence in the performance would continue.
Folks are just pointing out sometimes brokerage notes can have very interesting titles or even stocks. I remember Nomura's note, categorically from last week, they called out Tech Mahindra as a marquee sell. Like marquee, I thought would be something which would be, positive, saying a marquee name or whatever, but it's a marquee sell. But anyway, I think Kawaljeet actually likes Tech Mahindra. Kawaljeet, hi, morning. So that brings me to the overall question on large cap IT, because you still, like stocks like Infosys or TechM. What's the reasoning? What's the rationale? Because the companies, to be fair, have been disappointing investors on growth for a long time. And even in Tech Mahindra, that whole improvement of the margin trajectory, that seems to be just taking really long.
Well, I think they had outlined FY27 as the year in which they are going to get to 15% EBIT margin. I think they're pretty much on track here. So I don't think what the concern should be. I think even in the current quarter, even though their revenues would be muted, they will continue on the margin expansion trajectory. In a turnaround journey, what happens is that, there's too much of emphasis on what happens in one quarter rather than the entire journey in itself. And if you look at Tech Mahindra, the kind of improvements they have, the changes they have made on the leadership, the internal process, the deal filter, the structuring of deals, the TCV, I think they're pretty much on the right track on the turnaround journey. And, that gives us comfort, on the story as such. Now, of course, if you're going to live by the quarter, then yeah, maybe the current quarter may be modest in terms of revenues. But again, you'll have a decent margin performance here. It's just that overall makeup, we have to basically look at it. We are pretty much comfortable with our...
Okay. That explains Tech Mahindra, but sort of the bigger question on large cap IT, there's clearly, you have conviction on Infosys, maybe not so much on TCS. Both the companies have not really blown the lights out in terms of growth. What makes you still optimistic, and why more Infosys than perhaps TCS?
I think it all boils down to a top-down view on what happens to the overall tech spending. Like, let's say if we take a directional view that tech services spending would remain weak, the way it is right now, then the pessimism on some of these large companies is justified. But I guess, if the assumption is that at some point in time, the spending picks up, which our belief is that it would pick up, given that there's a lot of core modernization, data modernization journey still left in the large, for our clients. And I think that's something which many of these large companies will drive. You can basically expect, a reasonable growth. So at some point in time, there'll also be an uptick in discretionary spending. Our assumption was that, things will start improving in FY 2026. Of course, that got scuppered with the tariff imposition, which means that, normalization of the growth journey got deferred by a year. So now within this context, what you have to look at is that which are the companies that are executing well, and which are the companies that can capitalize on the ensuing opportunities. And I think that's where our confidence in Infosys comes in.
Okay, all right, Kawaljeet, quick conversation today, out of time, and hope you join us as we review some of these earnings as they start to come in very soon. First on the block, that's the IT pack, as always. Kawaljeet Saluja at Kotak Institutional Equities. We'll take a quick commercial break here. What we're going to do is come back, take a look at what's happening as far as markets go, commodities in focus as well. Stay tuned. Okay, welcome back. Let's shift focus to what's happening as far as commodities go. Manisha is here with what is top of mind. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, I'm looking at metals as a sector because we've seen a decline continue across the street for a second straight day, by the way. The month of June was good, but July really hasn't started on a very positive note for many of these metals. Well, one is the higher US trade will take effect from 1st of August. Now, it just keeps getting stretched, so there's no clarity, especially when it comes to copper. We don't know whether it's going to be in the same line as aluminum and steel, which are tariffed by nearly 50% there. So that also seems to be bothering the copper prices there. Also, markets are grappling with steep tariffs. Letters from US have gone to 14 countries there. It also has to do with the US dollar index, which is holding at around 97.5. Also weighing onto the markets. Strong US jobs data continues to support the US markets as well. So all of that has led to money shifting into other assets, and base metal prices have seen a bit of a decline. Take a look at copper then, and pardon me. Take a look at copper prices, and we've seen $9,800 onto that one. We did see $10,000 a ton also hit in the previous week onto that one, but that doesn't seem to be holding at this point in time. The copper stocks, if you look at those, have seen a very sharp decline. They just start at around 97,000, and we have seen copper stocks drop by nearly 64% from mid-Feb. Even after that, the copper prices have not been able to sustain above $10,000 a ton there. And it's not just about copper. Take a look at aluminum, zinc prices. We've seen 2% of a decline for both of these metals for this week as well. Palladium prices have come off their 8-month highs as well. If you look at platinum prices, well, they fell 2% overnight and are off their 13-year highs. The kind of that phenomenal run that we saw in the previous quarter in platinum, where we saw the prices gain up by almost 50%, now seems to be consolidating, even coming off because of some profit taking. The speculators also seem to be winding on their long positions, and that's very clearly seen because of the fundamentals as well. We're looking at production in South Africa mines continue to recover. Above ground stocks stand at 9.2 million ounces, and that is equal to 14 months of above ground global demand. So all of those factors also weighing on. When you look at the week-on-week, month-on-month basis in sense of many of these metals, platinum, palladium, copper, aluminum, zinc, all of them have come off their multi-month and multi-week highs.
Okay, all right. Thanks very much, Manisha, for that. Well, it's commodities in focus. We take a quick commercial break here. On the other side, it's a special segment. It's the economy. Trump's shot off letters to 14 countries announcing tariffs. Lata will be speaking with Robert Subramanian of Nomura and Chandresh Jain of BNP Paribas and the impact of these tariff letters on economies, currencies, rates and more. Stay tuned.
Welcome to It's the Economy. President Trump's announcements yesterday are interesting. The high tariffs for the 14 countries have been announced via letters, which don't have the force of law, but the executive order, which has the force of law, has pushed the date when tariffs become effective to August 1. Asian markets have therefore taken the announcements calmly. Stocks are in the green. Emerging market currencies are also stronger versus the dollar compared to yesterday's levels, while, of course, US stocks declined and yields rose. So it was actually US markets which showed negative reactions. To get an idea of the longer-term takeaways from these announcements for emerging markets, I have with me Rob Subaraman, Head of Global Macro Research at Nomura in Singapore, and Chandresh Jain, Rates and FX Strategist for EM Asia at BNP Paribas. Gentlemen, good morning and thank you very much indeed for your time. Rob, how should we read Trump's behavior so far? The letters, again, sound like threats. They don't have the force of law. What has the force of law, the Vietnam agreement, was actually half of what was threatened. So should we assume that we will settle down at lower tariffs?
Hi, Latha. Good to be back. I think these letters that have gone out, countries like Japan, Korea, Malaysia are looking at a 25% tariff rate. I think several ASEAN countries, Thailand, Indonesia, and some of the frontier ones are looking at 30% or higher. But as you say, the date where they're effective has been pushed out to August 1. And I think the market is assuming that this gives more wiggle room for deals and potentially is another case of Trump escalating to de-escalate. So markets have reacted, I think, fairly calmly given these rates. I think for India, it's interesting that India did not get a letter. And I think that does suggest that a deal could be actually very close and could be potentially on a relative basis quite positive for India. The last thing I would say, Lata, is in all these letters, there was a clause around the tariff rate for transshipments. The tariff rates could be higher, and it does look like the Trump administration is starting to focus increasingly on China circumventing tariffs through third countries, and it wants to really crack down on that.
Okay. Well, somehow this transshipment may not be a very big India problem, except maybe for Apple phones. But separately, back at Nomura, have you all redrawn growth rates for EM as a whole or the world as a whole? Any specific country?
We haven't actually made too many changes. We have had the view for EM and particularly EM Asia that the export outlook is going to darken. There's been front loading of exports, particularly to the US, to beat higher tariffs, and we think there will be payback from that. The other, I think, key aspect of our kind of developed market forecast is that inflation is going to reaccelerate in the US. And I think the CPI report on the 15th of July is going to be extremely interesting. That is between now and the August 1 new deadline for the tariffs. And if we're right and core CPI reaccelerates for the month of June, that could actually throw a bit of a spanner in the works for the Trump administration, because if the tariffs are contributing to that, the leverage or that Trump will have to use tariffs could diminish if it's starting to show some negative effects on the US economy through higher inflation.
Fair enough. Actually, I wanted to start with Chandresh on the dollar, but since you have spoken about core inflation, Chandresh, good morning. Thank you for joining us. Let me start with yields. How do you US yields have kind of, that 4.5 seem to have been the peak. Where do you see the yields headed? There is, of course, the bill as well. And what do you expect Fed to do for the rest of the year?
Thank you, Lata, for having me on the show. I think the market in US is already pricing a lot of negative news in terms of yields. The bill has already passed in US. Market is aware what's inside the bill. So any reaction, negative reaction to the bill should have already happened by now. I think market now is focusing on what Fed does on the policy rate. Market is pricing about 2 cuts for this year and more cuts next year. But in our view, I think 10-year yield will most likely stay in a very tight range, closer to the existing level, but will slowly drift lower towards the end of year, towards 4.25 on 10-year, and next year maybe closer to 4 to 4.10 on the 10-year side.
Okay, and you're not penciling in any Fed cuts, therefore?
Yes, so BNP Paribas has been very consistent in terms of the Fed cuts. We have been saying no cuts for 2025 because we think the inflation in the second half in US will actually go higher on the basis of higher tariff numbers, which we are seeing right now. And therefore, Fed will want to remain on hold for the time being and only cut in 2026.
Okay. Okay. I'll come to you for currencies, but Rob, what's your sense about the India growth itself? The government and the RBI are working with about 6.5%. Does that sound optimistic?
It seems about right for FY26. We're currently at 6.2% growth. And we are expecting the RBI to cut rates 2 more times this year in September and December. I think the key reason for that is because we think inflation is no longer an issue in India. We think it's going to be below the midpoint of the RBI's target, so below 4% for this financial year. It's currently below 3%. This is a very good combination for India. Growth over 6%, inflation below 4%. I think there's room for the RBI to cut 2 more times this year, and that will also help shore up growth. Very positive on India. I think in the medium term, I talked about this trade diversion. I think if India does have a tariff rate ultimately of around 10%, US tariff rate around 10%, similar to the UK, that's a pretty good outcome relative to many of its peers. And India could become a magnet for multinational companies to set up for, you talked about iPhones, but I think there's a lot of room for toys, textiles, footwear, electronics more broadly. I think India is going to be in a strong position to become a bigger manufacturing hub if it turns out on the more positive side of US tariffs relative to many other EM economies, including China.
I want to take issue with that argument because of some doubts, but let me get Chandresh in on just the dollar and finish the dollar-rupee argument. Indian yields have never been this close to US yields. If you take the 10-year, less than 2 percentage points often, the difference between the two. Likewise, inflation rates, never have we converged so much with US yields. So your view on dollar, first of all, I mean, is 97 or 96.8, or does it drift towards, below 90? What's your thought? And dollar rupee as well.
I think we are in a general environment where dollar is heading lower. I think we need to understand why it's heading lower. There are 2 kinds of flows which are happening right now. One is the flow from the economies which are current account surplus, such as Europe, Japan, Korea, Taiwan. They are sitting on massive US assets in terms of US equities and in terms of US fixed income. So these countries are now trying to hedge their US assets and by selling dollar forwards. And that's why across these markets, if you observe, forwards are very low. A second flow, which is impacting DXY, is the diversification flow, where people are trying to think what else we can buy apart from US assets. So they're thinking about European assets, Korea assets, India to some extent, and China to some extent. Both of these will push dollar lower to some extent. In fact, we are saying that in the next 1 year or so, DXY may be lower another 3 to 4% from the current levels. Now, coming to your point on dollar INR, if we understand India, India is a current account deficit economy, very different from what Japan, Korea, or Taiwan is. So they need a current account surplus to balance the balance of payment. Now, on the capital account, we only have bonds and equities, where bonds are actually not seeing much inflows. In fact, RBI recently indicated they are probably done with a cutting cycle. We also believe so. Bonds are not really getting too much of inflow from the foreigners. On the equity side, there's some dividend outflow which is happening, which is a seasonality in the next 2 months. Again, it's a dollar outflow. Then India has been buying a lot of defense and military equipments as well. That's why we believe dollar INR will come down, but it will not be the outperformer versus the other currencies like euro and others.
Fair point. Rob, to come quickly back on the issue that you raised, Trump has set the tariffs, but he seems like he'll be whimsical about non-tariff barriers. As well, for a businessman, that makes a big difference. So will we really be advantaged by the tariff difference? At the moment, that's the big thing India is waiting for. But the uncertainty looms. What's your guess?
Yeah, the uncertainty definitely looms right now, Lata. But I mean, where we stand, looking at what the Trump administration's done, they've got there's no real trade agreements. I mean, these are frameworks at the moment. It looks like still the U.S. tariff rate on China is over 50% when you add it all up. Japan seems a fair way away from a deal. The EU will see, also concerned about non-tariff barriers. I still think India, as an emerging market economy with a very large domestic market, is in a pretty good place and can benefit from this trade diversion over time. It's not going to happen overnight. I mean, for FX, I would tend to agree that I think the dollar is going to continue to soften. It's not like US exceptionalism is structurally over, but I think there is a move from the US economy to becoming a bit more of a normal economy, and investors are maybe doing more FX hedging and maybe incrementally buying a bit less US dollar assets. India, I mean, even with 2 rate cuts, we do think dollar INR can go lower. We think it could go a bit below 84 by the end of the year. And that is, partly on the basis that, yes, rates are coming down, but they are still relatively high in India compared to most other big economies. Yeah.
Fair point. Okay, thank you very much for an extremely useful conversation in a situation when there are so many moving parts. We will touch base with both of you when you're obliged. Thank you very much, Rob and Chandresh, for joining me. Wrap up on Bazaar. Short past is coming.
Kotak Mahindra Bank, top gainer on the Nifty, rallying over 3% after a strong first quarter business update. Loan book growth is higher than its consensus estimates. Deposits too higher by 14% year on year.
But Titan's the top Nifty loser. It's down close to 4% as it reports softer growth in the first quarter compared to its peers. The company says that consumer sentiment was hit by volatility in gold prices.
Textile companies like Gokaldas Exports, KPR Mill and Arvind see strong gains as United States imposes a 35% tariff on textile imports from Bangladesh.
Brokerage's McQuery downgrades Pharma to an underperformed rater, also cuts its target price to 1,010 from around 1,700 earlier. The stock is down 3.5%.
Brokerage HSBC upgrades divis to buy. It raises the target price to 7,900 rupees from 5,200 earlier, expecting peptide products to lead an estimated CAGR of 23% in the next 3 financial years.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Mangalam, and as you can see, markets more or less flattish, bit of a negative bias, some kind of nervousness ahead of the official announcement coming in from President Trump, though he has sent out letters to a whole host of nations. Mangalam, when's the last time you got a letter?
I don't remember the last time I got a letter, and I hope that India doesn't get any letter from Trump. And even if they do, like a lot of the experts have been saying, that it's just a letter to invite discussions more than impose tariffs. But be that as it may, the Nifty yesterday closed 0.0 points.
Yeah.
Today as well, as we're looking at it, 16.4 points on the Nifty lower. The Nifty Bank is higher by about 0.5%, but that's a large part of that is attributed towards Kotak Mahindra Bank. The broader markets, we have the Midcap index at an index level is down 0.4%. But your portfolio would not be feeling that bad, because if you look at the advanced decline lines, they're fairly split right down the middle. You have about 1,300 stocks in the red for about 1,200 stocks in the green. So there are just a few stocks which are, taking the overall index lower. And most notable of them are from the capital market space. So Angel One, for instance, down about 4%. We also have MCX, which is down about 3.5%. So we'll keep an eye out on this space. And then you have Kalyan Jewellers. After a big move in yesterday's trading session on the back of a 31% jump that the company reported in their, first quarter, Titan's reported weakness. They've spoken about volatility and consumer sentiment being fairly subdued. And we're in this phase where this quarter does not have as many festivals as the previous quarter did. Streets taking some profits back as well. Kalyan Jewellers lower. And we're also seeing some of these pharmaceutical names sell off. Lupin, Zydus Life, Granules, all of them at the low point of this morning. But on the other side, we do have a bunch of stocks which are rising. HDFC AMC, for one, is up nearly 3%. So let's get the latest on the trade talks between India and the United States. Parikshit joins in on the phone line. Parikshit, what are you gathering?
Well, we're hearing from sources that the U.S. government, especially Donald Trump and the White House, are now assessing India's proposal for a trade deal. Sources telling us that India has put a substantial and decent offer on the table, which would give access to industrial goods from the US side and labor-intensive goods from the Indian side. And this proposal literally covers $150 to $200 billion worth of goods traded between those nations. What sources tell us that there cannot be any further negotiations or proposals from India's side at this stage. We've done whatever we had to. There are red lines on agriculture and dairy which we cannot cross, we cannot compromise on, not just with US, but with any country for that matter. So the US is now assessing the kind of gains it is getting in the trade deal with India. They have to now come to the Indian government and say whether they want to accept this deal or they want further negotiations in the days to come. Sources telling us that while we are negotiating a trade deal with US with full intent and effort, we're also negotiating trade deals with several other nations and looking at all options to increase our export footprint.
Have you heard anything on any letter coming to India, Parikshit, from your sources?
Well, yesterday, all the letters, there's 12 to 14 letters that were issued. They were all letters to countries with which the US is not having a trade deal. Donald Trump has said that they are close to a trade deal with India. And this is what White House spokespersons have also been saying over the last few days. So far, the noises coming from the White House are very, very positive. We are, yes, expecting some sort of announcement or letter from the White House, but that will be possibly on accepting a trade deal or not.
Wonderful. And we shouldn't worry about what he has to say about BRICS, etc., right?
it's really up to Donald Trump. He has his own mind on these things. He acts unilaterally. But the fact is, what our sources have been indicating after this BRICS summit, that Donald Trump's biggest concern was around de-dollarization that is being carried out by BRICS, or the attempt by BRICS to have its own currency. None of that is on the table. There was a proposal from Russia several months ago to have a BRICS currency. There has been no headway, no discussion on that. The only thing that BRICS nations are discussing is having trade settlement in local currencies, which India and several other nations do a lot on a bilateral basis. So Donald Trump and U.S. concerns are absolutely unfounded. And even if there is a BRICS tax, they do not expect it anytime soon.
All right, take that point. Thank you so much for joining in, Parikshit, and giving us the latest on what we can expect on the India-US trade talks. But could you qualify it by saying that Donald Trump has a mind of his own and acts unilaterally when it comes to a lot of these issues as well? So let's hear out what President Donald Trump himself had to say on trade negotiations with partners, including the likes of India, after sending out a bunch of tariff letters to nearly 14 countries.
If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now, yeah.
Are the tariff letters that you sent today final offers, or are they negotiable?
More or less final offer. We've made a deal with United Kingdom. We've made a deal with China. We've made a deal. We're close to making a deal with India. Others we met with, and we don't think we're going to be able to make a deal, so we just send them a letter. If you want to play ball, you have to. This is what you have to pay. So as far as I'm concerned, we're done. We're sending out letters to various countries telling them how much tariffs they have to pay. Some will maybe adjust a little bit depending if they have a cause. We're not going to be unfair about it. And actually, it's a small fraction compared to what we should be getting. We could be asking for much more, but for the sake of relationships that we've had with a lot of really good countries, we're doing the way I do it.
All right, so that is what Donald Trump has to say. Meanwhile, just keep an eye on a couple of these pipe stocks. All of them are spiking. We have, Venus Pipes, which is up 6%. Another couple of pipe names as well, which have moved higher. Recent listing from last year, I think, Harium Pipe. That is another one which is seeing a fair amount of volume spike, and it's up around 12%. So just some sectors keep moving around left, right, and center. That's a bunch of stocks from the broader markets moving higher. Let's get in Somil Mehta of Mirae Asset Sharekhan for a quick technical check on the market. Somil, it looks like it's a individual stocks-driven market because the Nifty has been in a range, give or take all the volatility. It's tested the lower end of the range, it's tested the higher end of the range across multiple news cycles, and we still are in that range. The last couple of days, absolutely flat.
Absolutely, it's been very range bound. It's been very flat. But there's a lot of stocks which are moving and having very good run up. It's a very stock specific, very sector specific market at this point of time. Market has been Nifty has been in a very narrow range. The supports at this point of time is 25,300 and 25,200. That's a very crucial support zone at this point of time in the very short term. Anything below that will take the Nifty to 25,000. But I'm not looking at that. I'm looking at higher levels. Medium-term trend remains positive. Undertone still remains positive. I think the next target for Nifty in the short term would be 25,900. So this is the target I'm looking for in Nifty. In Bank Nifty has already started to move today because Kotak is doing good. ICICI is doing good. I'm expecting Axis and SBI to join in, HDFC Bank to join in as well. Bank Nifty has a very crucial support at 20 daily moving average, which is 56,550. That will be very crucial. And the next level in the short term would be 55,950. So these are the two levels which are very crucial as supports. I'll be looking for a target of 58,000 in the very short term. Medium term definitely looks great for Bank Nifty, but in the short term, 58,000.
Okay, got it. All right, Somil, you're sounding fairly optimistic on prospects on the indices. Got that. What about individual stocks?
So I have two stocks from the large caps. First one is ICICI Bank. ICICI Bank already started the move higher top, higher bottom formation, taking support at the averages. It was consolidating for a little while, but I'm expecting this consolidation to break on the upside. Stop loss would be 1420. Very good risk reward ratio at this point of time. Target would be 1500 in the short term. The next one is NTPC from the power pack. This stock has been consolidating for a little while now, from last couple of months, in fact. And now the downward sloping trend line has broken on the upside, closing about 20 and 40 daily moving average. So NTPC would be my top pick from the pack. Stop loss would be 330 and the target would be 370.
All right. Are you looking at any of the hotel stocks? Because not only do we have Schloss Hospitality doing well, that's Hotel Leela, but Lemon Tree Hotels is the other one which is spiking in trade right now. Can't see much in terms of moves for Indian hotels, marginally in the green, but there are a couple which are doing fairly well today.
Yes, ITC Hotels is my topic, actually. ITC Hotels has been making high tops, high bottom. Every time it dips, it takes support at 20 daily moving average and then resumes the uptrend. So this is my topic in the whole pack. The support would be around 217, 213 levels. That's the support zone. And I'll be looking for 270, 280 of target in the medium term outlook.
All right, take that point, Saman. Thank you so much for joining in and giving us individual stock ideas, even as the index is fairly range-bound. With that, we'll step into a short break. As we do that, let's tell you about the all-new CNBC-TV18 Prime. It brings you insights from policymakers, business leaders, economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, gives you unparalleled insights. You can tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. all weekdays and weeknights.
Welcome back. Well, let's take a quick check on the markets. Not moved too much, but there are a couple of outliers. And from the Nifty pack, the top gainer is Kotak Mahindra Bank. That after it reported a strong showing in its business update. Gaurav joins us to help us out with a greater analysis. Gaurav?
Well, yes, Kotak Mahindra Bank has actually reported great set of numbers when it comes to provisional updates. And the reason being that when we look at loan book growth, that is at around 14% on a year-on-year basis. Now, let's not forget that the industry is growing in the range of 9 to 10%. Kotak Mahindra Bank is known to outperform industry, but even when we look at the consensus expectations, Kotak Mahindra Bank has outperformed the expectations as well. In terms of deposit, we are seeing 14.5% of growth on a year-on-year basis, which is again strong. It is actually led by the term deposits because CASA has actually become or remained a little softer in this quarter. But at the same time, that is not a concern because usually Q1 is weaker when it comes to CASA. Let's also not forget that we'll be watching out on what segments have grown in Kotak Mahindra Bank's loan book growth, because for the last few quarters, they have been slowing down their unsecured segment. So NIMS is something that we should be watchful for. But definitely, in terms of provisional update, a great set of numbers from Kotak Mahindra Bank. And as a result, we are seeing stock is also soaring up in trade today.
Take that point up around 4%. That's the top Nifty gainer today, Gaurav. Thank you for that. But from there, let's go on to the top Nifty loser. That is Titan. Reported its first quarter updates post-market yesterday. And remember this on the back of very strong set of numbers coming in from the likes of Kalyan and Senco. Senco had a near 28% overall growth, 24% retail growth. And Kalyan Jewellers reported 31% growth. What does Titan do? Titan reported an 18% growth in their domestic jewelry business, and that's a lot lower than what the peers did. But more importantly, just a couple of weeks ago, we got a note from Macquarie, and they were anticipating around 20 to 21% growth in the first quarter with better margins as well. The company is disappointed the street on those expectations too. That's not all. They said that gold price volatility has affected consumer sentiment, and even the studded ratio is lower. Why is that? Because of higher gold prices, customers opted for plain gold jewelry as an investment class and also looked at lower caratage of gold. And studded grew in early double digits, whereas plain gold grew in mid-teens. So as a result of which, we saw the studded ratio come down, which means that there could be a downward pressure on the margin as well. Even the buyer growth was flat year on year. Now, one of the possible reasons for this could be that, Gudi Padwa this year was on 30th March, which is the fourth quarter, and the previous year was 9th April, which again is the first quarter. So as a result of which, and Titan having more exposure to Maharashtra as against, say, something like a Senco and a Kalyan, could have faced that issue. But even the buyer growth being flat is something that the street is taking note of. The other parts of the business not doing too badly. We had watches growing at 23%, decent performance for emerging markets and Carrot Lane as well as international business. Eyewear grew about 12%. So, it's a weak set if you look at the expectations and a weak set if you look at the peers, as a result of which the stock is the top Nifty loser today.
All right, well, let's turn our attention, though, to the special segment where we get you a few ideas for profit from Money Control Pro. Kanchi Shah of moneycontrol.com joins us to talk about a stock that she's tracking closely. Kanchi, take it away.
So the company that I've chosen for today is Escorts Cubita, which is a key player in India's agricultural machinery and construction equipment sector. In the month of June, the company reported a 13% increase in tractor volume over May. This improvement in sequential performance is very indicative of pickup in the rural sentiment, which is supported by early monsoon progress and pre-seasonal buying. Looking ahead to FY26, the tractor industry's outlook remains very much favorable. Industry volumes are expected to grow in the mid to high single-digit range. This growth will be underpinned by healthy reservoir levels, an increase in the minimum support price, a normal monsoon forecast, and improving terms of trade for the rural economy. However, from a market share standpoint, Escort Kubita's share had declined to 12.4% in Q4 FY25 compared to 13.7% in Q4 FY24. The decline is largely attributable to its relatively weaker presence in the eastern and the southern region. To address this, the company is pursuing a very strategic expansion into underpenetrated markets, specifically Western, Eastern and Southern India, where it sees significant growth potential over the medium term. On the export front, the company maintains an optimistic view, where the tractors are expected to grow by 20 to 25%, aided by focused efforts in geographies such as Europe, Mexico, and South Africa. In addition, Escorts Cubita is also exploring to enter into new emerging markets, which includes Myanmar, Cambodia, and Thailand, which could act as a future growth drivers. From a valuation perspective, the stock is currently trading at a 27.8 times its projected FY27 earnings, which appears to be little elevated right now. Thus, we advise investors to accumulate this stock on price correction with a long-term horizon as the company continues to strengthen its domestic and global presence.
All right, Kachi, thanks a lot for that. So that's about the idea for profit coming from our colleagues at Money Control Pro. With that, we'll slip into a short break. But as we do that, again, good news coming in for all you viewers, which is India's business news leader. That's CNBC-TV18. Just a click away, you can see the CNBC-TV18 app. It's the all-new app which gives you access to breaking news, in-depth articles, financial world updates, all of them at your fingertips. All you got to do is just download the app from either the Apple Store or the Google Play Store. If not, then the QR code is up for you to scan and download the app.
Welcome back. Well, the market's sitting with a mild cut as we speak. The Nifty continues to remain a little bit lower. What's outperforming today is actually the Nifty Bank. And that's being powered ahead because of the way we have seen, Kotak Mahindra Bank perform. So that's great news. From the broader markets, a couple of stocks, though, that are calling for attention. IEX has moved a little bit higher. It was trading in the red, so that's spiked up a little bit. Motherson Wiring, let's get that one up for you on the screen. Good move is what we're seeing on that particular name as well. A bit of a perk up on that stock, so I think that should come up as well. On the flip side, Nectar Life, small company, announced a deal trying to sell some part of their business. Street doesn't like it. The stock is locked down, lower circuit, down 20% as we speak.
Nigel, a couple of these stocks call for attention from the jewelry space as well. When we looked at Titan as the top Nifty loser and we spoke about Kalyan Jewellers seeing some profit booking as well, look at PC Jeweler. When the going was good for all these updates coming in, yesterday that stock was up 10%. Now, as you look at it, it's given up all its gains, down about 10% for this week, absolutely flat. And we are seeing, increased selling in all of these capital market names as well. So 361 WAM down 5%. We spoke about Angel One, and BSE is the other one, which is down about 4.5% as well. Let's get you an exclusive story now. Sources are telling CNBC-TV18 that the SEBI may consider linking options leverage to cash positions. What does this mean? How does that change your trades? Yash joins in to tell us more. Yash.
Well, Mangalam, this all seems to be a fallout of SEBI's investigation and action against Jane Street as an institution and the modus operandi of manipulating the exchange, the index rather there. What we've been given to understand from our sources is that market regulator SEBI may consider linking options market leverage to cash market positions. Now, just to simply explain the first line, it essentially means that if you only and only if you have certain amount of position when it comes to cash market, you'll be able to take and a leverage equivalent to that position in the cash market as far as the options market is concerned. Now, what we've been given to understand further from our sources is that linking of options market leverage to cash positions is being done to cut down on excessive speculation. Also, options position could be linked equivalent to cash market position through a derived formula. As I said, that if you have certain amount of position as far as the cash market is concerned, only equivalent to that which will be derived through a formula, you can take the simultaneous position as far as the options market is concerned. Now, as per our sources and in very detailed fashion, what our sources tell us is there are 4 things which market regulator SEBI wants to achieve through this particular proposal. First thing is increasing cash market liquidity. Second thing, reducing options market liquidity. Third one, reducing excessive speculation and protecting retail investors. Do remember there was a report which came out yesterday which spoke about losses made by retail investors. So that is one another intention from SEBI, that is protecting retail investors. And the fourth point which it wants to achieve is cut down on the ability of institutions like Jane Street to make fast money through manipulation, as SEBI calls it. Now, what we've been given to understand further than that is that the proposal to link options market exposure or leverage to cash market position could come up for board discussion very, very soon. The market regulator may also discuss other possible steps to identify and plug more loopholes when it comes to manipulation of options market through heavy capital being deployed. Now, apart from that, SEBI is also considering increasing cash market volume through allowing, and this is a consideration at this point of time, through allowing shorting in cash market as well as enhancing the SLBM, which is, loan against shares mechanism as well.
That point, Yash. Thank you so much for bringing us up to speed with what the SEBI is considering right now. While Yash was speaking, you could also see visuals of Ramdev Agarwal, who's joining in as a guest editor very, very shortly on CNBC-TV18. He's entered the CNBC-TV18 headquarters. In just a minute after this short break, you will have Ramdev Agarwal. Joining him will be Pranav Haldia, Rahul Saraf, Firoz Aziz. We will speak about the markets, IPOs, promoters and PE exits. More importantly, the rise of family offices, what it means for wealth creation and how the situation is likely to pan out. You can see him walking into our studio. So all you got to do is just stay tuned to CNBC TV18. We'll take your leave on this edition of Chartbusters as Ramdev Agarwal, our guest editor, enters the studio. Take a short break. On the other side, you will hear from the man himself, Ramdev Agarwal.
Hello and welcome to the CNBC-TV18 special. Over the next 30 minutes, we are unpacking a trend that is both massive in scale and quietly reshaping ownership in corporate India. We're going to be talking about promoter stake sales.
India's promoters, the ultimate insiders, have been steadily selling down their stakes. And this isn't a short-term trend. Over the past 4 years, data shows that a clear trend of exits of promoters is accelerating. Promoter holding across listed companies is falling.
Well, but here is the paradox in that sense, right? The other side of the argument. In a market which is flush with retail inflows, where earnings momentum hasn't always kept pace with liquidity, could this steady promoter selling have actually prevented the market from melting up, overheating in that sense?
And to make sense of this, we are joined by someone who's watched India's capital markets for over 4 decades, whose voice is as respected by promoters as it is by investors. Ramdev Agrawal, co-founder and chairman of Motilal Oswal Financial Services. He's also our guest editor for the day for the next 30 minutes.
So, as always, Rima and I'll take it easy, and Ramdevji will conduct the questions in just a bit. Our expert panel also, though, comprises of Pranav Haldia, who will be doing some of the answering to Ramdevji's questions. He's managing director of Prime Database. He's, of course, crunched the numbers on stake sales and ownership patterns as well. We have Rahul Saraf, India head of investment banking at Citi India, to decode the rationale behind these exits and, also what promoters are doing once they sell with that money. And of course, Feroz Aziz is joint CEO at Anand Rathi Wealth on how a chunk of this promoter cash is actually making a comeback right into the market in a different avatar, not just stock markets, but all kinds of financial assets as well. But, before we get to the conversation and the Q&A, let's just start by laying out the data and what this puts out, just to frame our discussion in the right context. And here is the data. Over the last 5 years, private equity and venture capital exits have surged. In 2023, sell amounts crossed 1 lakh crore for the first time. And 2024 saw a record 534 deals worth over 1.15 lakh crores. In just the first half of 2025, we've seen nearly 37,000 crores worth of exits. Now, this trend is even more striking among company promoters. These are private promoters that we're talking about. In 2023 and 2024, promoter stake sales touched 1.16 lakh crore and 1.1 lakh crores respectively. This is almost double the amounts seen just 2 years ago. In 2025, we've already crossed 64,000 crore rupees. And by the way, it's only July, so you've got half a year to go. As a result, private promoters' shareholding, if you just look at these numbers as how it's impacted their shareholding across listed companies on the NSE, it's steadily declined. From 45%, which is what private promoters held at the end of 2021, it's now come to under 41%. That's about 4.5% percentage point drop in just over 3 years. It's massive. On the flip side, where has all this money gone? Domestic institutional investors, powered by largely SIPs, have been stepping up with their shareholding, which has risen from 13% to over 17% in the same time period. So it's almost a transfer from promoters, private promoters, to institutional shareholders, which is largely DIIs. Here's the kicker. For the first time ever, possibly, the value also of DII holdings now exceeds that of FIIs. FII ownership of listed companies was around 16 lakh crores more as compared to DIIs. Basically, it was FIIs owned 16 lakh crores more of all listed companies over DIIs in 2021, right? That 16 lakh crore has all but disappeared, and then some. DIIs actually now own about 1.6 lakh crores in listed equities more as compared to FIIs. So actually, it's been an absolute dramatic change in terms of the composition of the market, even within institutional shareholders. And DIIs have really emerged as the big kind of block which has absorbed a lot of this supply which has come in. So that's the data. But now let's get the context and the perspective. Ramdevji, great to have you with us here. Yes. Thank you very much for joining us.
Very nice to see you.
And the data is striking, right? There is no doubt about it.
I was broadly having, but you put it very nicely. The data is absolutely crystal clear. That trend is building up. And, one of the things you said in the beginning, so retail investors are giving a floor. the resilience to the market, and the promoter selling is going to give that, it is going to save the market from melting up. So that's a fantastic thing to have, because this one, it avoids a crash in the market. It also avoids the melt up in the market. Okay. A second, and this gives a what you call sustained expansion of the capital market activity. Because if you have floating stock of say 30%, or there are a lot of companies there are 25, or government companies there are 15, 10% is there. So your activity is going to be small. But as your floating stock, which is now 60% on aggregate basis, floating stock goes to more like 75%. So what happens is that all the market intermediaries, one is the index, because of index expansion, say by 12, 13%, and other is the volume expansion by 4, 5%. So more customers, more stocks to trade, and of course the tailwind of economy, which is sustained at 7%. So I think it's a complete Goldilocks kind of situation, because in the stock market, any kind of melt up is borrowing from the return of the future, which creates problem. Now it will be very good for the market and for the market sustained
The numbers
expansion.
we put out, it shows that private promoter holding is now about 40%. It's come down about 4.5% in the last three years, roughly. You think this pace will continue at this rate?
If you see, now there are two things. Prices of the stocks are not determined by who is buying and selling, because number of stocks remain same fundamentally. So what decides the price of the stock is the earnings momentum. You see Indigo, they sold I think 25-30%, and at every price from 1500 to almost as late as last week at 50. So, and both the promoters have sold. So clearly market wants earnings growth, the company to become bigger and better. If that is happening, so in aggregate, if the Indian corporate profit, which is about say 15 lakh crores, that goes to say in 2 years time or 3 years time to 20 lakh crores, I don't think who buys, sells, then actually the game will be even bigger for the capital market participants. Foreigners will come, domestics will come, and more stocks will be there. So the stock price will not be impacted. But temporarily what will happen is the stock, it also depends on, because promoter knows the value of the company and what is going to happen in the next 3, 4, 5 quarters or something like that. If the motive is not that much positive, see, if I want to set up a family office and I sell by 5-10%, or I want to do philanthropy and I want to sell, that's a very ultimate positive thing to happen. But if I know for sure that outlook 2 years down the road is going to be very bad, or he can see that, and because of that, it is being sold. So that will have little.
What a sea change, right? Rima, I mean, 10 years back, 15 years back, I remember, I mean, promoters used to sell, and we used to.
It was a taboo.
It was one of the red flags.
Yes.
With companies, promoter sales. But not anymore.
Yeah, so this is the maturity of the market. I mean, in US, all the promoters, like I believe, Bill Gates holds hardly a percentage or two of Microsoft. So he has sold across, I mean, over the year he has sold. Jeff Bezos, this thing, Musk, they keep selling, and that to a good chunk. So markets are not that much perturbed in US, and hence that broader trend. This is the expansion of the market. We are about 5 trillion. In next 4 to 5 years, 6 years, will become 10 trillion large market. And it is required. This kind of liquidity buildup is required, because we've got tons of small companies. If you have 60-70% owned by the promoters, how, I mean, where is the depth? I mean, a lot of fund managers, they won't be able to participate in those stocks, because whenever you go to buy, the impact will be 10%. When you go to sell, it will be 15-20%. So that makes the market very primitive. So this is the best market,
So it's a sign of market depth and not distress.
No, not distress for sure,
So what are the broader implications of this? You spoke about how that this is a structural positive for everything related to capital markets. So from an investment point of view, if this continues, should one be looking at brokerage stocks? Should one be looking at wealth managers or some of these exchanges? I mean, what's the best way to play it?
So now from here, the next derivative starts. Who are the guys who are selling? So all the market intermediaries, like the guys who are going to come, they are the guys, iBankers, they are advising them to sell. So that, I mean, they are going to make their own fee. Then after that, see, how do I say, this promoter holding doesn't exist actually. It exists only in the digital paper. That 50%, 1 lakh crore value of the company, 50,000 crore has no relevance for the market. It's just there for decoration. But the moment you melt it, it is there for everybody. I mean, first the promoter is free to consume for their own consumption and philanthropic purposes. nobody can do philanthropy by not selling the stock. I mean, just the dividend is not good enough to kind of do big projects. So that is one. Second is that promoters can also look for parallelly promoting a very large, kind of new ventures in the family members or themselves, and unrelated family ventures. So basically, if you are a textile company and you want to get into steel, now you would not like to diversify within the textile company that particular thing. You sell 5-10% and promote for 1,000 crores, 2,000 crores, another equity base, and promote a new venture. So a lot of these possibilities are there. Wealth effect will be there. You can consume. I mean, you see all these 400, 200, 300 crore flats being bought. They're all coming out of the market cap melt down, whether it is IPO, whether it is QIP, whether it is actual selling. So wealth effect has to come. I mean, we are sitting on, our annual wealth change, just by numbers, is running into 25 to 30% of GDP. And yet we are struggling for 1% extra growth because consumption is not happening. So I think it will give some boost to the...
and those 300, 400 crore flat purchases is coming at... Earlier it used to come at 5-6% of company equity. Now it's coming at 0.5%, 0.4%.
That's the power of kind of fair or rich valuation of the market.
Yeah, but you have a bird's eye view, Ramdev. I mean, you have all these businesses, and companies come to you for all promoters come to you for all kinds of advice, whether they should do it, not do it. Yeah, and you made a mention of lots of these smaller companies which have never seen these kind of values before, right? When they come to you, what are you telling them, and what kind of conversations are you having?
I was there yesterday in Ahmedabad, and I met at least 6-7 of them. I mean, it's a different world altogether, I'm telling you. These guys, they come from, say, Kutch. They'll come from, like, tier 3, tier 4 cities. And they've done well. Somebody is executing infrastructure. And they actually first thing, they're very hardworking. Second, they have not seen serious money in their life. Okay. Third, they are getting kind of the bid just to get the mandate. Bankers are bidding, say, if the guy can get $500 million, people will start the bidding from $1 billion. His expectations are running wild. Yeah. And telling them that when it actually hit the road, then only you realize what exactly is going to be the number. But still those numbers are like even 4,000-5,000 crores. Is a wild number. So I think a lot of new companies are going to come. And I think you have seen every week, there must be some record. I think Prithvi can, Prime Database can
ask him
show what kind of a trend they are seeing. Yeah. This is a revolution in terms of number of companies which are getting listed. So one, they are going to get in the IPO itself, which is much more going to be primary selling, some amount of secondary selling. Second, once they discover the price, then this promoters...
they will start to monetize it.
But then they can monetize, and they are free to either invest for the new ventures or consumption or philanthropy.
So just to take on what Reema asked you, from as an investment house, what is the capital markets has been your favorite area?
Yes, so I can see what happens. One is that, of course, one time the deal value and then some commission you make. But that's the smallest part. Immediately this money comes in wealth management. So wealth managers, they get the corpus. So 2, 3, 4 of them will be nominated, and everybody will get very large chunk of, you can see large deals, and all the money is again coming back to the market. So actually, at one level, they provide the, melt up against the melt up. And again, they come back to give the flow to the same market by diversifying the portfolio. Correct. So that activity is, so it expands the wealth management platform. Yeah. It expands the AMC platform because wealth managers, they allocate the money to the mutual fund products or private equity products. So every aspect of the capital market activity will get a boost the moment that share certificate melts.
And AMCs and wealth managers, both, so owning a bunch of them makes sense for the long term in the Indian context then.
Yeah, see, the fund manager is deciding on merits of the company. He doesn't care. He actually goes and asks in illiquid counters, can I get the stock?
Correct.
Because if he goes to the floor, he loves the story. But if he goes to the floor, the cost of entry itself will be 10-15%.
Correct. Correct.
So, so it is important that he's allowed entry, and this is the only way participation can come.
You said that there could be multiple motivation why a promoter may want to sell part of his stake in the company, right? Some will be altruistic for philanthropy purposes, etc., diversification, next generation. But then you will always have these few bad, apples. So how can a retail shareholder identify and beware? What are the warning signs in such cases?
It is for the person who is buying the stock. His consideration is not who is selling, because in any case he's a non-owner of the company, so he is going to buy the company, and it is coming from whatever sources it is coming from. It is coming from existing retail, or it is coming from the promoter. It's a legitimate source for him. Just because the promoter is selling, the prospect for the future is not changed. But since it is coming from promoter, he should be a little extra cautious. Why he's selling? Maybe he can ask the broker, or he can ask the selling party what exactly is prompting you to sell. Probably most of the time you know why they're selling.
You know what we're going to do, Ramdiji, is take that commercial break, and then we'll get you your guests, not my guests, your guests on the other side. So, we'll do that. This discussion continues, but we'll widen the scope. Ramdiji mentioned wealth managers as a space. So we have Feroz Aziz of Anand Rathi joining us. All the data that I put out in the beginning, that was coming from Prime Database, and Pranav Haldia will join us, and he's got a really good eye for data in terms of what is coming up ahead as well. And of course, making a lot of these deals happen is Rahul Saraf, India investment banking head for Citi. So all three on the other side with Ramdiji coming up.
Can I get a piece of paper?
Welcome back to our special market show. The market editor, and of course, our market editor today is Ramdeo Agarwal of Motilal Oswal Financial Services. We also now have Pranav Haldia, Rahul Saraf, and Feroz Aziz with us to give us a rounded perspective. And I'll throw it across to Ramdeo ji in just a bit. But Pranav, that data that I used to kind of set up the entire discussion came from Prime, and excellent data as always. And that question which I put to Ramdeo ji, and he also said you'll have the best idea. Is the pace of these sales, as you see it in terms of the pipeline, I mean, is it as strong? What we've seen over the last few years has been very strong. Is it likely to be as strong going forward as well? Both in terms of the IPO pipeline, secondary sales, PE, VC exits. What's your sense?
Well, good morning and thanks for having me. Firstly, I would just mention that I think with all the promoter exits that you've seen over the last 2-3 years, there's really no reason to panic. The calendar year 2023 saw 36 lakh crore of promoter exits, and calendar year 24 saw 1.40 lakh crores. And this only includes bulk and block and offer for sale, which is used by promoters to meet the minimum public shareholding requirement. But you've seen that there's not been any meltdown in the secondary market. And in fact, we're going from strength to strength. So I think, this is, going forward as well, one can expect a lot of promoter sell downs taking place. We have to understand that, given the kind of IPOs that you've seen over the last 2-3 years, there are a lot of promoters who need to exit and bring down their stake to about 75% within the 3-year timeline to meet the minimum public shareholding requirement. And, block deals is one of the means which they use to reduce their stake. Even apart from this, you are seeing, of course, promoter exits for a whole wide variety of reasons. When promoter is buying, it's always considered to be a good sign. In my view, it should be always taken as a good sign. But when the promoter is selling, I think that's something that you alluded to earlier as well. It can be for a whole wide variety of issues. Of course, one of the issues can also be to, book some profit. They might feel that it's already well priced or the future may not be too bright. So as an investor, I think it's very important to keep a close watch on both promoter buys and promoter exits. One final point I would like to make as far as promoter exits are concerned is that, one of the things which we need to look at apart from for the reason of sale is also that the promoter should continue to hold a good amount of stake post the deal. And the deal should not have ideally happened at a huge discount. So if these things are in place, then I don't think it's a really worrying sign as far as investors are concerned.
No, absolutely. And I think that's very good context to provide, Pranav. Now, Feroz and Rahul are also with us, one from the investment banking deal side, the other from the wealth side. And of course, we have our market editor, Ramdeji. Floor is yours.
Yeah. Hi, Pranav.
Good morning, sir.
Very good morning. So are you seeing this as a broader trend? Because globally, promoters' blocks are not, this is a very unique feature of India that we are somehow, the very concept of promoter, I think, is a very new thing in the world. But here, our authorities, they have they hold the promoters for a lot of things in the company. So this concept of promoter and the promoters holding. So now, what do you think? This is a start of the, what you call, melting down and going to whatever is the global trend of 10-15% kind of thing? Or, and the second point is, earlier we used to think that it's a taboo to sell. It's a signaling to the market that companies overpriced or there's some trouble ahead and, going away from that. So what's your thing? How do you see this particular thing shaping up?
So, let me first answer the second question first. Like I mentioned that I think over the last 2-3 years, what you've really seen from 2023 onwards is that promoters have, reduced their stake significantly. I think the data also shows that. But yet it's not caused a meltdown. So unlike earlier, I think, of course, there's a lot of liquidity which is now available, which is being provided by domestic investors, primarily mutual funds in a big manner. And, I think the red flags which are there with promoter exits, why is it happening? Does the promoter continue to hold a good stake after the deal? Is it happening at a big discount? Is there any change in the fundamental of the company? I think these are some of the red flags which investors need to look at. Now, to answer your first question, sir, I think, we need to put this also in context with what's happening with the private equity and venture capital industry in India. which actually is about 20 years old now. And what you're seeing in India, like you mentioned, promoter is a very Indian concept. In fact, the very word promoter is only existing in India, and you won't find it in any of the Western markets. What you're seeing now gradually is that with all, in the early 90s and also in the 2000s, a lot of green capital, which companies were seeking, was actually being provided by the primary market. And you were seeing very, very new, fresh companies coming to the IPO market to tap that money. Of course, we all know that a lot of them ran out of business, or they ran away with investors' money as well. But that capital is, I think, now being provided by angel investors, by venture capital, and by private equity. And this is something akin to what you see in the Western markets as well. That for companies initially are funded, these investors are providing the risk capital. And after multiple rounds of such funding, after these companies have attained a certain size and scale, after they have attained a certain governance in the company, that is when they come to the public market. And this is, I think, where you are seeing a convergence between, what happens globally and now what you're seeing in India as well.
Yeah, please.
So, and what happens if this promoter's holding, which has come down to 40, comes down to, say, 25 in next, say, 5 years, 6 years, 7 years? What happens then? I mean, will it change the character of the market big time?
Well, I think, this minimum public shareholding requirement of 25%, which has now been there for, I think, close to 15 years, there's been a lot of discussion to increase it to maybe 30, maybe 35%. I think we also need to keep in context the fact that promoter holding has gone down by 5 percentage points in the last 5 years. This is despite the record number of IPOs that have happened over the last 4 or 5 years. And we have to remember that apart from some of the new age companies which hit the IPO market, a majority of Indian companies, which have come to the IPO market as well, continue to be family-owned, promoter-controlled companies, where they're diluting maybe 10, 15% at the time of IPO. And even post-IPO, they continue to hold, 80, 85%. So, when you're talking of declining promoter share, that is in the context of, the new listings which have happened.
Yeah, no, absolutely. Points taken, Pranav. Let's get the others in as well. Yeah. Rahul and Feroz are with us. Rahul, let me ask you. You work in so many deals, and you're in touch with so many promoters who come to you for all kinds of things. What is the underlying motivation, as you see it, Rahul? I mean, the bulk of it.
Sure, Prashant. I think if you step back in terms of the capital allocation needs of the family, whether it's to create a family office 5-10%, whether it is to buy a big house, as Ramdaji said, or is it for diversification? I think all of those are very important factors to understand what is the motivation. Is it for philanthropy? And what we've seen is Indian promoters are actually selling for any of these 4 reasons, but not necessarily to sell because they don't believe in the business. In general, when we see 45 to 40%, bulk of that is, yes, 1 or 2% or 3% sell downs, but you have to put it in context the MNC sell downs. Some of the promoters who are MNCs have sold down for capital allocation needs globally. Private equities who are promoters have also sold down because that's their business to, of course, sell down over a period of time and churn capital. Pranav talked about new age companies who actually have very low founder or promoter stake by itself. That skews the data as well. There will be some dilution of stake as well because new capital raise for growth has happened. And then last but not the least, in some cases, the minimum public shareholding has to be met and therefore promoter sell down. So all of that has to be put in context when we look at the promoter sell down, both in absolute terms as well as in percentage terms. The motivations, sorry, go ahead.
No, please go ahead.
I think that therefore the motivations have to be looked at in that context. And yes, 5%, 7% sell down is okay. But I don't believe that Indian promoters, Indian families will have a significant sell down all the way to 25% or below, because as a culture, we have the culture of passing down to the next generation. The big family offices which are getting created are still getting created on the back of control on the basic flagship business. that control is not going away. As against in the West or even in the East, like if you take Japan, the inheritance tax is there, where for the next generation, they have to pay 55% tax. And the only way they can pay it is by selling the stake. So I think some of that has to be put in context when we think about what happens 5 years from now or 10 years from now.
Feroz, on the subject of setting up family offices, how much of the money, to your mind, is fed back into the capital markets, re-enters the capital markets?
Yes, Rima. Before I go to that question on the previous topic, I have 3 important points which I want to make. And I really pray Ramdevji's 25% happens. Because in the S&P 500, we are looking at close to about 80% of the companies have 100% free float. And we have not more than 10% of them who have more than 80% free float. There are only 6% of the companies who have more than 90% free float. We are a country with promoter holding, financialization happening. If there's a paradigm shift and there's capital movement, we are a country with 940 lakh crores of household savings, adding 40 lakh crores, out of which only 6.7% is in equity. And largely top 500 companies, because that's what is mandated to domestic institutions as their tier 1 benchmark. So if there's no promoter holding, there will be bubbles, retail will lose money. That's point 1. Point 2, if I personally think that there's hardly any promoter selling in NSE 500 companies. Let me put some math to that table. Out of the Nifty 50 companies, 5 of them have done a stake sale in the first quarter. In the last year, if you look at Bharti Airtel, okay, and Kotak, very second decimal, and Bharti Airtel was 1.21%. After dilution, there's still a promoter holding of 52%. In NSE small cap, which is a little more flamboyant kind of an index, you have a sale from HFCL Limited, and after the sale of 4.2%, we still have a 34% promoter holding. So 34% it's not the last mile out, right? And if you go with this, these are the top 5 sales in those indices of 250 companies. Top 5, the fifth top 5 is 1.58% dilution and is left with 53% promoter owning. So that's point 2. Point 3, if Jane Street should not happen in India again, which SEBI has very rightly, under the auspices of great executive directors there who understand derivatives, your cash market has to be liquid. Otherwise, there could be manipulation in stocks using derivative markets. What did exactly Jane Street do? That was already, on your channel, I've said this twice, that it's so easy. If you have 250 stocks in the derivative index, if cash market free float is not there, वो stock move करेगा, put call खरीदेगा, और पैसे इधर से उधर transfer करेगा. You lose money in cash, you make significantly more money. So having low free floats creates manipulation opportunity and overpricing. So that's on point 1. Point 2, does the money find back its way in the family offices? The answer, like Ramdevji said, it's absolutely right that it comes back into the capital markets. Point 3 is, I think the money temporarily comes into capital markets. Anybody who is in the business likes to pull that money over a period of couple of years back into doing another business. But Uday Kotakji had actually said that the next generation of those big promoters actually want to just manage the money. So I think immediately 90% of the money comes back into capital markets, 30-40% goes back into the economy, rightly so. And because the debt capital is more expensive today, for the last 2.5 years, repo rates have been at 6.5, and that's why equity valuations plus high interest rates is creating promoter selling, and that's project is viable at equity. You don't need debt for it, so that's why you see they're deleveraged.
Yeah, no, absolutely. Ramdevji, just a quick point. I mean, as Feroz said, Rahul said, a lot of the money is family offices comes back into the market, so they're diversifying in that sense.
Yeah.
Actually, isn't that also a signal, as we were saying, they're the promoters are the ultimate insiders. If they are, so essentially they think that this is a great time to actually take some money, put it into family office, all kinds of other financial assets, house, whatever, right? Yeah. And then and maybe, as Feroz said, later use that money to start something new, not the business in which they first sold. So is that a bit of a signal at all, or no?
It depends all on the company, you know. Like some of the companies, say like in Indigo, you know, one of the partners is kind of just going out of the partnership. So he sold his entire large chunk, 25-30%. So that is a dissolution of partnership. He was a promoter. So that kind of thing. So every company will have a different reason. You know, I'm only worried about one concern where company knows, because promoter knows everything. I mean, if anybody knows the future of the immediate future, 2-3 years, it is the promoter. So, unfortunately, the investors, they have a very patchy knowledge of the future of the companies. And hence, there should not be arbitrage between the person who knows a lot more to the person who knows a lot less. That should not be the motivation. Otherwise, if I want to buy a house, I want to diversify into a new business, you have fundamental right to, I mean, that's the basic purpose of listing, where you can have the cake and eat it. I mean, in 75% also you control the company, at 50 also you control the company, at 10% also you control the company, if control is an issue.
I was just thinking, have your cake and eat it too.
Yeah.
This moment that we're talking about, right? It's a unique moment. It's come after a long time. I mean, we've spoken for the last 20 years. It's happening, and it may happen. But are there bigger forces at play? I mean, all this is enabled by this huge gush of liquidity. Right?
Yes, that has prompted. See, that has taken the market valuation by 15-20% higher. Liquidity also. If I want to sell 5% of my company, at least there is a liquidity backed buyer also. So I think this is a great opportunity for. I mean, we have seen some multinational companies at least trying the turf here, ITCs of the world, and they have this thing. Second, I think government, which owns about anywhere between 18 to 20% of the market. I think out of 480 lakh crores, I think around 75-80 lakh crores is all listed PSUs here, and government has unlimited need for.
But capital. By the way, I looked at the data. They're staying pat. They've not, that holding has not moved.
Yes.
At least since 2021.
But in fact, in successive budgets, the aspiration of the government has always been to sell.
Yeah.
And who can actually threaten the management of a government company, even if they own 2%? Yeah. So I think the opportunity for the government to use this liquidity provided by the system and use it for very constructively. I will find it difficult to use a lakh crore, but they can put up, I mean, on 1 lakh crore, another 1 lakh crore or 2 lakh crores of loans, and they can certainly accelerate the entire infra build-up. Infra itself deficit is so massive, every city, every state, that it can be a force to reckon with in terms of providing resources. But it is out-of-box thinking. I mean, you have to think that this opportunity is there for you to use and have constructive plan for usage. I see government as the most potential further capex possibility out of this liquidity, and to my surprise, all the government companies are in great demand. All the defense companies, PSU banks have also come back big time. In fact, the biggest delta in last 5-6 years is the PSU bank's performance. Yeah. So all these big blocks of capitalization is there, and they're not being hated, except probably the oil PSUs, which are still more reasonably priced. Rest all the pack is very fairly priced. So government must use this opportunity of the gush of liquidity and use it for infrastructure purposes.
One point I want to make on that thing, like the moment has come after a couple of decades. The great part of this moment having come a couple of decades is the other moment on the other side, the buyer side, has also taken a couple of decades. What is happening today, I was just doing a study on one of our digital platforms. The retail investor, the hypothesis is the retail investor is no more seeing the domestic mutual funds as an investment vehicle at all. He's seeing it as a savings vehicle, by which I mean the frequency at which a retail investor is opening his SIP values and checking it has fallen almost 100th. 5 years back, he would open his app to try and check whether am I making money. Now he's just parking the money and not worried about the value. That's why in 2 years, when Nifty did nothing, October 21 to October 23, Nifty was exactly 18,500 on both these expiries. But the SIP number went from 11,000 crores per month to 19,000 crores per month. Yeah. A decade back, where you collected 18,000 crores in the full year, if there were 3 bad months of the market, SIP numbers would drop 30%. In 2 years of sideways movement, if the SIP number could go up 80%, it's one of the indicators of the hypothesis that the saver is also now seeing it as a savings vehicle like gold. He doesn't check the price once he buys gold. He buys real estate, doesn't check the price. Now he's buying equity, not checking the price. Unlike the HNI, that's why HNI is selling whenever he should buy. And the retail, ironically, is far sharper and mathematically provable over the last 4 years. And your net flow from FIIs from FY21 is 0. From domestic is 15 lakh crores, almost 7 times more. So I personally think both the moments have come together.
Absolutely. We could go on, but we're being told that constraints of time. So I thank you, Ramdevji, for coming in and sort of running us through this mega theme, which I think we'll have to do a couple more shows on to really get our head around the entire...
Whenever this kind of issues come up, like what Firoz said, what is the global perspective, particularly US, where 90% 90% S&P 500 is less than 10%.
Correct.
I mean, it's a food for thought. I mean, in next 10, 15, 20, are we going to reach there?
Are we going to reach there? It's a logical question to ask, and perhaps yes. Thank you once again for joining us here, Firoz. Great that you could come down. Appreciate your time here. Rahul, appreciate you joining us. And next time, hope to see you in the studios. And Pranav, thank you very much for providing all the excellent data and, of course, the perspective as well. It's a wrap on this edition from Breema and me. Thank you very much for watching this edition of Market Editor.
Hello and welcome to Trading Hour, live from the Motilal Oswal CNBC-TV18 studio. I'm Sonal Bhutra. With me is Hormuz Patakia. Hormuz, good morning. It's another day where we're seeing some consolidation on the Nifty. Yesterday we ended absolutely flat, but above the 25,400 mark. So that continues to be a very crucial level to watch out for. Mid-caps are under pressure. That continues to be the case. 0.7% down there. That index should come up for you on the screen. So that's where we're seeing pressure come by. And right now it is at the day's low as well. Bank Nifty providing some support. That index is up 0.3%. But individual stocks today, Kotak Mahindra Bank, for instance, is supporting Bank Nifty. The quarterly update was such. On the other hand, Titan's quarterly update not so good like the peers. That stock is down 5%. So the market is looking at earnings, looking at quarterly updates, and of course that big question mark: what will tariffs on India be now?
Well, on that tariff news, at least the one good reaction that we are seeing is in these textile companies, right? Be it the Gokuldases, the KPRs, Siaram Silk Mills was up 12% in the early part of the trading session. So that is one sector that has done well in anticipation of a lower tariff in the deal, considering the fact that Bangladesh was imposed with a 35% tariff last night. So it'll be interesting to see the contours of the deal. Of course, most of these names have come off the highs now. Gokuldas is up only 2.5%. CRM Silk Mill still holding on to gains of around 10%. So keep an eye out on that. Leading the losses, though, in the broader markets are the capital market names, be it BSE, be it Angel One, be it CDSL, be it 361 WAM. 3 out of the top 5 losers on the Nifty 500 are these capital market names, anywhere between 5 to 7% lower as we speak in the trading session. A sector that is also not doing well, though, is Pharma, and that is on the back of multiple brokerage notes that have come out in today's session. Ekta is joining in with more on this. Ekta, at the lowest point of the day now, the Pharma index.
Well, yes, but I'll start with the good news where HSBC has upgraded Divi's Labs to buy with the target price raised to 7,900. The long-term growth, according to them, will be driven by tirzepatide as well as other peptides and contrast media segment. They see revenue potential of $450 million from peptides, $260 million from contrast media by 2030. They forecast FY25, FY28 EPS CAGR of 23%. Macquarie has written on pharmaceuticals, where they have revisited the export-focused pharma space. US generics market is under pressure, according to them. Price erosion is expected to accelerate due to fewer drug shortages. Revlimid is nearing the end of exclusivity. Early than expected price erosion is likely to impact Q1 FY26 numbers, according to them. Lower P multiples for US-focused generic companies are possibly what they are looking at amid changing dynamics. Aurobindo is downgraded to underperform. Dr. Reddy's is downgraded to neutral. Cipla, Zydus, Lupin, they've maintained an outperform but cut the target prices. Sun Pharma, they've reiterated an outperform. According to them, minimal US generics exposure benefits the outlook.
All right, so that's about the pharma space. A lot of notes coming by in the recent time as well. But let's go across to Mangalam. He's joining us with a note that has come on Leela Hotels. It's an initiating coverage, Mangalam.
There's a couple of initiating coverages coming in, surprisingly, from some of their investment bankers to the issue itself. So you have BofA as well as Morgan Stanley, who were among the investment bankers to the Leela IPO that came in just about a month and a half ago. And now they've initiated with a buy rating, both of them. So we start with BofA, which has a buy rating and a target price of 520 rupees. They say that the overall valuation at 20 times FY27 EV to EBITDA is attractive. They expect 12 to 14% jump in the company's revenue and EBITDA over the next few years. And they believe that on a low base, the earnings can actually double every year for the next 3 years on a CAGR basis, and 90% number is what they are attributing. Morgan Stanley, on the other hand, they're saying that, there is a concentration risk, which is a key to watch, where a large part of the revenue comes in from a smaller number of hotels as compared to the other peers. But they are positive on the stock because on a low base, they believe that the earnings can actually jump almost as much as 9 times. And the balance sheet, with now being net debt free, leaves a lot of free cash flow to fund the upcoming capex cycle as well. They too are overweight on the stock. Their target price is 549.
Ekta was an optimist. The pharma index is at the lows of the day. She started with a positive news. But any optimism that you want to share on Titan, Mangalam, that too is at the lows of the day?
Well, the only optimism that there is the fact that maybe a large part of Titan's weakness this time around can also be attributed to Gudi Padwa being in the fourth quarter, this year versus the first quarter last year. And as compared to, say, someone like a Senco or Kalyan, Titan has higher exposure to Maharashtra, so that may have impacted their overall numbers. Something that we saw in PN Gadgil as well, which is a Maharashtra player, saw just about 2.4% in terms of revenue growth. But be that as it may, just the reported numbers versus what the analysts were expecting and versus what the peer set has reported as well, it's a weak set coming in, and that explains the sell-off that we're seeing on the stock. Domestic jewelry business grew 18%. Buyer growth was absolutely flat. Gold price volatility affected consumer sentiment, and even the studded ratio was lower this time as more consumers opted for gold jewelry than diamond or studded jewelry. So margins may be a bit of a pressure point. So that's something I'll be watching out for when the company reports its overall numbers. The other optimistic part, however, was that Carrick Lane did well, 38% growth out there. The international business on a very low base did extremely well. Fragrances and their ladies' bags businesses did extremely well as well. Taneira, though, grew at just 15%. Eyewear grew 12%, watches grew 23%. So the ancillary parts of the business growing well, no problems out there, but the main part is fairly affected by gold price volatility.
Okay, all right, take that point. So ancillary business is doing well, but the major or the core business is impacted this time around. It is all about Q1 updates. Royalty companies as well, they have spoken about what they've done in Q1. So let's get started with that. Macro tech developers, a 10% growth in their pre-sales in Q1, which is lower than the 20% growth that they've been talking about. They say they were impacted by geopolitical worries, and that impacted 2 weeks in the quarter gone by, which they will cover up in the subsequent quarters. Collections are up 7%. They say they are on track to achieve sales guidance of 26,000 crore rupees in FY26, and they expect collections in second half to be higher than the first half. Phoenix Mills, they expect they have seen a consumption growth of 12%. In terms of trading occupancy, they have seen that it has come in at 89% versus 91% in the quarter gone by, but that was because of the shutdowns that they had taken themselves. For Sobha, it was an 11% sales value growth this time, and sales volumes grew by 27%. So looking decent, but these stocks have run up a lot, and all this growth is coming on a high base. So the question is, how much more is there in the price?
How much more indeed. We keep an eye out on these real estate names as well. Sonal, thanks a lot for that. By the way, just before we call time on this segment, pull up Nectar Life Sciences. That stock is down 20%, and this is after the announcement that they made in the morning that they're going to sell their API formulations business and their menthol business as well for around 1290 crores. And the stock initially had opened around 5% lower in pre-market, then fell to 15% at the start of trade, and now trades at the lowest point of the day. Nectar Life Sciences is the stock, 20% lower in today's session at the lowest point of the day. And some of the other losers, though, Aurobindo Pharma has extended its losses now, 4% lower on that stock. And since we were speaking of capital market names, MCX is also trading with losses of close to around 3%. Now, some of the stocks that are bucking the trend, though, in today's session, look at Hariom Pipes. That stock is now up 13.5% in a market where the Midcap index is down almost 500 points. So Hariom Pipes is at the highest point of the day. Aavas Financiers is at the highest point of the day, 7% higher on that stock. And Gabriel India staging a bit of a bounce back today, 9% higher on that stock as well. Recall time on this segment from Sonal and me. Thank you so much for watching. Halftime report on the other side.
Stocks trade ranged after Donald Trump points to a possible India trade deal after sending tariff letters to 14 countries. Financials and energy gain while healthcare and consumer durables drag.
Sources tell CNBC-TV18 the SEBI is weighing linking exposures and options segment to cash positions of market participants. The move follows alleged manipulation by Jane Street and the significant losses incurred by retail investors, specifically in F&O.
Kotak Mahindra Bank reports strong business growth in Q1 FY26 with advances growing ahead of expectations and deposit too seeing a healthy trend, though term deposit remain the driver.
Tightens kids after it posts weaker growth than its peers in Q1 despite a low base. What's more concerning is that the growth has come mostly from an increase in ticket size and not a rise in buyer numbers.
Donald Trump sends out tariff letters to 14 countries that it is not close to concluding trade deals with, including Japan, South Korea and Bangladesh. The new tariffs imposed from August 1 mostly mirror those in place before the pause till July 9th.
Well, hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Bangla Malu as well as Vinny Motiwala. Well, it is turning out to be a session where it is still wait and watch, guys. So we're just waiting by for our letter to come through.
So Pariksha tells us that our letter will actually be a letter of acceptance and not a letter of tariff because we are very close to getting a trade deal. Be that as it may, the broader markets, the portfolios would feel a little bit of a pinch in today's session because you have 1,700 stocks which are declining, just about 900 which are doing a lot better in today's trading session. The mid-cap, the small-cap, as well as the Nifty Next 50. If you pull out those broader market indices, you would see that, letter or no letter, the portfolios are in the red, a fair amount, that too, because the lines intersected sometime at around 10:30, and thereafter, the red line has moved much higher. The frontline index, range-bound. Today, the Nifty Bank is doing better, thanks to Kotak Mahindra Bank.
Absolutely. Thanks to Kotak Mahindra Bank, we're managing to see some bit of a green there for Nifty Bank. But other than that, only IT is the other sector that's only managing to hold on to green. And some of these textile names, Ekta, which we're seeing some bit of a green because of obviously possibility of a good tariff deal could support textiles. And Bangladesh, the rate being higher for Bangladesh versus what we're seeing right now is something.
So the story is that, whether we get our letter or not, it's okay. So long as Bangladesh got its 35% letter. So this is where
everyone is above us right now, except Vietnam, which is seeing some bit of a benefit if the rates increase. So,
okay, but well, maybe we need to actually really ramp up our manufacturing when it comes to textiles to, take advantage of the situation. But nonetheless, that's a conversation for a different day or a different topic. As of now, we do have a lot of the frontline indices which are under pressure as well. So, or frontline stocks under pressure, such as Titan, Dr. Reddy's, all of these stocks which are in focus. But let's start talking about one frontline stock. Kotak Mahindra Bank is the top Nifty gainer after a strong first quarter business update. Gaurav is here to tell us more about it. Gaurav, go ahead.
Well, yes, as you said, Kotak Mahindra Bank actually came up with a very strong number. 14% growth is what we are seeing in terms of advances on a year-on-year basis. And this also translates into around 4% growth on a sequential basis. Now, let's not forget Q1 is usually weak. And on that front, Kotak Mahindra Bank is actually doing well, more than industry, as well as more than what the consensus were expecting from the Kotak Mahindra Bank. Other than that, from deposits, there also we are seeing some good growth. 14.5% on a year-on-year basis is what we are seeing in terms of deposits growth. And this was actually specifically led by the term deposits, because when it comes to CASA ratio, and specifically the CASA deposits, there we saw a little bit of softness on a year-on-year basis. But again, Q1 is a little weak on a CASA front, and that is the reason Street is actually expecting the same kind of trend to happen for other banks as well, and that is what is happening in Kotak Bank as well. What we are likely to see is that the NIMs is something that we should be watching out for, because the mix of this advances is something which is really important for Kotak Mahindra Bank at this moment, because we know that for the last few quarters they are actually bringing down their unsecured segment. So definitely that is something that we should be watching out for. But at this moment, a good set of number in terms of provisional update, and as a result, we are also seeing stock is also up in trade today.
All right, we take that point. Thanks a lot for that. Let's move on and talk about an exclusive story that Yash is bringing to us. Sources tell CNBC-TV18 that the SEBI may consider linking options leverage to cash positions. Yash, if this move does indeed take place, then a lot of the option volumes may dry up. That's perhaps reflecting in the kind of moves that we're seeing in a lot of these capital market plays as well.
Well, this seems to be a fallout largely of SEBI's investigation and action against Jane Street. What we've been given to understand from our sources is that market regulator may consider linking options market leverage to cash market positions. To simply explain this, SEBI is considering a proposal where only if you have certain amount of exposure in the underlying cash market, equivalent to that, like a multiple of that, could be the allowance as far as the options market exposure is concerned. Options market could be linked to the equivalent cash market through a derived formula. As I said, a formula will be put in terms of the cash market exposure, and a multiple of that could be allowed as far as the options market exposure is concerned. According to our sources, four things are what SEBI plans to achieve through this particular mechanism. One, increasing cash market liquidity. Second, reducing options market liquidity. Third, reducing excessive speculation and protecting retail investors. And fourth one, cut down on the ability of institutions like Jane Street to manipulate indices and make fast money. SEBI is also considering various other steps to sort of identify and plug any more loopholes as far as the options market is concerned. All these proposals could be discussed by SEBI's board very, very soon. Apart from that, to increase cash market liquidity, SEBI is considering a couple of steps like, allowing shorting in the cash market, also enhancing the SLBM or the loan against shares mechanism.
Okay, Yash, thank you so much for that. We'll be keeping an eye out on these capital market names as well, whether BSE, MCX, Nuvama, Angel One, all of them also in focus. But on that note, we're going to slip into a very short break. But remember to tune in to the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back. Well, it's time for a special segment, Quarter Se Quarter Tak, where we bring you earning expectations from each sector. Today, Reema is going to tell us Q1 FY26. How will it possibly be for the IT space? Reema, will we see some good news for the IT sector in this quarter?
Well, unlikely. So you're not going to see the usual strength that we typically see in Q1 because so far the visibility on demand reviving is very low. So let's look at the early indications from the CNBC-TV18 poll. Well, large caps are showing weakness while mid caps continue to lead the charge. This is the large cap picture, and as you can see, 4 out of the 5 large cap IT companies are likely to report a decline in their revenue. Commentary across the board is likely to reflect that while the macro environment hasn't improved in the last 3 months, the good part is it hasn't deteriorated. Now a little bit more about the guidance. Now, Infosys is likely to raise the current guidance. It stands at 0 to 3%, but they made acquisitions, and therefore that guidance could be upped. If the lower end of the guidance is raised from the current 0 to 1%, it's unlikely to signal anything positive. It's the upper end which needs to move on an organic basis. Now moving on to HCL Tech. HCL Tech too could upgrade the lower end of its guidance. So 2 to 5% may become 3 to 5%. But here is where the good news comes in. Mid-caps are likely to outperform and very strong growth. Look at Coforge. That's been leading the charge in the mid-cap space, and we're expecting about a 6.5–7% kind of a constant currency revenue growth on a quarter-on-quarter basis. Persistent is close to about 3.5–4%, and that's been the revenue run rate, at least quarterly growth rates for Persistent over the last couple of quarters, 3–4%. That's going to continue. Hexafair and Emphasis also upbeat. So mid-caps are likely to report stronger growth, and this is led by some market share gains and favorable portfolio. For instance, a few mid-cap companies have a little less exposure to manufacturing. So that's the key, takeaway. Large caps weak, mid-caps will continue. Now moving on to the stock price performance. As we've been highlighting, mid-cap IT has underperformed. On a year-to-date basis, the Nifty IT has underperformed by nearly 17%. Valuations for large caps are similar to their 5-year averages. But then again, they've got muted revenue. Earnings growth is expected to be fairly muted for the large cap IT companies. So in that context, even if the valuations are not expensive, are they cheap? It's the mid-caps where you are seeing a valuation premium. Now, the mid-cap IT companies are trading at 32–33 times PE on an average, about a 38–40% premium to large cap IT, which is at about 23–24 times. But that's because the mid-cap IT companies are also likely to report stronger growth. With high valuations are coming strong growth expectations. So this is the EPS estimates for mid-cap IT companies over FY25 to FY27. We spoke about Coforge's strong top-line growth this quarter of 6.5%. Well, they're likely to report a 38% EPS CAGR growth over FY25 to 27%. Hexafair Persistent could see about a 20% kind of growth, much higher than the single-digit EPS growth that large-cap IT companies are going to report. Now, what to watch from TCS, because that's the first one off the block on the 10th. Well, constant currency is likely to decline by 1.5%. The what to watch, the company last quarter told us that the international revenue growth, that's ex of BSNL, in FY26 is going to be better than FY25. Do they hold on to that? Does that commentary get stronger? And one puzzling factor for all analysts is that, margin expectations are not going up. And this is despite reduced contribution coming in from the low margin BSNL deal. So why is that not happening? Why are margins not expanding for TCS? And also, if you remember, last quarter, they decided to defer the wage hike. So the timing of the wage hike will be watched very closely this time. Back to you.
Okay, Reema, thank you so much for that. It will be important to watch out for IT companies, large cap IT companies not expected to do well. But on that note, we're going to slip into a very short break. Up next, we'll come back and talk about Trump tariff impacts on textile stocks and how is that expected to do going forward as well. We'll have Prerna Junjunwala of Elara Capital joining in with us.
Welcome back. You're watching us here on Halftime Report. We are seeing incremental pressure over the broader markets, down almost 0.8%. And a lot of these capital market plays are seeing a big cash. We have MCX, which is down 3.5%. Angel One down 6%. BSE itself is lower. And alongside that, we have names like 361 WAM as well, lower in today's trading session. But all eyes are on whether India gets a trade deal with the US or not. Parikshit joins in with the latest on what his sources are telling him. Parikshit, a deal very near for both India and US, at least a mini deal?
Well, Donald Trump says they are close to a trade deal with India. Frankly, everything is up to Donald Trump now. From the Indian side, we've given a decent proposal, a decent offer for a trade deal, which gives good access to industrial products from the US side to India, and also good access for labor-intensive sectors, MSMEs and SMEs from the India market. India has also drawn red lines that there can be no concessions on wheat, rice, maize, dairy, sensitive areas in agriculture and dairy, because they are very important for our farmers. And this is not just for US, it's for any trade deal, any country for that matter. We cannot offer concessions on these fronts. For the moment, sources telling us that negotiations from the Indian side are over. We've offered whatever we could and made the best offer we could to the US. It's really up to them to accept this now or give a hint or give an indication that they want more negotiations in the days to come. So what we understand is that Donald Trump and the White House are now assessing India's offer to see what are the kind of gains and wins that US companies are getting from this deal. Maybe in the next 24 to 48 hours, we will have some clarity. But sources also telling us that India is not just putting all its bets on the United States. We are working to have trade deals with multiple countries. Those negotiations are on simultaneously. And India is looking at various options to increase its export footprint as well.
It's in best interest of India as well. So you say 24 to 48 hours, we either get a deal or we get a letter. Is that what it is?
You know, it could be anything, Mangalam, frankly. It could be a letter stating that we accept your offer for a trade deal and we want to have an interim trade deal with you. Or it could be a letter saying that we are going to impose a reciprocal tariff on you. So let's see what happens. It's really up to Donald Trump. But India now, and sources here in the government saying that we are ready for any eventuality after drawing our red lines and giving the best offer.
It's up to Donald Trump. So let's actually go across and listen to what Donald Trump actually had to say on the trade negotiations with the partners, including India, where he mentioned that he's close to a deal after sending out a bunch of tariff letters to multiple countries. He's also said that these tariff letters are not a negotiation tactic, but they're pretty much the best that they can do.
If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now, yeah.
Are the tariff letters that you sent today final offers, or are they negotiable?
More or less final offer. We've made a deal with United Kingdom. We've made a deal with China. We've made a deal. We're close to making a deal with India. Others we met with, and we don't think we're going to be able to make a deal, so we just send them a letter. If you want to play ball, you have to. This is what you have to pay. So as far as I'm concerned, we're done. We're sending out letters to various countries telling them how much tariffs they have to pay. Some will maybe adjust a little bit depending if they have a cause. We're not going to be unfair about it. And actually, it's a small fraction compared to what we should be getting. We could be asking for much more. But for the sake of relationships that we've had with a lot of really good countries, we're doing the way I do it.
Okay, all right. Staying with the entire tariff discussion to talk more about the impact on textiles, we have with us Prerna Jhunjhunwala, who's the Vice President at Elara Capital, joining in on the line for her quick take. Well, Prerna, welcome to the show. Bangladesh has around 35% on textile imports in terms of a tariff, and that's a slight reduction from, say, what was imposed in April this year of around 37%. Vietnam, 20% in terms of textile imports. So given this, where does India stand to benefit?
Hello. In India, it all depends on the trade deal that is getting signed with the USA. As of now, with the no trade deal, we are at 26% after the baseline tariff gets over. But if we are signing a trade deal, we are confident that the tariff rate for India would be lower than these two countries, which should benefit in Indian textile sector for sure. Given that our players, our cost structure is positive, except the advantage that these countries
What about
to gain market share.
Okay, we have you on a scratchy line, Prerna. We're just trying to repatch that connection. India doesn't have a trade deal right now. It's about 28% is the tariff. They've shot off a letter to Bangladesh saying that it'll be 35%. Could you give us a sense on what Bangladesh's share of revenue from the US is? How does that compare with India? And what is the differential in cost of production for both Bangladesh and India?
Yeah, so the major differential on the cost front for Bangladesh and India is the labor advantage that they have. Their cost of labor is around $115 per month, whereas for India it is between $150 to $170 per month. So that would translate to a disadvantage for Indian cost structure by about 10 to 12%, which gets settled if the tariff rates are higher for Bangladesh against India. In Bangladesh market share for apparels is about 9.3% of which equates to around $7.3 billion for the US imports, whereas for India it is 5.9%, which equates to around $4.7 billion in CY24. So we have we have a differential of about 4% for total apparel imports of US, and that's where the opportunity lies.
Prerna, what about if the rate for India, there's no change in that, it's at that 26% which is currently there, then would we still have a benefit against Bangladesh, or that's not possible then? Given that, you're talking about the labor cost as well.
I think we will still have benefit against Bangladesh because we'll at least be at par on the cost structure, because as I mentioned earlier, we are at a 10 to 12% disadvantage on the cost structure because of labor. And that gets settled with the tariff differential.
Okay. Well, Prerna, where do we come in when it comes to taking advantage or real advantage of the opportunity in terms of scale and manufacturing capacity?
So Bangladesh is definitely much higher on scale than us today. They are at around $40 billion of overall exports of garmenting to the world as compared to India, which is at about $17 billion. So we need to definitely scale up our manufacturing capacities in the garmenting for sure to take advantage meaningfully from this tariff differential.
Prerna, there were some reports that were also suggesting, more like channel checks suggesting that, currently in terms of demand trends, there's high demand coming in for the spinning yarn, spinning mill side. Is that something you've seen on ground, especially, players given in Tripura and the China Plus One is working out for them? Is that something you've watched out for right now?
As of now, we're not seeing a very huge improvement in demand because there is a lot of uncertainty at this point in time from U.S. markets. Orders from U.S. markets are not at par with what they were at earlier in the same months. So export markets are not very favorable at this point in time. And in Indian markets also, we are not seeing a huge demand propping up because of weakness in the total apparel industry in the Indian market. So we're not seeing a major improvement or any order inflow in a major term for Indian spinners at this point in time.
So given all things where we stand with, tariffs, global demand, the raw material prices, our production, our costs, everything considered, what, according to you, would be the top picks that one should look at if they want to make a bet on the textile space? If you could give us a couple of names.
So we have a buy rating on Arvind Limited. That is our top pick from our coverage. We also like home textile players who have capacities in place and are having client relationships currently with most of the geographies that we are signing FTAs with, because India is not only a story on US tariff, differential. It is also a story which is structurally panning out for FTAs being signed globally, which government is trying hard. So, and textiles will be a major beneficiary of the same. So, home textile players who are having exposure to the and European markets as client relationship should gain and as well, along with government company. So Indocount and Welspun are our preferred companies in home textile space. In garmenting, any company which is expanding capacities should gain. So we like KPR from long-term perspective, plus Pearl Global, Gokaldas.
Okay. Sure. Prerna, just, I think we've got on a bad line, but I'm just going to try my luck. From a company perspective, not from a PICS perspective, from a company perspective, which one do you think would probably be most at an advantage to take, to benefit?
So from the company specific, that's what I mentioned, that the companies which will benefit the most are the companies which are expanding the most, because India doesn't have capacities. So companies like Pearl Global, Kitex, who are expanding real time to gain advantage of this situation, should benefit, though we do not have any rating on these companies.
Okay. Companies who are expanding will benefit the most. Thank you so much, Prerna, for joining in with us and giving us your views on the textile sector and what we're expecting in terms of Trump tariffs and which companies would benefit as well. But on that note, we're actually going to slip into a very short break. On the other side, we'll come back and Manisha Gupta will join in with us with Sumit Gupta of Avasara Global Commodities. Stay tuned in for that.
Welcome back. Joining us on the show is Sumit Gupta. He's CEO, Vasida Global Commodities. Sumit, hi, thank you so much for joining in. Your first reaction on the sowing numbers. While we do understand that the monsoon has been quite well, we've seen 14% above normal monsoon until time. But the sowing numbers, I mean, are they slightly confusing because we've seen sowing across board increase?
Hi, good noon, ma'am, and thank you very much for having me on the show. You know, monsoon and sowing numbers are two things which are completely interrelated because I was reading a book in which it was rightly and aptly defined that monsoon is the agriculture minister of India, and it is the one which decides the fate of almost 100 million farmers in this country. So, coming on the look at the monsoon this week has came a week early, around 23rd of May, and the monsoon has reached North India significantly earlier or week earlier than usually timelines. And in terms of spread of rain, what is more important to see, we have seen there are surplus pockets in central India, and there is slight shortfall, which is deficit, which is building up in Marathwada region, and it is not so evenly distributed in parts of Karnataka and Maharashtra. And if we look for the forecast of July month, it is not looking as great for Maharashtra and Karnataka, though IMD says the rainfall will be surplus in July. In total numbers, yes, it can be, but in terms of spread of rainfall is more important to witness for us. And and as we are putting the number of or the planting number, which is more critical, the sowing is early, sowing is not more. Because if you compare the last year's sowing number and this year's sowing numbers, and superimpose it with the monsoon arrival dates. Last year monsoon came late, and monsoon was not as good in June. Okay, this year we had very good pre-monsoon rainfall in May. It was one of the most wet May month in last maybe 50, 60 odd years. And then we had good June onset because of early onset of monsoon. And because of that, what we are witnessing at the moment is early sowing, not more sowing. Okay.
I get your point on that, Sumit, and very, very well said on that. But also, as we move ahead from here, pulses, of course, have been trading below MSP. We've seen some concerns for oilseeds as well. How would you look at the core cereals, something like maize, where there's a lot of thrust at this point in time? By the time it's July end or mid-September, that is until when the sowing for Kharif continues, where do you see more numbers continue to emerge?
In terms of, if I have to look at from the planting numbers point of view, today farmer has no option. Minimum MSP is not minimum support price, it's a maximum sale price possible for farmer at the moment. Because government is providing, in a way, support to farmer to sell it to them. But if you look at the procurement of pulses, if I'm not wrong, the chickpeas is around 400,000 tons. Pigeon peas is around 600,000 tons, as against production of 10 million tons in chickpeas and around 4 million tons in pigeon peas, and all commodities are still trading below MSP, and that is the case in oilseeds also. So farmer has no option but to either to move to pulses or oilseed. Last year, farmer has done this thing because pulses prices are significantly higher. And you have raised a very pertinent point on maize. Maize prices last 2 years have been pretty friendly for the farmer, and last year farmer responded with acreage increase. But with the government policy on the rice release to the ethanol plants, actually it has taken the incentive away from the ethanol plants to depend solely on maize. And that is where maize prices also for the large part of the season has traded below MSP. So, and given an option and looking at the benign rainfall which we are witnessing across the country, farmers will go for the aggressive crop. When I'm saying aggressive crop, that means where there's an upward yield potential. And which is that commodity? That is maize, largely in central, western, and south India. So you might see maize acreages significantly jumping over last year numbers. Soybean acreages may go down, and pulses may stay where they are. So overall, there will be a recalibration in favor of maize.
So, Sumit, when you say maize numbers could go higher, is there a percentage number that you're putting out there?
Yes, in terms of number, what we are witnessing potentially, central India, it can be as high as 15 to 20%. And on pan-India basis, it will be higher by 6 to 7%. On maize.
The other thing is the food grain numbers, Sumit, because every year we see government put out yet another record number in sense of food grain production from 2023-24, where it was a record number at 332 million tons. For 25-26, the number has been put at 354 million tons. Do you see India achieving those kind of great numbers?
And I will ask a question back to you, Manisha ji, about that. Okay, India is not exporting anything apart from rice. That means indirectly we are saying India is consuming more because government is not building stock. We are not exporting much. That means India is consuming a lot more grains than they were. One number that you can put is in ethanol. India, yes, is consuming 18 million tons of grains more year on year because of the ethanol blending program. In last, let's say this number has gone up from 2 million tons to 17, 18 million tons in last 3 years. Okay. But what about other consumption? And we should feel proud if that thing is happening. That means India's economic prosperity is working. Okay? And over a period of time, this deficit is going to grow bigger because Shivraj Chauhan ji yesterday made a statement that we will double our maize production by 2047. But is it sufficient? Because we are going to double our consumption in the next 9 to 10 years. Okay? So our consumption is moving at a rapid pace, and we have to look at those numbers along with the increase in production.
All right, Manisha, thank you for taking us through this conversation. Sumit, two nice punchlines you gave us. One was that MSP is maximum sale price and not minimum support price. And agriculture is, Monsoon is the agriculture minister of the country. Wow, I'll take those two with me along with the insights that you've given us as well. Take a short break, come back on the other side. Sachidanand Tekar from Trade Bulls joins in to give us some trading strategies. But if this morning you hit a snooze button and just got up, you have missed nothing on the Nifty. That's exactly what the ticker is telling you. Absolutely flat on the frontline index. In fact, yesterday's close on the Nifty was also 0.3 points, if you must. And right now it's just about 3 points on the way up, though it's recovered from the lows. And the range has been very narrow on the frontline index. So both the Nifty as well as the Nifty, the Sensex, if you look at it, the frontline indices, they are consolidating. But the key sectoral indices which are doing well are the Nifty Bank and the Nifty IT. Both of them come up for you, and that's a good sign for the market. The broader markets, they are under pressure. We look at the Nifty Midcap Index, the Small Cap Index, the Next 50, all of them down by almost 0.5% to 0.2% in some cases, with the advance decline far outnumbering, the declines far outnumbering the advances itself. The option writers aren't expecting a major shift from this range, because if you look at it, the 25,500 call writers are still active. The premium of 50 rupees telling you 25,550, thereabouts, a little closer to 25,600, there will be supply. But at the lower levels, 25,400 put is equally active for a premium of 65 rupees, telling you that around levels of 25,350, there would be support. So broad range, 25,350 to 25,600, no different from where we've been on the Nifty for the last many days. A lot of short positions added on these capital market plays. We've been talking about Angel One, BSC, CDSL, and a lot of long positions. However, on the other side, we have HDFC AMC, which is seeing some long positions being added, and Kotak Mahindra Bank, of course, after their first quarter update, is seeing fairly well long position build-up sort of bids coming in on that stock.
Okay, all right. So that's the F&O setup. We have Sachidanand Uthikar from Trade Bulls joining in to discuss the technicals of the market now. Sachi, thanks very much for joining in. If you could just give us a sense in terms of the Nifty strategy, considering that we've been in this consolidatory sort of mode in the past few sessions.
Good afternoon, Ekta. Good afternoon, Mangalam. I think clearly, the market is displaying that pause. But if you look at the overall trend structure, for the last 9 weeks or so, the Nifty has maintained its closing above its 5-week exponential moving average support. Now, this particular support is placed at 25,315 kind of a zone. And that's why I think the writers are also adamant out there. We are not expecting any move below this particular level, and hence the strategy has always been to accumulate Nifty close to that, close to its 5-day exponential moving average support, which is placed around 25,400. On the lower side, one can keep a stop loss at 25,320 on a closing basis. Eventually, we are of the opinion that the Nifty may scale towards 25,700 and even surpass that particular hurdle to rally towards 26,000. If you look at the overall structure on the weekly scale, the positioning of the weekly ADX is very important. It is on a verge of a breakout. Right now, it is quoting somewhere close to around 24, and a breakout about 25 would be a strong indication of directional momentum. So I think this pause is healthy for the overall trend structure. The bias remains positive, and the buy on declines strategy continues. One can keep a stop loss at 25,320 on a closing basis and expect a rebound back towards 25,700 during this particular week.
Okay. Sachidanand, also, what's your thought coming in on the Nifty Bank? What are the levels we should keep an eye out on there as well, given Kotak came out with good, Q1 updates coming in this time? Is there something important to watch out for there in today's trading session, as well as your top bets also that you're looking at?
For Nifty Bank, the data is suggesting a wide range towards 56,500 as a support and 57,500 as a immediate hurdle. But if you look at 60 minutes charts, there is a good convergence of its short-term averages, and that's why we believe that this relative outperformance may continue, and in fact may lead the Nifty as well to break out above that 25,500 juncture. So I think one can keep a stop loss at 56,920 from a trading perspective and expect a swing back towards 57,500. So bias for both the indices remain positive. Nifty Bank, as of today, is placed very well. But eventually, we see that Nifty could, swing towards that 25,500 hurdle and move towards 25,700. When we look at stock, both the counters that we are discussing right now we have communicated to our clients as well. That will be my disclosure. The first one is Tata Motors. If you look at the overall structure, for the last 4 trading sessions, the stock has been consolidating well. It has managed to sustain above its 50-day exponential moving average support, which is placed somewhere close to around 692. Even on the 60 minutes chart, so we are observing a kind of a triangular formation, which is again a consolidation contraction. We are expecting that the stock could see a good breakout above that 710 mark, and we may see a rally towards 750. Hence, we are recommending building long positions, keeping a stop loss at 688 on a closing basis. The first target would be around 710. The second target is placed at 750. The second stock which we have recommended is from the same space. Uno Minda has been in a very strong uptrend. If you look at the daily chart, there's a bullish pennant formation, which is again a good sign of continuation of strength. The OI addition has been significant, and we are expecting that this particular rally may continue towards its pattern target, which is placed at around 1230. Hence, we are recommending building fresh long positions here. One can keep a stop loss at 1088 on closing basis.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in and taking us through your strategies. We need to take a short break, but as we do that, here is some good news for our viewers. India's business news leader is now just a click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or the Google Play Store, or just scan the QR code on your screen.
Welcome back to Halftime Report on CNBC TV18. As of now, the last hour, we've seen 361 RAM. That's seen a bit of an increase coming in for the day's lowest point. Credit Access Grameen, Angel One, which has seen also an increase from the day's lowest point. So keep an eye out on all the stocks in today's trading session as well. We've seen a fall coming in all these names today, but some bit of a recovery from the day's low is what we're watching out for. But let's keep an eye out on the Pharma pack as well. Why are they buzzing in today's trading session? Seems like a lot of brokerages have come in as well this morning, Ekta.
Well, yes, I'll start with HSBC, which is written on Divi's Labs. They've upgraded the stock to buy, and a target price which is raised to 7,900 from around 5,000 odd rupees. According to them, there are long-term growth drivers driven by tirzepatide as well as other peptides and contrast media. They see a revenue potential of around $450 million from peptides and around $260 million from contrast media by 2030. They forecast FY25 to FY28 EPS CAGR of around 23%. Macquarie has written on pharmaceuticals as a whole. They've revisited the export-focused pharma space. US generics market is under pressure. Price erosion is expected to accelerate due to fewer drug shortages. Revlimid generic is nearing the end of exclusivity. Early than expected price erosion is likely to impact Q1 FY26 results for key players. Lower PE multiples for US-focused generic companies are possibly something that they're looking at amid changing dynamics. So they've downgraded Aurobindo to underperform. They've downgraded Dr. Reddy's to neutral. Cipla, Zydus, Lupin maintain their outperform, but they've cut the target prices on all three of them. Sun Pharma, they've reiterated an outperform with a target price of 2,135. Minimal US generics exposure benefits the outlook according to them. That's on the pharmaceutical space. But Leela Hotels is also in focus after Bank of America and Morgan Stanley have issued a coverage on the stock. Mangalam, you're looking at that. Tell us more.
Yep, the hotel sector has been on a cyclical uptrend, and that's exactly what they're betting on for Leela as well. Both Bank of America and Morgan Stanley have initiated coverage buy rating or overweight rating as far as Morgan Stanley is concerned, and they have target prices between 520 and 549. The thesis is pretty similar. The valuation is attractive at 20x FY27 earnings to EBITDA, and you have 12% revenue CAGR and 14% EBITDA CAGR that BofA is expecting, with net profit actually compounding at over 90% for the next 3 years on a very low base. Morgan Stanley says that the only risk to watch out for will be the concentration risk, where a large part of the revenue comes in from a small number of hotels. But apart from that, EBITDA grows at 12% over the next couple of years. Net income actually compounds and grows all the way up to 9 times as interest costs come down as well. So balance sheet of the company is nearly debt-free, leaving a lot of free cash flow to fund the upcoming capex cycle. So the hotel industry is doing well, and in that we have this one, which is a fairly interesting play as per these two brokerages.
Absolutely, but not only that, Mangalam, we're seeing Titan also, that's in focus today, and that's on the back of its Q1 updates. Not anything exciting, right? So not glittering today.
Titan's not glittering in today's trading session, and a large part of that could actually have to do with Maharashtra. Why is that? Because, the same time last year, we had Gudi Padwa in the base, and this year Gudi Padwa was in the 4th quarter. And if you compare Titan's numbers to, say, someone like a Kalyan or a Senco, it would look a lot lower, because Kalyan reported 31% growth, Senco reported 24% growth. A large part of Kalyan's revenue comes in from the southern part of the country. A large part of Senco's numbers come in from the eastern part of the country. So not much exposure to Gudi Padwa. But if you discount for that as well, 18% growth is what the company has reported. Gold price volatility affecting consumer sentiment is what they've said. Studded ratio was lower as demand for plain gold has come in at mid-teens, whereas studded has grown in early double-digit, which means that margins could be under pressure, and that's a bigger problem as against just the revenue growth of 18%. Buyer growth was flat as well. Some of their ancillary businesses did fairly well. Watches grew 23%, no problems there. Emerging markets led by the fragrances and women's bags business grew by 38%, though not very strong for the Taneira business, which is the saris business. And CaratLane grew about 38% as well out there too. There was decent same-store sales growth. Around 11 to 12% is what the company's overall same-store sales growth has been. The analysts were expecting 20 to 21%. In light of that, the company has reported 18%, which is why there is further disappointment on that stock.
Absolutely. Well, Titan is definitely losing ground in today's trading session. It's the top loser on the Nifty at this point in time, down around 5.5%. Thanks, Mangalam, for that. Well, for the markets as a whole, we have the Midcap index, which has recovered a tad bit, so just about lower by around 0.3% at this point in time. Advanced decline ratio still needs some kind of improvements, around 1,700 stocks advancing to around 2,000 stocks declining at this point. In terms of specific stocks from the broader markets, what really stands out in terms of gainers as well as good amount of volume is Edelweiss Financial. That stock is up around 1.5%, but trading on great volumes. And even Info Edge is up around 2% trading with big volumes in today's trading session. So those are a couple of broader market stocks which do stand out. Badamji Paper is down 2.5% from the broader markets. We have Moil, which is down around 2% as well at this point. Overall, quiet day for the Nifty, just about higher by around 15 odd points. Biding time before we do get that letter or trade deal. So let's see what takes place there. As of now, it's a wrap on halftime report. Business Lunch will take all the action forward.
Stocks trade in a narrow range after Donald Trump points to a possible trade deal with India after sending tariff letters to 14 countries overnight. Financials and energy stocks are gaining while healthcare and consumer durables are the big drags.
Sources tell CNBC-TV18 SEBI is weighing linking exposures in option segment to cash positions of market participants. The move follows alleged manipulation by Jane Street and the significant losses incurred by retail investors in F&O.
Kotak Mahindra Bank sees a strong business update in the first quarter with advances growing ahead of expectations and deposits also seeing a healthy trend, although term deposits remain the key driver.
Titan skids after it posts weaker growth than its peers in Q1 despite low base. What's more concerning is that the growth has come mostly from an increase in ticket size and not a rise in buyer numbers.
And Donald Trump sends out tariff letters to 14 countries that it is not close to concluding trade deals with, including Japan and South Korea. The new tariffs imposed from the 1st of August mostly mirror those that were put in place before the 9th of July pause.
Hello and welcome to Business Lunch live from the CNBC-TV18 Motilal Oswal studio. I am Vamakshi Doria and with me is Hormaz Patakia. Well, Hormaz, today is a rather muted day. Nothing much that is different as compared to what we saw yesterday, except the fact that the textile stocks are the sector of the day. We're seeing some very big moves come on all of these counters. On the other hand, the capital market players, they're not doing so well.
As has been the case over the last couple of days now for the markets. It is the last 3 to 4 days now, absolutely quiet, or at least on the benchmark indices. But yes, as Vamakshi was highlighting, the textile names, although they are off the highs of the day, but still they are the ones that are being significantly in the green. And on the flip side, it is the capital market names that are not doing well, be it the likes of BSE, Angel One, although they too have staged a bit of a recovery from the lows of the day. BSE still remains 6% lower. As you can see, at one point the stock was down 9%. So some recovery coming in from the lows of the day. And Angel One too at one point was down 6.5%. That has too trimmed its losses now down to 3.5%. But some other names that you see at the bottom of your screen, Nectar Life Sciences is one of those names, 20% lower. And this is after they had announced the sale of their API and formulations business earlier in the morning. So that is one stock in a lower circuit in today's trading session. So that is some of the movers. There are lots of activity, stock-specific activity in the broader markets, Vamakshi, and a lot of business updates as well that are putting in a reaction as well today.
Well, absolutely, Hormaz. All eyes are on the updates that have been coming from most of these companies. Take a look at Titan as well. You know, that stock has seen a big slump in today's trading session because the expectation was, like some of its other peers, the stock, the company would post a good provisional update, but that has not actually come through, and resultantly the stock is down and out in trade. What's also not doing too well is the pharma pack. Of course, barring Divislab, where there was an upgrade from one of the brokerages, but most of the stocks like Aurobindo Pharma, Lupin, Granules, all of these counters are actually down and out in trade today. What's doing well, on the other hand, is the IT pack. The Nifty IT index is the top sectoral gainer of the day. Take a look at Coforge. That stock is up almost 2%. Emphasis too doing quite well in trade today. But moving on, let's get the latest on the trade talks between India and the United States. Parikshit is joining in for more on this. Parikshit?
Well, yes, we believe that the ball is now in the court of Donald Trump. India has made a decent offer. That's what sources are telling us. It's a decent offer which gives access to US industrial goods in the Indian market. And at the same time, Indian labor-intensive sectors get good access in the US market as well. We believe that this proposed trade deal could literally cover $150 to $200 billion worth of goods traded between the two nations. When it comes to agriculture and dairy, there can be no concessions either for US or any other country for that matter. So be it wheat, rice, maize and dairy, India cannot compromise on giving market access to US companies in these areas. But there could be certain less consumed items, such as possibly blueberries, pecan nuts, which may get access. Sources also indicating that there will be no further negotiation from the India side. We have nothing more to offer beyond our proposal. Now the US has to clarify whether they accept this or they want more negotiations till the 1st of August. It is important to note that in the last 2 to 3 days, while the Indian side has been hopeful of a deal, while there has been intent to have a deal with the United States, India is also not putting all its bets on the US. Sources indicating that we have varying methods to diversify our exports. We are trying to increase our exports through many ways, and we are negotiating trade deals not just with US, but many other countries simultaneously.
Parikshit, thanks a lot for that update. Now, while the Trump administration says it is close to finalizing a deal with India, at least 14 other countries have been hit by huge tariffs. Here's a roundup of Trump's latest tariff actions.
Donald Trump on Monday began telling trade partners what tariffs they will face from August 1st. That's later than the original July 9th deadline, and the president appeared to suggest the new date wasn't totally set in stone.
No, I would say firm, but not 100% firm. If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now. We're always subject to negotiate something that's fair, but we've talked to most of the countries, and pretty much they've had their way for many, many decades, as you know. And it was time that we just wanted fairness. We've made a deal with United Kingdom. We've made a deal with China. We've made a deal. We're close to making a deal with India. Others we met with, and we don't think we're going to be able to make a deal, so we just send them a letter. If you want to play ball, you have to. This is what you have to pay. So as far as I'm concerned, we're done. We're sending out letters to various countries telling them how much tariffs they have to pay.
So far, 14 letters have gone out to other countries. Investor attention focused on the 25% levies set for major trading partners Japan and South Korea. However, the new tariffs do not add to previously announced duties on specific sectors. That means the rate for cars, for example, stays at the existing 25%, rather than hitting a cumulative 50%. The letters say that any retaliatory tariffs will trigger further US levies. And Trump says it's the least he could have done.
This is not really equitable from our standpoint, because it's just a small token by comparison to the damage that's been done over the years.
South Korea and Japan both said they would continue talks ahead of the new August 1st deadline. Among the other letters sent out, Laos and Myanmar were the worst-hit nations, with tariffs set at 40%. EU sources said they did not expect to get a letter and aimed to reach a trade deal by Wednesday. Earlier on Monday, US Treasury Secretary Scott Bessent said that he expected several announcements over the following 48 hours. He said his inbox was full of last-ditch offers.
Well, let's also hear out what William Lee, Chief Economist and Executive Director at the Milken Institute, and Nomura's Rob Subbaraman had to say on the tariff issue.
What President Trump was trying to do was say, bring your investments into the United States, bring your production into the United States, bring your technologies into the United States, and we will give you a protective barrier of tariffs to protect you from unfair competition from other countries. And right now, President Trump has sent out a bunch of letters saying, okay, you don't give me an offer, here's my offer to you, 25% tariffs. I think that surprised everyone by the fact that they were so low. But I think that's also President Trump's way of saying to everyone, let's talk, and let's talk now. Some of our closest friends have also been some of our most troublesome trading partners, including Canada. I mean, they're trying to protect the dairy industry. The Japanese are trying to protect their rice industry. Everyone's trying to protect their home turf in some way. And I think President Trump is saying, we acknowledge that, but let's try to remove as many of these home turf barriers as we can. Americans just consume way too much, right? And so that we have to live with the fact that we will have an overall balance of payments deficit. Where they're distributed, that's the thing he's trying to shift with these tariffs, right? He's trying to shift the deficits to our friends and take them away from our competitors.
The market is assuming that this gives more wiggle room for deals, and potentially is another case of Trump escalating to de-escalate. So markets have reacted, I think, fairly calmly given these rates. I think for India, it's interesting that India did not get a letter, and I think that does suggest that a deal could be actually very close and could be potentially on a relative basis quite positive for India. in all these letters, there was a clause around the tariff rate for transshipments. The tariff rates could be higher, and it does look like the Trump administration is starting to focus increasingly on China circumventing tariffs through third countries, and it wants to really crack down on that.
Time for a short break here on Business Lunch, but just as we do that, remember to tune in to the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. You can tune in to CNBC-TV18 Prime at noon for the Global Reset, 1 p.m. for the Big C, and the Global Lens at 8:30 this evening. Welcome back. Flat as flat can be for the index, and some flashes on your screen as well for Concor. The first quarter business update, total volumes up 11.5%, domestic volumes up 9%, the EXIM volumes too up 12% on a year-on-year basis. The stock down around about 1% in today's trading session. Remember, it just started trading ex-bonus last week, the 1:4 bonus issue that was given out. So the stock now 1% lower after its business update. But a very interesting study that the market regulator put out yesterday evening, and they had highlighted something similar last year as well about the derivative trading and the losses that individual traders make. Now, if you take a look at the figures, the index options turnover premium is down 9% on a year-on-year basis. However, you compare that on a 2-year basis, it's up 14. On a notional basis too, it's down 29% from last year, but at a 2-year basis, it's up 42%. Now, individual turnover too, down 11% from last year, but up 36% from the over a 2-year period. But the big number though is the 1,05,000 crore figure. That was the overall net loss that derivative traders made in FY25. I'm talking about the retail derivative traders, of course, and that is a 41% jump from the 74,000 crore loss that they had made in FY24. So the losses have widened in the derivatives market for individual traders on a year-on-year basis. Now, if you take a look at the common trend here, 9 out of 10 traders still continue to lose money, as was the case last year as well, and as has been the case over the last 4 years now, starting FY22, 9 out of 10 traders continue to lose money in the market. Now, if you take a look at FY25 on a standalone basis, analyzing it every single quarter, what has happened is that the net loss by traders over Q3 and Q4 has come down on a sequential basis, as has the number of traders, and that is because of the curbs that SEBI had issued, the measures that they had announced in November of last year, and starting November of last year until April of this year, they've announced a slew of measures, and since then that effect is seen there. And if you take a look at the other metric also, the percentage of loss-making traders is down from Q3 to Q4, and the average loss per trader, which in Q3 was 63,000 rupees, has now come down to 58,000 rupees on a sequential basis in Q4, although the numbers are still lower than what they were in Q1 and Q2, but they are still there is still a reduction seen on a quarter-on-quarter basis. Now, despite this, India continues to remain a very highly traded equity derivatives market compared to other markets, and that is what the SEBI study is indicating, and that is evident from the 5-year CAGR that you see. The index options notional CAGR over the last 5 years has doubled. So that goes to show the kind of activity you have seen, and the measures that SEBI has taken has impacted across categories. And if you see the number of traders comparing the December 24 to May 25, the number of traders for sub 10,000 rupee traded value is down 30%, 10,000 to 1 lakh is down 20%, 1 to 10 is also down 20%. And as the categories start getting bigger, of course, the number getting smaller, and there is a proportional reduction in that as well. So the common trend here is that 9 out of 10 traders still continue to lose money, but the losses though have widened from FY24.
Well, interesting data out there, almost just tells you, the big number, 1.05 lakh crore, the kind of losses that people are making in F&O. So, interesting story there. But moving on, let's get you an exclusive story. Sources are telling CNBC-TV18 that the SEBI may consider linking options leverage to cash positions. Yash tells us more. Yash?
Well, this seems to be a fallout largely of SEBI's investigation and action against Jane Street. What we've been given to understand from our sources is that market regulator may consider linking options market leverage to cash market positions. To simply explain this, SEBI is considering a proposal where only if you have certain amount of exposure in the underlying cash market, equivalent to that, like a multiple of that, could be the allowance as far as the options market exposure is concerned. Options market could be linked to the equivalent cash market through a derived formula. As I said, a formula will be put in terms of the cash market exposure, and a multiple of that could be allowed as far as the options market exposure is concerned. According to our sources, 4 things are what SEBI plans to achieve through this particular mechanism. 1, increasing cash market liquidity. 2nd, reducing options market liquidity. 3rd, reducing excessive speculation and protecting retail investors. And 4th one, cut down on the ability of institutions like Jane Street to manipulate indices and make fast money. SEBI is also considering various other steps to sort of identify and plug any more loopholes as far as the options market is concerned. All these proposals could be discussed by SEBI's board very, very soon. Apart from that, to increase cash market liquidity, SEBI is considering a couple of steps like, allowing shorting in the cash market, also enhancing the SLBM or the loan against shares mechanism.
Yash, thanks a lot for that update. Now, one of the stocks sulking in today's session is Titan, as Ramakshi just highlighted earlier. But the other business updates from other jewelry companies have been fairly decent. Earlier today, we did speak to Gautam Duggad, who is the head of institutional equities research at Motilal Oswal Financial Services, to understand his outlook on the markets, the stocks and the sectors that he is bullish on. Listen to what he had to say.
We remain very, very positive and constructive on jewelry. Titan has been our long-standing top idea in not just jewelry, but overall consumer discretionary space, and our view has not changed. Coming to trend, that is where we've had a tactical positioning change in our model portfolio now. We've replaced trend with Jubilant FoodWorks. For a company which is trading at 110, 120 P, there's absolutely no room for error. So there are quite a few additions there. Jindal Stainless is something we've added. UTI AMC is a new stock. As I mentioned, Radico, Jubilant, they are new additions. We've added Lodha, Macrotech basically. We've added Niva Bupa. So quite a few allocations, new allocations. And of course, we've also gone, we upgraded our stance on auto.
Well, let's slip into a very short break. But before we do that, here is some good news for our viewers. India's business news leader is now only a click away. Introducing CNBC-TV18's all-new app, get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back. You're watching Business Lunch on CNBC TV18. The United Arab Emirates has introduced a nomination-based golden visa for Indian citizens, offering lifetime residency for a one-time fee of approximately 23 lakh rupees. Earlier, pathways required a minimum investment of 5 crore in real estate or business commitments. Shivani Bajaj is here with more details.
Well, yes, the UAE has rolled out the refreshed Golden Visa scheme for Indians, slashing costs and widening eligibility in a move that builds on the India-UAE Comprehensive Economic Partnership Agreement, or the CEPA. Now, signed in 2022, CEPA aims to deepen trade, investment and mobility between the two countries. And this latest Golden Visa reform is a big step in that direction. Indians can now apply for lifetime UAE residency by paying a one-time fee of 1 lakh dirhams, roughly around 23.3 lakh Indian rupees, without needing to buy any property or start a business, which were mandatory under the earlier route. This is a major shift from the existing criteria that demanded around 2 million dirhams, which is around 4.6 crore plus, in property or business investments to qualify for the Golden Visa. This time, the visa has been opened up beyond high net worth investors and individuals, now available to professionals like teachers, nurses, scientists, digital creators, e-sport players as well too, rather than just HNIs and business owners. Applications can be filed directly from India through designated centers or online portals, and candidates will be assessed on professional credentials, clean background and potential contribution to the UAE's economy and culture. Now, experts believe that over 5,000 Indians are expected to apply in just the first 3 months, which is the pilot phase, with more than 4 million Indians already living in UAE. This opens new pathways for tax-free income, business opportunities and full family sponsorship as well, including children, parents and domestic staff. Back to you.
Well, as Vamakshi is already dialing Shivani's number to get more details on this, you can catch more on this on our website, CNBC-TV18.com. Moving on then, Israeli Prime Minister Benjamin Netanyahu, who is on an official visit to the US, has nominated President Donald Trump for the Nobel Peace Prize for, quote-unquote, his role in forging peace in the Middle East. Now, at a meeting in Washington, D.C., he even shared a physical copy of the letter with Trump. Here is what happened.
I want to present to you, Mr. President, the letter I sent to the Nobel Prize Committee. It's nominating you for the Peace Prize, which is well-deserved, and you should get it.
Thank you very much. This I didn't know. Wow. Thank you very much.
Thank you.
Coming from you in particular, this is very meaningful. Thank you very much.
Meanwhile, even as Netanyahu spoke of peace in the West Asian region, Israel bombed Houthi ports and a power plant in Yemen, its first such strike in a month. The military said the strikes were in response to repeated Houthi attacks on Israel.
Well, with that, we call time on this edition of Business Lunch. We leave you with the markets just as flat as they were when we started off the day. The Midcap Index, though, is staging a bit of a recovery from the lows of the day. From Amakshi and me, thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. We are live from the CNBC-TV18 Motilal Oswal studio. For the markets, Nifty has seen some recovery from the lows. Bank Nifty is the one which is supporting those gains that we are seeing. Midcap's under pressure, but there has been a recovery again. So recovery is the theme that we are tracking right now. We'll have to see whether that stays or not.
That's right. Good afternoon, Sonal. You're actually looking at the markets, especially in the mid-cap index. It looks red, but there's been quite a bit of a sharp recovery, especially in the last half hour of the session. But we have a lot lined up for the show, so let's start off with the top headlines. Stocks trade ranged after Donald Trump points to a possible India trade deal after sending tariff letters to 14 countries. IT and private banks gain, while healthcare and pharma drag. Mid-caps lag.
Textile stocks like Gokuldas Exports, KPR Mills and Arvind see strong gains as the United States imposes a 35% tariff on textile imports from the Bangladesh.
Brokerage firm Macquarie downgrades Aurobindo Pharma to an underperformed rating, also cut its target to 1,010 rupees a share from 1,700 rupees earlier. The stock is lower by 4%.
Merchant bankers of Schloss Bangalore initiate coverage on Leela Hotels. BofA Securities has a buy call with a target of 520 rupees a share. Morgan Stanley initiates with an overweight rating and target price of 549 rupees a share. They expect 12% annual EBITDA growth through FY27. Okay, those are the top headlines in some stocks that we are tracking as well. For the markets, as we've been pointing out, it is recovery, which is the theme of the day. And that is something that we've seen on the Nifty, which is up around, which is actually quite flat, but it has recovered from the lows. The Bank Nifty is the one that should come up for you on the screen right now. That one is in the green, and that led to majority of the gains that we've been seeing as well. Mid-caps, those are the, that is the pocket which was under a bit of pressure, 0.7% lower at a point in time, but there has been a massive recovery at around 12 p.m. So watch out for that one. The small cap index too has seen a recovery. And for more names, of course, we'll go to Hormaz in just a bit.
That's right. The capital market team, I'm sure Hormaz has that on his list. BSE is the one. It's seen a very, very volatile trading session, a very sharp intraday dip, followed by a bit of recovery. But Hormaz, I'm sure you have the capital market teams and a whole host of other stocks too. This is our special segment, Midcap Movers. Hormaz is standing by the wall.
Most certainly, capital markets, yes. But before we get to that, of course, the theme of the day before the capital market stock started to fall was textile. And the textile names, although they have fallen off the highs of the day, they're still holding on to some bit of gains. The CRM Silk Mills at one point was up 12%, still holding on to a 6% advance. Vardhaman Textiles up 5 to 6%, still up 4%. Gokuldas in the earlier part of the session was up around 6%, still holding on to gains of around 2.5%. And the capital market names, as you just mentioned, they too are staging a bit of an intraday recovery. BSE being the choppy one in today's session, at one point was down 9%, still around about 6.25% lower. Angel One was down 6.5%. That has trimmed its losses, as has CDSL and as has 361 WAM, still in the red, but off the lows of the day. The sector that is sulking today is Pharma, and be it large cap Pharma or be it mid cap Pharma, they are the ones that continue to trade lower. Be it Aurobindo, Lupin, Granules, Zydus, all of them trading with losses of anywhere between 2.5% to 4%. Some stocks that are doing well on the volumes front in today's session, they are the ones that are bucking the trend. And look at Sonata Software and look at Midcap IT as a space in general is doing well. Sonata Software now up 7% on very strong volumes. Look at Lemon Tree, Aavas Financier, CEAT is 5% higher now on very strong volumes. And lastly, a sector that I wanted to put the spotlight on, a couple of pipe names. Look at Hariom Pipes, 9% higher on that stock, off the highs but still holding on to gains, and Venus Pipes too, moving in tandem with that, 5.5% higher on that stock as well. Back to you guys.
All right, so we'll be talking about what's happening with one of these stocks as well in just a bit. That's Hariom Pipes. But thank you so much, Hormuz, for joining us as always. But it's time to welcome Shrikant Chauhan of Kotak Securities for a technical check on the markets. Shrikant, good afternoon. Thank you for joining in. What's the next important level on the Nifty you're watching out for?
Yeah, good afternoon, Sonal. Good afternoon, everyone. See, like for Nifty, it is in the range. It is not crossing the important crucial mark of 25,500 since the last 3 days. And till the markets are like quoting below the levels of 25,500, we are going to see range bound sort of activity. But while looking at the overall performance of stocks in today's date, I'm of the view that eventually the market is going to cross the level of 25,500, and we may even see the levels of 25,800 in the near term. That's the overall view. The strategy should be to look for adding position if there is any correction in the market. And for Bank Nifty, there also we are expecting range-bound activity, but today it is relatively better than Nifty, and it is quoting above the levels of 57,100, which is positive. So based on its formation, there also I am expecting 57,500 or 700 sort of levels in the near term.
Okay, Srikanth, and any individual picks you have for our viewers today?
Yeah, in that most of these mid-cap companies, they are doing well, Vivek. In that specifically, we like persistent system, and today we are seeing good amount of buying interest in mid-cap IT companies. So value buying is definitely going on in the market, and in that specifically, we like persistent system, which is around 5,900. There, if we consider the its technical pattern of last 6 months, then it is forming higher top, higher bottom series. And based on its formation, the stock can move towards the levels of 6,200 or 250 in the near term. So it's a buy at current levels with a stop loss close to 5,800. The other stock which we like is newly listed stock, that is Rise, which is currently around 110, 112 levels. Whenever there is a rally in the stock, we are seeing good amount of buying attraction, and the stock is always crossing its previous high, which is positive. So based on its technical formation, Rise also can move towards 130 in the near term. That's the overall view. And we should look for adding at current levels more on dips with a stop loss close to 100 rupees.
All right, Srikanth, thank you so much for joining in. Rise Industries is up 8.5% as we speak. With that, remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back to Midcap Radar. Well, one particular pocket of the market or one particular segment of the market that's doing very well is the entire textile pack. This is rallying post-Trump's tariffs, as Trump has imposed a 35% tariff on exports from Bangladesh. Winnie now joins in with more details.
Hi, good afternoon. So yes, in terms of the tariffs that have been imposed on Bangladesh, that is at a 35% rate. 35% rate. Now, obviously, what it was previously for Bangladesh was 37%, so a slight bit of a reduction there. Now, other than that, for textile players, also Vietnam, when you're looking at it, US has imposed 20% tariff rates on them as well. Now, India currently is at 26% in terms of tariffs for textile. So, obviously, you will see that benefit coming in for India versus Bangladesh, because 35% versus 26%. So, that is a benefit there. Now, other than that, market share. You know, if this continues and this 26% rate is still there for India after we actually see the deal happening between India and US, then obviously we'll see a bit of an advantage coming in on that front as well, because market share of India is just at 6% in terms of what we are importing. Overall imports to the US from India is just 6%. Then we have Vietnam, which is at 19%, and Bangladesh, which is at 9%. So we'll stand to gain versus, you know, Bangladesh or China as well. Vietnam currently, they have an upper hand versus India, given that their rate is 20% versus 26%. Now, obviously, if the deal goes through, competitive edge and the tariffs are lowered for India or remain at this rate, then we'll have a competitive edge versus other exporting countries except for Vietnam. And if the rates remain unchanged, then Vietnam will continue to have a competitive edge over India as well. So important to watch out for. But today, because Bangladesh's rate is at 35%, which is higher than India, as of now, we'll wait out for our trade deals coming in as well. Textile stocks are waiting, given that benefit coming in there.
Oh, yes. So some of these stocks in focus. Thank you so much, Vinny, for joining in. Earlier today, we spoke to Prerna Junjunwala, Vice President at Elara Capital, with this and the impact on the entire space. Listen into what she had to say.
With the no trade deal, we are at 26% after the baseline tariff gets over. But if we are signing a trade deal, we are confident that the tariff rate for India would be lower than these two countries, which should benefit in Indian textile sector for sure. Given that our players, our cost structure is positive.
Well, no wonder then you're seeing the entire textile pack doing quite well for themselves in this session today. But moving on, one stock, one we don't discuss too often, is Hariom Pipes. You know, they came out with a provisional update. Nigel joins in with more details.
Well, that's right. Hariom Pipes, if you look at it from the recent high of more than 800 rupees, the stock saw a sharp correction. In fact, it halved from the top. For the last couple of days, it's been buzzing on solid volumes. One particular reason is that over the weekend, we got their quarterly update, and they look rock solid. So if you look at the volume number, there's a solid growth of more than 30% on a year-on-year basis. And as we know, the value-added products as a percentage of the total mix is rather high. So this is something that the street has caught on to. Besides that, at the start of this year, they had promised a 30% volume growth, not only for FY26, but for FY27 as well. They said for the next couple of years, they're looking at a volume growth of closer to 30%. Besides that, they're going to be ramping up their expanded facility with particular focus on value-added steel. They're also looking at further spreading their wings in Tier 2, Tier 3, as well as in rural markets. And they're also looking at strengthening their presence, their dealer network, both in Western as well as Northern India. So put all this together, the Q1 numbers, well, it's walking the talk because they've guided for 30% and they've delivered more than 30%. The street likes that. Well, just to give a reference point, if you look at APL Apollo, on a very, very large base, that one delivered a growth of only around 10% on a year-on-year basis, while Hariom, that's total capacity, around 700,000 tons, is equal to what APL Apollo delivered in the first quarter itself. Though on a larger base, APL Apollo delivered only 10% growth, Hariom has delivered close to around 30% growth. And APL Apollo, actually, they're lagging behind, because for the year, they have given a 20% volume growth. So we'll have to see how they catch up in the coming quarters. Nonetheless, the street likes it. They also have some valuation comfort because it trades at around 10 times EV on EBITDA. Larger players like an APL Apollo trade at around 30 times EV on EBITDA. Even the recent listing, actually, Sadbhav Steel Tubes, that trades at around 35 times on a PAT basis, while this smaller name trades at around 25 times on a trailing PAT basis. So put all this together, good operational update, promising better times ahead, and valuation comfort is the reason that Hariom Pipes, after correcting to nearly half of what it was, has popped up in trade.
All right, that explains the move. Thank you so much, Nigel, for joining us and explaining to us what's happening with this particular stock. The pipe space is buzzing in general as well. But let's talk about the other name that is on our radar. Leela Hotels is in focus. There are some initiating coverage reports. Mangnam is joining us with the lowdown. Mangla.
There are a couple of initiating coverage reports on Leela Schloss, which is, the Leela is listed by. The stock at the high point of trade And that's because Morgan Stanley is bullish, and as is BofA Securities. So BofA Securities have initiated coverage. They have a buy rating. They have a target price of 520 rupees. They believe that the company's revenues going forward can compound at around 12%. EBITDA can compound at 14%. And on a low base, led by lower interest costs, the net profit can actually compound by over 90% over the next 3 years as well. And for all of this, they do believe that the valuations at 20 times EV to EBITDA for FY27 are fairly attractive. So as a result of which, they're bullish. On Morgan Stanley as well, they've initiated coverage with an overweight rating. Their target price is a shade higher than that of BofA Securities at 549 rupees. And they believe that, the only risk that the company has is that of, one, the cycle turning on the downside, but that's for the entire sector. Specifically for Leela, concentration risk, a large part of revenue and profitability coming from a small number of hotels is something that we'll have to keep an eye out on. But X of that, they expect the EBITDA for the company to grow 12% compounded over the next couple of years. And the net income will increase 9 times as even interest costs come down, which means that the balance sheet, which is currently net debt-free, also will keep throwing up a lot of cash for them to benefit from the upcoming capex cycle. So hotel sector has been doing well over the last many years, the last 3 or 4 years at least. And from here on, Leela is likely to do better, is what the belief of both Morgan Stanley and BofA Securities is.
Thank you so much, Mangalam, for joining us. And as you can see, the stock high by over 5% on good volumes today. But moving on, pharma stocks are in focus. This is post multiple brokerage notes and varying themes. Ekta joins in with more details.
Well, I'll start with HSBC on Divi's Labs. They've upgraded the stock to a buy with a target price of around 7,900 odd rupees. The long-term growth is going to be driven by factors such as tirzepatide as well as other peptides and contrast media segment. They see revenue potential of around $450 million from peptides and $260 million from contrast media by 2030. They forecast an FY25 to 28 estimated EPS CAGR of 23%. Macquarie has written on the entire pharma space. They've revisited the export-focused pharma space. US generics market is under pressure. Price erosion is expected to accelerate due to fewer drug shortages. Revlimid generic is nearing the end of exclusivity, and early than expected price erosion is likely to possibly impact Q1 FY26 results for key players. They're looking at lower PE multiples for US-focused generic companies amid changing dynamics. Aurobindo downgraded to underperform. Dr. Reddy's downgraded to neutral. Cipla, Zydus, Lupin, they've maintained their outperform ratings but cut the target prices. Sun Pharma, they've reiterated an outperform with the target price of 2,135. Minimal US generics exposure benefits outlook according to them.
All right, that's about the pharma space. Thank you so much, Ekta, for joining us with all those details. With that, we'll slip into a break. Here are some good news for our viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back to Midcap Radar. Well, it's now time for our special segment, Quarter Se Quarter Tak, where we bring you earnings expectation from each sector. Today, Rima will tell you how Q1 FY26 is expected to pan out for the IT sector. Rima, Q1, will we see some good news from the IT pack?
Well, unlikely. So you're not going to see the usual strength that we typically see in Q1 because so far the visibility on demand reviving is very low. So let's look at the early indications from the CNBC-TV18 poll. Well, large caps are showing weakness while mid caps continue to lead the charge. This is the large cap picture, and as you can see, 4 out of the 5 large cap IT companies are likely to report a decline in their revenue. Commentary across the board is likely to reflect that while the macro environment hasn't improved in the last 3 months, the good part is it hasn't deteriorated. Now a little bit more about the guidance. Now, Infosys is likely to raise the current guidance. It stands at 0 to 3%, but they made acquisitions, and therefore that guidance could be upped. If the lower end of the guidance is raised from the current 0 to 1%, it's unlikely to signal anything positive. It's the upper end which needs to move on an organic basis. Now moving on to HCL Tech. HCL Tech too could upgrade the lower end of its guidance. So 2 to 5% may become 3 to 5%. But here is where the good news comes in. Mid-caps are likely to outperform and very strong growth. Look at Coforge. That's been leading the charge in the mid-cap space, and we're expecting about a 6.5–7% kind of a constant currency revenue growth on a quarter-on-quarter basis. Persistent is close to about 3.5–4%, and that's been the revenue run rate, at least quarterly growth rates for Persistent over the last couple of quarters, 3–4%. That's going to continue. Hexafair and Emphasis also upbeat. So mid-caps are likely to report stronger growth, and this is led by some market share gains and favorable portfolio. For instance, a few mid-cap companies have a little less exposure to manufacturing. So that's the key, takeaway. Large caps weak, mid-caps will continue. Now moving on to the stock price performance. As we've been highlighting, mid-cap IT has underperformed. On a year-to-date basis, the Nifty IT has underperformed by nearly 17%. Valuations for large caps are similar to their 5-year averages. But then again, they've got muted revenue. Earnings growth is expected to be fairly muted for the large cap IT companies. So in that context, even if the valuations are not expensive, are they cheap? It's the mid-caps where you are seeing a valuation premium. Now, the mid-cap IT companies are trading at 32–33 times PE on an average, about a 38–40% premium to large cap IT, which is at about 23–24 times. But that's because the mid-cap IT companies are also likely to report stronger growth. With high valuations are coming strong growth expectations. So this is the EPS estimates for mid-cap IT companies over FY25 to FY27. We spoke about Coforge's strong top-line growth this quarter of 6.5%. Well, they're likely to report a 38% EPS CAGR growth over FY25 to 27%. Hexafair Persistent could see about a 20% kind of growth, much higher than the single-digit EPS growth that large-cap IT companies are going to report. Now, what to watch from TCS, because that's the first one off the block on the 10th. Well, constant currency is likely to decline by 1.5%. The what to watch, the company last quarter told us that the international revenue growth, that's ex of BSNL, in FY26 is going to be better than FY25. Do they hold on to that? Does that commentary get stronger? And one puzzling factor for all analysts is that, margin expectations are not going up. And this is despite reduced contribution coming in from the low margin BSNL deal. So why is that not happening? Why are margins not expanding for TCS? And also, if you remember, last quarter, they decided to defer the wage hike. So the timing of the wage hike will be watched very closely this time. Back to you.
Thank you so much, Rima. So all eyes on TCS at least, to start off the Q1 earnings season as far as the IT pack is concerned. Margins as well as the wage hike will be the key questions that analysts as well as investors will have on their mind. Well, one particular stock from the broader end of the markets is an auto ancillary company that we're talking about, and the name of the company is Bellrise Industries. Remember, it's a recent listing. Today, the stock is up over 7% on very, very strong volumes. What exactly has transpired here? Well, very interestingly, Jefferies today has initiated coverage on the stock. They have a buy rating and a target price of close to 135 rupees a share. Remember, the company makes auto ancillary parts for the auto space, two-wheelers as well as four-wheelers. And on the back of this particular initiating coverage report from Jefferies, that stock today is doing very well in the session. Well, a couple of other stocks that we could keep an eye out for. The first one, of course, is Voltas. News reports indicate that the company has gone ahead and launched a new series of fans or a new range of fans, while that stock has recovered quite sharply and now trading near the flat line. On the other hand, one of the competitors, which is Crompton Greaves Consumer, again, a renowned fan maker, that particular stock is bearing the brunt of selling pressure. That stock is now trading near the day's lowest point. Some recovery seen as far as the entire realty pack is concerned. Prestige Estate has managed to move to the day's highest point, and the entire capital markets team, all of them, especially MCX, has managed to rebound quite sharply from the day's lowest point. But with that, it's all the time we have on this edition of Midcap Radar Mutual Fund Corner when we return.
Hello and welcome. You're tuned into MF Corner on CNBC-TV18. I'm Sonal Bhutra. With me, as always, is Winnie Motiwala. Winnie, good afternoon. We keep talking about where to invest, but today we are going to be talking about how to invest, different ways in which we can invest into mutual funds. So let's get going with that interesting conversation.
Absolutely, Sonal. Good afternoon to you as well, first. And, obviously, given that, this industry has seen such a surge coming in, especially over the last decade, it's going to be important to understand the different ways of investing, right? So whether you're investing through a demat account, now there is a traditional way of statement of account as well. What is more important? Which one you should be choosing? Where will you see an impact coming in, either in terms of your convenience, your cost, your flexibility? What is better for you in terms of the ways to track your portfolio or start investing as well? Now, to talk to us about all of this, we have Kirtan Shah, who is the founder and CEO at Credence Wealth, and Rushabh Desai, founder at Rupee with Rushabh Investment Services, joining in with us. Kirtan, as well as Rushabh, good afternoon, and thank you so much for joining in with us. I want to start by and talk about, these two ways that are there of investing, or that has come up now. What is the main difference between, investing, whether you have a demat account, like how you invest in stocks through your demat account? Obviously, that's possible through for your mutual funds as well, or your SOA, that's the statement of account for mutual funds, especially in SIPs and redemptions. What is the difference there? Kirtan, let me start with you first. What are we watching out for in differences here? What is the key over here?
Winnie, thank you so much for having me on the show. Winnie, like you rightly pointed out, demat is as straightforward as you would have otherwise known when you buy and sell stocks, right? So similarly, when you buy and sell mutual funds, and if it reflects in your demat, it's exactly similar to how stocks operate. But SOA, which is a statement of account, like the name suggests, it's a ledger or a record of transactions that the AMC directly has every time you do a transaction. So every time you buy and sell or a dividend is received, it's actually recorded in the SOA, and it is directly with the AMC. Unlike a demat, which is probably with a broker and then there is a DP involved, over here in an SOA, you are directly communicating or transacting with the AMC directly. You did point out two data points here where we spoke about SIP and redemption. If I can throw some light on that, when you do it through the SOA mode, you typically have an ENACH that you have with the bank for an SIP. So because the bank has a direct link through the ENACH with the AMC, every time that 5th of the month or the 10th of the month comes, that is your account is debited, and it is invested to the AMC, and you receive units versus that. What happens in a demat typically is that all of these features like the STP or the SIPs or the SWPs are not as convenient or not as straightforward as in SOA. Of course, a lot of brokers now have technology in place or APIs that they use to do this transaction. But in a demat, every time that SIP hits or an STP hits, it's actually a new transaction that's happening, unlike in an SOA, which acts like an SIP in the normal phrase that you and I understand. Also, in redemption, because you are directly working with or transacting with the AMC, right? There is no intermediary as such there. But in a demat, when you put a redemption transaction, there is a DP, there is a broker, and then the money comes to you. So there is a sound possibility that probably in the demat you might see a little delay in terms of receiving the redemptions versus the SOA.
Got it. Thanks for explaining that, Kirtan. Rushabh, let me come to you and take this one step forward. We've understood what it means, what the operational differences are. But how do costs and charges compare between demat and statement of accounts? There will be fees, transaction charges, exit loads. Are the investors clearly informed about the differences they will have to pay in terms of costs or in terms of compliances once they choose between the two?
Hi, Sonal. First of all, thanks so much for having me on the show, and it's good to see you back on the air. As Kirtan already beautifully explained, the difference between a demat and SOA. The demat certainly has annual charges for sure, which the client would need to pay. And over and above that, whenever the client does any kind of transaction, especially in stocks and in ETF, there can be additional transaction charges over and above of these annual charges. So there are two charges levied here. One is the annual charges, and second is the transaction charges which the investors need to pay here.
Right, Rushabh? Rushabh?
Yeah.
Yeah, you were making a point.
Yes. So basically, there are typically two charges here, Vinny. So one is the annual charges, which I just mentioned. It depends on the demat account, what the client is holding, either from the annual charges varies from banks to banks and demat account to demat account. And of course, the transaction charges also vary. So the investor needs to be very careful, in choosing the demat account, because there will be annual charges as well as the transaction charges here.
Okay. Kirtan, does an investor actually lose a bit in terms of flexibility or benefits, like maybe switching to STP or a direct AMC access? When you choose any of these, where is it, especially in terms of demat? Is there a possibility of that, one could face an issue on that front?
Winnie, yes, there definitely is one. So like I was explaining in my first answer to you, what typically happens is when you transact in a demat, you are not directly transacting with the AMC, right? So an STP, which requires a switch, or an SWP, all of these are inbuilt features that the broker may offer to you, right? So the broker may put a technology in place which is then coordinating and communicating at the back end in terms of transaction, where each of these transactions are actually not the same way that happens in an SOA, because in an SOA, the transaction is happening directly with the AMC. So it is quite possible that the broker that you are transacting with probably may not have an SWP feature to offer to you or an STP feature to offer to you. Most brokers that I know of have solved for the SIP problem, where they have an API in place and that acts as a new transaction or a new buy order every time the SIP clicks. But I see a lot of brokers don't have the STP and the SWP option, and hence it definitely impacts the flexibility, which is actually not the case when we talk about SOA.
Okay, we take that point. Rishabh, do you have anything to add on this?
I more or less agree with what Kirtan had to say. Definitely in terms of STP and SWP seems to be a little bit of an issue. But overall, in both methods, whether you go through a demat account or through digital platforms directly, through third party or the AMCs, usually now in today's time and age, the technology is more or less in place. So any kind of purchase, redemption, and SEP is quite seamless in my humble opinion. But yes, as Kirtan already mentioned, that SWP and STP can be a little bit of an issue right now.
Okay. Kirtan, 2 points that I want to also know in terms of nominee registrations, inheritance, and the ease of transmission that comes in between a demat and a statement of account, as well as in terms of any taxation or tax nuances or regulatory front that one should be aware of between demat and a statement of account. Is there any difference on that front for us?
So I think if I can take the first part first, see, typically what happens is you have platforms like the MFU, which allow you to, kind of update your nomination details, which can be then seamlessly taking care of all the folios across AMCs that you are invested across. But of course, demat has a slight advantage here over an SOA when it comes to inheritance, because what typically happens is if something happens to the account holder and that has to get transferred to the nominee, you will have to do individual paperwork, while at the aggregate level, platforms like MFU and all can help you standardize the process, but you will still have to reach out to each AMC with paperwork for the transition to take place from the account holder to the nominee or in terms of inheritance. So that definitely is a small challenge when it comes to SOA, because you will have to transact with each of these AMCs independently and individually, unlike a demat where probably this transition is quite smoother than SOA in my opinion.
We take that point. So Rishabh, anything to add to that? Plus, between the two, what would you recommend to an investor, or is it whatever suits their preference at the moment?
See, at least at this point of time where we are a country where, equity investing and mutual fund investing is so underpenetrated, I think investors first need to concentrate on, building, understanding mutual funds and, how they are transacted, and you can actually do that without a demat account. You actually don't require a demat account while purchasing and selling. And there are multiple platforms where you can do transactions very beautifully today. But yes, in terms of, little bit a sophisticated investor or an HNI or an ultra HNI investor, who has multiple asset classes, multiple products, multiple transactions, and a huge amount of money which he or she deals in, then definitely a demat account is certainly required. So I think in terms of all these nitty-gritties, absolutely for a sophisticated investor, demat account will make his or her life much more convenient in terms of even transferring units from person A to person B, which really helps in terms of inheritance as well. But actually, from a basic standpoint, you really don't require a demat account while executing it, especially in normal mutual funds, which are non-ETFs, Sonal.
And Kirtan, what would your suggestion be? If someone is just starting off, then would it matter, whether it's a demat or a statement of account, the traditional way? What would you suggest?
I think if an investor is typically looking at doing mutual fund investing where she is looking at doing SIPs or STPs or SWPs, which is very basic long-term wealth creation using investments in intermediaries over a period of time, I think SOA is far simpler in that context. But of course, if there is a sophisticated investor like Rushabh was mentioning, where she's looking at doing ETF kind of investing or direct stocks or PMS kind of investing, I think for that set of investor, demat is definitely the need of the hour. But somebody who's starting afresh and is looking at investing over a period of time using SIP kind of model in mutual fund, I think SOA is more than enough.
Got it. Take that point, Kirtan. It's a very interesting conversation, but we'll do one thing. We'll take a quick break. On the other side, we'll take up another topic and discuss in detail about that, what's happening with the market returns and what's happening with the way mutual funds have performed in the last 2 to 3 years. Stay tuned for that. Welcome back. You're still tuned into MF Corner. We still have with us Kirtan Shah and Rushabh Desai. We've seen recent mutual fund returns, which are soaring in some of the equity funds. They've delivered over 30% in just 6 months. This brings about the question, will these returns revert to the long-term market average, or is a new normal emerging? This matters for anyone planning their financial future, as aligning expectations with market realities is key to smart investing. So we take these questions to our guests. Rishabh, this time let me start with you. We have seen funds delivering 30% plus CAGR over last 3 to 5 years. Will we see them sustain this outperformance across market cycles, or do top performers typically lose their rank after corrections? What next for these high-performing candidates?
See, it looks very difficult. 3 to 5 years, 30% CAGR is absolutely mouth-watering, and we saw a phenomenal bull run over the past few years. So I feel that the next 3 to 5 years could be a little bit difficult to get 30% CAGR returns. But let me give you some perspective, Sonal, for you and your viewers. See, we did see a good price correction, and we are currently in a time correction. So the markets are stagnated over the past few months, at least at this point of time. So if there is ample of liquidity and if the earnings are healthy over the next in the next few years, I don't see a reason why equity products cannot deliver superior double-digit risk-adjusted returns, right? But over the longer period of time, what typically happens is that these kind of 25-30% CAGR returns kind of normalize and come down to probably say around 20%, 18% or 17% or so. But if you time it well, if you invest it in the right style, if you take probably say contrarian bets, say for example, momentum did very well last year. But during this market correction, momentum strategy got beaten down hands down. I mean, we saw hefty drawdowns of negative 25 to 30% in many of the momentum strategies. So probably if someone would have invested at this point of time in momentum strategy, then definitely there is no reason for me to believe why we cannot get a superior double-digit risk-adjusted returns over the next 3 to 5 years. But it's very important to be in the right strategy and take contrarian bets if someone really wants to generate some superior returns over the longer period of time. And what you just mentioned, that typically, yes, the top performers keep on changing from time to time. Let me give you some very interesting data on this as well, Sonal. See, I pulled out around 250 to 300 equity mutual funds, and we saw that from 2017 to 2019, the top 3 performers were actually the bottom performers from 2020 to 2022. Actually, they were ranked 205, 204, and so forth. Same goes with from 2018 to 2020. The top performing funds were the bottom performing funds in 21 to 23. Same goes with 2019 to 2021 and 2022 to 2024 as we speak. So over the past 3 to 5 years, we have definitely seen where the top performers have kept on shuffling from time to time. So it's very wise for investors to choose consistent performers rather than top performers soon.
Okay. Wise to choose consistent performer than just the top performers. That's interesting there, Rishabh. Kirtan, would you like to add anything to that? And are there any measures that one could look at, like people look at rolling returns, Jensen Alpha? Is there something that could show us maybe some persistent returns in mutual fund performances or outperformances, or are there any tools over there?
So I think, Winnie, what needs to be understood here while we are looking at mutual funds is that there are so many variable factors that impact the performance of the fund, right? Typically what happens is that, let's say over the last 2-3 years, if the funds have done very well, suddenly so much of money starts chasing those funds, and those funds swell so much in their AUM that they end up losing their agility to be able to do exactly what they did in the last 2-3 years. And also, in my opinion, and I am a very firm believer that the data also that Rishabh shared, why the top performers keep changing is primarily, in my opinion, because of style. Right? If you look at the last 12, 18 months, the value style of investing has done very well because market thought that it's slightly expensive and there was not a lot of liquidity chasing the market. Right? So now you will typically see that for 18 to 24 months, one particular style of investing does well, which is value in this case in the near term. Right? And you will see all value style of fund perform would do typically better than probably a momentum or a growth style of investing. But if you look at the last 24 months of returns on
Okay. All right, Kirtan, we'll just come back to you in a bit. I think there's some patchy line right now, but we go across to Rishabh, the same question. And just in addition to that, how have active funds fared compared to, say, benchmarks and passive funds? And this consistent value add by active managers, is that the norm, or does mean reversion prevail ultimately?
Vinny, see, outperformance and underperformance is part and parcel of active funds. There will be periods where active funds will show some super outperformance, and there will be some periods where the same active funds will be the bottom performance. So I think, in my humble opinion, for a retail investor, for an investor out there, the best strategy is to chase consistently outperforming funds. It doesn't have to be the top performing 1, 2, or 3. Just look at the rolling returns over the past 5 years, 7 years, and 10 years. I think that is the best way to chase a fund. And also, as what Kirtan also mentioned, that, styles also play a very important role. So while we choose different categories, different AMCs and different funds, within that, it's very important, to choose and diversify across different styles and strategies as well. So typically there are 4 types of styles in the market. One is growth, second is momentum, third is value, and fourth is contra. So value and contra can be kept in one bucket, and growth and momentum can be kept in second. So it's very important to diversify across various funds as well. And as you rightly pointed out, yes, there have been funds which have underperformed, unfortunately, and that is the exact reason why passive funds have gained so much of attention over the past few years. So I think today is a time where, a combination of active and passive portfolio works best in one's portfolio.
Okay. Kirtan, is there a way, or, do you think many factors, like Rushabh is also mentioning, right, overall sector rotation, macro trends, there's going to be liquidity, all these factors will play an important role. But, will this be the reason of persistence, maybe alpha that is created in some of these mutual funds? Any specific conditions that we could watch out for, that could lead to some bit of a better performance versus, other portfolios or other mutual funds?
So I think sector rotation or probably a macro trend change is definitely a big positive for the active guys, is because, in my opinion, if at all there is a micro or a macro change in trend, is exactly where the assumption is that the fund manager will be able to pick sectors much ahead of somebody else and be able to ride through the 2-year, 3-year wave, which will work out in favor of the sector. So I think a macro trend or probably a micro trend change definitely leads to sector rotation, which works out in favor of the active guys. But unfortunately, I'm on the other side of the curve when we talk about liquidity. Liquidity for me is counterproductive for active guys, is because when there is a lot of liquidity and then there is a broader market momentum that's happening, that's where active guys have traditionally in the past not been able to do great. So if there is a lot of liquidity that is chasing the market, I would definitely believe that passives will end up doing much better than active. But like even Rishabh was saying, that over a longer period of time frame, it is actually different styles of combination that you bring together to build a core portfolio in which active and passives both will end up playing a role. But if we talk about actives very specifically, I would also want to stick to seeing that there is consistency in the portfolio.
Got that point, Kirtan and Rishabh. Pleasure speaking with the two of you. We had a lot more questions, but we have completely run out of time today. So we'll continue this some other day. But thanks a lot for tuning in with your expertise. With that, we'll take your leave on this edition of MF Corner. But stay tuned. Closing bell comes up next to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Hang Seng currently trading above the flat line, but the Taiwanese index has been a bit of an underperformer today.
Close to making a deal with India. Others we met with, and we don't think we're going to be able to make a deal, so we just send them a letter.
Support for the Nifty stands at the low of 25,331. Resistance on the Nifty stands at the high of 25,669.
The markets really are figuring out that we are in this process of restructuring.
Nothing very much, 25,444 on the Nifty. The Nifty Bank is just sort of settling down, but doesn't amount to very much, at least the open, 57,000, flattish open there.
Within the consumption space, the higher ticket discretionary goods, they've done far well.
Every aspect of the capital market activity will get a boost the moment that sales certificate melts.
What we've been given to understand from our sources is that market regulator may consider linking options market leverage to cash market positions.
Donald Trump says they are close to a trade deal with India. Frankly, everything is up to Donald Trump now.
For the markets, Nifty has seen some recovery from the lows. Bank Nifty is the one which is supporting those gains that we are seeing. Midcap's under pressure, but there has been a recovery again. So recovery is the theme that we are tracking right now. We'll have to see whether that stays or not.
Well, that was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar, and with me are Surbhi and Nigel. Hi, guys.
Hi, guys. And yet another afternoon where the Nifty is finding it difficult to even move 20, 30 points. I mean, it's that kind of a session. It's just uncanny. It's a strange kind of a silence that has descended, at least at the index level. Midcaps are falling. So that's the situation that we're in right now.
I'm wondering by the end of today, if we end somewhere around here, it would mean for the first two sessions of the week, the markets have not moved at all. Yesterday, the Nifty didn't even move 1 point, and as we speak, it's moved a point. The good news, though, is that today the Nifty Bank seems to be in good form. That's up close to under 150 points. And from the word go itself, that one's actually been outperforming. So not such a bad outcome. I think everyone's waiting by for what President Trump's tariffs and tantrums are going to do next to global equity markets.
And Asia was higher today. So Kospi was up 1.8% as it closed out the trading session. Hang Seng up more than 1%. The Chinese markets up close to about 0.7%. But the Indian markets, like radio silence, even today, the trading session had a range of just about 70 points. Yesterday, it was 80 points. Today, even narrower. And this would be the 7th now consecutive day that, markets have been absolutely unchanged and unmoved, consolidating in a very, very tight band.
Yeah, I'm pretty sure that there's enough chatter there. Whether this kind of radio silence, I think Reema used an absolutely beautiful term, whether this kind of radio silence has anything to do with what's been ongoing with Jane Street, with such a large institution being told to wind up positions, whether it has anything to do with the market perhaps looking at fresh F&O regulation that could be coming. Remember, our colleague Yash did a story on this. We'll actually have him back to explain exactly what that story is all about, where Yash's sources are telling him that the regulator could look at some sort of interlinkages between positions in the cash market and F&O positions just to regulate excess speculation. But more on that story as we go on. Right now, let's talk about the few movers and shakers, at least on the index. I mean, some names that we can spot for you. Titan has been down right from the morning. This 18% growth in their jewelry business, the market hasn't liked it one bit. That stock has been under consistent pressure, and there's no sign of buyers, at least as of now. Aurobindo Pharma has been down. It's been moving, not from the, necessarily talking about the Nifty 50 pack, but in general, it's a stock that's been reacting to a pretty strong brokerage note, which has been cutting price targets on the stock, a negative brokerage note, and we'll get to that as well as we go on. There are names like Angel One on the lower side as well, which have been losing some ground. But all is not lost. I mean, for all the losers, you do have some green as well. Wari is having a good day. Names like Motherson Wiring, not too bad. CEAT, look at CEAT today, almost 6% up on CEAT as well. So some movers and shakers out there, but the Nifty guys finding it hard to break through this absolute logjam.
Well, that's right. But let's focus on PNG-RB. They are set to release its final order on the unified gas pipeline tariff. The proposed unified tariff structure would replace zonal pricing with a single rate across the pipeline. My colleague Sapna got in touch with the PNG-RB member, Mr. A.K. Tiwari, to learn more. Let's listen in to what he had to say.
I would like to share that in 2022, when we have announced the regulation, it was in the interest of the pipeline operator. And in 2023, when the unified tariff was announced, it was more focused on the interest of the consumers. But this tariff order, this amendment which we have announced recently, takes care of the pipeline operator, takes care of the consumer, takes care of the investor, as well as CGD companies. So earlier there were 3 zones, now we are going to reduce to the 2 zones, and with the concept of one nation, one grid and one tariff. And most important is that we are going to have one tariff for CNG customers as well as PNG domestic customers, because we have given huge target for CNG stations as well as the around 12 crores plus target for the PNG domestic consumers. So this tariff plays important role in the total cost. So when we are going to have one tariff for CNG and PNG, I think the CGD companies can take advantage of converting to achieving their minimum work program, and also CNG stations.
Okay.
So that is the concept behind it.
Okay. So we are at 2 zones right now. So if my understanding is correct, will you bring it down to 1 zone, something like that?
We have partly done here, because we have done 1 zone, 1 tariff for CNG, PNG, and slowly we are going to move for 1 tariff pan-India basis. This is slowly we are going to do it, but after analysis we'll do it.
Correct. So what happens to this 1 zone now? I mean, will that also remain, or you'll have a sectoral approach?
We may have, because CNG
Please elaborate.
CNG and PNG are the customers to whom we have given the target, entities have given the target, and then minimum work program is there. Pan-India basis, we have allotted 300 plus geographical areas. So I think the CNG, PNG will be 1 tariff, and remaining maybe 1 tariff in the days to come.
How many years would this take? A year or 2 years down the line for this to work out?
We have concluded these tariff reforms within 2 years or so maybe 1 year.
Okay. And just a small repetition, what happens to the end user rates under the current tariff regulations, the fresh ones that you have brought out?
For CNG, PNG?
Yeah, what's the usually players?
They will reduce, because the tariff which is around 120 rupees per MMBTU on the transportation tariffs is going to be drastically reduced. As per the tariff order regulations, it is 52.5% of the second zone. If we resume the second zone as 110, 120 rupees, it will be in the range of 50, 55 or maybe that.
Okay.
So that is there.
Okay. So net, what has been the response of the CD players themselves? I mean, good, positive, or not that happy?
They have participated in the open discussion. All were enthusiastic, and I have got phone calls with so many CGD players, and they are happy. And we are going to soon announce the tariff order after due deliberations. That will do it.
How does it really benefit the CD players? I mean, does it bring down the input cost, but at the same time the end user rates will also have to be reduced, so it's a bit of a balancing act for them?
Yeah, once the input cost, because as I have told you, the tariff is also one of the important input costs. So when the input cost will be less, the consumer will be benefited with the rate of the CNG and PNG.
Okay.
That is there.
And when do you plan to bring out the tariff order, sir? I mean, the
there is a process. We have recently amended it. Now we are going to ask the details from the settlement committee as per the regulations. And there are some important pipeline operators are there, GAIL and Pipeline Infrastructure, PIL. So their tariff order, we have already concluded the PCD, public consultation, we have already concluded. So that is also on the card. So together we will bring the tariff order of these whatever.
Okay, it'll be synchronized.
Yeah, we want to synchronize, because again and again doing the tariff order and then is not.
Okay. So when can we expect the order for GAIL as well? Would it be like a month, 2 months, or could it be earlier,
think,
next month maybe?
Maximum 2 months.
Okay. So they've also, made this recommendation of a 33% increase. So broadly, where do we stand on that as of now? Would it be somewhere as per what the company has actually sought, or would there be a more balancing act, a more nuanced approach that the regulator will take?
See, we always try to give the reasonable return to the pipeline operators, and we have analyzed, and whatever they have submitted, we are going to act on that, and maybe a balancing approach will be there. And I would like to say one thing, that system use gas is one of the important OPEX for them, for which we have already brought the regulation here. How to reduce the cost of system use gas, wherein we have given that they have to plan 75% of their estimated quantity which they are going to consume. They have to plan domestically or international market long-term basis for 3 years. They have to allocate whatever the least cost is there in their kitty for the system use gas, so that the cost will be reduced. So all these factors are being analyzed, and we are going to take view on that, and we are going to conclude the tariff order very soon.
All right. Well, we'll keep an eye out on those stocks. IGL, I think, has perked up a little bit, among all the stocks. I think that's moved to the high point of the day. But I will get Sonal to explain this in greater detail with regard to market ramifications as well. So we'll keep an eye out on that front. For the time being, let's go across to Mitesh. Mitesh, we spoke earlier this morning and the markets have not moved. What's your take? Market's going through a bit of consolidation, but what's the trade right now if you take one?
Good afternoon, Nigel. I have, been maintaining that the contraction phase is going on, and therefore not much might happen in the market. And I think that's what is happening. As I said, the only worry will happen in case the Nifty starts or shows signals of getting below 25,200, which we are still far away from. So nothing much practically on the index. But on the stop, I have a buy on SRF with the stop at about 32.40 for targets of 2,400. That's looking well. And Kotak Bank is something, which has kind of given a breakout in the last few hours. So Kotak Bank is a buy. You will stop below 21.95, look for targets of 22.85.
Okay. All right, got it. Thank you, Mitesh, very much for that. Now let's get to that exclusive story that we were referring to just a while back. And this could be potentially quite a big move. Sources are telling CNBC-TV18 that SEBI could consider linking options leverage to cash market positions. Yash is getting us these exclusive details. Yash, what exactly are you picking up? What kind of perhaps further tightening are we expecting in the F&O market?
Well, this seems to be a fallout largely of SEBI's investigation and action against Jane Street. What we've been given to understand from our sources is that market regulator may consider linking options market leverage to cash market positions. To simply explain this, SEBI is considering a proposal where only if you have certain amount of exposure in the underlying cash market, equivalent to that, like a multiple of that, could be the allowance as far as the options market exposure is concerned. Options market could be linked to the equivalent cash market through a derived formula. As I said, a formula will be put in terms of the cash market exposure, and a multiple of that could be allowed as far as the options market exposure is concerned. According to our sources, four things are what SEBI plans to achieve through this particular mechanism. One, increasing cash market liquidity. Second, reducing options market liquidity. Third, reducing excessive speculation and protecting retail investors. And fourth one, cut down on the ability of institutions like Jane Street to manipulate indices and make fast money. SEBI is also considering various other steps to sort of identify and plug any more loopholes as far as the options market is concerned. All these proposals could be discussed by SEBI's board very, very soon. Apart from that, to increase cash market liquidity, SEBI is considering a couple of steps like, allowing shorting in the cash market, also enhancing the SLBM or the loan against shares mechanism.
Thank you very much for that. And you can see all the capital market stocks take a beating today on your screen. Right on the ticker, you can see CDSL, for instance, is down nearly 1.5%. But even the others, like in Angel One, Nuvama, BSC, are all taking a big knock. Yash joining in with the CNBC-TV18 exclusive. Thank you for that. Gurmeet is now joining in from Complete Circle. Gurmeet, more tightening of the regulations linked to derivatives. What have you made of this latest news piece?
I think something will come. I don't think so. It may not be as strong as linking it to cash positions, but I think it will be more in terms of more awareness being created. Look at the losses, Rima. Last year was 75,000 crores. This year is 1.05 lakh crores. So in 2 years, the retail traders have lost 1.8 lakh crores. Now, this number could be disputed because a lot of people would have lost an FNO and Quadbi could have made money on cash because, you get the figures on a net basis, right, on FNO. But there are a lot of prop desks who also you do covered calls and they run a proper model. So, but even if you discount 20-30%, it's still quite a large number. And this can have issues in terms of, economic stability, if I were to say that. And I would not mind saying that some of the slowdown in urban consumption could partly be attributed to this. So from a long-term market stability point of view, I think some regulation and more awareness, you can't dictate behavior, but more awareness like the MF, mutual fund Sahi campaign. If you can do more campaigns on long-term investing and the risk management, especially on the FNO side, that would help. So I think from a market perspective, the shift may go from transaction-oriented capital plays to fee and annuity-oriented capital marketplace. Let's say, for example, asset management business. Look at, for example, HDFC, about 9 lakh crores of AUM. Their average spread is about 46, 47 bips. So it doesn't get really impacted by too much activities, which means you will make 2.5, 3,000 crore PAT, and it keeps growing. Now with alternates picking up, SEBI launching a new category like special investment fund, which is a 10 lakh category. I think that could be a game changer and might add more assets on the alternate side. And valuations are 30, 35 times. I'm not saying that's cheap, but it's still lesser than, kind of valuations we are playing at 60, 80 times to exchanges and depositories. So my sense is asset management companies may see more flows from an institutional flow perspective and from a retail participation perspective.
Okay, all right. Hi, Gurmeet. Good afternoon. Good to see you in. What do you make of the recent PNGRB regulations? And, what do you like from this space?
So, Nigel, while the valuations are very cheap, look at MGL, for example, 13, 14 times trailing. But if you see last 2-3 years revenue, it's been very flat, 7,000 crores, give and take, 100 crores here and there. And last, few years or few quarters, because of the cut in APM, which is administrative price mechanism, you had to procure gas on spot prices, which led to increase in your overall input cost. I think with the uniform tariff coming it might be good news from a consumer point of view, but I would like to see a little more clarity on pricing point of view, because anywhere where the pricing is not in your hands can have implications on your P multiple. One stock we are tracking more from a tactical point of view is Gujarat Gas. The volumes have recovered, especially the industrial gas volumes have recovered big time post-COVID. They have been spreading more CNG stations. Even the domestic consumption connections are improving. So that's something which is on our radar. But this is not something we would like to add on a fundamental basis in the core portfolio.
Okay, so that's a take on gas stocks. Got it. Midcap index, by the way, is down about 0.5% right now, and the advanced decline ratio has also progressively gotten worse. It's about 1,600 stocks now declining, and just about 1,000, just about 1,100 actually, which are on the advancing side. So that's been the picture. Gurmeet, hi, good afternoon. Okay, let's talk about the 6% cut on Titan. Now, is this a buying opportunity? Because we all remember the heydays of Titan, right? When the stock would just not let you get in. So is this a buying opportunity for maybe a great company, or is it time to look at other players, tier 2 players, which are growing faster?
I think you probably could wait for a quarter visit. It's a temporary slowdown because of the increase in gold prices. And also, one thing which concerned me, that the mix changed from studded and jewelry more towards coin, and that had an impact on margin as well. I know stocks like Titan, there is very little margin of safety. And still the heavy lifting is still done by the jewelry business. The other businesses, which is eye care, digital, the clothing, etc., are yet to meaningfully contribute to the bottom line. So I would be wait and watch. Even for other jewelry makers, I think you can have a lean Q2 and then a better festive season. So I think a better time would be maybe a couple of months later. I'm more keen on some gold-based NBFCs now because that reduces your credit cost, delinquencies at gold prices remain firm, and RBI is cutting rates. The norms with respect to lending, especially they became very stringent even on gold lending. That has eased considerably. And as volumes pick up and the credit cost comes down, interest rate gets transmitted, that could be a better play.
Gurmeet, what about Schloss Bangalore or Hotel Leela? I know you've looked and liked in the past Indian hotels, but what about Schloss Bangalore? There were no fireworks on listing. In fact, the issue price was 430. We saw the stock even decline moderately over the next couple of days. But now brokerages are betting. Target price by BofA is 520, Morgan Stanley 549. They like the fact that the company's debt is coming down and valuations are seemingly attractive. Have you looked at this Hotel Leela? I know you've stayed there, but what about from an investment point of view?
No, I think we're happy with Indian hotels. I think it's been a good wealth creator for us. We also like Lemon Tree more in the mid-end segment, and the model is changed now. If the managed key and own keys, the ratio would be more 50-50. So we stick with these two. And we are adding Interglobe as well on the travel side. We're looking at some more B2B plays also like RateGain, etc. So overall, we like the travel and tourism space. But in hotels, I think the largest allocation remains Indian hotels, will continue to remain for some time.
Got that. Thank you very much for joining in. As we get into a break, let's get our viewers some excerpts from our conversation with our market editor for the day, Motilal Oswal's Ramdev Agarwal, who gave his take on the stake selling spree that we've seen from promoters, private equity and venture capital firms in India. Should you be worried, or is it just testing the market depth and it's good for Indian investors over the longer term? Listen into his views.
More customers, more stocks to trade, and of course the tailwind of economy, which is sustained at 7%. So I think it's a complete Goldilocks kind of situation, because in the stock market, any kind of melt up is borrowing from the return of the future, which creates problem. Now it will be very good for the market and for the market sustain expansion. A lot of new companies are going to come, and I think you have seen every week there must be some record. I think Prithvi can, Prime Database can throw what kind of a trend they are seeing. This is a revolution in terms of number of companies which are getting listed. So one, they are going to get in the IPO itself, which is much more going to be primary selling, some amount of secondary selling. Second, once they discover the price, then this promoter's stake. But then they can monetize, and they are free to either invest for the new ventures or consumption or philanthropy.
Welcome back. You're with us on Closing Bell, and joining us next is Tushar Pradhan, Director of Hexagon Partners. Tushar, thank you so much for joining in. First and foremost, we'll talk about, of course, investments and portfolios, etc., in just a bit. But what have you made of the market's mood and character last couple of days? I mean, it's after a very decent comeback from the lows through much of April, May, half of June. Suddenly, the market's getting into this limbo mode, a bit of a logjam of sorts, extremely quiet. What do you make of it?
Well, I think on the surface, just like in the sea, maybe it looks a little calm. But there are many stocks which have seen significant movements underneath. So individually, stocks have either gone up substantially over this last week or they have come down substantially. So there is, on an average, maybe a calm that we can see from the visible, average. But I think there is some action otherwise. But I think the main reason for maybe a hesitancy or maybe a lack of direction could be because of this overhang of the trade negotiations which are happening. And one of the things which I have been highlighting for some time is that it's not about the trade negotiations per se, but how will the global supply chains actually change in response to finally when people come to know what the tariff rates are going to be across the world, which as of now, which we don't know. And they keep getting postponed. So July 9 was supposedly the first deadline, and now it is going to be shifted a little further. So the level of uncertainty continues to remain very high. And as you all know, markets don't like uncertainty. So it's one of those things which probably could be an answer to your question in terms of why the markets have just kind of become subdued a little bit, because now the wait is a little longer. I think that's one of the reasons which I can come up.
What about the Jane Street impact on the markets? They were the market maker for many trades, especially on the derivative side. On the other side of the trade, they were always there with the kind of volumes and liquidity they provided. And now that just seems to be absent. Is that a big factor? And how will it impact the markets going forward? What are the implications of SEBI's interim order?
See, these are issues which, at least at my end, I don't have much data in terms of knowing what is their participation. And if that is one participant, there may be so many other participants which we clearly don't have any data on. We all know that markets are, a function of demand and supply, in addition to the fundamentals that we look at over the longer term. So in the interim, if there is a change in terms of activity or by way of participation by these very large participants, or as we call it, the big whale traders, then it is going to have an impact. However, as I said, we don't have enough information to decide whether this is going to have an impact on other big traders or the fact that the volumes are going to go in one direction. I think overall, if you concentrate on the fundamentals of an economy, the traders are going to be at a second derivative of your base economy and your base market, right? And they will keep changing from time to time. So I won't read too much in terms of what's going to happen immediately. I think focusing on the long term is something that we continue to do, and I don't think there's any change in that picture.
All right. Hi, Tushar. Good afternoon and good to see you, Ben. What about the consumption theme? Some of those stocks have given you zero returns in the last 5 years. But now suddenly the street is getting a little bit optimistic. And mind you, the bluest of blue chip names have not given you returns, while the markets have compounded by more than 15-18% on an annual basis. It's time to look at them. Indians are going to have more amount of money in their hands. Input costs are hopefully going to cool off. And the hope is that, consumption will go up. Your take?
Yeah, that's an interesting question, Nigel. I think when you look at an economic cycle, you have to remember that, there are certain kind of companies which take center stage, and then they hand the baton over to another set of companies, and then another over the entire cycle. So it starts with, a capital cycle. It starts with a capex boom, where there is a significant increase in production facilities and essentially manufacturing as a base across, either driven by demand or the fact that there is credit available, and that leads to a capex cycle. Now that is followed by significant increase in employment across the economy as a direct result of this increased investment. And then that leads to increased incomes. And of course, India being an agrarian economy as well, there's a combination of rural and urban, which adds to the general demand going forward. And once you have this cycle of increasing incomes leading to consumption, we have a lot of pent-up demand, which first of all comes in what we call as discretionary, which is more to do with items which are more sustainable, like a capital asset or a appliance for most people. And then that is followed up with what we know as FMCG across the economy. So there are certain phases that these companies do well. And as we all know, FMCG largely is a defensive sector where we see a level of consumption no matter where the economy is. So we have seen our economy at a very significantly high rate of growth in the last 3 or 4 years, where consumption really comes as a significantly smaller portion of the growth in the overall economy. And as a result, obviously, the stocks haven't done much. I think if we continue to remain optimistic about our economy and the growth going forward, consumption, I think, is going to remain fairly small as a percentage of the overall growth, given the fact that most of these companies already trade at significantly high PEs. So I fail to see whether you're going to see a FMCG-led boom or that these companies will start making significantly positive returns from here.
Okay. So that's on FMCG. And finally, Tushar, I mean, before we let you go, just overall, given everything that's happening, we're running into earnings season. Just in terms of the total portfolio construct, right now, what would be your top 2-3 themes?
So I think we continue to remain very, very positively inclined towards capital goods. Essentially, I would think mainline manufacturing going forward, including process industries. We've seen a little bit of a lull in the last year, even the financial year ending FY25, where we saw a little bit of a tapering off in terms of ordering, whether it was from the government capex side or the private capex side. Interest rates were also significantly higher than what most expectations were. So there was a little bit of a bottleneck in terms of incremental capital addition. I think the current moves and the preemption from the RBI in terms of CRR cut, along with an expectation of gently falling interest rates into the future, I think manufacturing and essentially capex-driven capital goods is where most of our expectations are very, very keenly at. This is, of course, followed by the fact that we are going to see significant infrastructure growth, which is a continuing feature, which again had a little bit of a lull last year due to election activity and generally reduction in activity overall. I think all of that will lead to even auto to a certain extent doing well domestically. Now, this may not tally with trends globally, but I think our economy is pretty much on its own steam. So I think a little bit of auto, discretionary, capital goods, infrastructure, this is really where our keenly focused sector bets are likely to be. I think secondarily also we do tend to like the capital goods down in the machinery side. So we are talking about capital goods which are in the power transmission, that capital cycle as well. And I think that is really, again, something which is likely to pick up. Again, where we saw a little bit of a lull, both from a stock price perspective as well as volumes perspective.
Tushar, always good to hear your thoughts. Thanks a lot for joining in and giving us those details. Wishing you a good day, good week ahead as well. We'll catch up soon. Well, time to slip in a short break. As we do that, let's get you some market opinion actually. Earlier today, we spoke to Gautam Dugat, the head of institutional equity research at Motilal Oswal Financial Services, to understand his outlook on the market and stocks and sectors he's bullish on. Let's listen in to what he had to say.
We remain very, very positive and constructive on jewelry. Titan has been our long-standing top idea in not just jewelry, but overall consumer discretionary space. And our view has not changed. Coming to trend, that is where we've had a tactical positioning change in our model portfolio now. We've replaced Trend with Jubilant FoodWorks. For a company which is trading at 110, 120 P, there's absolutely no room for error. So there are quite a few additions there. Jindal Stainless is something we've added. UTI AMC is a new stock. As I mentioned, Radico, Jubilant. They are new additions. We've added Ludha, Macrotech basically. We've added Niva Bupa. So quite a few allocations, new allocations. And of course, we've also we upgraded our stance on auto.
Welcome back. Well, the market's not moved too much, in fact, but in the last few minutes, suddenly we've seen a bit of a spike that's come in there on the Nifty itself. And that's courtesy of a few stocks that have now bucked the trend. Wipro has moved a little bit higher. Mahindra and Mahindra, in fact, has cut its losses. So we are back at around 25,500 odd. JSW Steel from the red, that's moved into the green. And let's pull up a heavier name. I think ITC has done a little bit of a jig on its own. ITC, you have SBI. Both these two are larger weights on the index, and both of them have seen a bit of an up move. The Nifty Bank, by the way, is now up 300 points, and that's led the way. Mitesh Thakkar is back with us. Mitesh, still in a range, you would say, or do you think this market actually wants to go ahead and test higher levels, and also give us your stock picks?
The signs of expansion haven't appeared while the market has moved 40 points higher from the negative side. But again, I think, what could be the key here would be the Bank Nifty. We had a buy on Kotak Bank, and I think, that's done well today. SBI is also looking good to me. So maybe if the Bank Nifty picks up, we'll get some signal on the upside on both the indices. But for the timing, just waiting and watching it out. SBI, in fact, is one of the BTST calls. Take a BTST here with a stop at about 807 for targets of around 820. And the other one is a BTST on NHPC. I think that's, fired up in the last 1.5 hours. So BTST here at the stop at about 87 for targets of around 89.5.
Got it. Okay. All right. Thanks a lot for that, Mitesh. Let's focus on one of the top gainers on the Nifty, though. And all through the trading session, Kotak Mahindra Bank is doing well. That's after it reported a strong showing in its quarterly update. Gaurav joins us to fill us in with more details. Gaurav?
Well, yes, Kotak Mahindra Bank definitely remain as an outlier today, and the reason being that a strong update is what we have seen from the company for first quarter. When it comes to loan book, we have seen 14% growth on a year-on-year basis, and this also translates into 4% growth on a sequential basis. Now, this is actually stronger than the industry growth, and it is also stronger than what the consensus was expecting from Kotak Mahindra Bank in this quarter. On the deposits fronts also, we saw a strong set of number, 14.5% of growth on a year-on-year basis is what we are seeing from the bank. Although this growth was driven by the term deposits because CASA growth was a little softer on a year-on-year basis. But let's not forget that Q1 is usually softer for CASA, and that is the reason that is not a big concern. Now, what remains as a key thing to watch out for is the loan book proposition. What segments have actually led this growth is something which is really important to see in terms of net interest margins, but that is not a concern as of, at least for now. This will be seen in its Q1 results. For now, on the back of the good set of numbers, we are seeing the stock is still holding up in trade today.
Thank you very much for that. Let's now get to D Street chatter. Things are very, very quiet on the index front. But let's find out what's happening in the dealing rooms. Nimesh is now joining in with what he's picked up. Nimesh?
Hi, Rimano. So, as you rightly pointed out, another lackluster day of trade, not much in terms of volumes as well. But there is individual brilliance in some stocks and some sectors. And again, the PSU is the one which is leading the way. Some select PSUs are again buzzing in trade today. And there is generally momentum towards the PSU stocks, even from a flow perspective. I guess from an FIB or institutional flow perspective, today the sector which stands out is defense, as well as a bit of select financials, and that's showing up in the Nifty Bank as well. But again, it's very, very selective is what I understand from a flow into select private bank stocks, as well as in some defense names as well. I guess the big trade or the near-term trigger would be the India-US trade deal, and that may have an impact on some sectors like textiles, pharma. So those are the things to watch out for, at least in the very near term. But again, some individual stocks are doing good, some sectors are doing good, but otherwise it's been a lackluster day of trade. Even from a flow perspective, it's quite muted.
All right, but some buzz on D Street chatter. Nimesh, tell us individual stock. What's the buzz?
Well, so the first stock on my list is Aditya Birla Capital. It's been consolidating in a narrow range, but I understand there could be a large block very soon. Remember, this is the trading window is closed for the promoters. So if the deal has to happen, it has to be non-promoters. I understand the PE is likely to sell some small stake in AB Capital very soon. So that's the first name. The second stock is India Shelter. It's recovered from the day's low after a large block. Nearly 5% equity got changed hands. I understand the PE, the venture fund, was a seller in today's block. So the disclosures would be quite interesting on who the seller and buyers were. The third stock is IDFC First Bank. It comes on my charter list every now and then. There is buying interest from large institutions in IDFC First Bank ever since the bank raised money from some market investors. And even in today's trade, there is buying. So expect high delivery volumes in IDFC First Bank. And the last is Torrent Power. Generally a stock which doesn't get too much from an institutional perspective, but there is selling pressure is what I understand in Torrent Power in today's market.
Thank you very much for that. Quite a few hotel stocks are higher in trade. So ITC Hotels, 2.5% up on that. Lemon Tree is gained close to about 5.5%, 6%. Perhaps it's a rub-off impact of the up move seen on Leela Hotels. The Schloss Bangalore, BofA and Morgan Stanley have issued coverage in the stock. Target price stands in excess of 500 rupees. Stock is spiking. Mangalam joins in.
Right, so we have both the investment bankers to the IPO, which is BofA Securities and Morgan Stanley, among the many others. Now they've initiated coverage on this stock, so they are looking at it from that angle and saying that there is still a lot of uproom left in Schloss Bangalore, which is basically the operator of Leela. BofA Sec, for instance, has a buy rating and a target price of 520 rupees. They believe that the revenues of the company can compound at around 12%, EBITDA at 14%. Overall valuation is fairly attractive at 20 times FY27 EV to EBITDA. But more importantly, they believe that the net profit on a low base can compound over 90% for the next 3 years, and that's where the delta will come in. Morgan Stanley, on its part, has a slightly higher target price than BofA Securities at around 549 rupees. They have an overweight rating as well. The only risk that they're putting on the table is that of the table turning for the hotel industry, and more importantly for Leela itself. A large part of their revenue comes in from a small number of hotels, so that concentration risk is something they've put on the table. But be that as it may, they too believe that the EBITDA of the company can grow upwards of 12%, and the net profit on a very low base and on account of lower finance costs can surge almost 9 times in the next few years. And with a stronger balance sheet and higher free cash flow, they will be well capitalized to fund the next cycle of capex as well. So both these brokerages fairly confident on Leela's prospects.
All right, checking in, looks like Mangalam, but you're buying a lot of shoes. What about jewelry, Mangalam? The ladies want you to buy more. You're not doing your bit. Titans in focus. Disappointing soft quarter one showing.
No jewelry, no shoes, Nigel. Nothing. No buying anything right now.
Good. I told you. Time will catch up.
Yes, and for Titan, the important part is that you got to look at it in two ways. 18%, one would say, okay, not bad on Titan's base, etc. But two things happened. You know, a couple of weeks ago, Morgan Stanley put out a note, Macquarie put out a note saying that they're expecting 20 to 21%. Their channel checks have suggested a very strong first quarter. And the second part is that Titan's numbers came in after Kalyan and Senco. Senco reported a 24-25% retail growth. Kalyan itself reported a 31% growth. So to that extent, Titan looked a lot weaker. Companies, attributed this weakness to gold volatility that's affected consumer sentiment. And add to that, studded ratio was lower. Because of higher gold prices, people are opting more for plain gold jewelry than studded jewelry, and that's margin dilutive for the company at large. Studded ratio has been under pressure for the last few quarters for Titan as well. More importantly, buyer growth was flat year on year. Now, a large part of the weakness can be attributed to the fact that, Titan has higher exposure to Maharashtra than, say, someone like a Kalyan or a Senco. And this time around, we had Gudi Padwa in the previous quarter as against the first quarter in the last year. So that base effect and regional skew may have come by, but the street expectations are such that it's seeming like a disappointment. And then we're also seeing some other, portions of the company which are doing well, but they're ancillary. So watches, for instance, grew 23%. We saw a near 50% jump in their fragrances and bags business that's reflected in their overall emerging business. And Carrot Lane grew by about 38% as well. So ancillary is doing well for them. The large part of the business, which is jewelry, not as well, with flattish buyer growth.
All right, Mangalam, talking about quarterly updates, one segment where there has been a decent showing from smaller players is the pipe makers. And earlier today, we had highlighted, Hariom Pipes, a stock that's got absolutely hammered. That has spiked up. I think we should get the intraday chart up for our viewers on the screen. From the top, it's seen some selling. But a stock after halving from the top, well, that's popped up in trade because they delivered a 30% volume growth. As is the case with another smaller name like JTL. Now, that stock, in fact, it's got hammered from the top. Profitability took a hit. Volume growth has been disappointing. But in quarter one, JTL, the volume growth out there is 25%. Keep in mind, the leader is APL Apollo. That's delivered only a 10% growth. So that's why you see some kind of interest in stocks like JTL, Hariom Pipes. The last couple of trading sessions, they're moving with very, very high volumes. So that's important. Also, we had a recent listing, which is some of the steel tubes. That one as well has moved up. So on a relative basis, a couple of these smaller names are actually looking more attractive in comparison to the large names. So that's why, in fact, Sadbhav Steel Tubes, I think we should get that stock as well up for you on the screen. That said, let's focus on brokerage notes. Bellrise, that's in focus after Jefferies notes. Sudarshan joins us to help us out with the fine print. Sir?
So what a move the stock is seeing. It's up currently at 10% after Jefferies has initiated coverage in the stock with a buy call, and target has given it of rupees 135 per share. And that implies an upside of almost 30% from current levels. Jefferies believes that company might see revenue CAGR of 12% and EPS CAGR of 18% over FY25 to 28. Even it believes that balance sheet might improve, and in FY25 that company has net debt of almost rupees 600 crore, and against this it might have net cash of rupees 2800. Sorry, it had net debt of rupees 2800 crore in FY25, and by FY28 end it might have net cash of rupees 600 crore. Also on the valuation front, it finds attractive at 18x FY26 P, and it believes that it might improve further if company simplifies its structure. What are some of the catalysts? It believes that rising two-wheeler demand and focus on premiumization will aid the growth. Also, company has been increasing content per vehicle and also focusing on the expansion into four-wheeler space and the export segment. That also might aid growth. And on the back of all these factors, Jefferies is bullish on the stock.
Got it. All right. Thanks a lot, Sid, for joining in and filling us in with those details. Let's welcome Jay Bala of CashTheKiosk.com. Jay, a bit of a lull. I think we haven't moved too much since the last time we chatted. But your guess is we are bracing ourselves for a bigger inning, so to call it in cricketing parlance. The Nifty is gradually going to find its form and rocket up from here.
That's right, Ajit. Good to be here. Yeah, probably the markets are heading higher is more. The reason being Reliance is having a breakout like I pointed out last time. The 1538 was the very short-term resistance. It's crossed that yesterday too. And it's like the only resistance for Reliance right now is about all-time high at 1600 and 1606 to 1632. So, that should give fillip to the overall market direction. And the resistance for Nifty is about 25,660. And once that's taken out, it's only 26,000 odds is the next resistance for the markets. So the odds are looking bright for Nifty. So Reliance is giving the heads up for the markets that it's possibly breaking out higher.
All right, Reliance, yeah, that's the one actually that was a relative underperformer a few months ago. And the last 6 months, Reliance Industry is that big boy, which is as good as an index itself. That's really been leading the way if you just pull up a last 6 month chart or thereabouts. Let's talk about the other big component, Jay, though, the Nifty Bank. What are the levels you're looking at the Nifty Bank? And give us your view on a couple of these banking names. Kotak Mahindra Bank, well, the quarterly update is very, very good. We'll have to keep an eye out on how the NIMs pan out because we know that they have a large amount of their loans that are linked to repo. So we'll have to see whether or not there is some compression because that will adjust first. So Nifty Bank, Kotak Mahindra Bank and SBI that's gone through a nice sleepy period. Is it ready to fire up?
Yeah, that's what it's looking like. I know SBI bottomed ahead of the overall markets in March, and the markets bottomed in April. So that's having a slightly different cycle versus the Nifty. So it's possibly leading the markets higher. But the structure is that it's a bit overlapping, not excessively or desk thumping bullish. But it is bullish if SBI were to take out 837. And if that happens, I think the overall markets are going to get further fillip besides Reliance. And when it comes to Kotak, at least a short-term high is coming, which could also be a fresh all-time high for the stock. So both these stocks are likely to lift the banking index. The resistance for the banking index is about 58,500 to 58,900. Sorry, 59,000. And the supports are about 53,480.
All right, we were talking about a couple of stocks earlier, Jay. Let's get to them. Hariom Pipes, we were talking about how the stock halved from 850 to around 400 rupees. And then it's bounced back post the strong operational update. I believe that's one of the stocks on your radar. Tell us why, because otherwise in the last 1 year, it's been a big underperformer. And also Lemon Tree, which is moving with very, very good momentum. But you believe they're both good for high levels. Tell us more.
That's right. Let's take Lemon Tree first. It's bottomed in October and it's moved from the October lows to 2025 high in 5 steps. So that's a trending move for eliticians like us. And then from then on, it's gone into a sideways consolidation, which has been choppy and overlapping. That's once again a classic corrective signal. Today, the price crossing over 141, it's signaling a reversal for the October to 2025 January move. Or a continuation to that move. Basically, it's an inverse head and shoulders breakout, and the stock is likely to hit somewhere close to 170, maybe even 200. But we'll leave it as a conservative estimate about 170. When it comes to Hariom Pipes, it's a very interesting stock. It's a relatively new listing, listed in 2022. From the 2022 listing low, it's got to about 888 in 5 steps, and then it's pulled back to near perfect 61.8 Fibonacci retracement, and that was about 320. So from that point onwards, it's breaking out in today's price action. There's a great possibility that this is going to be a 3-bagger from here on. But be a bit careful. The price history is quite recent. It's 2022 to 2025. So I'm bullish on the stock. With the caveat that it's got a relatively less price history, but it's reasonably good price history to consider. It's going to fresh all-time highs.
Okay. All right. The market has made quite a move in the last 15 odd minutes. Very, very interesting. From being absolutely comatose, not even 1 or 2 points up or down, suddenly you've had this big swing on the Nifty. 60 points higher now. Very, very interesting. We'll do one thing. We'll take a break, come back and also get Jay's views on the whole Jane Street saga and whether the winding up of the positions there, whether it has any near-term implications for market volatility or volumes. We'll get to that in just a second. But as we take the break, remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. You can tune in at noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens comes to you at 8:30 p.m. Okay, let's get you a quick view on the global trade and tariff, conundrum that's been on. William Lee from the Milken Institute spoke to us about what the implications of these Trump tariffs could be.
What President Trump was trying to do was say, bring your investments into the United States, bring your production into the United States, bring your technologies into the United States, and we will give you a protective barrier of tariffs to protect you from unfair competition from other countries. And right now, President Trump has sent out a bunch of letters saying, okay, you don't give me an offer, here's my offer to you, 25% tariffs. I think that surprised everyone by the fact that they were so low. But I think that's also President Trump's way of saying to everyone, let's talk, and let's talk now.
Okay, that was a global view coming in. Back to that conversation with Jay Bala. Jay, very quickly, before we move to other sectors and stock names, I just wanted to get your thoughts on the implications of this wind down from, a large entity like Jane Street and some of the other algo traders, high-frequency traders in the market. Do you see that impacting the market in any sense, whether on weekly option expiry days or monthly expiries? Should we be prepared for anything over the next few weeks?
Yeah, I see a very short-term impact on the options market. Possibly, in the very near term, the other algo firms will get a bit cautious, and there could be, and obviously some retail investors would also consider this as a rigged game, and then there'll be options drying up in the short term. But in the medium term, it should all come back to normalcy. And the main problem is not with what Jane Street did, and it's basically to do with the concentration of the Nifty banking index. There was too much weightage towards HDFC Bank, and if you take up what is a good index structuring, you would see no index should have more than 10-15% if you are structuring a good index, and the fact that they were optionable, that has caused the problems. But this, at my very short point, is that this is going to be a short-term impact.
Okay, all right. So short-term impact maybe, but not too sort of disruptive. So let's quickly get back to stocks and sectors. Give us 2-3 names that look perhaps like strong trades to you, because your overall stance on the market has been fairly positive, Jay.
Yeah, the markets have done good rotation from the April lows, and the markets are waiting for Nifty IT to join. And given that the results season for the tech-heavy Nifty IT index is quite just around the corner, that it looks like Nifty IT is consolidating and possibly a breakout is coming. But I've considered the move from the low from the April as a counter trend bounce, and I've been anticipating somewhere about 39,000 to 40,000. The index is there. If 40,000 were to get taken out for the Nifty IT index, I think that will be a good breakout, possibly led by TCS, about 3550. Also, the real estate sector seems to have gone to a sideways consolidation, and it's starting to perk up one more time. So, this is another area where you might want to keep a watch. Probably further higher highs are likely to come through. And obviously, reliance on banks are the key to markets pushing much higher in terms of weight.
Okay, all right. Jay, I wanted to ask you about a couple of other names. The Troika, something that we track. The US bond yields, that's perked up a little bit. Where is that one headed from here on? And if you could also tell us about Brent crude prices, because the OPEC plus, there was a sharp spike in production, but Brent crude prices have been resilient. What's your view on both these two?
Yeah, when it comes to US 10-year yields, it's no joy for traders. It's stuck in a range between 410 bips and 466 bips. So a breakout on either of the side has to happen before a trending move happens. My guess is that it's possibly breaking down below 410, but at the moment you're sitting on the hands when it comes to the US 10-year yields and the bond markets. When it comes to Brent crude, I'm anticipating possibly end of a counter trend bounce in the next couple of sessions. Maybe could stretch into beginning of next week. But I anticipate the April lows to get tested in the next couple of months, maybe a couple of months to a quarter. I think the final low is in place for the long-term corrective that started post the Ukraine war. So I'm anticipating a bump up to about $71, $72 for Brent, and then a decline below the April low. For the NYMEX variety, the low April low is about $55. So I'm anticipating a break of the April low in the next quarter.
Okay. All right, Jay, thanks very much for all the analysis and the updates today and the trading ideas. We'll quickly wrap up the day, which has had some interesting action towards the end of the last half hour. Maybe you can attribute that to the weekly expiry on the Sensex. 60 points up on the Nifty is what we have. I think there are interesting statements from Ms. Madhvi Puri Butch on the Jane Street matter, which are at the bottom of your screen. So we'll get to that in a second. But overall, for the market, the Nifty finally managing a little bit of green. The leaders include names like Kotak Mahindra Bank, Eternal, which is up 2%, Asian Paints 2% higher, NTPC and BEL from the PSU space did well today. There's Grasim, Adani Ports, and some big names like L&T, SBI, HDFC Bank. These big boys also managed to push up on the higher side. The downside, the casualty of the day has been Titan after its first quarter update, 6% lower on that stock, and some cooling off in pharma names like Dr. Reddy's and Cipla as well. But the broader market, Nigel, I mean, from a cut of almost 0.5% on the index, the close at least is not that bad.
Well, that's right. A lot of stocks actually moving around. You had Belrise that was higher post that note coming in, Jeffrey's note. So that stock was high. Hariom Pipes, as we covered, that in fact, after underperforming to a large extent, that stock in fact has perked up post its quarterly update. So that one was higher. Lemon Tree Hotels as well did well. That was up closer around 6%. Motherson Wiring was up closer around 4%. So that stock in fact is higher. And Sadbhav Steel Tubes, that one was up closer around 15% in trade. A couple of losers though in trade today. BSC got slammed. Ola Electric is now down close to around 40 rupees or thereabouts. So massive downtick is what we're seeing out there. And towards the end of trade, you had stocks like JG Chemicals that have rallied 25% just in the last 1 month or so. That one, in fact, from trading in the red, it recovered close to around 7% from the low point of the day. So big up move on that particular name as well. Well, on that note, though, I think we'll wrap up on this edition of Closing Bell. Stay with us. Markets Forward comes up next.
A smart recovery in the last hour helps Dalal Street end at the day's high. Financial heavyweights help Nifty and Sensex end 0.25% higher. Banks outperform the mid-caps slide.
Kotak Mahindra Bank was the top Nifty gainer after it reports strong business growth in Q1 FY26. Advances grew ahead of expectations while deposits saw a healthy trend. Term deposit remained the key driver.
Titan skids after it posts a weak growth than its peers in the first quarter, despite a low base. What's more concerning is that the growth has mostly come in from an increase in ticket size and not a rise in buyer numbers. Good evening. This is Markets Forward, the show where we aim to get you all the key data points to gear up for the next trading day. I'm Manglam Malu. With me, Vinny Motiwala. It was a largely range-bound trade in today's session. In fact, it was just towards the end that we saw a spark in the Nifty, led by the Nifty Bank. It ended well over the 25,500 mark, but still well under the top end of the range in which the Nifty has been meandering for the last many weeks, between 450 and 25,600. I mean, it's been that range that,
It's such a range that, it's not much of a move that you're
seeing.
Exactly,
that's exactly what's taking place. 25,522 is where we closed. The broader markets, however, saw a bit of a gash on the way down. So that's what we have in terms of trade today.
Absolutely, but something happened in the last 30 minutes at least, right? Some bit of a recovery that we saw coming in. So whether you look at the broader end of the markets or the Nifty, you did see that recovery coming in. And Nifty Realty, that's the one I want to highlight as well, because that was in the red in the morning trading session. And then we saw a sharp recovery among the top sectoral gainers coming in was the Nifty Realty. More than 1% of gain over there, and banks that managed to hold on to some bit of a gain in today's trading session. But yes, that's how the market looked like. But well, here's the lineup that we have for you all in store today. And we'll start with the top movers and shakers of the day with Hormas, and then move on to individual stocks. We'll have Kotak Mahindra Bank that surged in today's trading session, obviously after the Q1 update that came in from the company. While Titan, on the flip side, saw a slip coming in the trading session due to weak Q1 updates versus its peers. Meanwhile, the pharma sector was buzzing, driven by commentaries from Brokerage firms, and Hormas will also join in with us to give us the key reasons of why these stocks were buzzing in trade as well. But first up and first part of the day and the segment, I beg your pardon, is the top movers and shakers of the day coming in from the big wall from Hormas. And take it away, Hormas.
The first part of the last part of the day, that's more important to emphasize. And of course, it was the jewelry stocks led by Titan on the way down today after the business updates. And it had a rub-off effect on Senco as well, giving up some of those gains that it had yesterday. PC Jewelers recovered from the lows. At one point was down 9%, and PN Gadgil opened higher. But as Titan continued to grind lower, that too ended at the lowest point of the day. The sector of the morning, though, was textile names, and a lot of these stocks reacted to those tariffs that were imposed on Bangladesh and a potential deal with India as well. Vardhaman Textiles gave up most of those gains. Gokaldas, KPR and Trident had a fairly decent day at the office. Pharma stocks were sulking in today's session after the double downgrade that Aurobindo received and a downgrade that Dr. Reddy's received from Macquarie, both of them ending with 2 to 3% worth of losses. Lupin, Granules, Alchem 2 ending near the lowest point of the day. Capital market names had a volatile day today, with BSE at one point was down 9%, saw a bit of a recovery, as did Angel One. MCX 361 WAM also recovered from the lows, as did CDSL, but still ending in the red. And in a market like this, the stocks that hit a new high in today's session, Naveen Fluorine was one of them. Gabrielle is making a comeback, as was SML Isuzu. And the last two names, Transrail Lighting and Sanatan Textiles, not necessarily a 52-week high, but their highest levels post-listing. Back to you guys.
Right, Hormas, thanks a lot for that. Let's welcome our guests as well. Jay Wala of CashTheChaos.com and Sudeep Bandyopadhyay, Chairman at Indie Trade Capital, join in. Thanks a lot, gentlemen, for joining in. Jay, coming to you first. We've been in this range, a very boring range for the market, so to say. Today was extremely narrow for most part of the trade until the last hour where we saw that spike. Do you think that last hour spike was significant enough chartically to call it a trade? Or maybe you believe that this range continues?
I think breakout is due, Mangalam. The fact that we've got tea leaves showing from Reliance has broken out above important resistance at 1538, and the only resistance for the stock is about all-time high about 1606 to 1632. So that is already. I mean, Reliance is an excellent barometer of the Indian markets. So if that is breaking out, it's very likely that overall market is breaking out. And the last hour wasn't that significant for me. But from a very short-term price action, if you are a swing trader holding for about a few hours to a couple of days, I think as it is, the low of 25,300 would be a stop for the stock to go past 25,600 to about 25,800. So for a swing trader, that might be significant. But the tea leaves for the overall market is already there from the clients.
Okay, that's the view coming in there. Sudeep, I'm going to come to you also. Your thoughts coming in just before the earnings season as well. What are we watching out for? We may see some of those letters coming in overnight as well for India, or whether the deal comes in. But today, textile stocks were surely chirped up. Is there anything that you're looking at ahead in terms of a play coming in, whether in terms of US-India trade deals or Q1 numbers?
US-India trade deal, it's very difficult to predict, Vinny. We have to wait for the letter to come in, because while the market has been cheering the textile stocks today based on what has been imposed on Bangladesh, Vietnam, Indonesia, and others, we still don't know what's going to be our rate. So I think we are playing in the dark, and it's a little risky. So I'll wait for things to get a little more clear before taking a bet. Valuations are not cheap, but of course, if we have a favorable trade deal, definitely these textile stocks will benefit, because that's one of the largest items of export to US from India. As far as quarterly results are concerned, I think I'll be keenly watching the technology stocks, TCS in particular, which comes out with results very soon. We'll have to see what's happening to the margin, because while the BSNL contract value is coming down, the margin improvement isn't visible. So hopefully the margin improvement will be visible this quarter. They also have postponed the wage hike last quarter. Probably they will take it now, and we'll have to see what kind of impact that has on the margin. And that will be a trend setter for the overall IT industry. Apart from that, I'll be very keen to watch the cement numbers. While this is a monsoon kind of a period, so demand may not be that robust. But the fact is, overall demand in the economy has gone up, and they have significant margin improvement, which they demonstrated last quarter also. Like to see what's happening on that.
If we take that point, you're speaking about, the IT pack. The IT index actually is about 15-16% away from its 52-week high, as against the Nifty, which is less than 3% away right now. Will be very interesting to see how that goes, because the market runs on three legs. Jayabala spoke about Reliance, we have IT, and the third one is banks. Banks actually today were supported by Kotak Mahindra Bank, which was the top gainer and top contributor as well, on the back of strong business growth numbers coming in the first quarter. Gaurav Jabalkar joins in with the details on that one. Gaurav, on the one hand, these are good numbers, and on the second, Kotak Mahindra actually reported a pre-quarterly update after so long.
Well, yes, two surprises as you suggested. First is that Kotak Mahindra actually reported their pre-quarterly numbers, and second is that when it comes to numbers also, they have reported very strong set of numbers. So advances grew almost by 14% on a year-on-year basis, which also translates into more than 4% growth on a sequential basis, which is actually higher than the industry growth as well as the consensus estimate that were there for Kotak Mahindra Bank. Other surprise was in terms of deposit. There also we saw strong set of numbers. Around 14.5% of growth is what we saw on a year-on-year basis. Although this number looks a little softer on a sequential basis, but let's not forget Q1 is usually softer for banks in terms of deposit growth on a sequential basis. Now this was also led by term deposits, and CASA was something which was a little softer on a year-on-year basis as well. But this is again not a concern, because this is actually industry trend where we are seeing CASA ratios coming down across the sector. Now what remains as a key thing to highlight is that Kotak Mahindra Bank was actually one of the main banks in the large sector banks who actually reported good set of numbers with the growth more than 12 to 13%, what we have seen on an average for the bank's update so far. We will be watching out on what segments actually led this growth in terms of loan book, because this will drive NIMs. But as of now, for good set of numbers, bank has got appreciation from the market. It ended with more than 3% gains today.
0.5% on Kotak Mahindra Bank among the top Nifty gainers today. Let's switch to the top Nifty loser today. That was Titan, fell over 5% at the low end of today's trading range, ended about 6% lower despite 18% growth. Why is that? Because of two important reasons. One, the growth was lower than its peers. So, yesterday we had Kalyan Jewellers reported 31% growth. Senco as well reported a 28% growth, retail growth of 24%. In light of that, Titan looks a lot lesser in terms of quantum of growth. The second part of that is a couple of weeks ago, brokerages had estimated that this time around it was a good performance and maybe the revenues for jewelry business would grow in excess of 20%. So there was disappointment on street expectations and versus peers as well. Bit of that disappointment can be explained with the shift in Gudi Padwa in the previous quarter as against this quarter, and the last year it was in the first quarter itself, so there was that base effect, and Titan obviously has a higher exposure to Maharashtra than say someone like Kalyan Jewellers or Senco, but nevertheless studded ratio being lower, gold price volatility affecting consumer sentiment, and being zero buyer growth is what the company said was absolutely flat year on year, has had the street worried. The studded share was lower largely because gold prices were volatile, and at this time people look for plain gold jewelry more than diamond jewelry or studded jewelry, and as a result of which studded share was lower, and that may impact their margins in the first quarter numbers as well. The other parts of the business not particularly bad. 23% growth in watches, fairly good. Emerging businesses growing at 38%, led by fragrances and women's handbags, which grew over 60%. That was positive as well. CaratLane also showed a 38% overall growth, which was an improving trend versus what it had seen in the last few quarters. So all said and done, weakness versus peers and weakness versus expectations is what took the Titan stock lower by 6%.
Absolutely. Mangalam, also does the factor of, being Titan, being a bigger player versus Senco and Kalyan, that also comes into play in terms of the growth as well?
In terms of valuation multiple, definitely it does, because, it is the bigger player and it is supposed to post industry-leading growth. On its base, it definitely has posted industry-leading growth on an absolute basis, because Titan's 18% is worth, the entire business of a lot of the other listed jewelry companies itself. But it also is trading at a big valuation premium to all the others, though Kalyan's valuation multiple has increased over the last few quarters and it's narrowed versus Titan. But Kalyan also, in the earlier part of the year, saw a big gash on the stock price, so the valuation discount has somewhat normalized. So we'll keep an eye out on how this industry pans out going forward. And over the last few quarters, the outperformance of Titan has come off versus the other players as well. So, I guess, Jay would be a good, person to ask a chartical question to Titan. We're discussing how the jewelry industry is shaping up, but from just a price pattern point of view, what is your thought on Titan, Jay?
Yeah, Titan had a breakdown in beginning of this year, early February, March 2025, and the price objective was for the stock to fall to about 2,600. It didn't go there, and then it started bouncing from the April lows. The bounce from there is also not a convincing move to say that it's going to record highs. It's a more of a middling price action. But it's more obvious when it comes to Kalyan Jewellers. It looks like the high of all-time high that it registered could be there for a while to stay. And we are possibly not seeing a final low for 2025. So, Titan is a bigger player, as you rightly pointed out. And I would say, you can stay neutral and not get too bullish on the jewelry sector yet. So avoid for the moment. Even my assessment of the gold price action is that possibly it's already clocked a significant top, and possibly gold is set to correct to somewhere about 2,700 without a marginal fresh high about 3,500. Maybe the high is already in. But if the London fixing for gold is to drop below 32.45, I would come to a very strong conclusion that a significant high has been made for gold.
Okay, that's a view coming in there for the jewelry sector right now on the technical front. But let's just focus on talk about the pharma sector, because that was also in focus today. A couple of brokerage notes that have come in from global firms like HSBC as well as Macquarie on some of these pharma names, and the pharma index fell over 1% in trade. Now, Ekta is joining in with us to give us more details on this one. Ekta, what are the brokerages saying and which stocks are in focus?
Well, I'll start with HSBC on TV's Labs. They've upgraded the stock to a buy with a target price of around 7,900 odd rupees. The long-term growth is going to be driven by factors such as tirzepatide as well as other peptides and contrast media segment. They see revenue potential of around $450 million from peptides and $260 million from contrast media by 2030. They forecast an FY25 to 28 estimated EPS CAGR of 23%. Macquarie has written on the entire pharma space. They've revisited the export-focused pharma space. US generics market is under pressure. Price erosion is expected to accelerate due to fewer drug shortages. Revlimid generic is nearing the end of exclusivity, and early than expected price erosion is likely to possibly impact Q1 FY26 results for key players. They're looking at lower PE multiples for US-focused generic companies amid changing dynamics. Aurobindo downgraded to underperform. Dr. Reddy's downgraded to neutral. Cipla, Zydus, Lupin, they've maintained their outperform ratings but cut the target prices. Sun Pharma, they've reiterated an outperform with the target price of 2,135. Minimal US generics exposure, benefits outlook according to them.
All right, Sudeep, you were looking forward to the IT space. Is there anything particular that you're looking forward to in the pharmaceutical space as well this time around?
Well, pharma will have to see, what kind of, business volume they clock out of US. I think we are clear that there is a problem as far as, pricing pressure as far as generics are concerned. So we'll have to see what position these guys are in. The domestic pharma space also needs to be seen. The growth is definitely there, and companies servicing the domestic pharma market are kind of assured of steady growth. So I think we need to look at the numbers there as well. Overall, I think I'll be very keen to see what kind of numbers Sun Pharma comes up with, because they have very limited exposure. They have significant exposure in domestic market, limited exposure as far as US generics is concerned. So I expect good set of numbers and valuation bump up in Sun Pharma.
Okay, that's a view coming in on the pharma pack. But let's move on. And the market regulator is also considering measures to limit retail participation in futures and options market. Now, sources tell CNBC-TV18 that SEBI may actually consider a proposal that links option leverage to cash positions. Now, no decision has been finalized yet, but Yash is joining with us to give us more details on this one. Yash, what will this mean? What is this indication that we're picking up right now?
Well, certainly, as you rightly pointed out, no decision has been finalized yet. Of course, at this point, the proposal is far away from a decision-making stage. But what we've been given to understand from our sources is that there is a view amongst SEBI officials that there should be certain amount of linkage when it comes to options market leverage to cash market position. Now, what does this mean? Essentially, it means that if you have certain amount of position when it comes to the cash market, equivalent to that, as per a formula which will be derived, you will be allowed to take position when it comes to the options market. Linking of options market leverage to cash market position, according to our sources, the view that SEBI has would cut down on excessive speculation. Also, options position could be linked to the equivalent cash market position through a derived formula, as we mentioned. Now, there are 4 important points which SEBI plans to achieve through this proposal, which is at a discussion stage right now. The first one is with respect to increased cash market liquidity. Second one, reducing options liquidity. Third one, reducing excessive speculation and protecting retail investors. Fourth one, cut down on the ability of institutions like Jane Street to make fast money through manipulation. As I mentioned at the beginning also, this is currently at a very early stage. Possible that it may be discussed with the SEBI board before any action or any movement happens on this particular proposal. But there are a couple of other steps also which SEBI is discussing. One is allowing shorting in the cash market, also enhancing SLBM or taking loan against shares mechanism which currently exists.
All right, Yash, thank you for that. As a result of which we did see a big correction on a lot of these capital market players. If option volumes do dry up, then it'll be a problem for not only the exchanges, but a lot of these capital market participants and brokers as well. That was the view that the street took. But as Yash said, it is very preliminary in discussions. With that, we'll take a short break. In fact, thank both Jay as well as Sudeep for joining in and telling us about their views on the markets and a lot of individual stocks. On the other side, we get you all the corporate voices and the key market events to watch out for. Stay with us.
Welcome back to Market Forward on CNBC TV18. Now let's move on and talk about some of the corporate voices that we had on the channel. PNGRB is set to release its final order on unified gas pipeline tariff. Now the proposed unified tariff structure would replace zonal pricing with a single rate across the pipeline network. My colleague Sapna got in touch with PNGRB member A.K. Tiwari to learn more on this. Take a look at what he had to say.
We are going to have one tariff for CNG customers as well as PNG domestic customers. Slowly we are going to move for one tariff pan-India basis. The tariff, which is around 120 rupees per MMBTU on the transportation tariffs, is going to be drastically reduced. Pipeline operators are there, GAIL and Pipeline Infrastructure, PIL. So their tariff order, we have already concluded the PCD, public consultation, we have already concluded. So that is also on the card. So together we'll bring the tariff order of these, whatever.
Okay, it'll be synchronized.
Yeah, we want to synchronize because again and again doing the tariff order and then is not.
Okay. So when can we expect the order for GAIL as well? Would it be like a month, 2 months? Or could it be earlier,
think,
next month maybe?
Maximum 2 months.
All right, GAIL tariff order in the next 1 or 2 months. That'll be something that the street will most definitely keep an eye out on. But let's get you some corporate voices of the day. We had the management of Parlay Products join in today. They said the firm was seeing good demand, both rural and urban demand was seeing some revival. Rural, remember, accounts for 55% of their sales. They said that there was prolonged weakness in urban and that's recovering. They expect FY26 to be a good year with category growth pegged anywhere between 12 to 13%. They've gained market share in the last 1 year, so they expect to gain this year as well, which implies that they would grow upwards of 13%.
Next up, we have Astra Microwave. The management tells us that it maintains a revenue target of 1,200 crore rupees for FY26. The firm is expecting order wins worth around 1,800 to 2,000 crore rupees from QRSM projects, and the radar upgradation is projected to contribute 300 to 400 crore rupees to its revenue annually. Additionally, the company is eyeing significant growth opportunities, in upgradation of the Su-30 aircraft as well.
All right, with that, we're out of time on this edition of Markets Forward. But before we wrap, as always, let's get you some key market events to watch out for. Gaurav standing by with all that you need to know for trade tomorrow. Gaurav.
Well, let's talk about US market. Three crucial things is what we are going to get from US market. First is that US oil inventories, crude oil inventories, which will actually decide the crude oil prices. US 10-year treasury yield auction is also going to happen, which will decide the treasury yield trajectory going forward, and FOMC meets minutes. Now, this is also something which is crucial from the US markets. Other than that, from the Indian markets, AMFI data is what we are getting in the coming days, specifically tomorrow. From the China, we will also get CPI and PPI data. That is also crucial. Other than that, there are some stock-specific action which will be there tomorrow. First, let's talk about Titagarh Rail. Now, board meeting is going to happen to consider fundraising. This will include issue of securities, which also includes QIP and rights issues. Other than that, there are some stocks which will be trading ex-dividend date. So, we have Sundaram Finance, SJS Enterprise, Emphasis, SML's Isuzu, Pfizer and Johnson Control, Hitachi Air. And lastly, let's also focus on new listing, Kryzac. Now, this IPO will get listed and this company is definitely going to be in focus tomorrow.
All right, take that point. Gaurav, thank you so much for joining in, giving us all those details. With that, we wrap up on this edition of Markets Forward. Thank you for watching. We'll be back with more news and updates on the other side.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening.
We've made a deal with United Kingdom. We've made a deal with China. We've made a deal. We're close to making a deal with India.
The United States is close to making a deal with India, says President Trump. Indian government sources say they've made a decent offer covering goods worth nearly $200 billion. Rule out any further concessions on agri and dairy sectors for now. President Trump reignites the tariff war, sends letters to 14 nations, including Japan, South Korea, Bangladesh, Malaysia, Indonesia and Thailand, threatening higher tariffs from August, leaves room for negotiating, saying tariff letters are more or less a final offer from the US. A late recovery on Dalal Street helps the Sensex and the Nifty end near the high points of the day. Financial stocks lead the rally. Midcaps underperformed today. A SEBI study shows that retail investors lost over 1 lakh crore rupees in the derivatives market in FY25. The regulator is considering measures to limit retail participation in the futures and options market, but no decision has been finalized yet. A preliminary report on the Air India Ahmedabad crash is likely to have been submitted by the investigators to the Aviation Ministry. Air India has disbursed 25 lakh rupees ad interim compensation to 57 families so far. Documents of 75 individuals have been verified. That's a CNBC-TV18 exclusive. Israel steps up attacks on Gaza after 5 soldiers are killed in an explosion. President Trump and Israel's Netanyahu tout a controversial proposal to displace Palestinians from Gaza after a meeting at the White House. Netanyahu also nominates Trump for the Nobel Peace Prize. Tesla shares slide 7% as Elon Musk's plans of launching a political party reignite concerns over his commitment to the company's future. The EV giant's market cap erodes by nearly $70 billion in 2 sessions. Musk's net worth shrinks by $16 billion to $346 billion. Musk's ex argues that online content cannot be regulated as per the whims and fancies of government officials, claims the misuse of power by a union government at the Karnataka High Court. This after the Railway Ministry ordered the takedown of a viral video of a car being driven on railway tracks. More and more CEOs sound the alarm as artificial intelligence disrupts the labour market. A special report is coming up. Well, let's go straight to the top story this evening. President Trump has reignited his tariff war, even as he announced a 3-week extension to negotiate trade deals. Now, Trump sent out letters to leaders of 14 nations, starting with staunch allies, Japan and South Korea, proposing a 25% tariff. Now, here's what you need to remember. This is exactly similar to the tariffs proposed by Trump on the 2nd of April, so we've gone back to what was proposed then. Malaysia, South Africa, Indonesia and Thailand also face tariffs. Trump said, and I quote, "If you want to play ball, this is how we play," end of quote. So countries have seen their tariffs rise from what was announced in April. Bangladesh faces a 37% tariff compared to 35% in April. Myanmar, Cambodia and Laos also face higher tariffs. The new rates will apply from August, and President Trump has left room for negotiations, saying the tariff letters are, and I quote, more or less a final offer from the US. So where does all of this leave India? Well, President Trump says a deal with India is close. Here he is speaking about the new raft of tariffs and a possible deal with India.
If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now, yeah.
Are the tariff letters that you sent today final offers, or are they negotiable?
More or less final offer. We've made a deal with United Kingdom. We've made a deal with China. We've made a deal. We're close to making a deal with India. Others we met with, and we don't think we're going to be able to make a deal, so we just send them a letter. If you want to play ball, you have to. This is what you have to pay. So as far as I'm concerned, we're done. We're sending out letters to various countries telling them how much tariffs they have to pay. Some will maybe adjust a little bit depending if they have a cause. We're not going to be unfair about it. And actually, it's a small fraction compared to what we should be getting. We could be asking for much more. But for the sake of relationships that we've had with a lot of really good countries, we're doing the way I do it.
Well, that's President Trump. Parikshit is standing by with more. Parikshit, President Trump there saying that we are close to a deal with India. So what are we hearing from the Indian side on where things currently stand? A trade deal today, tomorrow, anytime soon?
Well, US President Donald Trump now has to take a final call on the India-US trade deal. Sources telling CNBC-TV18 that India has made a decent offer and now the White House is assessing the proposal and the market access gains that US companies will actually get. We learned that India's proposals cover almost $150 billion to $200 billion worth of goods traded between the two nations. US officials now have to indicate whether they want to negotiate further with India or have a deal at this stage. India is unlikely to make any further concessions at this stage, and there's going to be no compromise on red lines, which are wheat, rice, maize, dairy products, and also genetically modified crops. There may be some concessions with regard to blueberries, pecan nuts, but those are products which are not consumed in a large manner. India cannot open up sensitive agriculture and dairy sectors for the US or any other country for that matter. Sources say the deal that India has proposed will be a win-win for both India and the US. While US would get market access for its industrial goods, India would get significant access for labor-intensive goods. The deal will include quotas for lower tariffs for some product lines. Officials we spoke to are also indicating that India is not putting all its bets on the United States. While we would welcome any trade deal with America, India is also negotiating trade deals with other nations and is looking at all options to increase the export footprint as well. If we speak about the trade between the two nations in FY24, it was around 129 billion US dollars. There is a 41 or 42 billion dollar trade surplus in India's favor. And this is something that the US has been objecting to. And India has been saying we are buying more energy, we will buy more defense equipment, and that trade deficit will be automatically bridged as well.
All right, Parikshit, many thanks for joining us. So that is where things currently stand. We are counting down to see whether there could be an announcement on a trade deal between India and the US as early as tonight, or perhaps over the next few days. Now, from shock to regret, the 14 countries facing higher tariffs have responded to President Trump's letters. Japan's Prime Minister Ishiba has called the tariff announcement truly regrettable and said that they will continue with negotiations. Japanese exports account for over 4% of total American imports. In Seoul, South Korean leaders have promised to accelerate tariff negotiations with the Trump administration to swiftly resolve trade uncertainties. Reuters reports that Thailand's finance minister has called the latest tariff rate shocking, but remains confident that it will drop to levels similar to other countries. Trump has threatened a tariff rate of 36% against Thailand. Malaysia says it will continue to engage with the US government. Asian markets did not react much to the latest tariff salvo. Stocks gained across the board, with South Korean Kospi rallying 2% and the Hang Seng gaining about 1%. Market watchers and investors believe Trump will de-escalate from the higher tariffs before the August deadline.
What President Trump was trying to do was say, bring your investments into the United States, bring your production into the United States, bring your technologies into the United States, and we will give you a protective barrier of tariffs to protect you from unfair competition from other countries. And right now, President Trump has sent out a bunch of letters saying, okay, you don't give me an offer, here's my offer to you, 25% tariffs. I think that surprised everyone by the fact that they were so low. But I think that's also President Trump's way of saying to everyone, let's talk, and let's talk now.
The market is assuming that this gives more wiggle room for deals, and potentially is another case of Trump escalating to de-escalate. So markets have reacted, I think, fairly calmly given these rates. I think for India, it's interesting that India did not get a letter, and I think that does suggest that a deal could be actually very close and could be potentially on a relative basis quite positive for India.
Well, that's the latest there as far as Trump and tariffs are concerned. But let's talk about the market action. The Sensex and the Nifty made a smart recovery in the last hour of trade today. Financial stocks helped the Nifty and the Nifty Bank closing in the green. That's the picture there for you. The Nifty up by about 61 points. The Sensex closing 270 points higher. The Midcap index was down in the red today. The Bank Nifty was up by over 300 points. Let's go across to Nigel now. He joins us to wrap up the day's market action, pretty much mirroring what we saw across Asia. Relatively calm, Nigel, in the wake of all of the tariff uncertainty.
Well, the markets were quiet for majority of the trading session, but there was a bit of a spurt in the final half hour of trade, and all the gains that came about today were actually accounted for in the final half hour of trade. Otherwise, trading has been more or less lackluster. On the domestic front, we're waiting by for the results season, while on the global front, you're waiting by for Trump's final tariffs that are likely to be announced. But waiting by for that quarterly earnings, well, we did have quarterly updates that came about. And that gave you a bit of a sneak peek into what the numbers are going to be looking like. Kotak Mahindra Bank delivered a very, very good set of numbers. All eyes will be now on the profitability or the NIMs. So we'll wait by for that once they declare their numbers. But for the time being, the growth looked good. Titan on the flip side, well, the growth wasn't as much as what the street was anticipating. And that's why that was one of the big losers in today's trading session. What else did come in for profit again? You had Dr. Reddy's that was lower and Bajaj Auto as well. Both of them from the Nifty pack itself were lower. While on the flip side, Eternal and Asian Paints did continue their uptrend. In fact, Asian Paints at the last few trading sessions has been a bit of an outperformer after underperforming for the last 18 months or so. From the broader markets, one segment that's been getting hit is the capital market plays, and that's because of the regulations that are coming about. The notable losers today were BSE as well as Angel One. Both of them did come in for profit taking. Brokerage notes do continue, and they're having their impact. So Macquarie went ahead and downgraded Pharma. That stock, in fact, was under pressure today. And Belrise, the newly listed entity, Jefferies came out with the note. They're optimistic on the prospects. So that one, in fact, did quite well. But you'll have to say the Nifty is still in that band of from 25,250 to around 25,750 or thereabouts. Trump's tariffs will give further direction. But as of now, the street believes that maybe, in fact, the worst case scenario will not play out. And the hope is that maybe, in fact, the best case scenario could play out. If that's the case, then the markets could continue their uptrend once this global uncertainty is out of the way.
Well, staying with the markets, a SEBI study shows that retail investors lost a whopping 1 lakh crore rupees in the derivatives market in FY25, with losses widening compared to the previous year. However, SEBI's curbs towards the end of the calendar year 2024 brought about a decline in the number of unique traders and losses that individual traders made. Hormuz is standing by with more. Hormuz, this has been the big story through 2024. We saw the regulators intervening. We saw the government expressing concern. And the numbers tell you why the concern is warranted and legitimate.
There are certain things that don't change, and what has not changed this time around as well is the fact that retail traders continue to make losses in the futures and options market. Now, as per the SEBI study that was put out last evening on the regulator's website, most of the parameters that you would see when it comes to the options turnover in a notional basis and even on a premium basis have declined on a year-on-year basis. However, when you look at that from a 2-year time frame, that number is still in the green and significantly in the green at that. But the big number, as we just mentioned, the losses that the traders made in the equity derivative space in FY25, 1.05 lakh crore rupees, and that is a 41% jump from FY24 when that loss was just around about 75,000 crore rupees. So the losses have mounted on a year-on-year basis. Now, when you take a look at the number of traders remaining loss-making, 9 out of 10 in FY24, that number remains the same in FY25 as well, as has been the case over the last 4 years. But if you take a look at FY25 on a quarter-on-quarter basis, there has been a slight reduction when you compare Q3 to Q4, and that is reduction in terms of the number of traders and the losses that these traders have made on an individual basis. Now, if you take a look at the number of traders, that has come down, and if you take a look at the average loss per trader, that too in Q3, which stood at around 63,000 rupees, has now come down to just under 58,000 rupees at the end of the fourth quarter, and that is as a result of a slew of measures that SEBI put in place during last year. They started that in November of last year. Around 6 to 7 measures were put in place until April of this year, which is why you see that result, that difference, that drop between Q3 and Q4. Now, despite this, India continues to remain a very highly traded derivative market as per the SEBI study, and that is evident from the 5-year CAGR that you see. The index options notional CAGR over a 5-year basis has doubled, and that shows the kind of activity that you have seen in the F&O space. And the curbs that SEBI put in place over that 5 to 6 month period from November of 2024 that has impacted traders across categories. The biggest hit, of course, is the traders for a smaller amount, the traded value of less than 10,000 rupees. That figure is down 30% from last year when you take a look at December 24 to May of 25, and across categories as well, from 10,000 to a lakh, from a lakh to 10 lakh. Those figures are also down over 20% each. But as the categories grow wider, the decline in the number of traders also narrows, but across categories the number of traders has seen a dip. So certain things have not changed the fact that the retail traders, 9 out of 10, continue to make losses. The losses have widened, but with the curves that SEBI has put in place, we would hope that FY26 puts up a better picture.
All right, Hormuz, many thanks for joining us. And US-based trading platform Jane Street has told its staff that it will contest the ban by SEBI. As per Reuters, the firm has said that its practices in question were basic index arbitration trading. Remember, market regulator SEBI had barred the company from trading in the securities market. The company has also been ordered to impound over 4,800 crore rupees for allegedly manipulating stock indices through derivative positions. This is the highest impoundment that SEBI has ever imposed. Now, Kotak Mahindra Bank shares gained after its June quarter business update reflected a stable performance. The bank posted steady momentum in both lending and deposit growth, even as gains in low-cost deposits moderated. The loan book rose 14%, while deposits continued to grow at a healthy pace of 14% compared to last year. And more business updates. Titan shares down to a 3-week low after its first quarter revenue growth was below market expectations. The company's growth weaker than its peers in Q1. Despite a low base, brokerages have also flagged that growth was mostly on account of an increase in ticket size and not a rise in the number of buyers itself. We will head to a break, but up next, a preliminary report on the Air India Ahmedabad crash is likely to have been submitted by the investigator to the Aviation Ministry. That and more when we return. A preliminary report on the Air India Ahmedabad crash is likely to have been submitted by the investigator to the Aviation Ministry. News agency ANI cites sources saying that the initial report is now with the government. The crash killed 241 people who were on board the plane. According to authorities in Gujarat, 19 people died on the ground. Air India, meanwhile, has disbursed 25 lakh rupees as the interim compensation to 57 families so far. Documents of 75 individuals have been verified. Madhiha is standing by with the exclusive details. Madhiha, take us through where things currently stand in terms of the compensation payout. Air India had said that 25 lakh rupees would be the immediate payout to tide over any kind of emergency exigencies at this point in time. Give us the breakup of how the compensation has been disbursed so far.
So there are two different payments that families of the victims will be receiving. Air India has started releasing the interim insurance compensation of 25 lakh rupees to families of the victims. The final amounts will be decided by the airline's insurers is what we are learning, depending on the financial conditions of each family. So those who lost their sole breadwinner may receive more, while families not entirely dependent on the deceased could receive less. This means that payouts will vary from family to family. Air India is handling the compensation for the 12 crew members separately. So the process for the remaining 248 victims, including 229 passengers and 19 people are being processed, 19 people on board are being processed separately. So far, Air India says 25 lakh rupees has been dispersed to 57 families and documents for 74 more individuals have been verified. The airline says it's actively engaging with the remaining families to release compensation as quickly as possible. Now, in parallel, the Tata Group had announced 1 crore per deceased, which will be paid from a 500 crore trust, about 50 crore of which will be used to rebuild the hostel building that collapsed in the crash. 50 crore will be allocated for treating the injured, and the rest will be used for long-term support for the families of those who lost their lives in the crash. But the controversy emerged over claims that Air India is forcing families to sign papers disclosing their financial dependency to the deceased in an attempt to slash compensation in payment. So Air India has categorically denied this, calling the allegation unsubstantiated and inaccurate. The airline says it's only collecting basic family information to ensure basic financial information to ensure that payments go only to those rightfully entitled, and adds that asking whether a family was financially dependent is a reasonable and necessary step in the process to ensure that payments to those most in need of assistance are processed faster.
All right, Madhiha, many thanks for joining us. That is the latest on the compensation that is being provided by Air India to the families of those who lost their lives in the air crash. Online fast fashion giant Shein has confidentially filed for an IPO in Hong Kong. The move is seen as an effort to apply pressure on UK regulators after facing delays for the London listing. The Chinese-founded Singapore-based retailer submitted a draft prospectus with the Hong Kong Stock Exchange last week and is seeking the approval from China's securities watchdog. Now, shares of Tesla slipped nearly 7% in trade after Elon Musk announced plans to form a new political party. The move eroded the Tesla market cap by more than $68 billion in a single day. The drop marks one of the worst single-day performances for the company this year. Musk's fortunes took a beating also, losing $15.3 billion on the 7th of July. As per Bloomberg's billionaire index, Musk's current net worth stands at $346 billion. And staying with Musk's social media platform, X has argued that online content cannot be regulated as per the whims and fancies of government officials. Ashmit joins us now with the action from the Karnataka High Court. Ashmit, fireworks in court once again today.
Well, indeed, the brief that appears to have gone from Elon Musk-backed X to the lawyers in Karnataka High Court is to not mince words. It was just in the previous hearing last week that we'd seen B.G. Raghavan, the advocate appearing for X, arguing about how any Tom, Dick and Harry officers had been issuing takedown orders. Today, in today's hearing, the very same counsel arguing before the Karnataka High Court that the complicated subject of online content regulation cannot be left to the whims and fancies of government officers. In fact, the claim that was made by the X counsel is that the rationale with which some of these orders are being passed is that I think so and therefore it is, and that this is something which is untenable, which is not permissible under the framework of the IT Act and therefore needs to be struck down. Now, all of this was, of course, in reference to the recent takedown orders that had been issued by the Railway Ministry with respect to a video that went viral of a car driving on the rail track. And here again, the ex-counsel argued that a train running on train tracks is not news, but a car running on train tracks becomes news, and therefore that video being posted online makes no difference whatsoever to the railway safety, and therefore railways has no business issuing takedown orders. And this is the example that was used by the ex-counsel to manifest how there are orders being issued under the threat of removing safe harbor protection from X, the social media platform, and that none of the safeguards that have been prescribed under Section 69 are being complied with. These are arguments being made by X. You were yet to hear from the Government Counsel, Solicitor General Tushar Mehta in this case.
All right, Ashmit, many thanks for joining us. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with more.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. The world is truly going nuts over pistachios. The Dubai chocolate kunafa, a pistachio-stuffed dessert that went viral on TikTok, has sparked a global pistachio craze. The sweet treat has fueled demand for pistachios in everything from lattes to pastries, and prices have gone soaring. Despite a record harvest in 2023-24, the U.S. expects an even bigger crop in the upcoming season. But for now, supply is struggling to keep up with this desert fuel demand. To discuss this, we are now joined by Rajiv Pabreja. He is MD and CEO of Commodity Trading Corporation. Rajiv, hi, thank you so much for joining in. And I will talk about supplies later, but I do want to talk about the demand first of all, because we're looking at a huge surge in demand, whether it comes in from US or Dubai for that matter. Europe demand has been surging quite strongly as well. And then for the Indian markets, it is absolutely about pistachios as soon as the monsoons hit, and then Diwali would soon be starting, and then you have the winter demand coming in as well. How are you looking at the demand, first of all, what we saw in the previous year, and what are the estimates for this year?
See, pistachios have become a very in nut because almonds were the main in nut. But if you see the growth, overall growth for pistachio has been the highest. If you see the history, if you see the last 5-year growth, it is almost, we have grown up by 3 times. Earlier, India was importing 3 years back, 4 years back, we were importing 10,000 ton. We are importing 30,000 metric ton. And especially, we are depending on kernels only from Iran. Iran is one of the main supplier of kernels because the kernels best quality only come from Iran. Pistachio and shell, we were earlier depending on Iran, but now we are dependent. US is also one of the big player who is supplying us, one of the biggest player actually for that. But from USA, we have a time because anything shipped from USA, it reaches to us in 60 to 70 days. And anything shipped from Iran can reach to us 10 to 15 days. But due to this wars-like situation and USA changing tariffs and everything, there has been a lot of dynamics changing every day. So there is a lot, and Diwali is this year early, and from last few days, shipments were disrupted because of the wars-like situation. We were buying kernels from Afghanistan. The route from Pakistan also stopped. Demand will be another 1 week. There will be a big demand in India, and there will be a shortage in India.
We'll come to those numbers also in a bit. But you know what, Rajiv, in last 6 months itself, from trying a Dubai kunafa to a pistachio latte to pistachio desserts, almost everybody really seems to be going gaga over this. How have you seen value addition when it comes to pistachio, and why is it the latest crazy nut that everybody is going to?
See, one is that health benefit. If you see, there has been a study. If you see yesterday news only, there was an article. It reduces diabetes also. And it is a natural product from straight from the tree. It is coming to you.
It's high in protein.
And protein. Protein is important because people, they see Indian population is a vegetarian population. If you see, if you know people who don't eat egg or a non-vegetarian, for them it's the best thing to have as an alternative for the protein. And especially after this chocolate kunafa thing, India is also getting crazy for that. Indian manufacturers have started making kunafa in India. And we have a lot of chocolate bars, we have coffees, we have shakes, we have drinks. So many things are coming up with, even, like we used to have almond butter, we have now pistachio butter in the morning. So there people are coming with new ideas, even the chocolates, even the cakes are being coated with pistachios and all this thing. So demand is going up. People are asking for more of pistachios, especially the kernels, as I told you. Indian kernels demand has gone almost double than last year. There is a big trend and a new change because of the health factor. Plus, the green color makes it's more attractive. Even the sweets, you have a lot of things to there.
But Rajiv, will soon have to pay higher price for this green color that everybody seems to be getting attracted to. So talk to us about the prices then. What is it that we've seen in last 5 years in sense of prices, and where do we stand right now? And with all those supply concerns and demand surges that we are seeing, what is your sense on a price forecast from here?
The prices, if you see the current prices in the next 2 months, the prices will remain firm because America is almost out from the supplies and they don't have much of supplies. And even if we buy today, it will not suffice. It will come for another 60 to 70 days. Because of the Iran logistics and the war situation, and they had some blast on the port. So last 2 months have been very irregular supplies from Iran. Turkish crops absolutely failed because the new crop Turkey is failed because normally when there is the prices go up, sometimes Turkey also supplies. But because of Turkey new crop failed, their consumption has gone up. They are not exporting anymore. And Afghanistan route is closed because of the Pakistan. We cannot buy directly from coming route is closed from the Pakistan. There will be a shortage, prices will go up, but Indian population is so big, even if the prices go up and demand goes up, and the price will remain firm, very firm. And after 15 days, Diwali production will start. All the manufacturer will be planning for Diwali. They will start packing, they will start processing, because pistachios normally in shell is roasted. So you need roasting, packaging, and then reaching to the customers. It will take, it's a procedure, it will take time.
Sure. Rajiv, so when it comes to India, and as you said, in 3 years, did you say 3 years, from 10,000 tons to 30,000 tons of an import that's happening in India? That's a 3-year thing.
Yes.
In 3 years, we've gone up by 3 times.
Yes.
And
so
then,
last 3-4 years, the trend from last, if you see the history, India was doing very little, 10,000 tons. But from last 2-3 years, there have been a lot of promotions, a lot of work going on, and health benefits, and especially being a protein alternative to the protein, and Indian population is vegetarian, and the pockets of Indian people are having a good income. So automatically the demand has gone up, and a lot of advertisements about it for the health benefits. The demand has gone up to 30,000. If you see compared to China, we are nowhere. China is consuming more than 100,000 tons. So we still are much more. If you see, as per the population wise, we are not eating much, but demand is going up, and this is one of the production which is the demand is going by 12 to 14% per annum growth is there still now.
I'm wondering how much that kunafa demand must have taken the pistachio demand as well on the higher side. But
it has.
It has. So how much was Dubai's
Dubai was never. See, Dubai earlier was not a consumer. It was more like a. But now, because of this kunafa thing going crazy, a lot of everybody, Indian manufacturers started making kunafa. There are so many companies who are not doing, and big companies, big brands have also started making kunafa chocolates, because they want to be in. They don't want to leave this new thing coming in.
Yes. Rajiv, so when it comes to India, and I do want to know that, as you said, it's pistachio in kernels, and then it also is overall pistachio demand in India. So when you look at that as a basket, does India still consume pistachio the way it is, or there is a lot of value addition and there is a growth there as well?
Value addition has gone up. Earlier India was basically more eating it was used for the sweets purpose. But now we have shakes, we have cakes, we have, as I told you, we are using for morning. People are taking with the chocolate, butter, as a butter. We have pistachio butter coming up, pistachio things coming up. Alternatives are coming in, even the drinks. You have coffee, you have shakes with this. So alternatives are coming in. Halwa earlier it was only traditionally for the sweets, but now a lot of consumption is going on. Even people are snacking. You go to the office, people just like the young generation X, which is new generation, is there. They carry a small packet into the office because they think we need protein. We just eat 1 ounce, or 20 grams or 30 grams of pistachios a day to keep us healthy and strong and get good protein in our body. So trends are changing, people are changing. And even earlier what happened, people have to have in-shell pistachios roasted. But now even people are getting kernels roasted in different flavors. Earlier there was not a flavor mark, only one salted one. But now it's low salted, black pepper. Some people are even using it with a little spicy one like chili flavor.
Rajiv, I've tried
a lot of things are coming
and
with the
chocolate as well. So I get you totally on when you say that value addition has been quite strong. But Rajiv, since you mentioned Diwali, and pistachio is of course one major big part of it, but there are other dry fruit expectations as well in sense of demand which are going to go up. What is it that you're looking at Indian markets now? Huge import, of course, for pistachio, but when it comes to cashews, almonds, walnuts, a lot of those superfoods, seeds, etc., what is the kind of demand that India is looking at?
See, India, as I told you, India nuts demand is going up by almost 7 to 8% per annum. And all the nuts, even like walnuts, if you see, walnuts were imported like only 5,000 tons or something of that sort. But now walnuts also, India was an exporter actually. If you see 10 years back, India was exporting walnuts. But now we are importing walnuts from Chile and from USA. So India is changing. People are going for healthy products, especially after the COVID, the demand went up very, very high. People wanted to have something healthy, which is directly from the trees. So demand is going up, as I told you, and as a new crop is coming, all the new crops normally for all the nuts comes in the month of September, October. So the prices will hopefully come down when the new crop comes in. But for the Diwali, we have to depend all on old crop.
Old crop.
So market will stay strong, stable, and demand will not come down. And everybody has to have nuts.
It's a good time for you, Rajiv. It absolutely is a great time for dry fruit guys at this point in time. But thank you so much for joining in. So that's what Rajiv's telling us, that overall dry fruit demand is 7 to 8% on the higher side when it comes to pistachio. Well, that market is going up by 12 to 14% as well. And yes, pistachio is in almost everything from chocolates to desserts to cakes to halwas, and you name it, and you have a pistachio there. But with that, let's go for a short break. Don't go anywhere though, because when we come back, the Trump has proposed higher tariffs on Bangladesh's textile imports. What does that mean for the Indian textile industry? We will discuss that with Prabhu Damodaran of India Textpreneur Federation on the other side of this break. Welcome back. You're watching Commodity Champions, and shares of Indian textile companies rallied over 8% in trade after the US imposed a steep 35% tariff on garment imports from Bangladesh. The move is expected to boost Indian textile exports, particularly in the US markets, where Vietnam leads with a 19% share, followed by Bangladesh with 9% and India at 6%. While the tariff is a notch lower than the 37% initially proposed in April, it is still more than triple the earlier base rate of 10%. This could significantly shift sourcing decisions in India's favor. To unpack what this could really mean for the sector, we are now joined by Prabhu Damodaran. He's head of Indian Textpreneurs Federation. Mr. Damodaran, hi, thank you so much for joining in. First of all, your initial reaction. Everybody seems to be applauding this. At this point in time, the numbers look very, very good. Is India ready and has the capacity and the capex to make good use of this?
Good evening. Yes, it's good news emerging. All stars are aligning for Indian textile sector. Actually, if we want to see some kind of a data, yes, like the global trade is also in slow lane, and the same kind of things are happening in apparel also. We don't have any kind of a protein story like in the food sector to grow our kind of a trade in double digits. Only thing, how each country is grabbing the market share from others is the main key area to watch. In that sense, for example, for the past 3 years, if we take the CAGR of US apparel imports, US imported around $79 billion of apparel during 2024. If we take 2021 as the base year, the CAGR growth is only in the range of -1%. So the trade is not growing. The challenge is how we are going to capture the market from other countries. Now, with the Trump tariff announced as of now, we are at 10%, Bangladesh at 35, and Vietnam at 20. India definitely have advantage. Let us see what kind of a performance for India in the past 3 years. In 3 years, almost we and Vietnam and Bangladesh have similar tariff lines. So in such situation, India gained considerably in the US market. For example, for the past 3 years, CAGR of Indian apparel export to US stands at 3.8%. At the same time, Vietnam grown only at the rate of 1.4% CAGR and Bangladesh at 1% CAGR. This shows that even before these kind of tariff changes are happening, and American buyers are preferring Indian goods, Indian sourcing. So this trend will accelerate in the days to come because of the changes happening. At the same time, it's all moving parts. We can't say anything as static. For example, now August 1st deadline itself is a kind of a negotiation tactics with other countries so that Trump administration may even revise the tariffs based on the further whatever the trade deals happening with our competing countries before August 1st. So as of now, yes, we are at 10% and Bangladesh at 35 and Vietnam at 20 and Cambodia at 36, definitely leading to an advantage of for India. And already we are witnessing good amount of sourcing, and this trend will accelerate. Very, very importantly, India have some unique advantage. That is where global buyers are very, very upbeat on India. For example, we don't have any import dependency on raw material or intermediate goods to make textile apparels. That is a very big advantage. Now buyers demand supply chain visibility, source of goods wherever the origin is coming. So a lot of compliance also gaining momentum now. At this stage, India and China, only two countries have entire value chain in place.
Oh, absolutely.
So now China is already degrown by 6% in the US market for the past 2-3 years. Now India is the only reliable alternate to China. So we are very confident. Already our monthly export run rate from $350 million to US improved to $480 million now. And we may expect another $150 million of additional US exports in the days to come.
Okay.
Only thing, we need to invest boldly in capacities. We need to create scale and competitiveness to handle this kind of a massive inflow of orders with the combination of US. For example, if we imaginary situation.
I just want to get to some
deal-
numbers as well, Mr. Damodharan. You explained to us on where India stands, and yes, we are in a position of advantage here and our numbers seem to be increasing. But as you said, there is a need for capacity increase, competitiveness, and of course, investments as well. Just to get some numbers on table then, what is it that India contributes to the world right now in sense of exports? How much of that is a contribution to US? And with all this as a background, how do you see those numbers improving, let's say, in a year from here?
Okay, we can simply break down as monthly export numbers of apparel exports. China still, after all this noise around China plus one opportunity, China exports around $13 billion a month. Apparel exports alone. Apart from the $13 billion, if you take textile and fabric exports, they are doing another $12 billion. They may be losing market share at US, at the same time they're gaining or they are diverting the goods to other Asian countries. And Vietnam also, so monthly run rate of China at $1.13 billion, Vietnam at $3.5 billion, Bangladesh at $3.2 to $3.4 billion. We are at $1.5 billion monthly run rate of apparel exports. We improved from the average of 1.2 to 1.3. From this 1.5, we need to reach at least $2 billion monthly run rate so that our market share in US will improve from the current 6% to 8% range. And from wherever you see, either Europe or UK or any developed markets, our market share is only in the range of 5 to 6%. So there is a plenty of opportunity to grab. As I said, we need to confidently invest in the capacities. For example, now the low-hanging fruits. For example, spinning industry is a so matured sector in the entire value chain in the industry. We have good capacities, competitiveness. At the same time, due to various dynamisms of the industry, margin profile is changing, margins are shrinking. And so it's right time for the spinning companies to think of integration model so that they can venture easily into apparel, and asset turnover ratios are high in apparel, and EBITDA margin, ROC, everything is better. So India have more than 1,000 spinning companies, at least 100 companies have good size and scale. They can easily venture into apparel because somebody need to invest and create capacities. It is not until fabric stage we have a huge capacity. Apparel making is an area we need to boldly invest. Now Mitra Parks also coming.
Sure.
So 7 states.
So would you say it's a very divided market right now when you look at garments on one side and ginning and spinning, and of course these are different markets, and as you said, garments is something that India really needs to work on. So what is the kind of capex are we talking, and what is the number of companies that you think are ready to get head on into this?
Actually, we can categorize it small, medium, and large. 3 categories are there. Already integrated players who build size are making a decent margin, and they are very confident. And we are seeing a lot of listed companies also announcing a steady capex. Everyone is a little concerned about these kind of uncertainties because uncertainty is the enemy of any business. Now, if tariff clarity is coming up, naturally the integrated large companies must announce capex. They are the leaders and they need to demonstrate that in practical terms so that medium and small companies also will follow the same trend. In our own Tamil Nadu, already 35 to 40% of apparel exports contribution coming from Tamil Nadu. We are seeing a lot of SMEs also very confident about UK FTA, and a lot of UK buyers started engaging well on the ground, and we see that 70 to 80 companies are building up capacities in wherever the manpower is available. The workers availability is a very, very important thing. That is where the Mitra Park and the construction of staying facilities, those kind of infrastructure, plug and play infrastructure, these things are very, very important to scale up in garments.
Sure.
So we are seeing 6 to 7 states are very active, number one, and it's right time to launch PLI also. Say apparel PLI
that
for
exactly,
cotton apparel.
Mr. Damodran, is my next question really, because while as you said, competitiveness and capex needs to increase and capacity needs an increasing as well, but do you see that you would require, the industry that is, would need a government push as well to make use of this opportunity?
Yes, definitely, because the uncertainties always create some kind of hesitancy among the investors. So if we create this kind of a plug and play facility and offer some kind of a PLI, the momentum or motivation will be much more. And it's right time, because if we improve $1 billion additional exports from the current level, it creates 1.5 lakh new jobs. Only furniture and furniture manufacturing and apparel creates so much of jobs for the whatever the investments we are going to make. So it's a win-win for everyone. Win-win for the government, win for the policymakers by way of job creation, for the export earnings. So PLI is the ideal answer, and PLI should be designed in a way that even the medium companies also can be the part of the story, because PLI means mega scale. And in apparel, we can't think in those lines. We need to design a scheme that even the medium-sized companies can move towards the next stage of growth by building 500 seats kind of a capacity.
So as you mentioned, Mr. Damodaran, that it's a big opportunity right now for the Indian textile industry with the current tariffs that we've seen across countries there. So, but what India needs to do is, of course, a bit of a government push from one side, capacity, capex, integration. There's a lot that India needs to do. Today, of course, has been a knee-jerk reaction, but to take it ahead and make it a reality, there are some steps that perhaps need to be fulfilled right now. Thank you so much. Yeah.
One more point I want to add, a lot of expectation about tomorrow's announcement on US trade deal. Number one, we hope that will happen. Number two, maybe we may get a zero duty on imported cotton from US also.
Oh, well, absolutely. Those are a couple of very positive things that you mentioned, and yes, the street seems to be anticipating it as well. But thank you so much for joining in today. And with that, that's all the time that we have on this edition of Commodity Champions. Thank you for watching.
Hello and welcome to News Center. I'm Parikshit Luthra. United States President Donald Trump has reignited his tariff war even as he announced a 3-week extension to negotiate trade deals. Trump sent letters to leaders of 14 nations, starting with the staunch U.S. allies Japan and South Korea, proposing a 25% tariff. This is similar to the high duties that were proposed by him on the 2nd of April. Malaysia, South Africa, Indonesia and Thailand also face higher tariffs. Trump said, and I quote, "If you want to play ball, this is how we play ball," end of quote. So countries have seen their tariff rise from what was announced in April. Bangladesh faces a 37% tariff compared to 35% in April. Myanmar, Cambodia and Laos are also facing higher tariffs. The new rates will apply from August, and President Trump has left room for negotiations, saying the tariff letters are more or less a final offer from the US. So where does all this leave India? Well, President Trump says the deal with India is close, and sources tell CNBC-TV18 that India has made a decent offer. The White House, we learn, is now assessing the proposal and the market access gains that American companies will get. We learned that India's proposals cover almost $150 to $200 billion worth of goods trade between the two nations. India is also unlikely to make any further concession at this stage, and there is going to be no compromise on red lines when it comes to wheat, rice, maize, dairy products and GM crops. India exported engineering goods worth over $17 billion to the US in FY24, along with electronic goods worth nearly $10 billion and petroleum worth $6 billion. Meanwhile, US exported mineral fuels and oils worth nearly $13 billion to India, along with precious stones worth over $5 billion and electrical machinery worth $2.4 billion. I caught up with Lawrence Loh, Professor of Strategy and Policy at the National University of Singapore, to understand how Trump's latest tariff salvo may impact major Asian economies. Here's that conversation.
I think many countries in Asia, East Asia, South Asia, Southeast Asia, they are already caught in the buy now. They actually have very little options left. What Trump has given up, some almost like an ultimatum, initially 14 countries, and these countries will have to come to the bargaining table and strike a deal. So in other words, it's almost like take it or leave it, and many countries will have to just play by the game.
Right. In the short run, how do you think supply chains and exports from these nations are going to be impacted?
Oh, definitely, because the tariff basically just add certain costs for, say, the U.S. consumers. Also, definitely with higher prices that is going into the big U.S. market, suppliers from all parts of Asia will feel the pinch. In fact, it's like an artificially added price to some of their goods that go in, and I think this will make it very difficult for many of the companies to continue to operate in such a setting.
Right. I would also like to ask you about, does India now come into a more advantageous situation, considering that key Asian economies such as Japan, South Korea, Malaysia, Myanmar, if they are going to have higher tariffs, including Thailand and Vietnam, does importing from India become cheaper?
Definitely. I mean, but of course, India is still at this point in time in the stage of negotiation. What is on the table is maybe about 26% tariff. This will have to be effective if any deal is not made by the 1st of August. So that 26% is actually quite high, almost comparable to the current 25% by Japan. China is still in the stage of negotiation as well, together with India. And China may actually strike a deal maybe ranging from 30% to 50%. So in other words, the advantage that India may have if no deal is being struck with the US, the advantages of India will not be basically there.
Right. We are hearing possibly that a deal with India could be signed in the next couple of days. That indeed would be important. But do you feel that the current tariff situation that Donald Trump has imposed, will this bring ASEAN countries closer together? Who will be the winner in these tariff wars?
I think if you look at the 10 ASEAN countries, all of them differ in terms of their trade profiles, in particularly the balances with the US. For example, Vietnam will have the highest surplus with the US. On the contrary, Singapore is one that actually in itself has a deficit with the US. So in other words, the US actually have a surplus with a country like Singapore. So in other words, for ASEAN countries, it's very difficult to have a coordinated approach. A common approach is practically almost impossible because each of the country is so diverse in terms of the trade, and also some of the countries will differ in terms of their geopolitical interests. So you can see a country like Vietnam is already striking a deal. Some of the countries are still having high tariffs, so they really have to play ball. Countries like Indonesia, countries like Malaysia, or even Thailand, despite the uncertainty, they have to put their act together.
Right. Do you expect China to be the gainer as a result of these tariffs?
Nobody can gain whenever there's tariff. It's a lose-lose game. So what is trying to China is trying to do is actually minimize the damage for itself. And right now, one of the key challenge that it faces is actually transshipment. In other words, what the US is trying to do is to prevent, say, Chinese goods from being rebranded and transshipped through another country such as Vietnam. And I think that the US is quite particular about closing this option as well.
And President Trump's 25% tariffs on automobiles and auto components starting to take a toll on the Indian industry. Shraddha Suri Marwa, the CMD of Shrubros, and also the president of the Automobile Component Manufacturers Association, spoke to us about the impact of the tariffs and China's curbs on rare earth exports and the potential impact on the growth outlook.
We grew at 9.6% year on year for last year. The good news is that two-wheeler sector is growing. The Indian domestic market is growing. It's very hard to predict what the growth will be this year, but at the moment for Q1 we've been steady, and the numbers have looked good. We'll have to wait and watch a little bit to see how Q2 pans out, especially given the current scenario of supply chain disruptions and the geopolitics that's panning out.
Right. I'd like to straight away ask you about the rare earth magnet crisis. India has not received any rare earth magnets since the 2nd of April. How badly is the component industry getting impacted? How is it going to impact the bottom line and production?
This is a challenge that we are facing currently. There have been no imports since April. It's going to be till stocks last. At the moment, and the government of India is trying very hard, to support industry and also work for, government to government to see what can be done. The good news is we do have long-term solutions because we have the raw material, and eventually we will come out of it. It's going to be challenging right now. We'll have to see how Q2 actually happens. We're also looking at alternate solutions to see how we can substitute this and and continue supplies.
Right. Now, speaking about the tariff wars that we're looking at, Donald Trump has imposed high tariffs on Vietnam, Japan, Korea, many of the Asian economies over the last few days, almost 14 countries last night. How does this put India as a supplier for automobile components around the world?
So I think tariffs are very, very diabolical right now when it comes to the US. Different nations are getting impacted on different dates. The last night's 14 does not have India's name on it, but we do not know what's going to happen in the future. At the moment, it's while it is stressful, I think it's also an opportunity. As an industry, we're as an industry, I would say that we are not sweating right now. We are waiting and watching, and quite honestly, Parikshit, this is beyond anybody's control. So we'll have to just align and move forward. The only silver lining is that India is not the only country which is going to be impacted by tariffs. It's a global phenomenon.
Right. I'd like to speak to you about the 25% tariff that Donald Trump has imposed on automobiles. Now, this is on grounds of national security. India is also considering doing some retaliation against the US at the WTO. But this 25% duty on automobiles, on certain components, how is it impacting the industry, according to you?
You see, if you see our numbers for last year, actually exports grew, they didn't go down. And also, the domestic market's been growing, extensively. So while, we spend a lot of time actually focusing on, what's going to happen to India's exports, what we do need to do at this point is actually change gears and look at the domestic market, because that's growing. We are already number 3. We are growing very fast. India's GDP is growing. India's auto sector is growing. So I think there's a lot of opportunity here itself, and maybe we should focus more on that.
All right, on that note, we take a short break, but coming up, United Arab Emirates has rolled out a lifetime residency policy for a one-time fee of 23 lakhs. A special discussion when we return. The United Arab Emirates has introduced a nomination-based golden visa for Indian citizens, offering lifetime residency for a one-time fee of approximately 23 lakh rupees. Earlier, pathways required a minimum investment of 5 crore rupees in real estate or business commitments. Shivani Bazaz has all the details.
Well, yes, the UAE has rolled out the refreshed Golden Visa scheme for Indians, slashing costs and widening eligibility in a move that builds on the India-UAE Comprehensive Economic Partnership Agreement, or the CEPA. Now, signed in 2022, CEPA aims to deepen trade, investment and mobility between the two countries. And this latest Golden Visa reform is a big step in that direction. Indians can now apply for lifetime UAE residency by paying a one-time fee of 1 lakh dirhams, roughly around 23.3 lakh Indian rupees, without needing to buy any property or start a business, which were mandatory under the earlier route. This is a major shift from the existing criteria that demanded around 2 million dirhams, which is around 4.6 crore plus, in property or business investments to qualify for the Golden Visa. This time, the visa has been opened up beyond high net worth investors and individuals, now available to professionals like teachers, nurses, scientists, digital creators, e-sport players as well too, rather than just HNIs and business owners. Applications can be filed directly from India through designated centers or online portals, and candidates will be assessed on professional credentials, clean background and potential contribution to the UAE's economy and culture. Now, experts believe that over 5,000 Indians are expected to apply in just the first 3 months, which is the pilot phase, with more than 4 million Indians already living in UAE. This opens new pathways for tax-free income, business opportunities and full family sponsorship as well, including children, parents and domestic staff. Back to you.
All right, joining us now is Rohit Bharadwaj, Country Head, India and Director, Private Clients at Henley & Partners. Thank you very much, Rohit, for joining us. Rohit, frankly, have you got any kind of formal word from the UAE government? Is there a circular out on the UAE government website? Or whatever we're seeing around this 23 lakh rupee golden visa, Was this clause always there in terms of getting a visa through nomination?
I think it's very exciting where this recent news came up just a day or two before. But I think we still need to wait for an official kind of an update from UAE itself. But if we really step back, the Golden Visa actually was introduced in 2019 by the UAE. And at that time, the objective was to attract investors in terms of different opportunities to invest in UAE, to different options, whether it's real estate and also set up businesses. And over the last 6 years, they've actually done a lot of fantastic work in terms of, creating and also gaining that momentum of being the wealth magnet of the world. Now, according to our recent Henley & Partners wealth migration report, roughly approximately 142,000 millionaires are, projected to relocate globally, with UAE being the major beneficiary of a net inflow of such millionaires of approximately 9,800, individuals.
All right, that indeed is a big number. What I would also like to ask you, Rohit, and this is what the UAE authorities have told us yesterday. Golden visas may be granted by the UAE government on several grounds, including but not limited to real estate investment to the tune of 2 million dirhams, business ownership, distinguished contributions in fields such as science, medicine, arts, culture, media and sport. All nominations undergo a government-led vetting process, even those coming from authorized agents, with the final decision resting solely with UAE authorities. What does this entail? Can you really get a golden visa for 23 lakh rupees?
As I said before, we are yet to await an official announcement for the government. But over the years, they have been adding certain different kind of categories to attract highly skilled individual families from all over the world as well. So I think as we are yet to wait and get that announcement officially about the news which has been floating since last couple of days.
But as of now, if somebody goes to you or makes an application, what is the nomination route? Because what we are hearing is that possibly this is just a marketing gimmick that is doing the rounds, something that was already there, and it is being repackaged as something new, which is not new actually.
So currently, if somebody wants to apply for the Golden Visa, the investor route still is currently the most popular in terms of investing through the real estate or other investment opportunities, including the bank deposit option. They did include open certain kind of categories in the last few years, but we need to yet open whether such individuals or have they targeted certain country nationals to apply with certain regime. That is something which we yet to need to wait and watch.
Right. And how popular has been the golden visa for Indians? Could you give us a sense of what is the kind of growth on a year-on-year basis you've seen since 2019 when this golden visa was launched?
I think we've seen a tremendous inquiries from Henley & Partners. In terms of the the proximity of location between India and UAE, naturally there has been a lot of NRIs who have been there in UAE for generation. And a lot of people, the demand, the key drivers for attractiveness about the Golden Visa, it's still about, it's the achievement in your economic growth, improvement infrastructure. The initial trigger which started was for a lot of investors to invest and diversify their real estate. That was one of the initial triggers. And now a lot of people who have been there, who have bought their homes, whether for second home opportunities or relocation, they're also now creating a wealth creation, which is automatically leading to your employment creation sector within UAE. And within that, Dubai and Abu Dhabi has been the most important catalyst for that.
Right. And as of now, if somebody wants to get a golden visa, what is the minimum amount of investment that is required and the waiting period?
So it still stands the investment. If somebody needs to invest, it has to be 2 million dirhams of a real estate or another option of a bank deposit option for a 10-year visa, or a 1 million for a minimum 5-year opportunity of an investment. So that still, from the investment route, still stands.
Right. And in case if someone wants to use a nomination route, did the Golden Visa program already have a clause where a government or a business entity can nominate you, and 23 lakhs was needed to actually secure that nomination? Because these are some reports which we've already also read.
This is also news for us, honestly. So as I said earlier, we need to wait and watch. Is this something which they are actually opening up new categories, such as nomination under the business, to allow, whether it's on a attracting talent, or on a merit-based system? So we need to yet wait and watch. Hopefully we'll get some clarification, hopefully by this month.
Right. And finally, as you deal with a lot of Indian clients, in terms of popularity, where is the UAE Golden Visa compared to other destinations such as UK, for that matter, places where people want to move to or migrate to?
So in terms of the opportunity and the attractiveness, if you see that the UAE Golden Visa is a minimum or to maximum 10-year renewable permit, which is renewable every 10 years. When we compare with the most popularity, what we've seen is still the Europe Golden Visa, or the residence by investment programs have been continue to be very, very popular, because they also have a certain pathway. And if you as a family fulfill certain opportunities there and residency requirements, there is a pathway to PR or maybe citizenship in the future. So they still continue to remain very popular for people not only who are looking to relocate, but most importantly, who are looking to have a plan B or a second home, or to hedge their current residency as a sovereign risk.
All right. Rohit, thank you so much for joining us here with your view on the Golden Visa and reports of the changes to the Golden Visa regime and how possibly an individual could get it for 23 lakh rupees. But as you're saying, and it's important to point out, there is no official circular. And if you want a Golden Visa right now, you would still have to pay the required amount, which is almost 4.5 crore rupees. Thank you very much, Rohit, for joining us with that update. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
We just announced a 5,000 crore guidance. It's not ambitious at all. It's very
conservative, really.
It's very conservative. It's where some of these big guys were in 21. We're going to start that journey now. And I feel we can catch up very soon. We want to be a brand selling 20, 30,000 crores, and we can. We also want to continue doing what we've done on office. We build these large-scale institutional readable assets. We want to continue doing that.
A lot of time, because embassy keeps doing new things, people think we are very aggressive, but if you actually, somebody looks properly into the whole math, what we do, it's always a calculated downside move, whether it was WeWork, or whether the REIT was there, whether our tie-up with Blackstone was there, everything had a math which secured everything and kept us stronger as a foundation, which didn't get disturbed with COVID coming in.
Hello and welcome to the CNBC-TV18 special. Over the next 30 minutes, we are unpacking a trend that is both massive in scale and quietly reshaping ownership in corporate India. We're going to be talking about promoter stake sales.
India's promoters, the ultimate insiders, have been steadily selling down their stakes. And this isn't a short-term trend. Over the past 4 years, data shows that a clear trend of exits of promoters is accelerating. Promoter holding across listed companies is falling.
Well, but here is the paradox in that sense, right? The other side of the argument. In a market which is flush with retail inflows, where earnings momentum hasn't always kept pace with liquidity, could this steady promoter selling have actually prevented the market from melting up, overheating in that sense?
And to make sense of this, we are joined by someone who's watched India's capital markets for over 4 decades, whose voice is as respected by promoters as it is by investors. Ramdev Agrawal, co-founder and chairman of Motilal Oswal Financial Services. He's also our guest editor for the day for the next 30 minutes.
So, as always, Reema and I'll take it easy, and Ramdevji will conduct the questions in just a bit. Our expert panel also, though, comprises of Pranav Haldia, who will be doing some of the answering to Ramdevji's questions. He's managing director of Prime Database. He's, of course, crunched the numbers on stake sales and ownership patterns as well. We have Rahul Saraf, India head of investment banking at Citi India, to decode the rationale behind these exits and also what promoters are doing once they sell with that money. And of course, Feroz Aziz has joined CEO at Anand Rathi Wealth on how a chunk of this promoter cash is actually making a comeback right into the market in a different avatar, not just stock markets, but all kinds of financial assets as well. But, before we get to the conversation and the Q&A, let's just start by laying out the data and what this puts out, just to frame our discussion in the right context. And here is the data. Over the last 5 years, private equity and venture capital exits have surged. In 2023, sell amounts crossed 1 lakh crore for the first time. And 2024 saw a record 534 deals worth over 1.15 lakh crores. In just the first half of 2025, we've seen nearly 37,000 crores worth of exits. Now, this trend is even more striking among company promoters. These are private promoters that we're talking about. In 2023 and 2024, promoter stake sales touched 1.16 lakh crore and 1.1 lakh crores respectively. This is almost double the amounts seen just 2 years ago. In 2025, we've already crossed 64,000 crore rupees. And by the way, it's only July, so you've got half a year to go. As a result, private promoters' shareholding, if you just look at these numbers, how it's impacted their shareholding across listed companies on the NSE, it's steadily declined. From 45%, which is what private promoters held at the end of 2021, it's now come to under 41%. That's about 4.5% percentage point drop in just over 3 years. It's massive. On the flip side, where has all this money gone? Domestic institutional investors, powered by largely SIPs, have been stepping up with their shareholding, which has risen from 13% to over 17% in the same time period. So it's almost a transfer from promoters, private promoters, to institutional shareholders, which is largely DIIs. Here's the kicker. For the first time ever, possibly, the value also of DII holdings now exceeds that of FIIs. FII ownership of listed companies was around 16 lakh crores more as compared to DIIs. Basically, it was FIIs owned 16 lakh crores more of all listed companies over DIIs in 2021, right? That 16 lakh crore has all but disappeared, and then some. DIIs actually now own about 1.6 lakh crores in listed equities more as compared to FII. So actually, it's been an absolute dramatic change in terms of the composition of the market, even within institutional shareholders. And DIIs have really emerged as the big kind of, block which has absorbed a lot of this supply which has come in. So that's the data. But now let's get the context and the perspective. Ramdevji, great to have you with us here. Yes. Thank you very much for joining us.
Very nice to see you.
And the data is striking, right? There is no doubt about it.
I was broadly having, but you put it very nicely. The data is absolutely crystal clear. That trend is building up. And, one of the things you said in the beginning, so retail investors are giving a floor. the resilience to the market, and the promoter selling is going to give that, it is going to save the market from melting up. You know, so that's a fantastic thing to have, because this one, it avoids a crash in the market. It also avoids the melt up in the market. Okay. Second, and this gives a what you call sustained expansion of the capital market activity. Because if you have floating stock of say 30%, or there are a lot of companies there are 25, or government companies there are 15, 10% is there. So your activity is going to be small. But as your floating stock, which is now 60% on aggregate basis, floating stock goes to more like 75%. So what happens is that all the market intermediaries, one is the index, because of index expansion say by 12-13%, and other is the volume expansion by 4-5%. So more customers, more stocks to trade, and of course the tailwind of economy, which is sustained at 7%. So I think it's a complete Goldilocks kind of situation, because in the stock market, any kind of melt up is borrowing from the return of the future, which creates problem. Now it will be very good for the market and for the market sustained
The numbers
expansion.
we put out, it shows that private promoter holding is now about 40%.
40%.
It's come down about 4.5% in the last three years, roughly. You think this pace will continue at this rate?
If you see, now there are two things. Prices of the stocks are not determined by who is buying and selling, because number of stocks remain same fundamentally. So what decides the price of the stock is the earnings momentum. You see Indigo, they sold I think 25-30%, and at every price from 1500 to almost as late as last week at 50. So, and both the promoters have sold. So clearly market wants earnings growth, the company to become bigger and better. If that is happening, so in aggregate, if the Indian corporate profit, which is about say 15 lakh crores, that goes to say in 2 years time or 3 years time to 20 lakh crores, I don't think who buys sells. I mean, then actually the game will be even bigger for the capital market participants. Foreigners will come, domestics will come, and more stocks will be there. So the stock price will not be impacted. But temporarily what will happen is the stock, it also depends on, because promoter knows the value of the company and what is going to happen in the next 3, 4, 5 quarters or something like that. If the motive is not that much positive, see, if I want to set up a family office and I sell by 5-10%, or I want to do philanthropy and I want to sell, that's a very ultimate positive thing to happen. But if I know for sure that outlook 2 years down the road is going to be very bad, or he can see that, and because of that it is being sold. So that will have little.
What a sea change, right, Rima? I mean, 10 years back, 15 years back, I remember. I mean, promoters used to sell, and we used to.
It was a taboo.
It was one of the red flags.
Yes.
With companies, promoter sales. But not anymore.
Yeah. So this is the maturity of the market. I mean, in US, all the promoters, like I believe, Bill Gates holds hardly a percentage or 2 of Microsoft. So he has sold across. I mean, over the year he has sold. Jeff Bezos, this thing, Musk. They keep selling, and that to a good chunk. So markets are not that much perturbed in US, and hence that broader trend. This is the expansion of the market. We are about 5 trillion. In next 4 to 5 years, 6 years, will become 10 trillion large market. And it is required. This kind of liquidity build-up is required, because we've got tons of small companies. If you have 60-70% owned by the promoters, how, I mean, where is the depth? I mean, a lot of fund managers, they won't be able to participate in those stocks, because whenever you go to buy, the impact will be 10%. When you go to sell, it will be 15-20%. So that makes the market very primitive. So this is the best market,
So it's a sign of market depth and not distress.
No, not distress for sure,
So what are the broader implications of this? You spoke about how that this is a structural positive for everything related to capital markets. So from an investment point of view, if this continues, should one be looking at brokerage stocks? Should one be looking at wealth managers or some of these exchanges? I mean, what's the best way to play it?
So now from here, the next derivative starts. Who are the guys who are selling? So all the market intermediaries, like the guys who are going to come, they are the guys, iBankers, they are advising them to sell. So that, I mean, they are going to make their own fee. Then after that, see, how do I say, this promoter holding doesn't exist actually. It exists only in the digital paper. That 50%, 1 lakh crore value of the company, 50,000 crore has no relevance for the market. It's just there for decoration. But the moment you melt it, it is there for everybody. I mean, first the promoter is free to consume for their own consumption and philanthropic purposes. nobody can do philanthropy by not selling the stock. I mean, just the dividend is not good enough to kind of do big projects. So that is one. Second is that promoters can also look for parallelly promoting a very large, kind of new ventures in the family members or themselves, say, and unrelated family ventures. So basically, if you are a textile company and you want to get into steel, now you would not like to diversify within the textile company that particular thing. You sell 5-10% and promote for 1,000 crores, 2,000 crores, another equity base and promote a new venture. So a lot of these possibilities are there. Wealth effect will be there. You can consume, I mean, you see all these 400, 200, 300 crore flats being bought. They're all coming out of the market cap melt down, whether it is IPO, whether it is QIP, whether it is actual selling. So wealth effect has to come.
As an investment house, what is the capital markets has been your favorite area?
Yes, so I can see what happens. One is that, of course, one time the deal value and then some commission you make. But that's the smallest part. Immediately this money comes in wealth management. So wealth managers, they get the corpus. So 2, 3, 4 of them will be nominated and everybody will get very large chunk of, I mean, you can see large deals and all the money is again coming back to the market. So actually, at one level, they provide the, what you call, melt up against the melt up. And again, they come back to give the flow to the same market by diversifying the portfolio.
Correct.
So that activity is, so it expands the wealth management platform. It expands the AMC platform because wealth managers, they allocate the money to the mutual fund products or private equity products. So every aspect of the capital market activity will get a boost.
You said that there could be multiple motivation why a promoter may want to sell part of his stake in the company, right? Some will be altruistic for philanthropy purposes, etc., diversification, next generation. But then you will always have these few bad, apples. How can a retail shareholder identify and be aware? What are the warning signs in such cases?
It is for the person who is buying the stock. His consideration is not who is selling, because in any case, he's a non-owner of the company. So he is going to buy the company, and it is coming from whatever sources it is coming from. It is coming from existing retail, or it is coming from the promoter. It's a legitimate source for him. Just because the promoter is selling, the prospect for the future is not changed. But since it is coming from promoter, he should be a little extra cautious why he's selling. Maybe he can ask the broker, or he can ask the selling party what exactly is prompting you to sell. Probably most of the time you know why they're selling.
What we're going to do, Ramdiji, is take that commercial break and then we'll get you your guests, not my guests, your guests on the other side. So, we'll do that. This discussion continues, but we'll widen the scope. Ramdiji mentioned wealth managers as a space. So we have Feroz Aziz of Anand Rathi joining us. All the data that I put out in the beginning, that was coming from Prime Database, and Pranav Haldia will join us, and he's got a really good eye for data in terms of what is coming up ahead as well. And of course, making a lot of these deals happen is Rahul Saraf, India investment banking head for Citi. So all three on the other side with Ramdiji coming up. Welcome back to our special market show. The market editor, and of course, our market editor today is Ramdeo Agarwal of Motilal Oswal Financial Services. We also now have Pranav Haldia, Rahul Saraf, and Feroz Aziz with us to give us a rounded perspective. And I'll throw it across to Ramdeo ji in just a bit. But Pranav, that data that I used to kind of set up the entire discussion came from Prime, and excellent data as always. And that question which I put to Ramdeo ji, and he also said you'll have the best idea. Is the pace of these sales, as you see it in terms of the pipeline, I mean, is it as strong? What we've seen over the last few years has been very strong. Is it likely to be as strong going forward as well? Both in terms of the IPO pipeline, secondary sales, PE, VC exits. What's your sense?
Firstly, I would just mention that I think with all the promoter exits that you've seen over the last 2-3 years, there's really no reason to panic. The calendar year 2023 saw 36 lakh crore of promoter exits, and calendar year 24 saw 1.40 lakh crores. And this only includes bulk and block and offer for sale, which is used by promoters to meet the minimum public shareholding requirement. But you've seen that there's not been any meltdown in the secondary market, and in fact, we're going from strength to strength. So I think this is going forward as well. One can expect a lot of promoter sell downs taking place. We have to understand that, given the kind of IPOs that you've seen over the last 2-3 years, there are a lot of promoters who need to exit and bring down their stake to about 75% within the 3-year timeline to meet the minimum public shareholding requirement. And, block deals is one of the means which they use to reduce their stake. Even apart from this, you are seeing, of course, promoter exits for a whole wide variety of reasons. When promoter is buying, it's always considered to be a good sign. In my view, it should be always taken as a good sign. But when the promoter is selling, I think that's something that you alluded to earlier as well. It can be for a whole wide variety of issues. Of course, one of the issues can also be to, book some profit. They might feel that it's already well priced or the future may not be too bright. So as an investor, I think it's very important to keep a close watch on both promoter buys and promoter exits. One final point I would like to make as far as promoter exits are concerned is that, one of the things which we need to look at apart from for the reason of sale is also that the promoter should continue to hold a good amount of stake post the deal. And the deal should not have idly happened at a huge discount. So if these things are in place, then I don't think it's a really worrying sign as far as investors are concerned.
Rahul and Feroz are with us. Rahul, let me ask you. You work in so many deals, and you're in touch with so many promoters who come to you for all kinds of things. What is the underlying motivation, as you see it, Rahul? I mean, the bulk of it.
Sure. I think if you step back in terms of the capital allocation needs of the family, whether it's to create a family office 5-10%, whether it is to buy a big house, as Ramdev said, or is it for diversification? I think all of those are very important factors to understand what is the motivation. Is it for philanthropy? And what we've seen is Indian promoters are actually selling for any of these 4 reasons, but not necessarily to sell because they don't believe in the business. In general, when we see 45 to 40%, bulk of that is, yes, 1 or 2% or 3% sell downs, but you have to put it in context the MNC sell downs. Some of the promoters who are MNCs have sold down for capital allocation needs globally. Private equities who are promoters have also sold down because that's their business to, of course, sell down over a period of time and churn capital. Pranav talked about new age companies who actually have very low founder or promoter stake by itself. That skews the data as well. There will be some dilution of stake as well because new capital raise for growth has happened. And then last but not the least, in some cases, the minimum public shareholding has to be met and therefore promoter sell down. So all of that has to be put in context when we look at the promoter sell down, both in absolute terms as well as in percentage terms. I think that therefore the motivations have to be looked at in that context. And yes, 5%, 7% sell down is okay. But I don't believe that Indian promoters, Indian families will have a significant sell down all the way to 25% or below, because as a culture, we have the culture of passing down to the next generation. The big family offices which are getting created are still getting created on the back of control on the basic flagship business. that control is not going away. As against in the West or even in the East, like if you take Japan, the inheritance tax is there, where for the next generation, they have to pay 55% tax. And the only way they can pay is by selling the stake. So I think some of that has to be put in context when we think about what happens 5 years from now or 10 years from now.
Feroz, on the subject of setting up family offices, how much of the money, to your mind, is fed back into the capital markets, re-enters the capital markets?
Yes, Rima. Before I go to that question on the previous topic, I have 3 important points which I want to make. And I really pray Ramdevji's 25% happens. Because in the S&P 500, we are looking at close to about 80% of the companies have 100% free float. And we have not more than 10% of them who have more than 80% free float. There are only 6% of the companies who have more than 90% free float. We are a country with promoter holding, financialization happening. If there's a paradigm shift and there's capital movement, we are a country with 940 lakh crores of household savings, adding 40 lakh crores, out of which only 6.7% is in equity. And largely top 500 companies, because that's what is mandated to domestic institutions as their tier 1 benchmark. So if there's no promoter holding, there will be bubbles, retail will lose money. That's point 1. Point 2, if I personally think that there's hardly any promoter selling in NSE 500 companies. Let me put some math to that table. Out of the Nifty 50 companies, 5 of them have done a stake sale in the first quarter. In the last year, if you look at Bharti Airtel, okay, and Kotak, very second decimal, and Bharti Airtel was 1.21%. After dilution, there's still a promoter holding of 52%. In NSE small cap, which is a little more flamboyant kind of an index, you have a sale from HFCL Limited, and after the sale of 4.2%, we still have a 34% promoter holding. So 34% it's not the last mile out, right? And if you go with this, these are the top 5 sales in those indices of 250 companies. Top 5, the 5th top 5 is 1.58% dilution and is left with 53% promoter owning. So that's point 2. Point 3, if Jane Street should not happen in India again, which SEBI has very rightly, under the auspices of great executive directors there who understand derivatives, your cash market has to be liquid. Otherwise, there could be manipulation in stocks using derivative markets. What did exactly Jane Street do? That was already, on your channel, I've said this twice, that it's so easy. If you have 250 stocks in the derivative index, if cash market free float is not there, वो stock move करेगा, put call खरीदेगा, और पैसे इधर से उधर transfer करेगा. You lose money in cash, you make significantly more money. So having low free floats creates manipulation opportunity and overpricing. So that's on point 1. Point 2, does the money find back its way in the family offices? The answer, like Ramdevji said, it's absolutely right that it comes back into the capital markets. Point 3 is, I think the money temporarily comes into capital markets. Anybody who is in the business likes to pull that money over a period of couple of years back into doing another business. But Uday Kotakji had actually said that the next generation of those big promoters actually want to just manage the money. So I think immediately 90% of the money comes back into capital markets, 30-40% goes back into the economy, rightly so. And because the debt capital is more expensive today, for the last 2.5 years, repo rates have been at 6.5, and that's why equity valuations plus high interest rates is creating promoter selling, and that's project is viable at equity. You don't need debt for it, so that's why you see they're deleveraged.
Yeah, no, absolutely. Ramdevji, just a quick point. I mean, as Feroz said, Rahul said, a lot of the money is family offices, comes back into the market, so they're diversifying in that sense.
Yeah.
Actually, isn't that also a signal, as we were saying, they're the promoters are the ultimate insiders. If they are, so essentially they think that this is a great time to actually take some money, put it into family office, all kinds of other financial assets, house, whatever, right?
Yeah.
And then and maybe, as Feroz said, later use that money to start something new, not the business in which they first sold. So is that a bit of a signal at all, or no?
It depends all on the company, you know, like some of the companies, say like in Indigo, you know, one of the partners is kind of just going out of the partnership. So he sold his entire large chunk, 25-30%. So that is a dissolution of partnership. He was a promoter. So that kind of thing. So every company will have a different reason. You know, I'm only worried about one concern where company knows, because promoter knows everything. I mean, if anybody knows the future of the immediate future, 2-3 years, it is the promoter. So, and unfortunately, the investors, they have a very patchy knowledge of the future of the companies. And hence, there should not be arbitrage between the person who knows a lot more to the person who knows a lot less. That should not be the motivation. Otherwise, if I want to buy a house, I want to diversify into a new business, you have fundamental right to, I mean, that's the basic purpose of listing, where you can have the cake and eat it. I mean, in 75% also you control the company, at 50 also you control the company, at 10% also you control the company, if control is an issue.
Thank you once again for joining us here, Feroz. Great that you could come down. Appreciate your time here. Rahul, appreciate you joining us. And next time, hope to see you in the studios. And Pranav, thank you very much for providing all the excellent data and, of course, the perspective as well. It's a wrap on this edition from Breema and me. Thank you very much for watching this edition of Market Editor.
Hello and welcome to On the Record with me, Shireen Bhan. My guests today have a 30-year legacy in the real estate business. They delivered India's first real estate trust and they've also delivered 75 million square feet. Joining me now to talk about the real estate sector's trends, but more importantly, what's ahead for the Embassy Group, Jitu and Aditya Virani. Gentlemen, appreciate you joining us here on the program. Let me start by taking you back. It's a 30-year legacy, as I pointed out, for you. A lot has changed in India's real estate sector. Plenty bad, but some good as well. The last few years have been good for the real estate industry. How would you sum up the journey so far?
So when I started on this journey and I joined my father, there was a whole sense of people who were making these smaller buildings, smaller offices, doing construction really the crude way. There was nothing comparable to what it is today, because today the industry is as international as anywhere else in the world, you could say. We had all these Gujarati contractors all over the place. People always were looking, or developers always thinking of how to build an extra floor. And, this over the time just transformed into these large business parks and, large developments in one location. And I think it's just the evolvement, or maybe the newer generation stepping in, wanting to do things differently. And, I see I'm in the middle region where now I have kids in the same business. And I can see that they want to do things more differently than I did. And I would see the journey. The office space was, my father built office space with 500 square feet office space. The toilet inside was just for the owner of the office.
Yeah.
And people strolled down the corridor to use the common toilets. And now all of a sudden we have these large business parks with huge floor plates, and, concept of single office hasn't gone. And I think that's given the birth of flexi office, a great opportunity. So I think it's just the people, the newer generation coming in, and India's fast adaptability to international standards, and to a lot, I think there's a lot of these for companies coming in, the GCC companies, the internet companies coming in. I think technology companies, that's actually changed the outlook, how Indian developers started looking at his product. And a lot of design elements started coming in. Otherwise, there was no design. I still remember in 1996, I appointed a lighting consultant, and my father told me I was crazy to spend so much money. Because all of them built nice buildings, but nobody lit them up correctly.
Yeah.
And that was a big thing. So you learn traveling abroad, you see things, and you want to implement it. And now I'm the victim of the same my dad was.
They're telling you what to do now. It is.
But yeah, so the whole cultural thing was, to make this one buildings, look at the laws, try to exploit everything from one development, which I think is, taken a backseat. And I would honestly, not because I'm in this business, but I would say that all my colleagues in the business, and generally the business in India, we are as comparable as any international developer anywhere in the world.
Well, he talked about the next generation. So let me come to you, Aditya. It's been about 9 years for you at the Embassy Group as well.
Yep.
As you look at the road ahead, the legacy that you take forward as well, and the opportunities that you are looking at, how different is the landscape today from what he inherited?
Yeah, and look, 9 years have flown by, and even in those 9 years, I've seen a transformation of what Indian real estate was then and what it is now. And I think the big theme is the institutionalization of the asset class. Moving from these small offices that were strata sold, financed off plan, to now very institutional, large ticket. We did the first REIT, these large assets that are owned by huge institutions or REIT type of a trust. I think the whole financing of the asset class has changed. I think the whole design aspect of the asset class has changed. And I only think it's going to keep evolving, and you're going to see that strata grade B office actually slowly die a slow death. And that's the way forward actually for this asset class.
When we talk about the way forward, and you've set some pretty aggressive targets in terms of what you believe you're going to be able to deliver. As I pointed out, you've already delivered 75 million square feet. What's the expectation, given the fact that everybody believes that this is going to be India's moment as far as manufacturing is concerned, this is going to be India's moment as far as GCCs are concerned. Real estate has been seeing an upswing with regulatory changes like RERA, etc. coming in. I mean, what are we really talking about in terms of penetration, in terms of untapped potential?
I think that, there are big industry stalwarts in this, but I don't think anybody has a clue that what we're in for, because urbanization, is actually right now at a much slower pace than it should happen. And as that happens, and I think, for the younger generation, it's a huge opportunity where it is going to explore multiples than what has already happened. People are always looking at the luxury market, but it's the mid segment which has got such a big gap till today. And I think...
But do you believe that supply in that mid segment is now going to come on stream? Because, I go back to a conversation that I was having with Keki Mistry just the other day, and he said, look, that's the untapped opportunity. But is that an opportunity that's viable? Is that an opportunity that you're, for instance, looking at from a future
perspective? We think it's quite viable because, luxury apart market is X. It can be Delhi, Bombay, Bangalore, but there's a certain amount of luxury flats or apartments you can sell. But because we all come from affluent families, we feel that we travel around internationally and we feel we need to build luxury apartments. And
But has
they come
taken
the
you by
comfort.
surprise just the way that the luxury housing market is taken off? I mean, you know, like we were just talking about what's happening in Delhi, for instance. I mean, flying off the shelf. Now, whether that is speculator or it is actually end use is a different story altogether. But has what we've seen in the luxury market surprised you?
I think still there's more to come. Look at the size of the scale of our economy and the people. I mean, let's look at the percentage of rich. It may be a very small percentage, but you know, I was at a conference of Anurag and somebody from Morgan Stanley was giving a talk where said that, you know, there are like 5 million super rich in India.
Yeah.
And then the next level is a 20 million bracket, 50 million bracket, out of which 20 million will move into the super rich bracket. So now we're talking about, if we go by Morgan Stanley statistics, if the 5 million are causing so much of turmoil in the luxury market or expectation, all these stories, can you imagine when these 20 million move into that sector, what would happen? So I think India is still a lot to be seen luxury. I mean, compare China and, you know, we are there. So even if we are lagging behind China, even if you look China 15, 20 years back, it was far different from what India is. When look at the luxury market over here, there's not much happening. So I think personally, I feel there is a lot to come. But, you know, as a company, we would look at a level like luxury to a certain extent. But the next level is where, you know, we think the business is.
I think China is a great example because this is where India is, you know, 20 years ago. And today, China built tens of millions of houses every year. You know, we build 5 lakh houses, new houses. So there's a massive shortage of housing. There are 32 million people moving into cities every year. And yes, luxury has taken up a big part of the volume. You really break it up into affordable, mid-segment, luxury. This is the typical breakup. And a lot of that 30 million is falling in that affordable segment that doesn't really get addressed.
Yeah.
You know, luxury, although it hits the headlines with these big numbers, it's such a small fraction of the potential of this country. But I think that mid-segment, you know, where the typical IT workforce is in.
In pricing terms, what would qualify as the mid-segment today?
I think different cities would have a different term, but for Bangalore, I'd say that 1 to 3. Today, that 3 might be 4 to 5, even pushing 5.
We're talking about crores, just for the benefit of everybody who's watching. Yes.
5 crores. So 1 to 3 crores is really that sweet spot where, look, wage growth is keeping up with that. And if you look at housing growth, yes, in the last 3 years, it's kind of higher than where wages were. But if you look at a 15-year average, I feel it's actually underperformed. You've seen costs go up. You've seen land go up. You've seen land costs go up because infrastructure hasn't been able to keep up. So you're not able to go out really far and buy cheap land. And that's also partly why you can't cater to this affordable segment is your raw material cost. Your cost to build can only be that tight. You know, then you compromise on delivery. But the land is really where it struggles to hit then that affordable. And I guess why most developers are focused on the luxury side. We actually see a big opportunity on luxury. We've done that as a brand, but also now on this premium, everything below. Actually, we just launched something 60 lakhs onwards, sold out 80%. We see opportunity play across from 60 lakhs all the way to that uber luxury 50, 100 crore ticket size.
Well, you know, so if that's going to be the play for you, what you see as the impediments, land costs you talked about as being perhaps the biggest one. But what do you see as some of the other big impediments that get in the way of being able to address this untapped market?
So I think a lot has to do with regulation. I think, you know, sometimes in our country, we need to have a committee to see that which regulations work and which don't work. So I think regulation is the big thing, and I think the government is working quite at a fast pace extensively and connecting things and learning things from what has happened and setting in some best practices. And infrastructure, you know, I mean, as you can see, you know, Mr. Gadkari is building roads all over the place. I think this has to happen in all the states. You know, unfortunately, if after independence, all we had done is build roads, you know, we would be far more prosperous than we were there. And so I think that recognition is coming now about roads, traffic. People are getting bored of all this conversation, which is happening, you know. When we walked in, that's first 5 minutes, we had a conversation on traffic.
Weather and traffic.
So I think that all this is accumulated. And then, like I earlier said, because there is still the luxury segment also has a gap, people in their comfort zone prefer not to risk themselves. and remain in the luxury market so that, they have that margin. They don't lose out because, like Aditya mentioned, the cost of construction is pretty much similar. If you take the difference between luxury and the regular, it's like maybe 20% upside, not maximum, more than that. And that's why people are just sitting in this comfort zone. And because, again, the demand and supply to be met is still controlled.
Yeah.
When it explodes, then, let's say somebody like me say that, oh, where's a, I don't have a place in the luxury market.
Yeah.
It's occupied by XY developers. Let me focus on another region which I can capture that market. So this will happen over time as business gets matured.
Well, speaking of maturing of businesses as well as new developments, a development that took place early this year in January of 2025 was the merger with the erstwhile India Bulls. For you now, take me through what the rationale was behind that decision, and more importantly, what that sets you up for in terms of future growth. Aditya, I'll start with you.
Yeah, maybe why the merger is a big thesis that drove, and say from my point of view, it's an access to a large vehicle with the potential to do a lot. It's our development company. It's our flagship development company. Everything that we want to do will be done in this company. It complements our structure. We have a REIT. It's very simple. Ready assets go into that structure. Development company, housing, office, future asset classes in Embassy Developments, which was the erstwhile India Bulls. And we have WeWork, and we actually have a few different companies being incubated that will have its own growth story. But what it does, it gives us access to a large public company with paid up land bank, pan-India presence, a team. We inherited 500 people, all of them who have been in these projects from the very beginning, who know Mumbai, who know NCR. These are deep markets for us as Embassy to penetrate in. And we feel the opportunity is there. The macros all line up. We feel the brand is so powerful. We feel that the halo of Embassy is immense. And what we can do now with this vehicle, the team, the assets that we have, the execution capability, I feel, sky's the limit. If you look, we're playing catch up. We just announced a 5,000 crore guidance. It's not ambitious at all. It's very
conservative, really.
It's very conservative. It's where some of these big guys were in 21. We're going to start that journey now. And I feel we can catch up very soon. We want to be a brand selling 20, 30,000 crores, and we can. We also want to continue doing what we've done on office. We build these large-scale institutional REITable assets. We want to continue doing that. It's not a resi play. It's a commercial and resi play. Focus on our key markets, Bangalore, Mumbai to start. We'll see where we go next. We have a few assets in other cities. And yeah, the potential is, ginormous. We have a big financial year. We've announced a 22,000 crores GDV. 18.5 resi, rest is commercial, and we're going to see how we can play this cyclical asset class, hedge our bets, both office and residential.
I want to bring up the numbers for everybody's benefit, because you've seen quite a significant turnaround as far as FY25 is concerned. PAT of about 203 crore rupees versus a 485 crore rupee loss year on year. And revenue is up 100% to 2,547 crores. So, what kind of aided the turnaround for you, and what should we now expect in terms of the run rate from here on?
Shireen, it's not really anything special or secret that's happened. It's actually what we've been doing at Embassy the last 4 years. We've been quiet. We've kept a low profile intentionally. We had a lot of stuff to clean up. We did clean it up. We paid down 5,000 crores of debt over the last 4.5 years. And it's actually the balance sheet of Embassy that's basically come into this company that's made these numbers look really high. But we've been making small, deliberate steps, these slow compounding to get ourselves here. And this 22,000 crores of GDV is actually lands that we've been working on for the last few years, getting it to this stage. Approvals are not easy.
Yeah.
Some of them are agriculture. You have to convert it. It doesn't, happen overnight. So actually what's happening now is accumulation of all the hard work that's happened these last 3.5 years, tough last 3.5 years, to get us to this place. We feel we're sitting on the launch pad. We feel that, that blue skies ahead and we can do so many things with this company. And all locked in land. So it's quite exciting of, the future of Embassy developments.
Well, let's talk a little bit about the future, because, you spoke about the 3.5 years of pain that you've had to go through in order for you to be able to get where you are. So what is the expectation now in terms of new launches? You talked about the guidance that you've held out, but slightly longer term, land monetization, etc. What's the plan from here on, given the many opportunities that you've already spoken of?
Well, like Aditya mentioned, we've been working for 3.5, 4 years, and sometimes I feel, being a positive person, that this delay in the merger was actually very beneficial for us. For whatever reason the merger got delayed, it gave us time to recollect, get all these projects going through. And, for us, I think, like they say, this old saying, there's no pain, no gain. And, today we will value everything what we've got. And I think it also made the company very resilient. To face whatever it is. I mean, I think, in my opinion, as a father, for me, for Aditya, being my son, to get that experience and to make him stronger. So there are a lot of tangible gains we got, which money can't buy.
Yeah.
And I think that will pay very long.
For everything else, there's MasterCard or the Embassy banner shaded.
So now, going ahead, I mean, I built this all the time. I'm 59 today. But it took me a while to do all this. But then these boys, they're in their early 30s. So they have a big run ahead of them. And we felt that, among all the real estate companies, we are a very strong second gen in the business, which is very important, because this is a business which professional people to take risk at the level, or
you need to have
calculated
skin in the
risk.
game. You need to have skin in
the game plus a calculated risk. So a lot of time, because Embassy keeps doing new things, people think we are very aggressive, but if you actually, somebody looks properly into the whole math, what we do, it's always a calculated downside move, whether it was WeWork or whether the REIT was there, whether our tie-up with Blackstone was there. Everything had a math which secured everything and kept us stronger as the foundation, which didn't get disturbed with COVID coming in, all of this happening, and we could hold on to all our businesses. And make a strong foundation now to launch ahead. So for us, the next few years, 10, 20, 25 years, is no looking back.
Yeah, well, clearly there's no looking back. There's only looking forward. But, you talked about WeWork, and let's address that as well, because Karan is on the WeWork roadshow at this point in time. And that's another story. I mean, it requires a whole other show on what actually happened with WeWork globally. But in India, you've managed to not just keep it going, but you're now heading to Dalal Street, or hoping to go to Dalal Street with WeWork.
Yeah, hopefully. Shortly we're looking. We filed our DRHP, and can't say much about it. But yeah, you're right that. But so again, it's one of the businesses which, when we looked at it, it was complementary to our traditional business. So everything we do at Embassy is somehow connected to real estate. So we run I don't know if you're aware, we run an IB school, which actually has all the professionals who work in our IT parks, most of their kids working there.
Right.
So the whole concept was to build a school and run it the best way so the international people get good education and they would believe in the culture of embassies. So when they have a choice to take office space, they would believe that they're dealing with a professional company.
Yeah.
Just like everything is cross, working for us. And WeWork was, traditionally for our traditional business, it was like a tenant. I actually one time said it, which still hasn't happened, but I'm sure it'll happen, that I said one day my son will be my largest tenant, But right now they have like 20% of the business is from an embassy building. And I must thank a lot of colleagues in my industry who've been very nice to Karan and, have offered him space at really good terms and, encourage him a lot. So that's kind of help for being in the business and having good relationship. But it's an extension and, co-working is the way forward going ahead.
It does deserve a show on its own, I have to say, because there's not too much we can say now, but it's very complementary. It's 27% of the office absorption is happening in the space. So it really makes sense for Embassy to have a position here. And I know it's clouded by WeWork Global and all the ups and downs that they've had. But the India story is really interesting. People should look out for what's happening with WeWork India and look out for your show with it very suited.
You talked about not wanting to take on debt unless you really have to. Land bank monetization, inorganic opportunities, what does the future hold at this point in time to fuel the kind of growth aspirations you have?
So right now we've got all these land banks, which all our plans are at approval stage. We're launching them. We have quite a few launches this year, next year. So it's basically to just get our own cash and, of course, reinvest back into property, buy land, mostly a back end. And I think there's a very good, because the market has become much more mature, it's a good opportunity where small money can buy you bigger opportunities and more structured when people know that you're strong enough and you'll deliver. And I think that's what our game is, to use our money and stretch our money to the maximum. And also monetize it. There are chances of all these assets.
Yeah.
Like I said, it's the money we probably need right now is only to get the approvals.
Yeah.
And after approvals, it's all cash accretive. So for us, just look at 31% cost of construction all through all our projects averagely, which means, even if the market slows down, for us, it's a big safety net. So we actually, like I said, between old school and new school, we look at it that we have our own cash.
Yeah.
And that can grow. I mean, we've done so well without our own cash. So I think with our own cash, probably we'll do much more,
Yeah. So let me end then by asking you, I'll come to the priorities for you, but the targets that you've set for yourself, for the business over the next few years.
Yeah, look, I put it in 3 different buckets. Our priority one is we have 3,000 crores of receivables that we just have to unlock. We have to put money in, hit our milestones, and basically collect money. So that's just staring at us right in our face. We have another 2,000 crores of unsold inventory. So just stock that we have to sell while the market's still good. We have another huge pipeline for 48,000 crores of GDV between office and resi that we can bring to the market, which if we're bringing 22,000 crores this financial year, and we'll stagger the rest. So kind of existing land bank is priority number 2. And priority number 3 is land banks that we still have. We have 3,000 crores, 3,000 acres of land in this company and new deals. We just signed something in Whitefield, Bangalore a week ago, and we're excited about it. We want to do more. This is, again, pipeline that's going to be built in FY 27, 28, 29. We're very cognizant of how the market is reacting to it. Like I said, we want to play cyclical game where it's not just a residential platform. This is residential and office. But we're laser focused on it, micromanage this. I think over the last few years, my expertise has really shined from being a micromanager. I'm detail oriented. It's very easy oriented. You've gone through, a period where you have to be a micromanager, and coming out of it, I think that's really going to be our big advantage going forward.
Sometimes when we're on the plane and he asks me a question, Dad, who looked into this last 30 years? And I want to look at the window and jump out, or nobody looked into it.
Clearly, that's the big difference between the old school and the new school, right?
Yes. So that's why, I'm quite comfortable, it's the business in his hand, and he's quite structured and very, predictable. Like he mentioned before we start our conversation that likes routine to do everything on time. I'm still a bit of a maverick even now, and obviously people don't change.
Thank you so much for joining us, Jeetu and Aditya.
Thank you, Shreya.
It's been an absolute pleasure, and look forward to hearing more from you as you build out on some of these plans that you have shared with us on the record. With that, it is time for us to take a break here, but there's a lot more that will continue on CNBC TV 18. We'll take a break and we're back in a minute with more.
Hello and welcome to Startup Street. I'm Arundhati Ramanan, and with me as always Shruti Mishra. These are the top headlines from the startup world. Linkrunner, an AI-powered app attribution and analytics platform, has raised 5 crore rupees in a pre-seed funding round led by Titan Capital. The funding will support hiring across engineering, data science and sales, as well as drive product innovation and go-to-market efforts across India.
Quartz, a creator intelligence and collaboration platform, has secured funding from the Chennai Angels as part of its ongoing pre-Series A round, which is targeted at $1 million. Quartz is targeting $30 million ARR by 2026, growing 3x year-on-year in enterprise client adoption.
Elon Musk's X argues online content cannot be regulated as per the whims and fancies of government officials, claims misuse of power by union government at the Karnataka High Court. This after Railway Ministry ordered the takedown of a viral video of a car being driven on railway tracks.
Tesla shares slide 7% as Elon Musk's plans of launching a political party reignite concerns over his commitment to the company's future. The EV giant's market cap erodes by nearly $70 billion in 2 sessions. Musk's network shrinks by $16 billion to $346 billion.
Google has rolled out an AI mode feature for all users in India to get helpful AI-powered responses and explore topics more deeply on the web. This feature, powered by a custom version of Gemini 2.5, will be available in Google Search, and there will be no need to sign up for labs. Those were the headlines that we're tracking for you this evening on What's Brewing Today. Credit-wise Capital, an NBFC focused on two-wheeler and MSME loans, has raised 200 crore rupees in its first institutional capital fundraise. The round was led by Trident Growth Partners, which infused 120 crore rupees. This is Trident's second investment from its 2,000 crore rupee maiden fund. The fresh capital will help the Mumbai-based lender scale its tech-driven credit platform across India's Tier 2 to Tier 4 cities. Joining me now to discuss this further are Gurpreet Singh Sodhi, the co-founder of Credit-wise Capital, and Pravan Malhotra of Trident Growth Partner, as well as my colleague Shruti. Gentlemen, thank you so much for taking time out and being here with us on Startup Street. Gurpreet, let me start with you, right? Credit-wise Capital is an NBFC that specifically focuses on two-wheeler financing and MSME lending. If you could take us through what you have on offer and the kind of presence you've already built.
Oh, first of all, Shruti, Aruna, thank you for giving us opportunity. About Credit-wise Capital, we started this company in 2019 with a focus on two-wheeler products. Since I come from a background where almost 30 years I have led the journeys, and after 30 years I now been a part of Credit-wise Capital. Along with me, one of my partners is Alesh Ablani. We both have been working together. So I think in last if I talk about in last 4 years, our growth has been phenomenal in two-wheeler industry because of a core understanding and a tech-driven approach. I think the best part we have built, and we have challenged the legacy way of working. We have a branchless model. We are today operating in 10 states. And if I talk about our growth, it has been 64% CAGR. Versus if I talk about the industry, finance industry growth is around 19%. So I think our strategy has been very, very clear. We wanted to serve the Bharat and Tier 2, Tier 3 cities through tech innovations, what we have built till now.
All right. Gurpreet, the follow-up question, you've got this fund infusion of 200 crore rupees. I believe you're looking to enhance your lending platform and deepen your presence in underserved cities. If you could elaborate on these plans and any new offerings you plan to roll out anytime soon?
I think this fundraise, phenomenally, what our focus has been very clear. It would be predominantly in 4 major areas. One for us is growth. Which we are already, we have been growing for last 4 to 5 years around 60% CAGR. The second is we wanted to enter into new space. We recently started loan against property. The best part is we have till now acquired more than 2 lakh customers, and we would like, the strategy has been from day one is to acquire a customer and live with that customer for 40 to 50 years, giving, fulfilling the needs. So we are starting a product called loan from property, which we will be sourcing through our internal customers. So it's a part of our cross-sell strategy. Then finally is we would now would like to build a strong team. And finally, the fourth is a tech build-up. So I think the best part for Credit-wise Capital, like me and my co-founders, has been focused is to bring in technology in the best of the way where it can create a customer experience, and finally it leads into the growth. Today, if you see, we are branchless. We are operational in 210 cities. despite of that, we are for last 6 years seamless working and with the ensuring customer satisfaction without us. So I think this is our moat. Our strength has been to underwrite. Within 1 second, 1 minute, we underwrite a customer. I think that is our strength, which is actually coming from a tech.
Sure.
Yeah.
Yeah, absolutely. You know, Pravan, let me bring you into this conversation. You've invested 120 crore rupees to lead the funding round in CreditWise Capital. That's focused on, two-wheeler and MSME lending. This also marks TGP's second major investment from its maiden fund, right? So if you could sort of talk to us about what made you bet big on this firm, if you could take us through the rationale.
Absolutely. Thanks, Arundhati. So I think, for our approach for Trident Growth, while we look across a number of different sectors, typically we're following sort of the consumption story. And lending in particular is something that sort of tracks that quite nicely. We have been looking at the secured lending space and tracked this for a number of years and been following companies. CreditWise Capital stood out early on based on the team and the background of the team. So as Gurpreet mentioned, the team is a combination of one which has tremendous domain expertise and long-standing experience in the lending space on two-wheelers, combined with a very strong technology and financing sort of background. So that stood out as a team that we knew was going to be was successful. And we've been working closely with them for some time and now decided to lead this round. In particular, again, as was mentioned, I think the tech-driven platform that enables them to very efficiently evaluate potential customers, to make loans, monitor them, is something that really stood out. It allows them to provide sort of industry-leading benchmarks in terms of the time, the efficiency, as well as very low NPAs compared to the industry standards. So we really feel that this is a high-growth company that was going to scale tremendously, and we're providing both capital as well as value creation through not only the team's experience, the Trident Growth experience, as well as our founder network and operating partners to help the team in the scale-up journey.
Okay. Pravan, let's talk about TGP now. It has a 2,000 crore rupee target size, reinforcing the firm's drive to invest in category-leading growth stage companies across India's rapidly growing economy. If you could take us through the sectors that are looking interesting, what companies are you in talks with to invest in?
Absolutely. So there are essentially a few different sectors that we're finding quite interesting now. So again, our first investment was in the enterprise tech space with SpotDraft, where we co-led that round. The second one with the CreditWise and the financial services space, in particular around lending. These are two areas we find quite interesting. We are closely tracking on the manufacturing segment right now, again, driven by the Make in India story, the shift from China on the manufacturing side, and in particular, some specialized players. So that's one where we're spending a lot of time currently. The other couple of areas that we're looking at is in the consumer space, in particular, some omni-channel brands, and then healthcare is another focus area that we're spending time on right now. So again, overall, we sort of track broad themes that are prevalent and the tailwinds that are driving sort of the India growth story. But within that, we spend a lot of time sort of looking at very deep mapping of sub-segments, tracking companies bottoms up, and then finding the right opportunity, the right inflection point where we can come in and lead the rounds and help these companies scale to the next level of their journey.
Sure, absolutely. And Gurpreet, coming back to you, you hope to also use the funds that you've raised right now to triple your assets under management, right? If you could quickly tell us, how do you plan to do that? And also, where are your AUMs currently at, and how much do you want to grow it by?
Yeah, sure. See, we started a journey in 2019, and today, if I talk about from 50 crores first year we round, in next 4 years we are around 700 crores AUM as on day we speak. The thought process and the vision what we have set inside and our team and my co-founders is to reach to 4,000 crores by financial year 29 March end. Out of this, 60% what we are targeting will come from our two-wheelers, and from the LAP, which is secured, 40% AUM will be coming from the LAP product. So this is the way we wanted to go. I think the thought process has been very clear, Shruti and Anna, is to keep the portfolio at the top, followed with the growth, a completely compliance-driven company, and the finally is the profitability also need to be ahead. So I think from day one, since I spent almost 30 years working for various organizations, but I think first thing what I was very clear here, the company has to be a profitable.
Okay.
I think that is something what we are always proud of.
Well, on that note, we'll have to wrap up our conversation. But Gurpreet and Pravan, many thanks for joining us on Startup Street, and wish you both the very best for all your growth plans.
Thank you, Shruti. Thanks, Sharma.
All right, moving on. On the hot seat today, we have sustainability packaging startup Bamboo. It has secured 90 crore rupees in funding led by Ashok Goel, former MD SL Propack and Anderson India Capital. My colleague Ritu Singh caught up with its founders and began by asking them about the brand's clientele and market strategies. Take a look.
At Bamboo, the vision of the company is to eradicate single-use plastics from wherever possible. And the first industry that we have targeted is the packaging industry, which contributes to roughly around 60% of the global plastic waste which is generated, right? And as you rightly said, there's a lot of greenwashing happening under the name of compostability. So there are two compostable solutions. One is home, one is industrial. Unfortunately, people are, what you see in the market is industrial compostable. What Bamboo is building is a home compostable material, which basically do not require any kind of special treatment for it to degrade. It can degrade naturally when it comes into the contact with the microorganisms present in the soil.
Well, Kunal, tell us about this 90 crores that you've now secured. How do you plan to deploy this for growth?
Yeah, so basically the plan is to grow, and we want to go globally as well as exponentially. So we have a couple of product lines that we have planned out. These are primarily the primary products. So up until now, we were serving the secondary markets of paper-based products, and the next plan is to go into biofill, which is our proprietary product, build the primary products, which is going to cater to the FMCG sector, going into manufacturing as well as into the agri sector, and create products which will be for the larger enterprises.
Well, give us a sense of what your current manufacturing capability is, and how do you plan to scale that?
So we have 7 lines of machines. These can churn up to like 2 crore bags on a monthly basis, but we are going to make it as 5 times of the capacity that we have. But building in newer infrastructures of the world-class machines from different partners across the world, we are trying to assemble it together in one location so that we can not just become one of the primary suppliers for these products, but also state-of-the-art facility for showcasing to the world.
Well, you also have plans to enter the global markets, and you're looking at the Middle East and also North America. What gives you the confidence that you'll find success there? What is the scale of the opportunity you're eyeing?
Well, see, we are trying to solve for our global partners, the largest FMCG companies that we are working with today.
Okay.
We are going to be globally with them, right? The first opportunity that we are looking to cater to is serving these customers globally.
So Indian companies that are already your customers and have presence overseas?
Yeah, global companies which are also present in India.
FMCG
and others, and CPG companies. So we are going to pick back with them, solve for them in India, and then scale it to the global markets. Once we are there with them in the global markets, then we are going to explore more opportunities, what we can do with the global customers that are specific to North America region or Japan region or Australia and so on and so forth.
So Kunal, your target is to hit 120 crores in revenues and profitability in the next 12 months. What will help you get there?
So primarily right now we have enough customers for us to give us 100 crores of revenue from an ARR basis. These are all large enterprises that we have already engaged with. But the plan is as we go exponentially in the global markets, we'll build our potential in the Europe and the US markets. And especially looking at the contribution that we would have done in India with the products that we would have launched, we'll take similar products to those markets so that the success is already demonstrated in our local markets and we'll take it to the global markets. We already have a lot of requests coming from those regions. So we are just holding for us to really get our capacities built up, and then we go to those markets.
Vaibhav, you also have plans to enter the D2C space. Now that is tricky and interesting as well. How do you see a typical Bamboo product in a household? What exactly is your plan here?
Great question, Ritu. So, see, D2, when we talk about the vision of the company is eradicating single-use plastics, right? Now, a large portion of it also is from the consumer side. Yeah. Say, for example, you have compostable garbage bags right now. You have your oxo-biodegradable so-called garbage bags. So we are trying to come into those spaces. For example, garbage bag is one of them. Then we have pet poop bags.
Okay.
Right. Then
same category. Yeah.
Similar category.
Yeah, and then slightly smaller.
Yeah. Right. And also, the female hygiene disposable bags as well. Okay. And then we are coming up with bamboo-based paper solutions for your tissue papers. tissue paper. So we are developing a home kit for, where a customer can actually go truly sustainable. When we talk about sustainability, it's not about only eco-friendliness, right? And what the products we develop comprises of 4 pillars that we have. One is definitely the positive impact onto the environment, then the scalability, cost efficiencies, and the functionality. So we are maintaining all of these 4 pillars whenever the product is getting developed. So in D2C also, if you see, we are coming up with antimicrobial garbage bags, which you have not seen before, and that 100% home compostable ones, right? So we are going to be the only one in India.
How soon will you be launching these D2C focused products?
So we are unveiling it today, but we would be launching it during the 15th of August.
Okay.
Freedom from plastic, this Independence Day. That's the story that we are going to do.
About 500 brands currently already use your product, but where is the demand really moving next? What are clients asking for?
So every customer is looking to change the way they have operated. So there is a lot of policy pressure in terms of moving away from plastics. So all large customers are looking out for an alternative solution, and this is the right time. So from a policy perspective, from the brand's requirement perspective, from the consumer's awareness, I think we are at the right point. And talking about the brands, I would not name them, but the largest of the brands across the world are looking for these solutions, be it Unilevers of the world, the ITCs in India, the Godreges in India. So everyone is looking for an alternate solution, and we are in trial phases with a lot of these customers. They have liked our product. We have to go to multiple stages of development along with them, but we are in a certain stage that we can confidently say that within the 6 to 9 months of time from now, when we have our machines and everything ready, we will be able to serve these markets.
On that note, it is time for us to head into a short break. But coming up next, actor turned entrepreneur Vivek Oberoi has 12 active firms in his portfolio and hopes to list 2 of them in the near future. We bring you a conversation with the star himself on his investment strategy. On the other side, stay tuned.
Welcome back to Startup Street. Amazon is gearing up for its flagship shopping event, Prime Day, from July 12 to 14. Ahead of this big sale, CNBC-TV18's Ashmit Kumar spoke to Abhinav Singh, the Vice President of Operations at Amazon India, who outlined that the firm's 2,000 crore rupee investment plan. He also opened up about Amazon's quick commerce ambitions in the face of stiff competition from the likes of Blinkit, Swiggy and Zepto. On gig workers, he cautioned against having different social security laws for different states. Here's a slice of that conversation.
Just a few weeks back, we spoke about investing 2,000 crores in improving our infrastructure, in expanding it, and also improving facilities for our associates, both who work inside our buildings and those who work out on road. We spoke about Ashray centers, which are these rest stops for delivery associates who deliver for any company, not just Amazon, where they can get free access to tea, coffee, charging, clean restroom facilities, an air-conditioned environment. And today, we want to talk about an expansion on the fulfillment side. We are launching fulfillment centers in Delhi NCR, Rajpura, Indore, Bhubaneswar, many such cities. And we are also expanding our delivery network launching 30 new delivery stations in tier 2, tier 3 cities, in Havra, in Chandigarh, Mohali. The idea is to be able to offer fast, reliable speeds, not just in these cities, but in nearby areas. So it's a continuous process, one and a journey we've been on for the last 13 years, metronomically investing, building a network that's enabled by tech, but employs hundreds and thousands of people.
You've given me a number of cues. I'll take you through them one by one. First, let's talk about FC's fulfillment centers. For the benefit of our viewers, large warehouses essentially, which serve as backends for the Amazon India operations. Let's talk about that. Let's talk about this new capacity that you're bringing online. Can you give us a few numbers? Where do things stand? How does it stack up against existing capacity? And what does the road ahead look like? Are we looking at more penetration of these warehouses or fulfillment centers in tier 2, tier 3 cities? Some indication as to what this expansion drive for the footprint of Amazon India looks like?
Absolutely. You started by calling them largely warehouses. They're much more than warehouses. They're technology-enabled fulfillment centers, which are driven by data technology, which helps our associates and managers ship a very consistent, reliable experience across the country. Just these 5 buildings I spoke about are 1.8 million cubic feet. To give you a perspective, right, these numbers can become a little hard to imagine. That's like 10 Eden Gardens put together just in time for Prime Day. It's a substantial increase in our network from an expansion perspective, and you'll see more as we get into the rest of the year.
So how are things positioned for you, July 12th to 14th? To begin with, the first time that we'll have a 3-day Prime in India. Usually we've seen a 2-day Prime Day. Give us a sense what your expectations are, any growth numbers that you have clocked in your mind in terms of what you're expecting over and above what you had in 2024.
One thing which is really nice about Amazon, and for me personally working here, is that we focus disproportionately on the inputs. And our inputs will always be about the customer, getting faster to the customer, getting to them as soon as possible with the widest selection. To give you a perspective, in 2024, we delivered 41 crore items the same day or next. So in just that 1 year, we have increased our speed by 26%. And we continue to do this every single year. So this Prime Day is going to be no different.
I want to get a sense of what your take is on the consumer sentiment. Very disparate indications coming in from either brokerage reports, from corporate earnings, or from macro numbers indicate a slight amount of sluggishness, especially in the first half of 2025. What has your experience been for the beginning of this year, and what your outlook is for the second half?
Again, I'll go back to the inputs. You make available the widest selection at the lowest price and the fastest speed. Work with sellers so that they're able to provide the right prices to the customers and provide the right infrastructure for the delivery to be done as soon as possible. From an overall market size perspective, we are a very small part of retail, single-digit percentage. So there is a lot of headroom for us to grow, and that's how we look at it. We stay focused on our inputs.
But just the second half of this year, given how first half has panned out for you, when you look at indicators such as the monsoons, the RBI rate cuts, the upcoming festive season, your outlook for what the second half may look like?
We are optimistic. We are optimistic about the opportunity in itself to serve India. And like I said, we will always remain focused on the inputs. We are very long-term optimistic about the India opportunity, and that's what drives us every day.
From lab-grown diamonds and Alcobev to digital education and green infrastructure, actor turned entrepreneur Vivek Oberoi is managing a portfolio that spans 12 active companies, multiple IPOs and investments across sectors. In an exclusive chat with Aishwarya Anand, he opens up about the vision driving his strategy, why founders come before financials, and how he blends gut instinct with market logic. Take a look.
It always starts with a founder, a founder's commitment, dedication, SWOT analysis of the founder. It's okay if he's failed before or she's failed before. But how hard are they willing to hustle? Like Nishant Sharma, guy from Rutland Square, one of my recent investments. He chased me for 6 months. And then I looked at what he was doing. I looked at his journey. I looked at how he started from waiting tables to investment banking. Today, it's a success story where we've jumped in the last 18 months in terms of revenue, 400%. And in a space like Alcobev, where distribution is a hurdle, that's a big jump. And the CAGR is going to be in hundreds of percentages, at least for the next couple of years, when we talk about Solitario. The idea was great founder, Ricky Vasandani, hustler, right? Great design knowledge. Wanted to go into the commodity of lab grown. And I was like, no, that's not the strategy. Let's go using the existing supply and the growth in terms of reactors of lab-grown diamonds in India, and let's build a truly global fine jewelry brand. So that's what takes you into 9 countries, 25 cities in a 2.5-year span. And now you're doing deals with partners like Haresa.
Correct.
Now they're a $7 billion giant, but they're partnering with an Indian startup. That's something to be proud of.
Help us understand how many companies are you currently overseeing?
I have 12 companies that I'm still active on.
Understood.
2 of which I'm taking public this year. Pentacle, Solitario, I'm taking public this year. iScholar, Ready Assist will be in the next 12 months, ready to go IPO, inherently profitable, solid EBITDA. For example, with iScholar right now, we've achieved about 1,000 crores in valuation. Our next round is focused on a roll-up play, more strategic acquisition, acquiring physical aspects of businesses and merging them with our digital umbrella and making a phygital play. So by the time we go public, I expect us to have a 2.5 to 4x jump for investors coming in this round.
Well, that was Vivek Oberoi on his investment strategy. With that, it's a wrap on this edition of Startup Street. For more news and updates, stay tuned to CNBC TV18.
Hello and welcome to the Global Dialogue. I'm Shireen Pan, and joining me now to talk about the state of the world, but more importantly, how India plays a part in what's happening globally, is the Global CEO of Deutsche Bank, Christian Sewing. Christian, many thanks for joining us here on CNBC TV18. Appreciate your time. Before I talk to you about what's happening in the rest of the world, let's talk about why you're here in India and how India is playing itself out in this era of volatility. You've just met with India's Commerce Minister Piyush Goyal. What's the read on India at this point in time?
Well, first of all, thank you very much for having me. It's a pleasure being here. It's a pleasure being in this country. To be honest, it is. That meeting was very positive, but the overall spirit in this country is outright positive. I've been here now for 3 days, and I have to say I'm amazed by the steam, by the drive, by the passion, you know, it's an economy which is obviously outright growing. It's actually with whomever you talk, the story is growth. And it is also coming, obviously, from Germany, being one of the leading European banks, looking at our clients. Our clients are actually looking to India out of the lens of this is an opportunity. A lot of global clients, a lot of multinationals, but also family-owned companies are in the process of reorganizing their supply chains, their production chains, and India is always top on the list. And that is, from a Deutsche Bank point of view, a huge opportunity for us. We have been here for 45 years. We have 23,000 people. We are growing immensely. We just put $800 million of capital into India. So we want to grow and our clients want to grow. So it's it's a very positive story. So I'm excited.
Well, let me build on that excitement that you just gave us a snapshot into. When you talk to your clients and you say that they're looking at opportunities in India, what are the opportunities specifically that they've been able to identify and that they want to zero in on?
The nice thing is it varies. Look, first of all, it's a market with 1.4 billion people. Number two, it's a market with such young demographic. You can see in which direction it goes. So simply from a market's point of view, it's an opportunity, in particular for a lot of European and German export-oriented companies. And there is lots to grow in this regard. Number two, the skill set which India is offering for all kind of industries is superior to a lot of other countries. And let me argue it from a financial point of view, financial services point of view. We have overall 90,000 people in Deutsche Bank, 23,000 are in India. Now, approximately 19,000 people are actually in our innovation, risk management, finance, operations teams. They are, so to say, the backbone of Deutsche Bank as a group. And the technology, innovation, and skills we get are core for the overall bank. And therefore, a lot of other corporates are also looking at India not only as a huge market, but also as a source of innovation, technology. And hence, it's actually your strength that it's very much broad-based. And therefore, I'm very positive on the development.
It's interesting that you brought up, the talent aspect. And I think the Global Capability Center story is a story that's firing on all cylinders at this point in time. But the point that you made about almost outsourcing risk management to India, and I think that's not something that is often appreciated or even reflected upon enough, and that's going well for you.
Well, look, risk management is obviously core to a bank, and most of you know that my career started in risk management. I was actually one of the people in Deutsche Bank who set up the rating center here in Mumbai, actually 20 years ago, over 20 years ago. But we are not fully outsourcing. I think most important also for a bank is that we are diversified, that we are well distributed. But one of the very critical analyses is coming out of India. Based on that, decisions are taken. But with the development we see here, more and more tasks can actually done here and automated here. So the quality of work is superb, but of course, we will make sure that we are not, so to say, creating a dependency which would be an own risk for Deutsche Bank. And therefore, we keep the balance, but clearly, India has grown significantly in terms of its strengths.
Back to one of the opportunities that you spoke of, when you talk to your clients, are they looking at making strategic investments in India? Are they looking at M&A? Are they looking at joint ventures? How exactly do they want to address the Indian market? What are the routes that they're looking at this point in time? How do you help them?
Well, again, it's not the one and only goal. Yes, there is, I think, over the next 3 to 5 years, there is big M&A activity. By the way, not only from Germany into India, but also from Indian companies into Europe. Because also India wants to diversify. India wants to grow in the international market. I'm really hoping that we hopefully get a free trade agreement with the European Union very soon. I think it shows the bilateral strengths which we can play between the European Union and India. So there is on both sides there will be M&A activity. Now on the other hand, if you think about Europe, if you think about our challenges but also opportunities, we need to read the Draghi report. The Draghi report is talking about 800 billion of investments which we need to be done in Europe in order to be competitive in terms of technology, defense, other infrastructure investments, sustainability. Now, when it comes to technology, we need the know-how and the technology which is coming out of India. So I can think about actually the joint ventures of Indian companies with German companies. Then again, the other way around is that German corporates are actually trying to diversify. They are looking for additional markets. India is a market. So it always depends. But the nice thing is that it plays, in my view, to the strengths of both countries or both continents, so to say EU and India or Germany and India. And therefore, I'm returning to Germany and also discussions with the government at home and saying, this is the market we should focus even more on.
Well, that would be music to the ears of the Indian government if you take back that message. But, on the India-EU FTA, it's been in the making for over a decade now. The hope is that it finally gets done. Do you believe that it's a closure is likely in calendar year 2025, or at least in this financial year? And more importantly, as you look at, we're waiting for the contours to play themselves out, but as you look at this trade deal, do you believe that it's going to ensure that we actually see a shift of manufacturing to India? Or do you believe unutilized capacity in Europe will actually be utilized to its fullest as duties come down and people can actually import to India?
I think to the latter question, both. To the first question, I'm not close enough to give you a deadline, but I can tell you indirectly that over the last 3 to 6 months, I have seen a mind shift and a mindset change in Europe and in particular in Germany when it comes to growth and competitiveness and what we need to do in order to stimulate growth. And this has something to do with our new government, which is clearly focused on competitiveness and growth. But I can also see that the EU is actually very much focused on, for instance, finalizing the FTA. Now, whether it takes 3 months, 6 months, I don't know. But the passion and the spirit, I think, on both sides to get together and to get something done is there. And that is different than from what personally I have felt in the previous year. And that is always the precondition that good things are happening. And in this regard, I also do think that the most recent visit by the EU Commission and also Ursula von der Leyen to India was well received. The feedback is very positive, and it's in my humble view, it's on the political side like on the corporate side. If the leadership is pushing for something, if the leadership really wants something, then usually things are going, and then things are also sometimes going quicker than we think. So I'm optimistic.
Well, we hope that optimism translates into an actual deal being inked. But, you talked about defense spending, and I think I want to bring up the fact that we've actually now seen this commitment being made at the NATO summit of Europe committing to 5% of spending on defense over the next few years. As this remilitarization of Europe takes place, do you believe that this is going to aid growth, or do you believe it may distract from other fiscal measures that may be required, in your words, the Draghi measures that you talked about, to kind of spur growth?
I think it will actually aid growth. It will not put the focus away from other items. And again, I best can talk obviously about my home country. And I find it overall very positive what has been decided. There's on the one hand the additional spending on defense, which is bitterly necessary in order to be capable. But at the same time, the country has established a 500 billion infrastructure fund. So you can see that actually the government has seen both as needed. Now, public spending is not the one and only answer. We need to be careful about that. But what I like about is that next to the public spending, and that was always my comment, the public spending is okay because Germany can afford it where debt to GDP is. But the public spending is only coming to, so to say, a full success if we get structural reforms in Germany, which is driving at the end of the day investments, which makes sure that private money is coming in. Because even the 500 billion is not enough actually at the end of the day to stimulate growth in Europe for good. And therefore we need the private investments that need structural reforms. And I do think that this two together and the actions we can see in Germany in particular, and Germany is usually the engine for Europe, will help that on the defense side, it will add growth and obviously also for other items. Now, last point, I think we need to learn from other countries. If you look at the US, for instance, a lot of people always said, well, defense spending of, I don't know, in the past 3.5%, 4%. Yeah. Well, if you really go into the details, the defense spending actually fired the technology spending. And a lot of technology, a lot of innovation came out of the defense spending. I'm always leaning to a statement that is that part of Silicon Valley is actually a result of defense spending. And if we do it right in Europe and in Germany, and we use the defense spending not only, so to say, for tanks, but also for innovation and technology, we can actually create growth which is far beyond the initial defense spending. And that is driving the economy. And I do think this is more and more what people think. So also there, we have an opportunity.
Yes, it's unusual in a conversation these days that we go for about 10 minutes and not talk about the US. And finally, we are talking about the US. So let's address what's happening in America at this point in time. And let me ask you that in the context of the 3 Rs: rates, the possibility of a recession, and key risks associated with the Trump tariffs. What's the pulse on each of those?
Well, let me start a little bit different. I first of all think that you should never underestimate the resilience of the U.S. economy. The investments and the flexibility of that economy, the innovation part, is something which really brings resilience in its own. And therefore, look, at the end of the day, one cannot exclude a recession, but the US has always shown that it is more resilient than forecasts have been. And therefore, I think there is a good chance that there is no recession in the US. One cannot exclude it. But the underlying data from the US remains pretty strong. On the rate side, look, I do believe that the Fed has a clear picture. They're very much data-driven. We as Deutsche Bank do believe that there is actually at least one decrease in interest rates this year, potentially more next year. But obviously, inflation needs to be watched. And therefore, I, at the end of the day, do think, yes, a gradual reduction, but not something over the summer, rather to the end of the year, in order to keep inflation under control. And my personal view is that is actually also quite right, because at the end of the day, inflation is the biggest poison for an economy. I talked about rates and recession risks, which look. There is a risk, obviously, not only of a recession. There is a risk that the volatility of decisions can have a more global impact. There is a risk, obviously, of further global geopolitical tensions. But there is clearly the risk, if the tariff discussion is escalating, that then we have a global downturn, and we notice it not only in the US, but also in other countries. And therefore, I think the biggest mitigation and the best mitigation is that we come to conclusion on the tariff agreements. And to be honest, one needs to actually see it from both sides, because also Europe actually, I think, did it well that it didn't escalate it in April, because there are also certain items where Europe, in my view, needs to step up and do things differently. If this is getting done in a, so to say, calm way, I do believe that we can avoid a recession. And then I also do believe that we will see rates coming down. And therefore, the months of July and August is quite important, actually.
You've been a banker for over 30 years now, and you've dealt with volatility. And many conversations that I've had over the past few weeks, people say that it's different this time around. What do you believe is different? When you look at how volatile things are, and what's also been surprising is the remarkable resilience of the global stock markets. I mean, unfazed by geopolitical strife, unfazed by actual military conflict. So how do you explain the resilience of the markets as well?
Well, I think, first of all, that the resilience is partially explained by a much better preparation of the players in the market. Simply look at the financial institutions. If you think about how financial institutions, the robustness of financial institutions, be it in the US or in Europe, If you compare it between the last global financial crisis and now, it's night and day. To be honest, I think we are as robust and as rock solid as we have never been before. And that's not only for Deutsche Bank, that's also for other banks. And therefore, the market has a different level of trust that even if there is volatility, we can absorb it, be it from a liquidity point of view, be it from a capital point of view. The same, I can tell you from a lot of corporates. If I look at the equity ratio of German Mittelstand clients, it is nowadays higher than 15 years ago. Corporates actually improve their own balance sheet in terms of liquidity, in terms of capital ratio, in terms of corporates learned through the COVID crisis to work on their supply chains, to make sure that they are more diversified. And therefore, I do believe one needs to take that into account, that we simply have, in my view, more robust players in the market. Now, I think you are touching on a really important point, that I'm also amazed that the markets are so solid. We see some, volatility in the markets, but then you are at all-time highs back very soon. And look, with a 35-year background in banking and very long in credit risk, I hope that people are nevertheless always prepared that there could be the one or the other event which really brings the market more severely down. And therefore, for that, you need to be daily prepared. And that is, in my view, the task, obviously, of a management of a bank to do that for your own balance sheet. But more importantly, that we advise our clients on risk management. And in this regard, I can really see a renaissance in advisory. The level of discussions we have with our clients on risk management, on hedging their risks, is not comparable to the years before. And it's an opportunity for banks who have that know-how and who have an investment banking capability.
You know, it's a very important point that you made there about just healthy balance sheets, whether it's for banks or it's for companies. And we've seen that happen in India as well. The deleveraging has happened significantly after the GFC. But what does that mean in terms of the appetite for risks? Because the problem that we're faced with in India is that even though companies are sitting on strong balance sheets, private investment hasn't picked up. So when you look at European companies who are sitting on strong balance sheets, at this point in time, do they have the appetite to take big risks, whether it's M&A or it's expansion or it's looking at new markets?
I would say that over the last 3 or 4 months, that appetite reduced because if there is too much volatility in the market, and it's not only the so to say the market volatility, but if the trust in so to say the planability of issues is decreasing, then companies are stepping back. Yeah. And we have said that also in our business and in the overall bank's investment banking business on the origination and advisory side. Fortunately, we haven't seen canceled deals, but we have seen delayed deals. So people are a little bit more nervous and cautious to do big investments. Nevertheless, they also see the opportunity, and they see actually the opportunity Europe has in these days. They see the opportunities in growth markets like India, in other Asian markets. We can see trade corridors between India and other Asian countries, the Middle East, which are really opening up. So people are looking into this. And I think that we may see for a couple of months, once this trade discussion is hopefully done and dusted and people have a better outlook view, I would say that then those investments are coming back. In general, from the balance sheets of the banks, but also the capability of the corporates, the risk appetite to invest long-term into growth is definitely there.
It's definitely there. So 2025, from an M&A point of view, from an IPO point of view, what are you foreseeing? I mean, India's had a great year the previous year and continues to see a lot of excitement in the IPO market, but the US was tepid. What do you see as the story for global IPOs as well as M&A for 2025?
I think it's a bit muted, to be honest, and that's what I also said at the last conference when I was talking about Deutsche Bank in this regard. Very happy about the overall development, but that particular business a bit more muted. But to be honest, as long as you know that it's only delayed deals, that people want to have clarification, for instance, on the trade discussion, that's not a big issue. We are planning this bank and also our corporate clients, they are planning for the long term. And whether it happens then in Q2 or Q3, at the end of the day, that doesn't matter. But clearly, I would say 2025, if I compare it now with that what we thought at the start of the year in the M&A and IPO market, more muted. But I wouldn't say that this means that the whole market falls away. It will come back then next year.
Oh, so let's talk about what's happening at Deutsche Bank specifically. You had a strong Q1 ahead of estimates. You're hoping to grow at between 5.5% to 6.5% annually over the next few years. What are you going to prioritize given the many opportunities that you see and the strong balance sheet that you sit on? And also in the context of the many tech changes that are happening, how do you reposition or rewire yourself at the bank?
That's a lot of questions, but you're right. I'm overall very happy with the development. It was a complex time 6 or 7 years ago, and now we are on a clear trajectory. And you know the opportunities which are presented for Europe, but also globally, because the answer of a lot of clients is that they would like to have at least one European alternative to the US banks. And as we are one of the last investment banks, corporate banks with such network, we are that opportunity is huge for us. So I'm generally very, very positive. Now, from the investments, it's focus, focus, focus. You can imagine that everybody in the bank wants to invest, and we need to take the decisions as where actually we do this. I do believe that one thing is clear, the global expansion of this bank, in particular in markets like Asia Pacific, is on top of the agenda. And we can see that also the brand name is really wanted here. That's one of the reasons why we invested so much in India. On the tech side, look, I think it is simply critical and fundamental and the precondition for being a successful bank for 3 reasons. Number one, you need to have tech for client experience. The client experience will be better with digitalization, AI, and technology. Number 2, cost efficiency. Number 3, very important for all of us and for us obviously too, is regulatory compliance. The more automated our processes are, the better it is. So technology is kind of, if we build the house of Deutsche Bank, technology is the platform.
You know, AI, and everybody's talking about the disruptive impact of AI across different sectors. From a bank's point of view, how much of AI are you already using? And what could a bank potentially look like 5 years down the line because of AI?
Well, first of all, the answer is that a bank remains a bank. I don't think that a bank will turn into just a technology company. People want to have our advice. People, the most important as a banker is that you have the trust of your clients.
But will bankers be replaced by AI agents?
Well, I would say that the coverage person and the people who are talking to our clients in the majority will remain human beings because that's what is wanted. But the way we get to decisions, the way we are handling the request, the way we are handling transactions, front to back processes will more and more automated, and AI can help a lot. Research, analysis can be done a lot with AI. Now, we need to have, obviously, for that, the most important is everybody's always talking about AI, and obviously, I love it. I saw, again, certain cases here and projects which are done in India for the world of Deutsche Bank. Super exciting. But the most important is that your data is clean and that you have good data. And therefore, I'm always saying, let's get everything right before we talk then about the luxury, and the luxury is then the application of AI. But to give you some examples, we are using AI in the retail banking when it comes to client servicing. We are using AI in the research area with great results. Completely different. I was just talking to our audit head. She's using AI in order to get to quicker and better audit reports. So it's across the bank. The most difficult task for us and the management board is to do the right prioritization.
So let me end then by asking you, since you will soon be leaving India, I'm going to ask you about the message that you leave your Indian team with. What's the target that you've set for Kaushik and team here in India, given the fact that you've made a pretty big investment bet on them?
Well, first of all, I said it yesterday when I left Mumbai, where obviously the majority of my time was, and a good part of our team is. I thank them because I think they've done fantastic work. I haven't been there for the last 2 years, which was a pity, and I will come back sooner. But they have done great work, and I'm really proud. Number two is that I think everybody should realize what opportunity we have, and we have our growth plans. But if I really go through my head again over the last 3 days, I think the team around Kaushik, they can even achieve higher results because the opportunity in this country is great, and it's nice to see that the brand name Deutsche Bank resonates so well. So actually, it is a success story which can even become a bigger success.
Well, we wish you the very best of luck with your plans for India, as well as the conversations that you're having with your clients. And of course, look forward to speaking with you as and when the India-EU FTA does finally get done. Christian, it's been an absolute pleasure. Appreciate your time here with us in the capital.
Thank you very much.
Well, with that, it is time for us to wrap up this edition of the Global Dialogue from all of us here on the team. For now, goodbye. Many thanks for watching. Hello and welcome to the Global Dialogue. I'm Shireen Pan, and joining me now to talk about the state of the world, but more importantly, how India plays a part in what's happening globally, is the Global CEO of Deutsche Bank, Christian Sewing. Christian, many thanks for joining us here on CNBC-TV18. Appreciate your time. Before I talk to you about what's happening in the rest of the world, let's talk about why you're here in India and how India is playing itself out in this era of volatility. You've just met with India's Commerce Minister Piyush Goyal. What's the read on India at this point in time?
Well, first of all, thank you very much for having me. It's a pleasure being here. It's a pleasure being in this country. To be honest, it